This is the first time that AI has reached an inflection point such that this AI capability is so easy to use. Almost anybody can program it. You can program it to develop all kinds of interesting applications, and it's so accessible. And so when you think about a new computing platform, whether it's the PC, the internet, the mobile cloud revolution, every generation, the number of applications, the number of programmers, and the reach of that platform increased. And this is absolutely the case. You could see this with ChatGPT, the AI heard around the world. In just a couple of months, it reached 100 million users. And the number of startups, the number of applications that you're now starting to see on generative AI is just growing extraordinarily. So this is definitely the beginning of a new computing platform.
Jensen, I want to ask you about the generative AI aspect. We saw a lot of that kind of in your keynote, the talking about generative AI. And Nvidia made some announcements, partnerships with Adobe, for instance. Where does generative AI, though, fit into your broader portfolio when it comes to AI?
Well, first of all, we're a full stack computing platform. We start out with the AI infrastructure, and this GTC, we announced a massive deployment of Hopper generation. AI supercomputers are being deployed all over the world. But very importantly, this is also the first generation where AI is moving out of the laboratories, out of research, and into industrial operations. And so instead of just a supercomputer for training, this is going to be now an AI factory for every industry and company to produce intelligence. Whereas companies in the past would build, factories for all kinds of different products and different things. In the future, there will be factories that are created for every company so that they can produce intelligence. And so this is really an extension, a major extension of how AI is going to be used. Generative AI is behind that. The second thing that we do is, of course, the operating system and the software stack layer of AI. We have two platforms for that. One is called NVIDIA AI. The other one's called NVIDIA Omniverse. One, NVIDIA AI is where intelligence is created. Omniverse is where intelligence simulated and tested. One is a virtual intelligence. The other one's virtual world. And these two platforms we have now put into the cloud. And so in doing so, we're partnering with the world CSPs to take the best of NVIDIA, the NVIDIA AI DGX supercomputer, the two NVIDIA platforms, NVIDIA AI and NVIDIA Omniverse, and we're now making it available as cloud services, all hosted inside the world's leading CSPs. And so in partnership with the CSPs, we're going to combine the best of NVIDIA and the best of the leading CSPs, and we're going to bring AI to the world as quickly as possible.
And Jensen, you're good at sort of laying out this grand vision, right, for those cloud service providers, for those clients. We're looking at some cool pictures, too, of how this is all going into play. You talked to us a lot last year at this time about the Omniverse. So I have two questions for you. First of all, to sort of make it concrete for those of us who are not steeped in this stuff all the time, what are some examples of this being put into practice? And how is your Omniverse different now than it was last year? Is it that being put into the cloud aspect?
Well, so far, Omniverse has only been an on-prem enterprise solution. And the fact of the matter is, this stack, this supercomputing stack, artificial intelligence stack, is really complicated. And the answer is to put that up in the cloud for us to fully manage it, host it, manage it. We host it from Azure and benefit from all of the security and all the industrial certification, all the storage capability, and all of their enterprise APIs, and all of their productivity APIs. And they've also done a lot of work with industrial metaverse. And so all of that work is now going to be tied into Omniverse, and we can take this to the world. What Omniverse is to help companies that build physical things to do everything digitally first. And so whether you're building cars or making, devices or phones or, building plants or factories, logistics warehouse, or designing large buildings, or even designing cities. Today, you have to do things kind of on paper, and then you try it in the physical world. And as you're building it and you make mistakes, you do change orders. All of that doesn't have to happen. You should be able to do that completely in digital And when you do it in digital, all of the organizations around your company, and these, the car industry has 14 million employees, and it takes all of those employees working together to build a car and manufacture it around the world. And so now these 14 million employees could have a digital platform that connects digital and physical, and for them to be able to design the cars, design the factories, all in Omniverse, use generative AI to test it, to help populate it, to optimize it. And then before they do that, they virtually assemble it before they break ground and build a factory in reality. In doing so, the number of change orders will reduce, the time to market will reduce, any plant opening delays would reduce. For an industry as large as the auto industry, which is $3 trillion large, all of this is going to translate to hundreds of billions of dollars of savings. So this is a very, very big deal that we can help the physical industry of the world become digital for the very first time.
Jensen, I want to ask real quick about AI and the cost of it. We've heard stories about how OpenAI, they're basically subsidizing ChatGPT at this point. When it comes to generative AI and these kinds of services, obviously NVIDIA's chips are very important. I guess how does that, is the company able to help clients at all as far as pricing goes? Is there a means for lowering the power cost? How does that kind of square?
Yeah, first of all, artificial intelligence is a two-computer system. The first computer is the training system, and this is what's sitting behind me. This is the Hopper DGX GPU. This is literally one GPU. It's got 8 different chips connected chip to chip using a really high-speed interconnect. And what the computer sees, what the programmer sees, is one giant GPU, the largest single chip, if you will, the world's ever made. Now, this computer trains the model. It develops the model. This computer works with software programmers to create the software, create the AI. Once the AI is developed, it is then run on a second computer. And the second computer could be as small as this. This is what's deployed at Google GCP. And this will run generative models for imaging, generative models for video, generative models for languages. Of course, there's a limit to how big models can be in this GPU. And we could create even a larger version of the GPU for inference. And that version is, for example, this one. And this is designed for large language model inference. And so all the way from this little tiny guy, which is called L4, which could be deployed all over the clouds, to this version, which is designed for large language models. And they run programs that are created by this computer behind me. And so inference has large range of scales, just like applications have all different sizes and shapes. Some of them require larger computers, some of them require smaller computers. And so that's number one, is we announced a whole family of generative AI platforms that range from L4s to L40s to H100s to our next generation Grace Hopper that allows us to inference in a broad range of applications, all one architecture, all software compatible for different sizes and different performance levels. Then the next thing that we have to do, and just by the way, this Hopper H100 MVL, in just one generation, we reduced the cost of large language model inference like ChatGPT by a factor of 10, 12 times in just 2 years. And so we're going to continue to do that. The combination of new architectures, new configurations, and new software technology, we should be able to do the same for AI in the coming years that we've done for the last 10 years, which is we reduced or we enabled the capability of AI to grow by about 1 million times. That 1 million times of performance wasn't followed by an increase of 1 million times in cost. And so we should be able to do the same thing over the next 10 years and drive down the cost of inference tremendously.
One of the interesting things that you guys have been doing as you've been building out AI, but not just that, is you're not just a chip maker at this point, right? I think people think of you as primarily NVIDIA is a chip maker, but you've got more software and services now that you're adding on. What sort of led to that decision, and how do you foresee that balance going forward? In other words, should we think of NVIDIA as a chip maker anymore?
Well, first of all, the services part of the software part of our business is going to increase over time. However, the systems part of our business, or the chip part of our hardware part of our business, will continue to be very large. The way that NVIDIA does things, accelerated computing is a full stack problem, which means you have to design an original chip, an original system software, brand new algorithms. And one of the algorithms that I mentioned during the GTC this time, of course, we talked a lot about generative AI, but one of the really important ones was computational lithography for chip making. So that's an example of a very important library that we created. Another one would be data processing, we call RAPIDS. Another one would be quantum computing, we call cuQuantum. There's a whole bunch of libraries that we created. There's some 300 libraries or so that are for use for different domains. The way that if you're a software company and you're creating a whole full stack, you have to start from building the system itself. And so the way that NVIDIA builds things, we build the entire data center, from the chips to the systems to the software to the networking, the switches, the computing fabric, all of the algorithms on top, and we bring it all up and we make it all work and we optimize it. And then the second thing that we do, and this is the part that's really magical, we disaggregate, we break everything down again, and we integrate all of our components, whether it's this size or this size or this size back here, we integrate it into the world's computing fabric through our OEM partners, our system integrators, our cloud service provider partners, and we integrate them into their computing system. And so as a result, NVIDIA is really an extension of everyone's computing system. And so Dell has an NVIDIA extension, HPE has NVIDIA extension, AWS, Azure, GCP, OCI, they all have NVIDIA extensions. And as a result, we have this giant footprint of one architecture that's called the NVIDIA architecture that every researcher, every developer, every startup, every company could take advantage of because it comes from literally everywhere. And so it seems like we're a chip company, but we've always been a full stack systems company. And now as we move further and further up the stack, and we build those stacks because the world needs us to do it, if it's available anywhere else, we wouldn't do it. But NVIDIA AI and NVIDIA Omniverse are so unique that we really ought to put that into the world's multi-cloud, any cloud, and allow you to be able to run those stacks everywhere.
So Jensen, as you talk about this increased suite, I mean, the broader technology industry, as we know, this is sort of the year of efficiency, not just for Meta, but that seems to be the mantra for a lot of large tech companies right now. How's that affecting your business, even though they might be longer term, very pro AI, very interested in it? Are you seeing sort of delays in decision making right now, for example, because of the environment?
We are seeing an acceleration of demand. We're seeing an acceleration of demand for our DGX AI supercomputers. We're seeing an acceleration of demand for inference because of generative AI. In fact, was the major theme of GTC is really that accelerated computing and AI have arrived, and both of them must be activated as quickly as possible to drive lower cost. I showed several examples where accelerated computing applied to computational lithography, computer-aided engineering, data processing, to even combinatorial optimizations for route planning could be improved dramatically in speed, but also reducing power by order of magnitude, reducing cost by an order of magnitude. The world is really challenged in not just the fact that we all have to save money and be more efficient, but in the world's data centers, we're power limited. And so in order for us to continue to increase performance while continuing to be sustainable, we must, number one, accelerate every single workload. Number two, reclaim that power. So if we used to spend 35 megawatts of power, let's reduce it down to 5 by accelerating the workload, as I demonstrated at GTC. Then use the 30 megawatts to now go back and invest that reclaimed power back into growth. So job one is now to accelerate computation, accelerate everything we can, reclaim the power, reinvest that into growth. Now, artificial intelligence has the incredible capability of predicting the outcome without doing the brute force computation. Brute force computation takes a lot of energy. And so the work that we're doing, for example, in Earth 2 to predict the weather and predict the climate, we're able to now predict weather nearly as accurately as first principle analysis and simulations, but do it 10,000 times more efficiently. And so instead of using a ton of power in supercomputing centers that does all the computation, we should accelerate it. We should use artificial intelligence to make the predictions, and as a result, reduce power, reduce time, reduce cost.
And so, Jensen, even though you're talking about reducing costs in this particular area, I mean, Nvidia is not now just an AI company, right? It still does other stuff. It still does gaming. It still does auto. Still does data center. To your point, that's not necessarily AI powered at this stage. And so, if demand is increasing for this area, how is that balancing with what you're seeing in demand for some of your other products in those other areas? And also, what's the proportion of your sales right now that are in these AI products, and how do you see that the trajectory of that through the end of the year? Sorry, a lot of questions
answering
there.
Backwards, I would say that that was a lot of questions. Data centers largely driven by artificial intelligence and accelerated computing is already our largest business. I expect it to remain our largest business through the year. And this is an area that we're seeing accelerated growth in demand in both training as well as inference. The gaming market had a very challenging year last year, and we see it returning. And we're doing very well with Ada. Ada is the world's generation of it's based on a technology called neurographics, which basically says instead of computing every single pixel, we render one pixel and we guess the other 8 or 16. This is just an amazing thing. We're using artificial intelligence, one large computer in our data center, and we save power for hundreds of millions of gamers. And so this way of doing computer graphics is really essential in the future. We've demonstrated incredible visual quality improvement, incredible performance, and simultaneously reduction in power. And so we're going to apply artificial intelligence to gaming. We're applying artificial intelligence, of course, to autonomous vehicles. AV and all of our auto business has nearly doubled. I think it's about more than doubled year over year. We expect next year to be another very big year. And so this year to be a big year, next year to be a big year. We're ramping into autonomous vehicles. We're ramping into electric vehicles. And very importantly, we're ramping into a whole generation of cars where the car makers realize now that they're really software programmable cars. And what they need to do is to build an install base, a very large fleet of install base, because that install base will be on the road for 15 years, that they can benefit from new software offerings and new applications that they can deliver to their customers and monetize that relationship for 10, 15 years. And so people now start to realize that NVIDIA is really the great choice, the best choice for those software programmable AV electric vehicles.
Jensen, I just have one last question for you, and it's just about interest rates. You know, we saw Jay Powell talking about raising rates again. How is that impacting some of your customers? Are you seeing them, we're obviously talking about pullback, not pulling back as far as AI goes, but how else are you seeing that impact the business?
Well, this is a time when we all have to do more with less. And not one company wants to do less. Everybody wants to do more, but they have to find a way to do it with less. Accelerated computing is really the best path forward to do so. The ability to roll up your sleeves and refactor your software, deploy it, that exact same software that's now refactored, and we have all the skills and the capabilities to help them do that. Once you refactor the software, you could save extraordinary amounts of money. The $1 trillion, what is it, about half a billion dollar spend of cloud computing these days, the vast majority of it is in data processing. All of that should be accelerated, and we can help companies do that, accelerate that, reduce the spend, even improve their performance, and very importantly, reduce the carbon footprint, reduce the power dissipated in order to do that job. And so across the world, accelerated computing is really the best way to do more with less.
First of all, batteries are the constraint here. It won't be the manufacturing site behind me. And the lithium-ion batteries that we use, both lithium and nickel are really the key constraining commodities. We normally get those from all over the world, from South America to Africa to Indonesia and Southeast Asia. We want to localize that here in North America, not just the mining, but the processing the materials. Actually, even if they're mined, let's say in the US, nickel, most of it is sent back to China to get processed. So the big change is going to be to onshore all that capability of processing, but also mining back here in the US. It'll be a huge job, just like it has been for semiconductors. Yeah, we're going to build, I mean, we build about 5 million vehicles around the world at Ford. We're going to build an extra 2 million with our EV business. That's why we call Model E a startup, because we're going to grow the company's revenue by 30 or 40%. And we're already number 2 in EV in the US. Most of the customers are new to us. So this is a growth business. We have to get these materials from around the world until we localize the supply chain, which is what we want to do. By the end of this year, we'll secure all the raw materials to make the 2 million batteries by 2026 that we're going to need to go in our vehicles. So we should be in good shape here. A lot of other companies are going to have to hustle to get that, but we're in good shape because we've been working on it for a couple of years now.
We'll talk more about the EV outlook in a second, Jim, but talk to us about the new truck that you teased, the T3. Is this some form of autonomous super truck? What is it and when does it launch?
It launches in about 30 months. So just over 2 years. We haven't shown anyone the truck yet because we don't want to give an advantage to our competition. But it is a built for tough, real work vehicle. But it'll have technology no one's ever seen in any of these electric trucks. We're the best-selling electric truck now with the Lightning. This will be a lot better. It'll be fully software updatable. So every part we can ship software to the car over the air. Your trucks are going to get better every time you get in it and move every morning. In fact, we think we're going to be able to land a semi-autonomous system, so you'll be able to go to your sleep in your truck while you're traveling on the highway. And it would be, I think, maybe one of the first vehicles you can do that safely in the U.S. And we think that kind of advantage is a big deal for truck customers. A lot of them work. They use their vehicle as an office, and to be able to do more work, bid out more jobs inside their truck while they're commuting to the work site is fantastic.
Jim, I'm a car guy. You and I have talked about this before. You're a car guy. How are you going to drive in a truck? So the truck is going to drive by itself and you could fall asleep in it.
Yeah, I mean, you're a car guy. On a sunny day on a highway, we have the technology. We're just finalizing it now. We took 600 engineers out of Argo, and they've been working on a autonomous feature that while you're on the highway on a sunny day, which is a lot of miles for Americans, you'll be able to, drive. We have the most successful hands-free system now. We just now need to make it even more reliable so you can take your eyes off the road, not just your hands off the steering wheel. And that technology is right around the corner, and you'll be able to do that in this kind of truck. That's why we're making it completely software enabled. We're doing the whole electrical architecture and all the software we're bringing back in-house at Ford.
We've also talked in the past about your focus on making the automobile subscription oriented. In this truck, will I have to pay for heated seats? What will I have to pay for every single month?
No, we're not going to charge a subscription for heated seats, but for productivity, it actually turns out we kind of know what the first 3 shippable software to the car is. Kind of like when we all first got our smartphones in 09 and 10 with music or email, and it is productivity. So we can now do telematics, predictive failure, driving coaching, even predictive failure of components on the truck. That's one thing, productivity. The second thing is partial autonomy. So that could be, hands off like we offer today, even eyes off in the future. And the third one's going to be safety and security. Like think of your Ring or your Nest at home. We're going to be able to record video. If someone takes something to the back of the bed of the truck, or someone takes your vehicle, we'll be able to have the video content and send alerts when you go over the speed limit, whatever it is. Those are the 3 softwares that we'll be able to ship to this kind of vehicle.
All right, good to know. The price of a warm butt is included in this truck. That is always good to hear. I just wanted to get that word out there. Now, Jim, you had a teach-in event. The CFO and your team down at the New York Stock Exchange. really went into great detail on new reporting structures for the business. Now, we talked to your CFO, John Lawler.
Yes.
And he broke down the longer-term operating margin for that EV business at 8%. Now, I got a question. Well, Tesla's at double digits. Why is that the case?
Well, Tesla hasn't had any competition until Ford and others came along. Now their prices are down like $7,000 in 1 year. So there's going to be more price competition, in that market. And we're counting on that. When we say 8%, it won't be at the prices we see today. And what we have to do is we have to design the truck differently. We have to scale with a plant like Blue Oval City here in Tennessee. We're going to have a more efficient distribution with no inventory, online, configuration. You can buy the vehicle and configure it online. And then we need to have a different manufacturing process with less labor content in the vehicle. When we do all those things, we'll make an 8% margin. If it was today, we'd make more than 8% because there's not as much pricing competition as I know there will be.
What are you seeing in the market right now for EVs? So all of your EVs have gotten really, really high marks, but you have a Tesla out there now cutting prices. What has been your response? What are you seeing in the marketplace?
Yeah, it's an interesting dynamic. The market is actually changing more than we expected, but that's a good thing. First of all, we have really no competition for Lightning and E-Transit. Both are best van and truck in their segment, electric, and we haven't cut or adjusted prices at all. On the Mach-E, the Mustang Mach-E that competes with the Model Y, our sales continue to go up. We've had to adjust the prices down, but we also have a new affordable battery coming for the Mustang Mach-E, and we're now doubling production, and that's starting to hit our showrooms now. So the demand is really strong for us. It is not the case for everyone, though. A lot of other EVs aren't selling. So I think, like always, it comes down to the best product wins. And I'm sure glad we're playing to our strengths. Mach-E is a Mustang. Transit, Transit's a van, and we do really well. And people love Ford trucks. So we're just playing to our strengths. We think that's the right move.
And Jim, you have an amazing look into the EV industry. Not only are you the CEO of Ford, but you're also on that Harley-Davidson board of directors, a company I know very well, and they have also pivoted to electric vehicles and electrification. How difficult is it to make that pivot to EVs with these legacy companies? Can you bring us inside these boardrooms a bit?
It's a really interesting question. And I would say that the common thread between Harley and Ford, these iconic companies that are changing, first, you got to play to your strengths. If you're going to go into a new market like electric vehicles or motorcycles, you got to play to your strength. You got to go after segments, even if they're new customers, for things that you know really well. Like our, Lightning will power your house for 3 days. It's got a huge trunk. Those are things that the challenger brands didn't really know about because they don't know the customers. The other thing is you got to organize differently. You need focus. These are new businesses. You can't use your prejudice of the past. I could give you 1,000 examples, like our wiring harness on the Mach-E. It's 1.6 kilometers longer than it needs to be because we used our internal combustion engine engineering standards for that wiring harness. But in electric, all that math changes with that heavy battery. So you need to set up a separate business with more focus. That's what Livewire is doing. That's what we're doing Model E. And I think that's the only way to reinvent the company like we're doing. You have to approach it as a startup.
I think this is a chance for investors to go deep on our strategy. The main message is that Ford has been, and like a lot of OEMs, been stuck in a valuation box with a lot of capital, low margins, fighting for slivers of market share. And what this Investor Day is about is explaining how that's changed. Now we will not be as susceptible to economic downturns because we have attach rates for physical services and software we've never had before, and we can grow to nearly 6 million vehicles. We have never grown like this since the 20s. So it's a chance to grow and to not be as susceptible to downturns.
I know you said it's a new Ford in some sense
yes.
for the company as well. We're talking about something like about an 8% EBIT margin for EVs by 2026. I think some in Wall Street applaud that, but also are kind of skeptical and concerned.
Yeah.
Can you hit that? What do you want to tell them, the skeptics out there?
Well, I think you should realize that everyone's product strategy is not a monolith. We have a very unique strategy compared to our competitors. We're going after larger vehicles where we know the customers really well. 3-row crossovers with a lot of room in the rear seat, a personal bullet train, a second generation Lightning, a truck that is completely different than anyone's ever seen before. Both are completely software updatable. Every part of that vehicle can be remotely changed with software. And so we don't see as much competition than maybe others will do with 2-row crossovers because we're playing to our strengths. These are customers we know really well, and we're going to design features like Pro Power on Board to power your house for 3 days, or Mega Frunks, or other software revenue streams that others probably won't have. We're going to have a lot less competition. Electrifying our pro fleet, our commercial vehicles, is a very unique opportunity for Ford. And I think because of that, our returns will be more durable. I guess the main message is we had to design these second generation products completely differently than the first gen products. Like when you look underneath, you'll be shocked at how different the engineering is.
Yeah, I want to let's touch on that. The second gen EV products. Why are you so excited about them? What does that mean for Ford is it the answer for profitability?
It is, and for customers it's a big deal. First of all, we're taking back our electric architecture. With the 150 modules we have today, all the suppliers write different software for. They buy the silicon, we don't. So we're taking all that back into the company. And that means we can make it completely software updatable, and it's our software. That means we can change anything. We can design it just like we want, and we spec the silicon ourselves. The second thing is, it's just radically simpler engineering. When you look at how these vehicles, it's half the fasteners, no brackets, large mega castings, totally 40 or 50% less, labor content because of how the vehicle is designed for manufacturability. The battery turns out to be so expensive that it's required us to completely re-engineer the vehicle in a way we probably should have done years ago.
So you mentioned batteries. We're going to talk about reiterating that 2 million EV run rate by 2026, I believe, right?
Yes.
Acquiring those materials, I heard, is a challenge. So
yeah.
How has that been? And then sort of how does CATL play into that with the new factory here in the States?
Yeah, we've had to hire literally hundreds of new people. And it turns out we thought that the nickel and lithium mining was going to be the biggest constraint to get the secured offtake agreements on the raw materials for that 2 million vehicles. And we were wrong. The most important constraint is really the processing of those raw materials, where it's done and who does it. So yes, we now have pretty much all the raw materials locked up. It turns out that the processing is the most important thing for us. And this is now we're also starting to diversify the chemistry of our batteries. In the past, we only had lithium oriented batteries. Now LFP has come on. We think it's a really great alternative chemistry. It's much cheaper, 30 or 40% cheaper for customers. It actually can be fast charged twice as many cycles, so it's really good for commercial customers. And that's why in the LFP phase chemistry, we're going to build the batteries ourselves. So it's our factory. We're building the factory. It'll be our workers in a plant. We're not going to import the batteries like Tesla's been doing. We're going to build them in the United States, and we're going to learn how to build them with CATL's technology.
So you mentioned Tesla real quick. They're sort of been in the news a lot with the driving of price downward pressure. Ford has responded in some fashion here and there.
Yes.
Is that kind of a problem that you see extending throughout sort of the EV run here in the States?
Yes. Yeah. It's happened around the world. I mean, everyone wants to grow. We have the opportunity to grow for the first time to 6 million units. We've never done that, really. At least half the EV sales we think are going to be new customers to us. I'm sure all the other companies are writing down similar numbers. So it comes down to how unique is your product strategy. And, we are going to see pricing pressure. And if you have not put that in your business plan and you haven't designed second cycle products with discounting included in your run rate to get to an 8% margin in our case, then it's not going to work out. That's why we put so much pressure, even on our first gen products, the Mustang Mach-E that faces off of the Model Y. We've reduced the price of the bill of material by $5,000 Normally, we look for hundreds of dollars.
In the first gen model.
Yes. So that was so painful for us, $5,000. And we have to go deeper to face off with Model Y and Tesla and their discounting, that we knew we had to totally redesign the vehicle.
We have a lot that we've been doing to make all of Pinterest shoppable. And one of the new things we're talking about is how we're giving even more ways for people to rediscover the joy of shopping. The first 20 plus years of e-commerce is really about sort of instant buying, making the buying more seamless. I think the next 20 years of e-commerce is going to be about rediscovering the joy of shopping, how you walk the bazaar, how you become inspired and discover. And this is already a natural strength for Pinterest, but we're doing a lot more to make the existing products on Pinterest shoppable. And now we're bringing features from our Shuffles app that lets people make digital collages, bring that right into our main app so that as people style outfits and pull together pieces from different parts of outfits from different boards, putting those together into an outfit, and then making it so that others can shop each of those individual elements, or even see other collages and how other people may have styled those things, which again really just gets more into the joyful part of shopping, the inspirational part of shopping, which really hasn't been solved in the digital world up to this point, but we think we've got a really great shot at solving that.
What inning are you in making Pinterest that go-to shopping destination?
So, it's interesting. The great thing about Pinterest is that more than half the people on Pinterest are there to shop already. So in a lot of ways, Pinterest solved digital window shopping, but all the stores were closed. You couldn't really easily take action. What we're doing now is making it so that all those stores are open. So we're making it so that all those things you find on Pinterest, you can easily connect to all the great places to go buy those. We're still relatively early in that, but as we've been bringing that in, we're seeing this really resonating with users. We talked about on our last earnings call, our shopping ads grew 50% plus year on year. Our mobile deep linking in shopping, which is what connects the user to a seamless checkout in the retailer's app, that's now 40% of our shopping revenue. So as we're bringing these features into the app that make it so that people can easily take action on what they find in Pinterest, we're seeing that users really like it and advertisers are getting a lot of great benefit out of it.
There's a lot of talk, and you could feel it in the air here, about AI. The sponsors are here for AI. Everything is just AI, and AI is having a moment. How does AI play into your future?
Yeah, so we have a great foundation in AI. Our computer vision is what people would know Pinterest for, really. Now, as a consumer, the way you would experience that is when you come to Pinterest to walk that digital bazaar, the recommendations, the visual experience of finding all the things that you're interested in through a great visual, whether it's a visual search or whether it's visual discovery, that's powered by really fantastic AI and computer vision. The interesting thing for us is that, I think a lot of this discussion about AI has missed how important it is what signal the AI is acting upon. The AI is only as good as a signal that it acts upon. And for Pinterest, we have hundreds of millions of pinners that come to Pinterest every day and curate what a great outfit looks like, what a great room design looks like in a certain aesthetic. And we're able to have our AI act upon billions of interactions from pinners that make these product associations, which is very different than what you'd find on any other social media platform or really any other shopping platform.
How do you view AI, as someone who's been in the tech industry for a long time? How do you see that evolving, or the job market? How do you see it evolving the retail industry? Because I go back and think through a recent op-ed by Bill Gates, Microsoft founder. It was about a week ago, talking about superhuman intelligent AI, and it was a little scary. But how do you see it?
Well, AI is definitely advancing quite rapidly and has been for some time. I think as we see this next generation of AI, it is really powerful. And so I think one of the most important questions out there is, what are people going to ask the AI to do? And are people asking the AI to do things that are positive and helpful? Things that are additive, which is where we're focused, is making sure that we're making really helpful recommendations for people that help them build a life they love and connect that digital experience into their real world experience, whether it's putting together a great room, making a great meal for their family, putting together an outfit that's going to help them walk a little taller. These are all things that connect in their daily life. And so I think this question of what do you use the AI to do is going to be really important. And with us, we're making sure that it's additive to people's lives, not addictive, which I think has been one of the criticisms of some of what has happened with AI and social media over the last many years, is that in a lot of ways it was becoming more and more addictive, connecting you to things that make you engage for longer, but may not make you feel better after you engage with it. In us, we're really focused on how we lead to more positive well-being outcomes. And we've had some recent research that we've released that actually demonstrates we're able to have that kind of impact, that we're actually able to make it so that when you engage on Pinterest, you feel more positive, you feel better after having spent that time on Pinterest.
Well, speaking of addictive, and since we last spoke, TikTok has been on Capitol Hill, really getting criticized for its business model. If TikTok was not in the US, what does that mean for Pinterest?
So, I can't comment on any one specific platform. I think with social media broadly, this question of, how do you make sure that it's additive and not addictive? How do you make sure that people feel better after having spent time with it is really important. And we think that's our role to play, because there's been lots of research that has shown that as people spend more and more time on social media, they have rising rates of anxiety, rising rates of depression. People feel worse after having spent time there. And that very same research consistently shows that after spending time on Pinterest, people feel better after time on Pinterest. That's not an accident, that's intentional. We're tuning the AI, tuning our platform to be a positive place for people to be inspired, to discover, and intentionally saying, we want it to be a place where people can build a life they love and feel more positive. And again, I think this would be a really important question for social media broadly.
Is it an uptick to your business though? Would you see, how should an investor think about it? Do you see a user uptick if they don't exist?
Well, I think we're doing something completely different in social media than anybody else. The thing that is completely different about Pinterest versus the rest of social media is that the user's there with an intent and a purpose. With so much of the rest of social media, users are in a lean back entertainment mode. And the reason that shopping works so well on Pinterest is that people on Pinterest are there with a purpose. They're in a lean forward intent mode. And so that is completely different than the rest of social media. And the reason that shopping works there is because as you interject with something, if somebody's on a platform to watch a funny dance video or look at pictures of their friends, and you try to interject something shoppable in that, that's sort of taking the user away from what it was they were trying to do, which I think is how much of social media would function. With Pinterest, more than half our users are on Pinterest to shop. And so when we give them great shopping features, great things to engage with, we're seeing that they really like that they really engage with it. But again, that's because our platform is fundamentally different than the rest of social media, and that users come to Pinterest with intent and purpose, whether it's shopping, redesigning a room, putting together a great meal. They're there with intent and purpose rather than just for lean back entertainment, which is what most of the rest of social media has historically been.
Strange time in the economy. Banking crisis, it's been a weird few weeks. How has that impacted the ad market?
I think the broader market, has been, going through a lot of change for some time now, and this is more of that. The thing that we have seen is that as we've been able to give advertisers more measurability of performance on our platform, connecting more of the user's intent on our platform to actionability, and making it so that advertisers can easily connect there, we're seeing that that's delivering really great performance for advertisers. So even in a shifting market, people are still advertising, and we think we can differentiate more and more through the high intent on our platform and through increasing the user's ability to take action on our platform, which then is not just great for the user because they're getting more of what they love, more of what they want to buy, but also great for advertisers too, and creating really good returns for them.
Has the ad winter thawed?
I think it's continues to be choppy out there, but I think I've talked about this on our last couple earnings calls. In each of our last couple earnings calls, I talked about how even in a choppy market, we can still go take share. And I think that's what you've seen in each of our last 2 quarters, was that we grew faster than the broader market. So we're in a quiet period now. I have no comments about this quarter, but in each of our last 2 quarters, I've talked about how if we can do more to show great measurability, drive performance for advertisers as a 1% player in the market, there's still opportunity for us to grow, even if that broader market may continue to be choppy.
First of all, when we do hybrid cars, and this is starting now with the Lamborghini Huerto, there's one clear promise we are giving to our customers, and that this generation is better performing than the generation before. But on top of that, it has to be much more sustainable. These are the 2 promises we have to keep. We cannot do one without the other. And then this is the start of our strategy. In the next couple of years, we will hybridize all of our lineup. It's the right moment to do so, not only because of the legislation, but also because this is giving a boost in terms of performance together with sustainability, and our customers are demanding both of them.
Hey, Stefan, so this is Pras here. So the car combines a V12 engine with 3 electric motors. You said it combines what customers want in terms of emotion, but also with reducing emissions, like you said. What has been the customer response so far for this vehicle?
We presented the car yesterday as a world premiere. We had a lot of customers from all around the globe, and the reception was phenomenal. Everybody was trying to put an order in. I have to say that already in the last weeks and months, we had, let's say, sneak previews, like we call them. And we have already the next couple of years of production covered with orders. We will start production in the second part of this year, and we will start deliveries by the end of the year 2023.
So Stefan, the car can go, I think, 10 kilometers in pure EV motor, around 6.2 miles. Is this a target that you guys had internally, or is it a regulatory thing that the EU wanted you guys to do to have a car with EV power?
But it's part of our global strategy. First going hybrid in the next couple of years. So the entire lineup will be hybridized by the end of 2024 in order to reduce the CO2 emissions in comparison of today by at least 50%. This is the first step. This is, let's say, a multi-layer approach, because it's not only because the legislator globally is demanding more and more reduction of emissions, but we also have to manage to do those things by keeping in mind that performance is to the utmost performance, because these are cars which are not meant to drive from A to B on a daily basis, but these are cars which have to fulfill the dreams of our customers, and therefore it's important that we keep this dream alive, and therefore the combination has to be perfect.
Stefan, you can bet your bottom dollar I can't wait till I can drive my Lambo to and from the grocery store one day in the future, and for it to make sense. You know, ultimately, when I am able to place that order one day, a lot of people who are placing those orders are wondering what that delivery timeline is like. Have you seen any variation in just the ability to fulfill orders right now?
In the last couple of years, so right after the first shutdown of COVID, globally, let's say the market was coming back much quicker and sooner than expected. And we are having an incredible run already starting from the year 2021. 2022 was another record year in terms of not only deliveries, but also in terms of profit for our company. And we have an order bank which is lasting between 18 and 24 months. I think this is more than solid. It's something which in the high-end industry is something which should be normal. I think if we can come down to between 12 and 18 months, it would be even better. We are working on it. We increased production in the last couple of years. But for us, let's say, the waiting time is also a signal of how much the brand is appreciated, and also how much our products are valuable. Because if you want to buy a Lamborghini today, you find a used car, and usually the used car is at least on a new car sticker price, if not higher than that. So this is a good investment also, and not only a dream becoming true.
Stefan, it's Julie here. Looking far into the future for Lamborghini, given that it is a performance vehicle, given that it is a special, storied brand, do you see a time where Lamborghini will not be making gas-powered vehicles, gasoline-powered vehicles?
For sure. By the end of the decade, we are planning to have at least 2 cars to be full electric cars, so battery electric vehicles. This is by the end of the 20s, and which will help us to reduce the emissions further by up to 80% in comparison, the CO2 emissions in comparison of today. We are doing it first with those cars which are more the daily drivers, like our Urus, the SUV, and we are planning to have also a fourth model, which is going to be a GT car, so of 2+2. And we will keep as long as possible the two super sports cars, like we have seen at the beginning of our brand new Lamborghini Revuelto and the follow of the Lamborghini Huracan hybridized. We will see how the legislation and the homologation rules are going to move after 2030, and then we will decide accordingly.
Stefan, a quick follow-up here. We just saw recent legislation in the EU where an e-fuels carve-out was allowed for gas-powered cars beyond 2035. Does Lamborghini believe in e-fuels as a solution for keeping these V12s on the road?
I believe in harmonization globally of the regulations. For us, it's very important. We are a global company. We sell small volumes, but all around the globe. We have a very well-balanced distribution, about 1/3 in the Americas, 1/3 Europe, Middle East, and Africa, and 1/3 Asia Pacific, more or less. And we cannot go with two different systems, so we need as much as possible an harmonization. And I see that synthetic fuel is going to be likely more for, let's say, ships and airplanes from the 30s. And I doubt that there will be a capillarity like it's today with the gas stations that will fulfill the needs of our customers. On the other side, all the manufacturers are investing in electric cars, in infrastructure, and more this is going to be, let's say, the new normal. And we have to adapt. We have to create a car, also electric cars. At least we have to be prepared also to do so, that are as emotional as the internal combustion engine cars we have today.
And Stefan, just lastly, while we have you here, the new normal in terms of this interior car experience as well has been touchscreens everywhere, just high touch capacities. For Lamborghini, is that something that you believe is going to be integrated into future models, even as people are paying, of course, high price tags, which to them might not be that much, but at the end of the day, looking at some of the rest of the technology out there, is that something that you're looking to incorporate into Lamborghini as well in terms of the technology and also what the number of chips would be necessary to also incorporate into the design if that were the case?
So it's clear that there are the three mega trends, no? But two are electrification and digitalization. Electrification we talked about, or sustainability in other words, and digitalization, or translated also software, is the other thing we have to heavily invest. And for sure, every customer is demanding something which every normal car in the future is going to have also in the super sports car. So we have to adapt our platforms, even if, let's say, the primary use of a Lamborghini is to enjoy the driving, but still we have to be up to date also in terms of digitalization of software.
I think there's a chance that inflation is just a little stickier than people think, and the fiscal and monetary stimulus of the last several years is more than people think. Unemployment is very low. We'll see. We have still a lot of fiscal stimulus with very low unemployment. And consumers actually in rather good shape. They have low unemployment. Home prices and asset prices have gone up for the better part of 15 years. They maybe now, but their equity in their home is at all-time records. They locked in a lot of fixed-rate financing, particularly mortgages, which is like 70% of consumer borrowing. So they're actually in pretty good shape. I personally think you may have had a sea change. And the sea change was that we've had 20 years plus of lower rates. And now, all of a sudden, it looks to me there's a lot of long-term inflation. So if we get monthly numbers and stuff like that, long-term inflationary effects. I call it trimming the sails. So you always do it a little bit. So we weren't big in subprime auto, but people are trimming the sails there, and they should. We're not really big in subprime credit card. Real estate a little bit, because real estate, commercial real estate, there's too much vacancies, and so you're not going to be doing the same kind of activity you were doing before. You have 600,000 casualties here. And so I look at it, this is maybe a little bit more like pre-World War II. Like, we got to get this right. And I think I like the fact that the Biden administration, and leaders are saying, we need to take care of this. It is for America. Because if we don't fix this, the world may not be completely safe for freedom and democracy as we know it for the next 100 years. I am a full-throated, red-blooded patriotic, free enterprise, proud American. This country is the most prosperous nation the world's ever seen. And of course we have flaws. There is not a nation on the planet that doesn't. But we are, and we're a moral nation. We didn't go to war in World War I and World War II to grab land or oil or money or gold or any of that. And then we did the Marshall Plan. I think we need to do Marshall Plans again to help some of these other folks. That is the forefront of keeping the world safe for democracy. And I'm proud of that. It's still the most prosperous nation the world's ever seen. My first message, I'm proud of them. Anyone, if you talk to anyone who's ever started a small business, and I always do this here, what's the thing that you recognize, what's the most important thing? How hard it is, how proud they are, how fun it is, how hard they're working, and we want to help them. So we help them with money, we help them with advice. It's motivating for us to see the dynamism in these companies.
We have two announcements here, one being a tire made out of 90% sustainable materials. And this is something we're really proud of relative to our goal of getting to zero greenhouse gas emissions down the road and helping the industry. Brian, what you know from the last time we talked, we had a tire at 70% sustainable materials. Now we're at 90%, and we're proud of this. What we continue to do is really focus on taking more petrochems out of the tire, replacing them with biomaterials and other materials that will allow us to recycle the tire more. And we're doing that not giving up any performance, and in particular around rolling resistance, which gives you better fuel mileage, whether you're in an ICE vehicle or you're getting range out of an EV vehicle. So more sustainable, no takeaway of performance, and we're the first company to get to that 90% level.
All right, so two ingredients. I'll call them ingredients. I don't know what else to call them, Rich. I'll call two ingredients that stood out to me on this tire. You're using soybean oil and rice husk waste. Why those two elements in the tire? And you mean to tell me that the tire will not wear out faster because you're using those products?
Well, Brian, you're exactly correct. So those two materials really got to give credit to the team for coming up with this. One, both of those actually don't degrade performance at all. They actually increase it. In fact, as we look at soybean oil, it makes a tire more pliable in cold conditions. That gives it more grip. And on rice husk ash, we use it as a place of petro-based silica. And what that does for us is actually improves rolling resistance on the tread. So this is a way of actually moving to those bio-based materials that I said and not giving up any performance. And in fact, in many cases, enhancing performance.
Why is a product like this so important to a company like Goodyear and its future?
Well, for us, I think, number one, it's the right thing to do as we think about the sustainability goals that we and our customers have. Secondly, it's what our customers are asking for. As you well know, we have Scope 1, Scope 2, Scope 3 goals that we have to achieve, and bringing a sustainable tire to our customers helps them achieve those. That's really important to us. And then when we add features like intelligence to it and our service proposition, we can bring a whole different set of solutions to customers as we think about the mobility trends that we see going forward around fleets, autonomous, connected, and electric vehicles.
How difficult is it to scale a product like this up?
So, Brian, it's actually a great question, and it is harder to scale because we're talking about a whole new complement of materials coming in, which means having to build a supply chain to be able to do that, and it's why having the right partners to collaborate with to get us those materials is so important. We're on the front end of that, but this is something that's going to continue to evolve. But, Brian, I want to tell you, this is not something that's just an idea that we have. While the 90% material is a demonstration tire, which, by the way, passes all Department of Transportation requirements, the 70% tire, the tire made out of 70% sustainable materials, you can actually go on our website and buy right now. So we're trying to bring this to life, even as that supply chain matures, to make sure that we're not just putting prototypes out, but actually bringing this to market.
When will I be able to see 100% sustainable tire from a Goodyear, and what would be in that tire that's not in this one?
So our goal is by 2030 to have a tire made out of 100% sustainable materials. Again, I'm going to give hats off to my team for their ingenuity, for their tenacity to get us to 90% today. And I'll certainly thank the collaboration we've had with our suppliers. I would tell you that other 10% is going to come from, again, replacing certain of the materials that we have to make sure we can get the performance we want. And it's ultimately going to rely on the collaborations with some of our partners to come up with some of the inventions that we need to replace that last 10%. But I'm confident that we're going to get there. I'm 100% sure we're going to get there.
We focus a lot on jobs and reskilling the workforce at Yahoo Finance, Rich. This seems like a real opportunity to upskill a lot of your workers. Would you agree with that?
I would agree with that. And I would say not only upskill, but I would say what we've seen is real purpose to those working on projects like this. So instead of just, getting a tire, giving us, a new size or maybe a different tire one of our customer might ask for, this is really working on a social problem, an environmental problem that we have. So not only upskilling, but giving our associates perfect purpose to solve a bigger problem is something that we've seen. The excitement internally is palpable. One big problem for manufacturers continues to be is inflation, Rich. Have you seen any peak in your business, any slowing growth rates in anything that goes into a tire at this point? Well, I would tell you, as you well know, the markets, particularly in Europe, are still giving us a lot of headwinds. The markets have been down as we went into the last months of the year, and we've still seen those high costs around some transportation, around labor, and around energy, certainly in Europe. But I would also say we're starting to see some of those raw material costs roll over. So as we get into the first half of 2023, we'll still see some of those headwinds coming. But Brian, I would tell you, as we look to the second half and as we look to some of those costs rolling over and we look to the economy perhaps picking up some more steam back then, we're pretty confident about the second half of the year. One of my friends, Rich, knew I was coming to talk to you, and they recently had a blowout in the tire. It wasn't a good year, so that's a good thing. But they spent $400 to get one tire. I mean, the pricing has gone up a lot, and the economy continues to slow. Do you see consumers balking a little bit, maybe pushing it to the limit on what tires, how far they should even have these tires left on the cars, given, their financial standings and the pricing of some of these products? Well, Brian, I would tell you two things. One of the things is that given the retail outlets that we have and our partners out there, we look very closely at treadwear as we take tires off as they get replaced. And I would tell you, we're not seeing treadwear going down to levels beyond what is normal. And that tells me that consumers are still in the mode of changing tires at a normal cycle. That's a really good thing. And yes, tire pricing has gone up, but that's also because, as we said earlier, those input costs have gone up so dramatically. And a way that we deal with that, and I'll go back to one of the benefits that we got from doing the Cooper Tire acquisition, is we have a whole lineup of tires at different price points for different segments that allow the consumer to meet the needs that they have. And I think that's actually one of the benefits that we got from that deal as well. Do you think you have the opportunity to push through some more price here? I think as we look at what our input costs are, it's something that we have to do, and it's something that we'll continue to consider. So yes, I do think it's something that we're paying very close attention to.
The reaction from customer has been incredible, amazing. We have over 20,000 in back order for 2023. Just to give you a point of reference, Press, in the Q4 of last year, the EV industry grew by 55%. And we grew by 122%. So we more than doubled the performance of the industry in Q4. And the 84 has been one of the main sellers within our product portfolio in Q4 last year. I think over the last 2 years, things have improved. Are they perfect? No, they're not. We still have some of the issues, but I think the issues have been reduced versus 2022, and particularly versus 2021. So I think it's not only semiconductors, but it's this entire supply chain, whether there are different suppliers, tier 1, tier 2, some of the logistic companies, but they're easing out. I think 2023 we'll still have some issues, but there will be minor issues compared to 2022 and particularly 2021.
The group was probably the most pleasant surprise in the quarter's performance.
Pleasant surprise.
Group business was up 10%. And there was some question, well, is that starting to wane? If you look at what we have on the books for 2023, we're actually pacing about 20% up.
Is it conventions?
It's small meetings, it's conventions. Even companies that have ratcheted back their more traditional transient business travel, they still feel the need to get their teams together. And so you're seeing a lot of corporate meetings.
I think it's important to put in perspective that buy now, pay later is about 5% of US e-commerce and less than 0.5% by my estimation overall retail. And yet people have been borrowing money to buy things for quite some time and continue to do so. Buy now, pay later is a better alternative. So from my point of view, we are very, very far from saturation. Affirm is unique. We cover both low AOV transactions, what's now traditionally called buy now, pay later, as well as monthly installments, which helps people buy more expensive things like furniture and bicycles, etc. And so obviously competition is good for consumers, good for merchants. There's a lot of space to go after. The enemy or the competitor is the credit cards, not each other.
Max, it's Brian here. Good to see you here. In the earnings that investors digested, was that more of a function of the cyclical nature of the economy and macro forces? Were there more operating challenges than you expected?
It's really two things. So consumers are pulling back discretionary spending. There's no question about it. You can see it in our reports. You can see it in other reports. But folks bought a lot of furniture when they were trying to set up their house to be more like an office, et cetera, and they're now digesting that. And so the consumer discretionary pullback is very real. The more important thing from my point of view, and it really is something that I hope all of our investors and anybody who watches the industry understands, you can see it in the letter. As issuers of credit of all stripes, buy now, pay later, fintechs, traditional banks, the delinquencies are rising. Ours fell in this quarter. We managed the business to credit outcomes for ourselves, for our consumers to protect their financial health, and for our capital partners. We said over and over again, we will do the right thing through the lens of managing credit to a number, and the industry will struggle. The industry is struggling. We are not. That absolutely comes with some amount of cost relative to growth. If someone should not be borrowing money because they can't pay us back, it is important for us to say we cannot do it. The $1 billion of applications are great. That a number, frankly, but the approval rate is what governs how quickly we can grow. And we will continue printing credit numbers that we control. There's an input into our business. It's really, really important we continue delivering on that input. As we get through the full economic cycle, we hope to have a definitive answer to all of our watchers that say, well, can you really underwrite? I think we can. We've showed it last quarter. We'll continue showing it.
Max, we've gotten to know you over the past couple of years as you've grown Affirm, and I'm sure the layoff news, having to make an announcement like that was very tough on you personally. Take us through that decision. How much money will that save the company?
It's tens of millions of dollars of operating expenses that we took out. It was a really, really difficult decision, probably the most difficult one in the history of the company, and it's been over a decade now. I believe it's the right one. Like a lot of Silicon Valley, we had hired more people that we were reasonably able to support given the revenue growth. As the economy slows down, you can reasonably expect more slowing. A lot of metrics, you have to control your operating expenses. As a publicly traded company, we have to take the responsibility, and I do. That said, the team is extraordinarily resilient. I've gotten just an unbelievable outpouring of support, both from impacted Affirmers and the ones still here. And we are plugging back into work and just going after it with the same gusto we always had.
Obviously incredibly tough at the moment when we do see these layoffs happening and companies having to make some of these costs. In terms of how you see the business growing from here, perhaps different offerings that you plan on foraying into beyond buy now, pay later. We know that there's been some forays into debit as well.
Mm-hmm. I think that's a great tee up. So Debit Plus, the card that we've been working on for quite some time, and it certainly took multiple shots at to really figuring out the user experience and frankly the underwriting challenges there. We're very excited about the state of that product at this point. The thing that I mentioned at the beginning of this conversation, the penetration into offline, the US retail, is tiny. It's 0.5%. And that is where our products can help, especially during an economic downturn. You don't just use buy now, pay later, at least from our point of view, you don't just use buy now, pay later for couches and bicycles. You can also use it for groceries. You can also use it for all the daily consumption decisions that you make. And the card that we're rolling out will help us bring the service and the transparency and no late fees and no deferred interest, all the things that we are known for to every Affirm consumer. So we're very excited about growing offline usage, very excited to help folks buy commodities and things that they just need as opposed to want. And so that there's just a lot of growth we see there.
And Max, listen, Affirm, it's a challenging business. It's complicated, I think, for a lot of average investors to understand. Now, maybe you could explain to them some of these contract renegotiations you're going through and the pricing structure on them. What are you trying to do, and are you through this process?
Yeah, I think that's this particular aspect of Affirm's business is actually not that complicated. The long and short of it is we charge consumers and we charge merchants for the transactions that we power. The APR that the consumer pays, not exactly the same thing, by the way, as a credit card APR, but you can almost think of it that way. The maximum rate that we set in our contracts going back 10 years was 30, and the national, there's not a law, but there's certainly a national consensus that the reasonable maximum rate is 36%, and that's about 3% per month. It goes back about 100 years that sort of a conventional wisdom was created. Because it's really important for us to be transparent with a maximum rate disclosure, and because there's fair lending laws that we absolutely have to meet, it is important we go and re-sign our contracts with merchants saying, hey, that is the new maximum rate. We take great pride in how we treat consumers. It's not a renegotiation, but it is something that has to be contractually documented. And the mistake I made, which I owned in the letter hopefully fairly clearly, we waited a little bit longer than we should to speak with our merchants about amending all these contracts. Doing that through calendar Q4 is a fool's errand. All these things took a lot longer than we expected. That said, we have very high confidence our merchant partners want more transactions. Being able to expand the maximum APR allows us to approve more people, and both sides, all three sides, Affirm, the consumer, and the merchant want more transactions, especially in a tough economic market. And so that is not a long-term concern. I feel very confident we have gotten through that, but the timing of it last year had a real impact on our ability to approve more people.
And Max, I want to ask you about a suggestion by Morgan Stanley analyst James Fawcett. He was saying that perhaps using buy now, pay later as a way to get customers in, and then perhaps having the best customers then move to more traditional credit products would be a way to improve efficiency and perhaps grow the business. What are your thoughts on that?
I think that's a little bit of, no offense to the analyst in question, sloppy thinking. Buy now, pay later is what I think typically referred to as the pay in for no interest 6-week product that is really fun. It really doesn't work for a lot of transactions. If you're buying anything that's more than a couple $100, you want to pay for it over time, but over 6 months, over 12 months, sometimes over 3 years if you're buying something particularly expensive. And that is a great product. It's a great alternative to credit cards. That's what we launched with. We've been doing this for a decade. And so I think arguing that you give people a taste of buy now, pay later with a 0% 6-week product, and then you sell them a traditional credit card is profoundly not what we will do. However, we do get a tremendous number of users through the 6-week 0 interest product. And then when the time for them comes to buy a couch or a bicycle, and they want to pay for 6 months or over 12 months, we're there for them as well. And so as a company that offers a full suite of credit, we are already there. And in fact, we don't think of one as the user acquisition engine for the other. It's just a full set of features that we must offer to our consumers to be a viable competitor, to be a viable replacement for a credit card. I think there's a fair number of other companies that only do buy now, pay later, pay in for. And for some of them, especially some of the contracts they signed or economic decisions they make, those are not profitable transactions, and they are struggling to figure out a business model that works for them. Our business model is great. One thing that we spoke about in a call is that the loans we generated last quarter are some of the most profitable, margin-rich loans that we've ever made as a company. And it suggests that our product is more valuable to consumers. It is really important for them to pay over longer periods of time, which the reason they become more marginful is because the terms of the loans are slightly longer. There's a little bit more interest earned in those. So generally speaking, I think buy now, pay later is not a user acquisition engine. It's a real product with real value for real folks. And we have 15.6 million of them. Last quarter's report are happy users.
And Max, you've been consistent with me in the past when we've talked. You said, Brian, I've not sold a single share of Affirm. Is that still the case?
Still
true. And are you looking to buy anymore, just given where things have gone?
I have not sold a single share of Affirm in the history of the company. I have bought shares of Affirm not an extremely recent history of the company, but I didn't just sit on my founder's grant all through the fundraising process for the company. As a private enterprise, I bought shares, so I remain in possession of extreme conviction around what I'm building with my team.
I think the worst is behind us because the housing market is showing signs of life for the first time in the last year. Everybody believes, whether it's true or not, that the Fed is done lifting rates. And with that, it's ushered a few more buyers into the marketplace.
I guess we're the best of the underperformers, right? I think that we are starting to see an uptick in builder confidence. You mentioned that, but it's still below 50. The builder confidence is getting better. It's not all the way there. We're cautiously optimistic that the worst is behind us. But when the Fed talks about raising interest rates again, with the problems we have in the supply chain, I don't think we're going to see a gigantic growth in the market, at least not in this year. But I do think the worst is behind us, particularly if they keep interest rates below the 7% mark.
I'm looking at, speaking of home builders, the home builder stocks, and D.R. Horton's up 7, and Lennar's up 10, and KB Home's up 12, Toll Brothers up 16. This is all percent this year. What does that tell you about their true sentiment? And you talk to these home builders. What are they telling you about the environment?
I just got back from our annual convention. There were over 100,000 builders there. And I've got to tell you that everyone is feeling optimistic, much more optimistic than I thought they would be when I got out there. And the general overall sentiment is that we're going to be off to a sluggish start at the beginning of the year, which is, I think, borne out by the statistics that came out yesterday on housing starts. But that by the end of the year, we'd be back into some pretty decent production. And that next year, barring any unforeseen circumstances, we should have a pretty solid year.
Jerry, in order for the housing market really to push higher, like you're saying, maybe we won't see that till the start of next year. What needs to happen in terms of mortgage rates? How low do they need to fall? And has that at all changed since we last spoke?
Well, we do think that we've seen the peak. We think that they're going to bounce around a little bit. Obviously, we'd like to see them get as low as possible. The lower the cost of capital, not only for the housing consumer, but for the builder as well, who has to borrow money at the front end of the pipeline. Obviously, that's better for everybody in the game. So we'd like to see them lower. We'd like to see the supply chain fixed. It's getting better. Anecdotally, I can tell you the biggest problems out there now are with appliances and electric transmitters. But the supply chain is still a mess. And of course, we still have some labor issues. So there are policy decisions that can be made that can really make sure that by 24, we come out of that box really, really full steam ahead.
What policy changes, Jerry?
Well, I'd like to see our immigration policies fixed so that we can have some legal immigrants coming into the country the history of this country basically is it's built on the backs of immigrant labor. And right now it's very difficult to employ immigrants and feel confident about it. So I'd like to see the labor supply fixed. I'd like to see a lumber agreement negotiated with Canada. It's been years, and we depend on Canada for roughly 30% of all of our lumber. So that's an issue. And then, of course, the other supply chain issues are out there. So capital, labor, and the supply chain are things that can be corrected relatively easily if they want to.
Jerry, when it comes to the labor issue there, I know you're saying some changes in policy when it comes to immigration that would improve that picture. But how bad is it today? Has it improved at all?
Well, right now in the residential sector alone, there are over 400,000 vacant jobs available. So, and on an annualized basis, the construction sector, including residential and commercial, we have to hire almost 750,000 people a year just to keep even. So the labor problem has been around since before the Great Recession. It's been exacerbated over time, and it's something that really needs to be addressed through immigration and through a change in our own thinking domestically about American kids getting into the construction trades.
Yeah, well, thank you for having me. And that is such a relevant topic. I get the great pleasure of spending time helping families with those two priorities, competing priorities. And I think the first thing you need to do is have proper communication with your partner or spouse. Really get on the same page with them as to what's most important for you. And then I think it's important to prioritize, right? And I think you're onto something, Sheena, that you really want to prioritize retirement ahead of education. But if you can, really focus on both, but certainly overweight the retirement conversation versus the education. But again, it's a difficult balancing act today versus tomorrow, and sometimes it's hard to save. But I would just say the most important thing is proper communication with your partner or your spouse and making sure everybody's on the same page.
Good marital advice, generally speaking, David. We got about a handful of kids to put through college, so we're taking notes. I mean, are we talking, when it comes to like percentage-wise, how should you allocate your savings?
Yeah, well, that's a great question. But let's take a step back, if we might, and just talk about some of the incentives that we have for retirement, right? There's a lot of good incentives that you may have, and that's sort of the ability to save pre-tax, Roth IRAs. And certainly if your company offers a match, you must match up into the 401k match. It's like free money. So a 50% match is like a 50% return. So there's a lot of great things. Don't forget about if you have health savings accounts. Talk to someone about whether an HSA is important. That's a really good retirement vehicle as well, especially as healthcare may be a big cost. But David, you hit on something. I have 4 children of myself. So how do you prioritize? How do you balance that? It's hard. But what I'd say is pick a percentage, right? Let's say you can save, let's just use a nice round number, $50,000. Maybe 70% of that $50,000 is allocated towards retirement. And then the 30% or $15,000, whatever it might be in terms of the math, is allocated towards education. And again, education 529 plans are a wonderful vehicle, a great incentive. They're estate tax planning, income tax planning, tax-free education. And just remember that you are still the owner of a 529 account, right? You want to earmark it for college. You do your best, but you're still the owner. So if you needed to pull that money back, you can. There may be some penalties involved, but you certainly can.
David, is that just a blank 70-30, 70 towards retirement, 30 towards college? Or is it if your kids get older, get closer to that college age, you should start to rethink that balance?
You know, I think the best thing to do is, if you can, start saving for college right away, right? Let's just open an account, say Poor Child, for $250. And some of the Secure Act 2.0 incentives have really made that even more important because you have a 15-year hold period before you could essentially roll those over. We'll get into that later. But, you know, I think the earlier you start, the better. So it's kind of opposite, Shauna, is what you're thinking, right? If you start saving more earlier, it may allow you to save less later on because you've gotten that head start. But I'd also say in terms of retirement, if you're 55 or older, there's some catch-up provisions that you can use. And so make sure you're taking advantage of those catch-up provisions, especially if you're in that stage, right? You want to make sure that you're overweighting retirement ahead of education.
All right, let's fast forward a bit to post-college, and you're trying to pay down those college loans. Should you prioritize them and flip this equation? Should that be your utmost priority over your retirement initially?
You know, so if you flip it, yeah, I would say that, you know, I'd say doing both if you can is the best practice, right? But doing one or the other, certainly you want to take a look at the interest rate, right? If you do have loans and you do have things of that nature, or scholarships, whatever it might be, take a look at the loan and what the interest rate is, and then what you think you might be able to earn in a diversified portfolio, and make the trade-offs. Talk to someone, use some sort of calculator. But yes, I'd say, you know, trying to pay down that high interest debt as soon as you possibly can is certainly a great idea. But don't forget, money compounds over time. Time's our best friend. Start saving for retirement as well. I know it's much easier said than done.
Well, it's great to be with you. Thanks for having me. You know, it's another roller coaster year. I think we've had a shock in each of the last 4 years, demand shocks, supply shocks. And last year was no exception because we came into the year short of inventory. And then, of course, the market dynamic was really volatile. Through the end, we ended up 6% up at about $1.2 billion, an all-time record for our brand, which we're super proud of. We worked hard for that. But interestingly, the fourth quarter was up almost 25%. So we saw once we were able to supply the entire market, just really strong demand. And we think that reflects our category and run. The category is super strong as people are out there moving their feet.
Yeah, I know we're moving our feet, Brad and I. So if the last couple of years were characterized by shocks, Jim, in as much as you can even forecast a shock, by definition, you kind of can't, but what does 2023 look like?
Crystal ball required. I've never seen a more uncertain time just in the global economy, and we're a global brand. So I think running is likely to muddle through. And we were talking about soft landing, no landing, what have you. I think running has a good shot of muddling through this economy with all of the ups and downs we see. It's been proven, not proven, but over the last 30 years, it's been more or less recession resistant. We saw it in the dot-com bust 2 decades ago, the Great Recession. Even in COVID, when retail shut down, people were out there running and our category grew. So we feel really fortunate that through thick and thin, we're probably going to see more people running next year than we have in the past years. So with that, though, apparel and footwear is an inventory-driven business. Not for the faint of heart. It's super hard to plan for demand these days, but we expect growth, maybe not as rapid as we have the last few years in this retail environment, but we do expect growth this year.
So, Jim, as you mentioned, since running is recession resistant from your perspective and your outlook here at this point in time, and it still is an inventory story, how are you working with some of your wholesale partners to make sure that you're taking on more of that share of shelf, or how you're managing that share of shelf, whether that be in person or digitally, knowing that those end partners are still going to need to sell through that inventory?
It's a great question. And I think there's more inventory, maybe across retail categories, but certainly in apparel and footwear, no one has probably the inventory they'd actually want right now. We have more than we'd like at this time, but we really see our ability to move through that this year is solid. And I think most of our retailers are in pretty good shape in that regard. But there's clearly too much inventory coming out of last year in the broader category. You have to work through it. I think in footwear, particularly, the lead times are longer. They're 6 months plus. So, there's no such thing as perfection in inventory, too little, too much. But I think right now our category is going to right itself in the coming months from an inventory standpoint, and hopefully we'll all be more towards normal in the back half of the year. But it's a puzzle, and when we hit it right, we all look smart. But I really feel that our category is going to be able to work through it in this next 6 months.
Jim, what's happening with pricing then? If the fact is that a lot of you and your competitors are over inventoried right now, does that mean you don't raise prices this year? Does that mean even you see a little moderation in prices or discounting in various channels? What's going on?
I think when there's too much inventory, it has to be cleared. But there are channels to do that. We don't have a broad, sort of chain of outlet stores. We handle our inventory through our core partners. But you're going to see a lot of inventory cleared through these off-price channels, as it has to be. It's just it's almost a rule of gravity. It has to move. But on the core product lines or inline business, which is still the vast majority, 80-90% of our business, we're seeing prices stabilize. And we've saw a lot of inflation in the last 2 years. The supply chain inflation has relieved a bit. And so I'm not seeing massive inflation in the coming year. That's a big word, but we're just not. We had inflation pressure the last 2 years. I see it moderating a little bit in our supply chain, and that's a good thing. So we don't have big plans for price increases in the coming year.
Jim, I've been doing a couple wear tests of different running basketball shoes, and it's coming down to the changing materials, too, that really kind of facilitate that ability to defy gravity, as you were mentioning gravity earlier a moment ago. When you think about sourcing some of those newer materials that are going into shoes, how is that changing or disrupting the existing supply chain that you may have had in order to produce the footwear?
Boy, Brad, I think you're on it. Materials have really revolutionized footwear. The product today, I believe, is so much better than just 5 years ago, and materials and putting them together in unique ways is a part of that. For example, our Glycerin 20 has nitrogen-infused a critical foam in it. And we're going to take that technology across our line. It's also in our Catamount shoe and our Hyperion Max. It's just better. It's lighter weight. It has the best cushion characteristics and durability metrics than we've ever seen in a material. So I think what's happening is that innovation obviously is keeping the category vital, but it also means you've got to be light on your feet from a sourcing standpoint. You just don't lock into, a big technology for a decade, because there's been so much change in materials. But it's exciting for the category. I think it's exciting for runners to see the innovation that we've seen in the last 5 years. And I think there's more to come. We've never had a stronger innovation pipeline at Brooks.
It's been incredible. In fact, the Diavolo itself, the new V4, is an evolution of our design that we originally launched when we brought the Diavolo out in 2010. It's a very unique model in the entire motorcycle lineup in the world, because it's this idea that we took a blend of a sport bike, a naked sport bike, and mixed it with a cruiser, which gives it this very muscular feel and appearance, but of course the performance you expect from a Ducati. So we've seen, while the bike hasn't actually been delivered in the market, we've seen customer order portfolio, which is basically how we predict our sales, been exceptional for this motorcycle. In fact, by far the best launch that we've had for a new model out of the Diavolo lineup. And then for the Multistrada V4 Rally, this is a continuation of the Multistrada V4, which has been historically one of our top-selling motorcycles. And the idea behind the Rally is really to give the person who's the owner of this motorcycle an opportunity to go on and to travel the world. And as we've experienced a little bit in the post-pandemic life, people want to get out and ride. This is the bike that you can hop on, put your aluminum panniers, your passenger, and go have that adventure of a lifetime.
So 2023 looking pretty strong with these two new bikes. 2022 was a record-setting year for you guys. What sort of powered that growth, and do you kind of see these trends happening this year as well?
I think a lot of it has to do with that post-pandemic effect that we've experienced, because people obviously were doing quite well financially and found themselves in a situation of like, I want to reward myself, I want to live life. And when they're going to do that, when they're going to seize it, they're doing it with a motorcycle. And when they make that decision for a motorcycle, they pick Ducati. We're at the top of the food chain, if you will, in the motorcycling community. But so our sales momentum has been very strong, both all over globally, but also in North America. And we delivered an exceptional result this last year. Unfortunately, behind Italy, we were number 2 globally, which is something that we're ready for the battle this year to be number 1. But it also, I think, was fueled by a lot of the enthusiasm for what we're doing in racing. I mean, this is the first time ever last year where we won the MotoGP Series Championship and World Superbike, and both of our riders in 23 are running with the number 1 plate all year long. And our Ducatisti, our clientele, they are enthusiasts about what we do racing-wise. So I think all of those things mixed together with the great product and just the market demand has been very positive.
So I want to get into racing in a little bit, but just we did note that there was some potential component issues, shortages. Did that sort of affect sales in the U.S., or was it kind of a non-issue?
Oh, I wish it was a non-issue for us. I mean, what ended up happening is we had 2 specific components early last year that slowed down our production. And we had a lot of bikes, what we call work in production. That basically means the entire motorcycle is there, assembled, waiting for one part. Mm-hmm. And that just slowed down for the first half of our year. What was incredible, though, is once that supply chain caught up, the momentum was right there. And we closed out last year, the second half of the year, with our best half year ever. And the great news is that momentum that we've built up is continuing. There's always a risk if you make somebody wait too long that they just decide to not buy. But with the demand of our product and the fact that we keep evolving, we keep bringing out so many new models, we haven't seen a slowdown at all.
Yeah, even on the these bikes are not cheap. So that buyer is still sort of hungry for these higher priced bikes?
Absolutely. In fact, what's the one thing when we look at the motorcycle market as a whole, there's a lot of obviously concerns about what's happening in the economy right now. But the reality is at our price point being that ultra premium, we haven't really seen an impact with our clientele.
So real quick, I want to talk about racing real quick. You mentioned that doing well this year in MotoGP, but in Moto E, I believe, right? Is that what they're calling the electric racing series that you guys are going to be the single make manufacturer for?
Yes.
I wanted to ask you about that. That's going to happen this year, but we're eventually going to see some of these potentially electric bikes coming in the future. Are customers excited about that future?
Yeah, in fact, this is, there's a lot of people have been asking us about our electrification strategy. And before we jump into the racing part of it, really our objective is not necessarily to check the box to build an electric motorcycle. It is, what can we do to reduce our carbon footprint as a brand? And electrification is one of those methods. We have other options as well, but that's one of the methods that actually seems to be the most predominant right now. And what we saw is, how are we going to do this? We're going to deliver an experience that people expect from a Ducati, to do that at the highest level. And the highest level for us is racing. That's part of our DNA as a brand. And so we are the sole supplier of the Moto E series, as you mentioned, and we just finished the production of all the Moto E bikes that will actually start the race series next year. And our objective is to take the technology of what we learn from this series at that level and find a way to distill it down to what we can bring to, let's say, our client level. And we have a lot of excitement behind it. Unfortunately, the race series won't come to North America until hopefully next year. But we're encouraging and driving that because it's very exciting to see this evolve in racing.
First of all, I love that you said that the outlet business is alive and well. It is. It's interesting. The narrative on the outlet business is these shopping centers that are quite a drive away with value-priced goods. For us, the outlet center business, we've moved much closer to the cities. We're building a shopping center right now in Nashville, Tennessee, which will open in September of this year, 12 miles outside of Nashville. The outlet retailers are really changing and evolving. A lot of new brands are getting into the business. So what you might have seen 10 or 15 years ago is completely evolved. Direct-to-consumer brands, better food and beverage offering, and even entertainment offerings, better amenitized space, so that when you come and you shop at one of our shopping centers, you want to stay for a much longer time.
Are you guys benefiting from what we're seeing to some degree as a trade down effect for consumers right now who are trying to save money in this big inflationary environment?
What's interesting is when we talk about trading down, we actually look at an outlet center and say a lot of the customers actually have an opportunity to trade up because we have a very aspirational customer. That aspirational customer may only have a certain amount of disposable spend that they want to spend on brands. And when they come to an outlet center, it's always going to be the best price every day on the brands they want. So they can trade up to a Ralph Lauren, trade up to a Lululemon, trade up to a Michael Kors, a Coach, a Kate Spade, which we have on sale every day in our centers.
Are they doing that as much right now?
Well, we see that happening. In fact, the accessories and the dress for work categories, which are some of the more fashion-oriented brands, those are the ones that, at least in the last quarter, and that momentum is carrying on, post-Christmas and into January, with some of the dress to work and more dressier and accessory type brands. So we're seeing great momentum in those categories.
And just wondering, you mentioned some of these trends that you're following here. What else are you seeing in terms of the shift of consumer habits as people finally reorient to a post-pandemic kind of hybrid, sometimes going to the office, sometimes staying at home, as it would have it, that kind of environment?
Well, first of all, our outlet centers, like I said, regardless of geography, a lot of the centers that we've built are in places like Myrtle Beach, South Carolina, Hilton Head, Daytona Beach. These markets are markets where folks have second homes, and now in this flexible work environment, people are staying in those geographies a little bit longer. So we're seeing those shoppers come and visit us more frequently. When they do, they're looking for a much different experience when they get there. So as I mentioned earlier, instead of just that power shopping experience that was the outlet shopping of 10 or so more years ago, now they're looking for a much more elevated experience when they're there. So we've added a number of restaurants and like I said, Dave & Buster's, so that when that carload of people come and visit our shopping centers, there's more for the consumer to do than just shop. There's other amenities, and like I said, it keeps them there longer. The longer they stay on property, ultimately they'll build bigger baskets and spend more money.
Cool. I have a couple questions for you. We were just showing your occupancy levels, which are enviable compared to the traditional mall business, I think. Tell us about that, why that is.
Yeah. During COVID, we lost about 1 million square feet. And with that, we lost a number of legacy retailers that were in pretty much all the outlet centers for years and years. And, frankly, it was time for those retailers to, sort of bow out of that business. We've since replaced them with those other categories that I was talking about, whether it's food and beverage and entertainment uses. But there's also a whole handful of new retailers that are entering into the outlet space, predominantly the direct-to-consumer brands and home furnishing brands. So we're seeing more Restoration Hardware, Design Within Reach, Crate and Barrel open up in the outlet space, in the outlet category, meaning that they're selling Second, goods that have been returned, goods that the manufacturer. So we've seen in the past, I would say, 1 or 2 earnings cycles that a lot of the retailer brands, the larger brands that have positions in our shopping centers, have reported that they'll be using the outlet channel to clear a lot of their excess inventory so that they can keep their full price channels a little bit cleaner. That definitely benefits us. The more inventory in the stores, the more promotional they are, the more I can draw a bigger catchment of customer to come and shop in our shopping center. That's really what it's all about. Everyday value pricing in our centers, that's what the customer wants. That's what they aspire to. When you bring an aspirational customer into an environment where they can buy brands that they've always wanted to see, that they always saw themselves purchasing at a price that they can afford, it could convert them into a customer with that brand for life. And that's also a strategy of a lot of our retailer partners.
Yeah, we're really excited about the chicken sandwich, and we've seen that sandwich mix in those high single digits through the fourth quarter. And something we're excited about because that's one of multiple growth levers that we activated in 2022, which resulted in our 19th consecutive year of same-store sales growth. But a little bit different than most brands, we actually experienced a deflationary environment in 2022 and didn't have to take price. And so as we navigated through the end of the year, the fourth quarter, we had an 8.7% same-store sales growth, which was driven 100% by transaction growth. And a lot of those were chicken sandwiches. It's a difficult environment for anyone to navigate, and there's a lot of uncertainty that remains through the back half of this year in particular. But as we look at Wingstop, our unique growth levers that we're activating against that are actually allowing us to bring a lot of new guests into the brand. And then in addition to that, we've demonstrated a proven value playbook that we think positions us a little bit differently than others and gives us confidence in our ability to deliver on that midterm outlook of mid-single digit same-store sales growth. Yeah, there's been some different issues that impact the egg-laying birds, which you're seeing show up in the grocery stores and translate to meaningful inflation there. But when it comes to the birds that serve the food service industry or a restaurant like Wingstop, there's a lot of supply. And they struggled with labor in those poultry facilities through the pandemic, and they've now returned to regular staffing levels and production's up. And so it's led to a favorable environment for poultry in general, but particularly for wings, which I think for Wingstop led to a really exciting year in 2022 with record deflation. And I think that really supported our record development year of opening 228 net new restaurants in 2022.
And so, Michael, so the avian flu, for example, that really seemed to have decimated the egg-laying chickens didn't affect the eating chickens so much?
That's right. That's right. You haven't seen that really impact any of those farms or grow houses, which is a good thing for Wingstop, obviously.
And you just talked about adding new units. I believe you said 228 for 2022. What are you looking for this year, and what kind of thought process went into the guidance that you're providing for this key metric?
Yeah, we have a significant amount of demand for growth with our brand partners or our franchisees. And we had a record year in 2022, but we completely replenished our pipeline of restaurant commitments going into 2023. And yesterday we guided to an expectation of this year of approximately 240 restaurants, which will make for another record year for Wingstop. Yeah, you mentioned Hot Honey, and that was one of our flavor LTOs that actually performed really well. It engaged with guests. They really like to come to Wingstop for that unique flavor experience that only Wingstop can offer. And so we actually do have a flavor pantry that is stocked, and we're excited to bring out some additional flavors in 2023. But just recently, we brought back Hot Honey because the consumers were really asking for it, and so we're excited to have that return for a limited time.
Yeah, so I think we're certainly accelerating at full speed ahead on all fronts, and I would just say for this year, I mean we've sort of announced this sort of flurry of news, and from showing that we can holistically execute while at the same time showing different sort of paths for additional growth, and everything from mentioning from kind of the new product for Iris Plus that has even longer range of capability, high performance, and is now actually the product that will be shipped as part of this multi-billion-dollar Mercedes-Benz contract and plan that we have with them for their vehicle lineups. And at the same time, it's really all about scale. So we're focused on getting this high volume automated factory that we have in Mexico online. That's actually, we're doing that ahead of guidance now for Q2, and then focus on the validation for that throughout the rest of the year. And then among other things there too, we're making it happen, announced a handful of new partnerships too to be able to accelerate that growth. Yeah, I mean, I think you're seeing some huge regulatory tailwinds here too from a push more generally for safer vehicles. And I think this has never been exemplified more when it comes down to it. So I think, it's interesting is that, from a regulatory standpoint, it could actually be like a barrier when you're trying to be able to replace drivers on cars. But that's never been our vision. Our vision and plan has always been to enhance drivers, not replace drivers. And that's exactly what the automakers that are working with are doing and leveraging our technology for. So, when they're scaling it, I think that, part of the long-term vision for what we have is, we have this 100-year vision to be able to have the opportunity to save as many as 100 million lives and 100 trillion hours out on the road over the next 100 years. And saving lives is what it's all about and can also make massive amounts of money. So I think, it actually ends up working in our favor.
Austin, you talked a moment ago about accelerating sales growth, right? And I'm looking at one estimate for your price to sales ratio at 73, which seems high. The stock has bounced about 70% this year after falling 40% over the last year. Like, when can investors expect, most investors don't have that 100-year plan, right, to make driving safer. When do you expect to see more of an exponential acceleration in that revenue growth?
Yeah, literally starting this year. I mean, we're talking about breakneck triple-digit growth, that we're giving guidance for the next several years. And when it comes down to it, I think the relevant side of this here is this is not a traditional kind of business there too, where quarterly or even annual revenue is relevant at this stage. People are generally makes much more sense to be able to look at, for example, a highly credible, forward-looking order book where that revenue can be realized, from that over the course of, this decade and beyond. And for example, we showed how we had, over 60% growth in that, and even from a conservative standpoint, that was at around 3.4 billion. So I think we're actually, that's around what probably the valuation. It's probably like less than 1x order book or something. So from that perspective, I guess it's all about perspective. But basically, we're showing that that from what we have today, there's a very, very clear trajectory, even just using 75% of awarded business that we already have today, where you can have $1 billion in revenue at a run rate by 2026, 2027, or at least $1 billion, or I'd say 1 million vehicles per year, translating to $1 billion in terms of run rate. So it's cool to be able to see, and then basically by 2030, you're talking around 5 billion vehicles per year, or a 5 billion run rate, with the opportunity for a 60 billion forward-looking order book. So the thing with the auto industry is it's like a flywheel with this. Once you get designed in, these are long-term arrangements. I mean, we're talking about like 15 years in total of how you build and accelerate, these programs and platforms with automakers and what you have to support it for. So it's getting very real, very fast. But the key is just about execution. We have everything set up for the greatest possible success and, just orders of magnitude growth. But we just got to make that happen.
At what quarter this year do you see that translating into profitability?
Yeah, so actually that was part of what we were talking about. So we for the first time, we're sort of unveiling this path towards profitability and showing that we're going to do this not just in the long term, but actually in the plan is to do this in the nearer term as well. So we're able to show that we actually, as soon as next year, on a run rate basis, by the end of the year, can be profitable for our core business. So this would certainly be a first, for the, autonomous vehicle space and revenue generated from that, of course, generally. So, it's good to be able to push the bounds of that and be able to actually show what's possible, by all means, from that perspective, and getting cash flow positive for that. And then for the following year, and on a run rate basis, we have the opportunity to make it the business as a whole profitable.
C3.ai is a computer software company, and we spent over a decade and about $1.5 billion building a software stack that allows us to take enterprise applications like ERP, manufacturing, supply chain, CRM, AML, what have you, and make them use predictive analytics to make them predictive in nature, to tell us not what our inventory levels were, but what our inventory levels need to be, not what our customer churn was, but which customers are going to leave us. not what our what the number of anti-money laundering events were, but we can stop AML in real time. So we're typically serving, say, Fortune 1000 accounts, Shell, Koch Industries, United States Air Force, what have you, with very large-scale predictive analytics applications, applying AI to the enterprise to allow organizations to deliver products at lower cost with lower environmental impact into the hands of more satisfied customers.
Perhaps for our own edification and perhaps some of that of our viewers, what then is the difference then between the predictive analytics AI applications that are currently already available to your customers and some of the more new generative AI conversation that we've seen in the kind of language learning models that seem to be really coming into the fray?
Great question, Brad. So what we've done in the last 13 years, we've built 42 turnkey enterprise applications for oil and gas, utilities, aerospace, defense, manufacturing, banking, what have you, that we use to serve some of the largest customers in the world. Now, with the advent of generative AI, this represents a very interesting opportunity. We've been working with this since about 2020, and we have an architecture that allows us to take advantage of these innovations. And this generative AI, it's difficult to overestimate the impact of this. Now, we're not using it for chat, okay? We're using it for a fundamental different purpose. We're combining enterprise search, think the Google user interface, with natural language processing, generative AI, and reinforcement learning to fundamentally change the nature of the human-computer interface for enterprise applications. So rather than look like these complex things with lots of menu structures and that kind of mind-numbingly complex supply chain applications, the user interface is just the Google search bar for HR, for manufacturing, for whatever it might be. And it's available on our website for anybody who wants to see it. There's a demo of the product. It's quite innovative. We've filed patents on the technology, I think 21 countries, but it's not, most people think about chat. This is not about chat.
Right, not about chat in this type of application. And yet, when you noted a dramatic change in business sentiment when you were talking around your earnings, does it have to do with the enthusiasm around ChatGPT and then the sparking of interest that has created? Or is it that the fundamental backdrop for the businesses you serve has been improving?
I think there's two things. Great question, Julie. I think there's two things that happen simultaneously. One, last summer in July and August, we just saw a significant downturn, in buying behavior in Fortune 1000 accounts. Everybody was hunkering down, preparing for a recession. They were scared. They were cutting costs. And, we called that pretty early. And since then, we've seen a massive tech recession with all the layoffs and what have you. And that affected us. Now, we're seeing in the market at large, something fundamentally has changed in terms of the people who are running these organizations are optimistic. They're moving forward. At the same time, there's been a realization that these organizations can use enterprise AI to fundamentally lower costs, serve customers better, deliver their ESG objectives, and deliver products with lower environmental impact into the hands of more satisfied customers. And this generative AI definitely accelerated the interest in AI. So AI now is at a peak, and that seems to work very well for C3 AI because I think we're the largest application player in that space. So I think in the coming year, we'll see a dramatic acceleration. Understand about 2 quarters ago, Julie, we changed our pricing model from a subscription-based pricing model where an initial contract might be 10, 20, 30, 40, $50 million, to a consumption-based pricing model where an initial contract is you just take the application, you install it, and you pay 55 cents per vCPU hour to operate it. So it's much easier to buy. Our pipeline of applications of opportunities has increased dramatically. Now, the short-term effect of that puts downward pressure on revenue. The medium and long-term effect of that is something of a hockey stick in revenue, and we expect to see that kick in sometime in the next fiscal year.
Tom, you've been in the industry and executive at a tech company in one capacity or another, and especially given C3 AI's advancements, you've seen how this industry has changed. You've seen how management styles have changed as well, and it's almost being kind of hypersped into this next era when you've got CEOs like Mark Benioff, CEOs like Elon Musk even, who are far different than the tradition of what we've seen in the past. Do you believe that CEOs right now in the tech industry are looking at people like Elon Musk and saying that, that's something or a management style that we should be unleashing within ourselves?
I think Elon Musk serves as a role model, for a lot of CEOs. And he's enormously independent, enormously politically incorrect, and it's a little bit refreshing. So it's and very entertaining. He's obviously a very talented guy and a great genius, and he's accomplishing a lot.
Maybe some others couldn't tread that politically incorrect thing quite as, I don't know if I would say successfully, but without consequence, shall we say, as he has. Tom, finally, I want to zero in on the AI industry a little bit more, too. Surely you're aware of what your stock has done this year, but also like anything else having anything to do with AI, right? Whether it's in the name, whether somebody drops the term in a press release, stocks have gone crazy. As Brad mentioned, you've been around for a while in this industry. You've seen other shakeouts, right? What do you think the AI shakeout, if you think there's going to be one, is going to look like?
The analogs would be the Ethernet, the internet, client-server computing, the personal computing, the smartphone. AI is this is soon will be a $600 billion addressable software market. Excuse me. Everyone will be using enterprise AI applications, just like they use PCs, just like they use relational databases, just like they use CRM. When we started at Oracle, there was no market for relational database systems, and we established a market leadership position there. When we started Siebel Systems, there was no market for CRM. We created that market. Today, it's a $120 billion business. So we established and maintained market leadership positions in both of those markets. The game we're playing at C3 AI is see if we can establish and maintain a market leadership position in what will be globally, in what will be a $600 billion addressable market. Now, I think there's some probability we will attain that. Worst case is we might be in second place, in which case it's still a pretty good company.
Yes, demand is uneven now, although it's more specifically accentuated in the compute space, because as we said yesterday, in the intelligent edge, in HPC and AI, and in the storage business has been solid and constant. However, on the compute side, obviously we see elongated sell cycles and digestion of what customers bought last year. But all in all, we feel pretty good about our performance, which was record-setting in Q1, and the guidance we gave, which is based on our winning strategy, a 2x order book when we exit Q1, and the fact that we have amazing innovation that we continue to sell to our customers to meet them where they need it.
When you look at the growth rates in your business, Antonio, from around the world, are you seeing any differences? Is the U.S. outperforming? Is Europe outperforming? How do you see it?
It's quite interesting. Actually, it's fairly level, I will say, Brian. I think, I was in Europe last week. I did a tour in the northern region. And the partners and customers I met, they all said very clearly that IT continues to be a top priority for their spend. I was actually fairly surprised about that. But they all realize that now, with the data explosion that we see, the need to deploy AI everywhere, the need to modernize and deploy that cloud experience everywhere across the hybrid IT estate is actually continuing to be a top priority. Now, within that spend, they continue to make shifts. And one of the areas where they spend quite a bit of time is driving resiliency, because obviously it's a key component of what we see today in this uneven macroeconomic environment.
We earlier on on our network, Antonio, we were speaking to a tech veteran, Tom Siebel, over at C3 AI, and he's dropping all sorts of he seemed very excited about the AI in his business. Now, you talked a lot about AI in your business. Is this just all hype? Is this a real thing here?
Well, actually, I concur with Tom. Tom and I actually were having a dinner together when we were in Davos. And I believe he's right. AI has the potential to disrupt every industry, and we are excited as him. Now, for us, it's quite interesting because for a generational change, as we think about these type of technologies like web, mobile, and others, this inflection point actually comes to our space because we have unique innovation. We have the best innovation when it comes to AI at scale, supercomputing power. And when we think about the generative type of language models we're talking about these days, they all need supercompute capacity. And HPE is the market leader when it comes down to supercomputing capacity and doing it in a sustainable way. One of the reasons why I went to Europe is because I wanted to talk to customers about their view of AI and then how they want to consume it. And we have an amazing pipeline that actually allows us to think about offering a cloud supercomputing that they can consume as a service. So very exciting for us, and there is opportunity to partner along the way.
Thanks for that invite to that dinner, Antonio. I was in Davos. I saw you there. I wouldn't mind catching some food with you guys and hearing about about AI. But dig deeper here for us, because a lot of investors I have a lot of AI conversations coming at them. They're confused. So when you say you power, or your offerings will power some of this AI, what do you mean by that? And what do you see in terms of order trends as you look forward because of it?
Well, I think, we need to differentiate the AI models, right? So AI is a broad term, right? So we think about machine learning operations as an example of that. To me, that's more inference and ability to process data at the edge. Then, when I think about AI at scale with large simulation and models, like, finding cures for diseases, designing the next, turbo engine and the like, and even applications like chatbot GPT, you need models that are very, very accurate, that constantly train and retrain themselves. But one aspect you have to address is the ability to prepare that data, to automate data pipelines, so developers can run those models at massive scale. And we as a company have a unique set of innovation that allows us to run this model at massive scale. Let me give you an example. With the Frontier system we deploy at the National Laboratory at the Oak Ridge Lab, we actually can run quintillion transactions per second. And you think about what that can do to models like ChatGPT, that can change the game. But also the fact that you're doing with 35% less energy. So we have to think about this in very radical ways. And HPE has unique innovation in the interconnect fabric and the ability to chain massive amount of computational power. In fact, the Frontier system is like 40,000 GPUs. So we believe we are very well positioned, but our goal is to offer an infrastructure as a service for supercomputing. So it's a supercomputer that runs on the cloud, and a PaaS layer, a platform as a service layer, to eliminate those very tedious type of work, including the data pipeline automation.
Antonio, all that sounds like a huge opportunity for you and your company. I look at the valuation on the stock, about 7.5 times forward earnings, 2 times order book. What's the street missing here, and why do you think they don't necessarily value you at the same level as some of these AI plays?
Yeah, I said many times, and I said at Davos, we continue to be, undervalued by the composition of our portfolio and the progress we have made. Listen, in Q1, we established a record-setting performance. It was the highest revenue since 2016. We delivered the best ever operating profit at 11.8%, and we achieved the highest ever EPS of 63 cents, which obviously was well above our guidance that we provided a quarter ago. Combine that with our winning strategy across edge to cloud, and the fact that we have amazing innovation, both organic and inorganically, right? We acquired 4 companies. We actually have the confidence to continue to win and raise the outlook for the revenue and the EPS. In fact, the new revenue outlook we provide is 2x the original outlook. I think the street sometimes get fixated on compute, honestly. Compute today is now actually coming down as a percentage of the total revenue. It's only 44% from the high 50s. And you need to look at the intelligent edge. The intelligent edge business, we talk about that as being the rule of 40, 20% growth, 20% profit. We deliver 31% year-over-year growth with more than 20% profit. AI again grew 37% this quarter, and storage was very solid with 10%. And we continue to manage that compute business with best-in-class profitability. In fact, we delivered 17.6% operating profit, which is even higher than some of our competitors have with a combined total enterprise business. So I think people need to digest that a little bit in the last 2 days with a lot of news. But I believe we are positioned for success. And remember HP GreenLake. It is a platform, it's the cloud platform. We deliver all these experiences. And that business today, in less than 2 years, we doubled the total contract value now up to $10 billion. And that revenue will unwind over the next 3 to 5 years.
This is such an exciting day. You know, first, Siemens in the USA this is Siemens' largest market. And we are so proud to have invested over $3 billion in the US over the last 4 years. So this is a continuation of our commitment to the US market. And what you're seeing here is the establishment of an East Coast rolling stock rail manufacturing location. We'll be beginning with passenger trains and looking forward to all of the growth that's ahead.
And this really does give us sort of a bit of a preview as to the future of railcar manufacturing. Talk about what that looks like versus what's currently on the market or the industry standard today.
Well, you know that the future is more electric and connected. We know that we need to be driving to all kinds of clean forms of power. So the rail cars that Siemens manufactures today, many of them have their own built-in power, some of it battery. We're moving toward hydrogen as well. And so we can expect to see the introduction of those new technologies, not only with Amtrak, but also with other transit systems. I'll tell you what, Rochelle, though, the thing I'm most excited about is the potential for a future of high-speed rail in the US.
And certainly when you look around the world and you see how far some of those advancements have come, you know, it's good to see now the US taking a stronger lead here. I do want to ask you, because it's not just investing in rail infrastructure, it's also an investment in the community. This is going to come with about 500 jobs created through 2028. Talk about that investment in the community and what this means when we really think of what American infrastructure is now versus when we traditionally think of what roads and bridges and things like that.
That's right. Yeah, and this is where Siemens is focused, with this combination of the real and the digital world. We combine the two, and we're bringing technology into the infrastructure that's all around us. Think of us as an industrial technology company, but you know what? The technology is only as powerful as the people behind it. So this selection of Lexington, North Carolina had a lot to do with the community itself. The people who are here, the educational system that's all around us, the power of the community college system in North Carolina are all factors in choosing Lexington as the home of our new rail facility. You know, making the jobs of the future available to communities such as this that had been hard hit when textiles and furniture manufacturing moved overseas. Now, with investments by customers in the rail industry, we're able to bring jobs here that are going to be the leading jobs of the next century.
So talk about some of the investments that you're making, because at the moment we're seeing a lot of companies pulling back on investing in partnerships. But over the past few years, especially over the past 4 years, Siemens has instead really stepped up those partnerships and investments. What are you prioritizing at the moment?
Yeah, and I'll tell you why we're investing right now. It is because we have a real transformation going on. We know that for years we've been needing to invest in the nation's infrastructure. And so with the passage of the bipartisan infrastructure law, now we have the down payment from the federal government being augmented by the investment of private companies and state and local communities who are all rebuilding the infrastructure that they need. So what we've focused on at Siemens really is, if you look across the board, you'll see this focus on transportation with mobility in passenger rail, light rail, as I say, hopefully the future of high-speed rail. But you'll also see us in cities working on connected buildings, working at the grid's edge, bringing the software power of microgrids to help transform the two-way flow of electricity, unlike anything that's ever been possible before. And look for us in this resurgence of manufacturing, because as more manufacturing is brought back to the United States, then we have the ability to set up new greenfield manufacturing locations. All of those can be set up using the latest tools. The digitalization of manufacturing makes a huge difference.
And we know that the future of U.S. infrastructure, especially front and center, we have Norfolk Southern CEO testifying in front of the Senate this week on Thursday, especially after these unfortunate incidents that have not just had an impact on the rail services, but also the environmental impacts as well. Talk about how that incident has really affected the conversations that you're having in your community.
Well, first of all, safety is a top priority across this entire industry. And our voice, the way we're using our voice in the discussion today, is to help people understand the power of technology to help us in the analysis and risk avoidance. I just heard a story today from one of our rail leaders who shared the news of a locomotive that badly needed maintenance, and the driver hadn't seen the need for it, but there's a command center where, because we have the digital sensors on the train, the remote notification was possible. It's this kind of use of technology that we believe will be part of the solutions to ensuring the optimal safety of our rail systems.
Barbara, obviously, with a lot of this advanced manufacturing that's needed for this also requires an advanced manufacturing workforce as well to be able to sustain it. What are you seeing in terms of the skills gap or perhaps any hiring issues that you're noticing in really trying to build the infrastructure of the future?
Well, we know that everyone is looking for good, strong workforce, new folks to bring into the workforce. And so what we've been doing at Siemens is investing in particularly what we've been thinking of as the middle skills, those jobs that require more than a high school diploma, but perhaps don't require a full 4-year degree. And using our experience as a German company with our knowledge of how apprenticeships work, we've been bringing that kind of earn while you work, earn while you learn kind of approach to the workforce development in the United States. And we're seeing fantastic progress as states begin to develop high school apprenticeships. So bringing young people into the workforce as early as possible, and then actually bringing people in from the sidelines, offering special training programs for veterans who might really thrive in the kind of environment we're in. Overall, the most exciting thing I see happening is the application of our digital tools. We've just demonstrated here in Lexington how we'll be bringing a virtual training program for welders. And what we've learned is that using these virtual tools, it's safer, and we can train people 6 times faster than is possible in the old-fashioned way of actually putting arc welders to steel. So just with the imaginative use of technology and reaching out to communities who perhaps don't even know that these great jobs exist, we're making real inroads.
And Barbara, I mean, you're a prime example, especially in an industry where you don't really get to see a lot of women in leadership positions. So I want to talk to you just about that sort of that rise through the ranks. And as you have that pipeline of young people coming through and looking at Siemens as an example, what is really the legacy that you'd like to leave right now?
What I hope to leave is a legacy in which our industrial technology company is one where anyone can feel like they belong, because belonging is what really transforms. Every stage along my career, I found myself in rooms of people who looked very different than I did. But I always felt like I belonged because I was dedicated to the mission, they were dedicated to the mission. We're a company that works on technology with purpose. And I know it's just like a giant magnet for talent. People want to be engaged in building a cleaner, more sustainable future, a more equitable future. And if I'm successful in my role, there's going to be a seat at the table for anyone who wants it.
We were certainly really appreciative of the opportunity to have this case heard by the DC Circuit Court of Appeals. Walking out of the courtroom, I would say we all felt very encouraged by how oral arguments transpired. And I think that's really a function of the legal team we have in place. We've put together the best-in-class legal team, and we've been consistent. The arguments that we've outlined why GBTC should be an ETF was the same when we filed our application, was the same when we had to litigate and file our briefs with the SEC, and they were the same earlier this week when we had oral arguments. And I think that consistency really works in our favor, and I think the market reaction is similar. Investors and folks are telling us anecdotally that they appreciated the oral arguments, and they're hopeful that the court will, side in our favor.
Yeah, GBTC rising in the wake of the hearing. You've talked about a timeline if you do get positive approval, which can take some months. Maybe even as soon as fall, we could see that ruling and a conversion. How quickly can a conversion happen if it goes in your favor?
Well, so what we've been guided by counsel is that we should expect a decision out of the DC Circuit by this fall. What transpires from there in terms of proactively working with the SEC on a conversion will obviously be something that we'll need to work out with them when that time comes.
One of the things that you were questioned about yesterday is the possibility. Right now, the SEC allows Bitcoin futures ETFs, but not a spot ETF. And the judges really talked about the sort of dichotomy or the questioning around that. On the flip side, the Securities and Exchange Commission, which has approved those products, in theory, could at some point rescind approvals, not just for the ETFs, but for Bitcoin futures, for whatever reason. What then would that do? What would be the cascading effect for you if that were the case?
I'm not aware of precedent where we've had, a year plus and billions of dollars of capital in investment products that are trading every single day and seen the SEC rescind those types of approvals, right? We don't have just one Bitcoin futures-based ETF here in the US. I think we have 3, maybe even 4 of them.
And some in Canada too, I believe.
Some in Canada, some in other jurisdictions as well. And so that, again, is really the bedrock of the case that we have. These are two markets that are inextricably linked. Bitcoin futures is a derivative of the Bitcoin spot market. So if the SEC got comfortable with Bitcoin futures as the underlying asset for a Bitcoin futures ETF, well, then they ultimately really also got themselves comfortable with the underlying spot market as well. And that's why GBTC should convert, as well as giving investors greater protections, right? That's the big takeaway from oral arguments and what we've been hearing from investors. This is the chance to take the world's largest Bitcoin fund, built in the U.S., raised in, under U.S. rules and regulations, and to bring it closer into the regulatory perimeter. That's an opportunity that, as a regulator who's meant to protect investors, should be seizing.
Why is it so important? Forget about the regulatory perspective for a moment. Why do you think it's so important for investors to have the trust be converted to an ETF?
Well, certainly today, the trust, trades at premiums and discounts. It doesn't have that embedded arbitrage mechanism. And so GBTC today, could be at a 40% discount to its actual net asset value, to the discount of the Bitcoin that it actually holds. And so in an ETF format, investors trading in GBTC, whether it's short-term, long-term, holding it for a very long time, investors will be in an instrument that effectively tracks the price of the underlying Bitcoin it holds. And we've seen now in the US, I think there's over 2,000 ETFs. This is a tried and true wrapper that will give greater protections, greater transparency, and all of that also comes with sitting on a national securities exchange, which in our case is the NYSE ARCA.
You could also argue an ETF is easier and more liquid to trade, right? Just sort of ETFs by definition is not a closed-end fund. And you can also redeem your funds. And this is something you've been hearing from investors as of late, some of whom want to more easily redeem their funds. There is a sort of a loophole, if you will, called Regulation M. Mm-hmm. You guys could, in theory, go under Regulation M and allow some of your investors to redeem those funds. Why not? Why not go that route? Why not even go that route simultaneously while you're still trying to get ETF approval?
Well, so Reg M is a separate and distinct set of rules than things like tender offer rules, right? So Reg M is something that is granted, or actually relief from Reg M is granted to ETF applicants. So the lawsuit itself is actually at its core asking for Reg M relief, the ability to simultaneously create and redeem shares of the fund, which will allow it to track the underlying value of the Bitcoin that it holds. Earlier in our life cycle, Grayscale did have a redemption program for GBTC way before it even went to the public markets as GBTC, and it was deemed to be in violation of Reg M. So since that time, we haven't operated a redemption program. We got a cease and desist from the SEC back then and haven't been able to operate a redemption program. So
have you tried to do it in other ways, in talks with the SEC? Or
Well, so-
did you just sort of say, okay, once you got the cease and desist, we're not going to try and do that again?
Well, under the cease and desist, we can operate a redemption program. So what we've really been focusing on is offering public market liquidity for GBTC on the secondary market. It's become one of the most liquid securities on the OTC market here in the US, and was really a pioneering move on our part to be able to take a private fund and bring it out into the public market, which has really opened the opportunity of investing in Bitcoin to a very wide audience.
One of the specific examples of an investor who is asking for a redemption is FTX, or I should say now the administrator in bankruptcy of FTX, who wants to redeem some of the funds. Is there any way to do that under the existing framework?
So I think the complaint you're referring to is actually coming out of Alameda, right? So Alameda is the now defunct hedge fund arm of Sam Bankman-Fried's FTX empire. So if we look at Alameda, they're not a US-based business. They're not under US regulations. And that's really in sharp contrast to a business like Grayscale or Grayscale Products, built in the US under US rules and regs. Alameda now, obviously we all know, we've talked about this, a lot of fraud, a lot of things that transpired that have forced those companies into Chapter 11. And so under the new leadership at Alameda, from a fiduciary standpoint, they're wanting to try and recoup assets wherever they possibly can. And we don't fault them for doing so, but they're quite misguided with this complaint. It completely flies in the face of what we're doing with GBTC. Converting it to a Bitcoin ETF is the best long-term product structure, and also, more importantly, the product structure that's going to actually unlock the most value for investors, which includes Alameda.
But they're not long-term holders. The job of John J. Ray is to retrieve as many of the assets as possible, right? So you're referring to an investment case, which is not really necessarily relevant to what they're seeking, right?
Well, I think it's fair to say that, the newly appointed management at Alameda is inheriting a series of investment decisions that were made prior to them. So actually being able to speak to the intent of their timeline or however it was that they made those investments would be really tough to do.
We saw the brand continue to evolve. We are launching the movie this year on July 21st. It's going to be a great event. We believe it has all that it takes to make it a societal event, a cultural event, and it is part of our transformation to continue to grow our IP-driven toy business and expand our entertainment offering. The Barbie movie has some incredible innovation. It's directed by Greta Gerwig, but an incredible cast led by Margot Robbie and Ryan Gosling and Will Ferrell, as well as some incredible actors that will support it. And we expect Barbie to continue to grow. We just launched yesterday another collection of STEM career Barbies led by the Wozicki sisters. And we couldn't be more excited about Barbie's long-term growth prospects.
Look, Adnan, I'm 40 years old. I don't know much about dolls, but they look to me like what they're changing. They reflect more of the society at large. Has that been a focus of you? I know what the dolls you just mentioned, to me, those are fearless women in business. Is that right?
Exactly. Our brands are all led by a very clear purpose and cultural relevance. Barbie reflects the world as children see it. Barbie's purpose is to inspire the limitless potential in every girl. And the journey has been very distinct. More than half of the Barbies we sell are diverse, not the original white skin and blonde hair Barbie that we used to know. So Barbie very much is about diversity, inclusivity, and empowering girls to reach their limitless potential.
At the Investor Day night, there was a lot of talk about this year being the year of dolls. I'm holding up two here, one from Anna from Frozen and one from Snow White from Disney Princess. And this is all part of your efforts to just build out the portfolio of dolls. How much do these brands or brands like this, how much will they bring in sales this year?
Well, we are expanding our dolls portfolio, and Disney Princess and Frozen is a very important part of that strategy. We have some incredible product of Disney Princess and Frozen, and it will continue to be a key focus for our company. It is one of our core strengths. Dolls, vehicles, and infant, toddler, and preschool are the three categories where we are a global leader. And we continue to expand and innovate our product offering. This will be yet another demonstration of our innovation and capabilities when it comes to the dolls category, and it will be an important year for us in this area.
We've closely been following on your efforts to focus more on content. Can you give us an update on that this year?
Sure. We own one of the strongest portfolios of children and family entertainment franchises in the world. And that gives us significant opportunities to expand and grow our business and have multiple touch points with consumers. And content is an important part of it. We talked a little bit about our movie strategy. Barbie is our first movie. There are 14 other pictures that we are now developing that we already announced. And on the television side, we also see incredible progress with a lot of innovation. We are launching 12 series and specials in 2023. It will have some really exciting offering. We just announced recently the new Hot Wheels show that will launch on NBC later this year. It's a show that will be about a car makeover competition, and it's called Hot Wheels Ultimate Challenge, and it will be another representation of more innovation for Mattel. There will be additional content of Barbie on Netflix. And of course, we also announced recently the launch of Barney that will relaunch in 2024, but it will be supported and accompanied by great content, both on television and film that we're now developing for future fans.
And we'll take this offline, but Barney was a hot topic for me back in school. Well, but we'll leave it there. I don't want to get too much into my childhood, but you are fresh off of earnings, of course, too. How much of the inventory overhang in retail from a toy perspective is left out there, and when does that get cleared?
Yeah, we did talk about elevated inventory that we have entering 2023. It will impact us primarily in the first half, but we expect that to clear over the year, and we do look to see positive increase in consumer demand for 2023. We are working through elevated inventory, but even with the continued macro uncertainty, we are confident about our strategy and plans for the year. There will be several exciting launches and initiatives that we'll bring to the market. We talked about Disney Princess and Frozen for the year. We are also very excited about the global rollout of Monster High, and of course, the Barbie movie in July, which will stimulate more demand. We continue to execute our multi-year strategy. We have a very balanced portfolio. Our category structure is working very well. We're seeing product in demand, although it's still early to tell. We're off to a good start in the year. And there's a lot of cross-category innovation in all of our portfolio. Beyond 23, we believe our strategy will continue to drive top and bottom line growth, and we aim to outpace the toy industry and gain market share.
Well, this has been a strange weekend in markets. Now there's concerns about rates going even higher. That has impacted the stock market. Consumers are starting to get jittery. How concerned are you about where the economy is at this point?
Well, we continue to monitor the economy. We do expect to see impact on consumer demand, although we still believe the industry will be flat to slightly up. The toy industry has demonstrated its resilience over time, and we expect it will continue to grow over time. Within that, we do expect to grow market share. But it is important to say that we are entering this year with the strongest balance sheet we've had in many, many years. Even in a challenging market and volatile market in 2022, we continue to improve our leverage ratio and strengthen our financial position. And that gives us flexibility and optionality to continue to improve our position and strengthen our competitive standing. We have begun share repurchases for the year after 9 years. And this really tells you how confident we are in our financial strength and opportunities that we see for Mattel to continue to grow and create long-term shareholder value.
Look, it's a very strange market, right? You saw job numbers increase, unemployment increase, labor participation stay the same. So one would say, well, how does that actually happen? If you look at the jobs that were created, we talked about this yesterday about the recruiter index. We saw that 40% of the jobs that recruiters were working on didn't require a college degree. So that would lend itself towards the hospitality jobs, the retail jobs that we're seeing the growth in. And if you look at the numbers in January, the January JOLT numbers, there were 1% fewer hires in January of 23 over 22, and there were 9% fewer quits between January 23 and January 22. So that means that fewer people are quitting, but the same number are getting hired. And again, these are in the millions, right? There were about 3.8 million people quit in January of 23. So 6 million were hired. So people are getting hired, fewer people quitting. That means that there's getting a tighter labor market. Tighter labor market, certainly if you're not having people participate, what we actually think is happening is that you're going back to a time where people had 2 jobs. And this was very common in the non-white skilled labor. You saw a lot of it in the remote working, people having multiple jobs. But this was common, and this came anecdotally from global heads of talent of our clients in the factories. You'd have a person working a shift Monday, Tuesday, Wednesday, 40-hour shift in those 3 days, and working at another factory Thursday, Friday, Saturday. And they had the double income, 2 jobs to make ends meet. You have inflation going up. You have higher cost of everything, eggs, et cetera. I need more money. Let me go hold down 2 jobs. And that could actually be what's happening now, is people going back to having 2 jobs. And that would make sense if you're seeing a flat labor participation, an increase in unemployment, and yet jobs are still getting created.
That's really interesting, Evan. In this case, right, do you have any kind of color through your site as to what kinds of 2 jobs people might hold? Are we seeing the double job thing move up the income spectrum at all? Talk to me about kind of the details of what you're seeing.
Yeah, so we started tracking the layoffs of industries with a partnership with Revelio Labs. We call it the layoff tracker. And in the layoffs, the percentage of layoffs from December 22 to February 23, obviously IT, about 24% of the layoffs were in IT, but about 22.5% were actually in manufacturing. The other thing we started to look at is job posts. The percentage of job posts changes from over 12-month period, year over year. So you had IT down like 5.7% in terms of job posts from a year ago to now. Transportation and warehousing down 2%, yet retail was up 4%, and healthcare up about 1.5%. So you're seeing, that's looking at the trends. If there are more jobs open in certain sectors, they're going to have more jobs available, more jobs posted now than they did a year ago. And again, I think the challenge that we all have is really extrapolating all this information, right? Because you're seeing companies post multiple jobs for the same role. If you were looking for a nurse for a particular hospital, a particular city, you might actually post that job 4 or 5 times. That city, the neighboring cities, the county, et cetera, yet there's still only 1 job that's open there. So I think there's a real interesting way to look at all this information, and I think it's going to evolve.
And going off of that point of posting a job multiple times, I mean, are these jobs hard to fill? When you're talking about services, hospitality, retail, how hard is it for employers to fill them?
Yeah, so you're certainly seeing that in healthcare. Healthcare has its own challenges. There's credentialing and licensing and background checks and all these other things that sort of happen in the healthcare space that adds complexity there. I think people were having trouble not filling them, but keeping them. There was a much bigger, in 22, a much bigger quit rate. We're still seeing quit rates above where they were in 2019. So we're still seeing a higher quit rate, but that's really the challenge. And I think the segment on right before, talking about retention. And we've been predicting that 23 is a really big conversation around how do you keep employees from leaving. It's so easy to apply for a job. If you think the difference when, 40 years ago, if you applied for a job, you printed up a resume, you mailed in the resume, or you looked at a classified ad, you phoned it in, you went in and out, it was a process. It was a much more elongated process. Today, it's click, 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 click. It's very easy to apply for a job. So companies are being inundated with applications. So that's not really the challenge. So on the one hand, it's a challenge at the top of the funnel, making sure you have qualified folks that align with what you're looking for, but it's also about keeping them. So really reducing this great resignation that started really post-pandemic or in the pandemic, followed by the job hopper economy where people moving around from job to job.
And you also want to get the best person for the position. And apparently you guys are working on using or helping people use ChatGPT to write the posts. So how does it help? How is it helpful?
Yeah, so the first is we announced and launched recruiterclasses.com. So there's a real need for recruiters to always improve their overall skills and improve their ability and their learning ability. And we launched a platform with the first course in it was how to leverage ChatGPT, really just off the shelf ChatGPT, how to leverage it and use it. That's a class that's available. We now have, it's a third-party platform also, so meaning we have third parties writing classes to go into this platform. We just added our next one for big wins for executive recruiting. And so we're going to continue to make tools and make it easier for recruiters to do their job. You know, the challenge today is that companies have laid off lots and lots of recruiters. So many recruiters are being asked to do more with less. And ChatGPT as a technology, we could train people on how to use it to really help them do things like writing job descriptions, et cetera. And you'll see other things that we're working on regarding around the technology. We've always been at the forefront of helping recruiters. We are recruiter.com, a destination site for recruiters and for the companies and individuals looking to seek out recruiters. And so we're going to continue to make investments to really help recruiters do their jobs, better, stronger, and faster.
We're really excited by the results that we had last year. We have really strong brand momentum, an all-time high of searches for Brilliant Earth. We have a fantastic differentiated product and a brand that really means something for the next generation millennial and Gen Z consumer. We also have, I think, a very differentiated omni-channel model. We've been expanding our showroom footprint. We had ended the year with 25 showrooms and expect to launch about 10 or more this year. So a lot of really strong initiatives around jewelry, around showrooms, and around just overall growing our brand awareness.
And emphasizing that pullback on discretionary spending. You guys did have 25% more customers in 2022. So break it down for us. Are consumers turning to perhaps lab-grown diamonds or lower cost options in this sort of environment to perhaps get bigger diamonds for less money?
I think lab-grown diamonds just continue to grow in popularity. We've been selling lab-grown diamonds for over a decade, and so have really been leaders here. I think it really provides a nice assortment for the customer, a nice choice. I think some customers really like that it's mining free, they're affordable, they're beautiful, and they do allow you to get that bigger diamond that you've really had your eye on.
And perhaps in this sort of environment, customers are looking for long-term investments. And so break down for us, what is the difference in resale value of a lab-grown diamond versus a natural diamond?
I think that customers don't really think about this as something they're going to have to sell later. They're buying a diamond for the emotional value. It's a symbol of love and commitment. And so whether it's natural or lab, customers are buying this because of how it makes them feel. And some customers really like in natural that they're buying into something that's romantic. It has, many billion of years of history. And I think lab, gives it a different value proposition. So I don't think it's about resale value. I mean, try selling a diamond anywhere after you purchased it. And I think that, certainly I don't think it's going to have the same value as when you originally ended up buying it.
And can you talk to us about the identification process? Is blockchain being used now? We saw the resurgence in the first place of NFTs a couple years ago. I know that has died down, but just wondering, people are more interested. We now have the technology that's capable of tracking not only real diamonds, but lab-grown diamonds as well. What is the user demand for this?
We've been selling blockchain, actually, blockchain-enabled diamonds for many years now, since 2018. And the value that we see is that it allows you to have a lot more confidence in the journey of a diamond. So, ultimately there's a database that's immutable that continues to be appended by the next chain of custody. And so you have transparency that you just didn't have before. You know exactly what the diamond size was when it was unearthed, what the rough diamond carat weight was. So I think that there's a lot of interest overall from the customer standpoint in terms of the practices, making sure that they're buying something that is consistent with their values, that's sustainable and transparent.
And Brilliant Earth does consider itself a digital-first brand. I want to emphasize that here. But you guys, as you mentioned, did open those showrooms. And so I'm curious, how do appointments then translate to sales? And do people still buy more online or at those showrooms you guys are investing heavily in?
We think the winning model in this space is really about omni-channel. Customers oftentimes start their journeys online, so they'll do a lot of research. This is a new category for them, and this is one of the largest purchases that they're going to make at that point in their life. And then they really like coming into the showroom and being able to touch and feel the product and really working one-on-one with our jewelry specialists. It is a high-touch sale, so making sure that they feel really confident and comfortable in that purchase, and ultimately, walking out with this really beautiful product and shopping together is another, I think, big trend that we're seeing. A lot of couples come in together, and we're able to provide a personalized and curated experience. So we know exactly what they want based on what their digital shopping behaviors are, and then we're able to curate that appointment. So that's what's so unique about our model is, we have so much more information about the customer that makes that customer experience so much better, and ultimately it's going to drive conversion. So when we open a new showroom, we see these amazing economics in terms of lifting the overall metro market. It lifts it over 100%. So it's really great for the customer experience, and it's also great in terms of the bottom line.
Absolutely. We only have about 30 seconds left here. I'm just wondering, in terms of that experience and taking the digital experience and what you've been able to power there into those showrooms as well, and having that same type of profitability and that margin at the end of the day, how do you maintain that even as you do power that new type of experience where a customer is coming in to a brick and mortar capacity?
Well, I think it's just having really a disciplined approach to how you're managing your investments. So every time we're opening a new showroom, we have strict ROI thresholds. And it's about a mix of that customer experience, but also making sure that you're being financially responsible. And that's how we've been able to drive profitability. We exceeded our expectations in Q4, and we're going to continue to have a really keen eye there in terms of providing a premium experience, but also making sure we're driving profitable growth.
I'd say it's a balance. I mean, the consumer has been under pressure for a while, since even last summer when inflation started to go up. And, there's additional current pressures around SNAP benefits being taken away, around, other aspects of what people are seeing in their lives. But on the other hand, sneakers are an affordable luxury, and people make choices. So our customers are choosing this as a category that they want to participate in. But no doubt people are being more choiceful about how they spend their money.
Your stock price has gone through the roof since you joined, Mary. And I think about it as it's the Mary Dillon premium in Foot Locker. Based on the magic you worked at Ulta, does that put more pressure on you you have to deliver on these 2026 targets maybe earlier than 2026?
Well, listen, I'm really lucky. I've got a great team that has embraced me into the industry, into the business, and we're working together to deliver that kind of exciting algorithm as we go forward. And it won't be easy. Like 23 is a reset year. We've been very clear about that. But we're investing in the capabilities that we need to really build the next 50 years of Foot Locker fame, I'll call it. So I'm very excited about that. Well, I've been in the role now almost 7 months. It's gone by so fast because I'm having the time of my life. And what I would say is that I had a lot of hypotheses about opportunities for the company, and they've been very much confirmed in the last several months. So we were talking about our lace-up plan, which is really pointing towards how we're going to drive long-term profitable growth for the company. And it's about simplifying, investing, and growing. And there's 4 different pillars. It's about expanding sneaker culture, which means more sneakers, more occasions, more people in the category. It's about powering up our portfolio. It's about getting closer to the customer through all things digital and becoming a best-in-class omnichannel retailer.
True story. I read every 129 pages in that investor presentation. I read every single one.
Thank you very much.
Of course. Well, I came away with the view that there's a rebranding of Foot Locker going on, better segmentation. Take us through it.
Yes. Well, listen, Foot Locker as a brand has over 50 years of authentic heritage in street basketball and youth culture. I mean, we are the OG in sneakers, and really refocusing on all things sneakers, relaunching the Foot Locker brand, the kids Foot Locker brand, to drive even more top-of-mind awareness, more inclusion for all members of the family. And I'm very excited about that. And a central part will be really highlighting and celebrating the role of our stripers. And those are the folks in our stores who bring the business to life every day, who have the customer connection, but the best thing is they are sneaker experts. So it's a very differentiated part of the Foot Locker brand.
So the Foot Locker brand, sneakerheads, what is the outlook for Champs Sports? How do you reinvigorate that? WSS? Yeah. How do you think about those brands?
Yeah, so I'm proud about the fact that we're just simplifying and focusing on the banners that we believe will drive that long-term growth, as well as differentiating them from each other. So you mentioned, I won't get into all this because I could do an hour on consumer segmentation.
It was 129 slides.
There was a lot,
yeah.
but we have a really great insights about motivations, different motivations that drive sneaker buying behavior, and we're really doing is positioning the banners to best serve those needs. So Foot Locker and Kids Foot Locker really focus on the sneaker maven and the fashion-forward expressionist and active athletes. Champs will be much more focused on the active athlete, and also WSS we talked about. That's a brand new business that was bought a year or so ago, focused on the Hispanic family. And there's so much tremendous opportunity given the demographic growth in the U.S. of Hispanic shoppers and their buying power. And that Atmos, which is our very special, based on all things Japanese culture and sneaker culture, headquartered in Tokyo with about 35 stores that we're going to really, that's the place that we are at the top of the pyramid as it relates to sneaker culture.
Why the 400 store closures?
Pardon me?
The 400 store closures.
We're optimizing that. Listen, we're going to be reducing number of stores, but increasing square footage. We're really stepping back and saying, what's the most powerful way for our portfolio to show up? And that's community stores, which do exceptionally well for us. Those are freestanding, full format stores that really connect into the local community through activation, even celebrating local artists. There's power stores, and what we're doing with those is moving more off mall. So we'll be closing some underperforming stores in some C&D malls and keeping the A and B stores that are doing great and shifting our portfolio over time to be even more off-mall.
Why off-mall? Why is that a focus?
Well, I think I saw that before. Just the trends in shopping. I think in general, shoppers are looking for more convenience. So we're used to being able to buy things online and in store. And sometimes the off-mall kind of shopping centers are just super convenient. But there's plenty of malls that are just incredibly strong as well. I just visited one here today in Las Vegas. And when you're in the right malls and you've got a lot of foot traffic, that's also a great place to be. So for us, it's a balance.
Talk to us about some of the relationships. Let me tick through them. Nike. Now, there's this view, a lot of the analysts that cover Foot Locker, Nike wants to open up its own retail stores. What does that mean for Foot Locker?
Well, listen, our relationship with Nike is revitalized. We're really looking forward to growing in the future. By the end of this year, we'll be in a position where we're growing again with Nike. I've spent a ton of time with the team. I'm wearing Nike Air Max 97 today,
I'm
the Golden
jealous.
Bullet.
I used to have a pair of those.
And like every great brand and company, I think wanting a relationship direct with their customers is really, of course, important. But in addition, what Foot Locker brings to our brand partners is something that's really special and unique. Access to a young and diverse consumer, access to people who want to shop both online and in person. And in fact, what we see is a lot of people want to shop in a multi-brand environment. So there's a role for retail and there's a role for direct-to-consumer, and we just want to participate in both.
So you see there, it sounds like you're saying that there is a coexistence. Nike can open up their retail stores, and you're still going to get their best product.
You know what? We're working with our partners at Nike every day to really build out our future plans. And in fact, we talked about we're going to be celebrating the 25th anniversary of the Air Max, the Tuned Air, I should say. We've got a lot of exciting things coming in basketball, running. So absolutely very excited about the future relationship.
What other brands are surging in your stores that investors may not know about?
Well, I'll tell you what's really hot right now is what we call vintage tech running. So it's a brand like New Balance, really reinventing and bringing back so much demand and heat around interest in wearing New Balance for just comfort and fashion as well as for running. I would say performance running is really on the move as well. Classic basketball, signature basketball. So again, at Foot Locker, I'm excited about, we did a LaMelo Ball tie-in with Puma that was specific, signature for us that did quite well. So all of those categories are really hot, and I would say for me it's about how do we unlock the inner sneakerhead in everybody, because there's various ways that you can build your sneaker wardrobe, which I hope you're starting to do. I used to be only in the active athlete category because I'm a runner, but now I also see that you can expand your entire sneaker wardrobe and find so many occasions to be more comfortable, frankly, and more fashionable.
The Foot Locker customers, they're economically sensitive. I go to my local Foot Locker and there's a lot of kids there. How are you seeing them shop right now? We're talking about a banking crisis. We're talking about inflation still high. Have you seen any pullback in consumers?
Yeah, I'd say it's a balance. I mean, the consumer has been under pressure for a while, since even last summer when inflation started to go up. And, there's additional current pressures around SNAP benefits being taken away, around, other aspects of what people are seeing in their lives. But on the other hand, sneakers are an affordable luxury and people make choices. So our customers are choosing this as a category that they want to participate in, but no doubt people are being more choiceful about how they spend their money.
Your stock price has gone through the roof since you joined, Mary, and I think about it as it's the Mary Dillon premium in Foot Locker. Based on the magic you worked at Ulta, does that put more pressure on you you have to deliver on these 2026 targets maybe earlier than 2026?
Well, listen, I'm really lucky. I've got a great team that has embraced me into the industry, into the business, and we're working together to deliver that kind of exciting algorithm as we go forward. And it won't be easy. Like 23 is a reset year. We've been very clear about that. But we're investing in the capabilities that we need to really build the next 50 years of Foot Locker fame, I'll call it. So I'm very excited about that.
We did do a debt restructuring. One of the items that was hard on was our balance sheet. We needed to sort out to give us the runway. We have restructured the debt by extending it to 2027, reducing our debt on our balance sheet by $1.2 billion, and adding another $1 billion of liquidity. So we have now the runway we need to grow our business and go on the offense versus being on the defense. Our business is, all about flexibility on cost, time, and space. And in this post-pandemic world, all topside occupiers, small businesses, medium businesses, and enterprises are seeking a solution that's complete, that's holistic, that doesn't require any capital investment. So it almost feels as if this moment was created for WeWork as a provider of space. So I think we set up ourselves very well on a balance sheet perspective to get on the offense.
Sandeep, Brian here. Good to see you. And you do mention your shareholder letter out this morning that you do think this is WeWork's moment. To that end, where are you at pulling back on expenses, and when will you hit that adjusted operating profit mark?
So, we've been at adjusted EBITDA positive in December for the first time in the history of this company. We will be adjusted EBITDA positive throughout in 2023. So we've achieved, and revenue continues to climb in 2023. Revenue grew last year, as you know, almost $700 million, or almost 26%. Occupancy grew as well, about 17%. And so effectively, we continue to see revenue growth at a time where we're actually taking demand from traditional occupiers, right? So we control 1% of the market in New York City, and we took 18% of the demand. In London, we control 1.5%. We took 35% of the demand. What that is saying to you is that the occupiers are leaning towards flex space. And so to answer your question, Brian, on expenses, we've been very diligent over the last 3 years since I've been CEO to take out expenses, whether it be right-sizing the organization, streamlining the real estate portfolio, and making sure we're a well-oiled machine. We continue to streamline the company. I would say that it's a process that never actually ends, and it should never end. You should get more efficient over time. But I would say the bulk of the work has been accomplished. For example, we took SG&A, which we've talked about being at the almost $800 million at the end of last year. It's going to be in the low 600s this year. So we're taking cost out there. We streamlined our real estate portfolio, and we continue to do that. The beauty of where we sit is we're a tenant. And when assets become obsolete, there's an oversupply in the market, we're able to adjust the supply and demand characteristic. We don't own the buildings, so we're not handicapped by mortgages. We're not handicapped by lenders, putting restraints on providing rent concessions and tenant allowances. We provide a turnkey solution. So occupiers are seeking certainty in this moment in time, and we're able to provide that certainty to them on an immediate basis.
Does the WeWork model right now, and especially in the profitability benchmarks that it's set for itself, does that
bake in another kind of drastic shift, if there were to be one, on the definition of what the workplace is, given that the pandemic turned that on its head, essentially?
Well, in many ways, it's exactly where we are, right? So in an environment where people want to come in, they want to come in for a purpose. They want to come in for collaboration. They want to be able to take space that's required. They want to be able to have a cost per head that's more reasonable. Look, pre-pandemic, human resource departments could predict 10 years out what the growth of a company would be. And CFOs were okay with taking on real estate to accommodate growth for 10 years. Today, that's an unknown. And so we provide that perfect solution where you provide 12 to 24 months commitment and you can grow with us. I'll give you an example of a company called Procore. Procore was a company that's a software company that does work in the construction field, and they took office with us in Tampa, and all through the pandemic they continued to grow, and they've continued to grow with us. Again, they took space as needed, and we managed their growth as it went on. You have companies that are going into new markets. Boston Consulting Group moved into Nashville. They opened an office at a WeWork. So again, since you don't know what the future is, even more so today, we become the choice, and we allow members to grow with us. Coinbase, took space with us in San Mateo. So these are all different types of clients that we have that are entering new markets or growing in existing markets, or they have a return to work policy starting in April or May, and for them, they need the space to house their employees today. So effectively, this is our moment. And to answer your question, if there is a hiccup of sorts, we don't know what that hiccup could be. But during a slowdown of an economy, flexibility becomes more the name of the game. I could very well see, and we're seeing it today, that clients would give up their large footprints and downsize. And since they don't know how much to downsize, how the future is, they could very well come into a WeWork. And we've seen that with a large search client in California who moved their corporate headquarters into a WeWork. And so we've seen fintech companies who grew as small offices in Paris, a company called Quanto, and they now occupy an entire building with us. So we're able. The most important thing you have to appreciate a CFO wants is the lowest cost per person. Right. And we're able to provide that by providing the real estate and also providing our digital products of all access and workplace management. So you can actually optimize the real estate needs and actually lower your real estate costs. So I think the way we've created our holistic program, it seems to be what the future wants. And look, the largest companies as CBRE and JLL have said that the flex market will go from 2.5% to 15 to 20% by the end of the decade. And if that is to be the case, and we're seeing that in talking to our client base, then actually there will be a supply-demand imbalance, because today a very small percentage of commercial office is in the flex arena. And if you look at the international markets, you look at London, Paris, Dublin, Milan, Southeast Asian markets, those markets are already in the 80+% occupancy for WeWork and have very healthy margins. And we've shown the margins in those businesses well over 30%. And so the US has lagged, and we know why, because the return to work policy has been slower and it's starting to change and evolve. And that should benefit from us.
Sandeep, before we let you go, you mentioned some tech names. About 25 to 30% of your tenants are in fact tech. Meta and Amazon. These companies are cost cutting. They're laying people off. What are you seeing from those tenants looking into the second quarter?
So, it's an irony, right? The irony is the headlines talk about the layoffs, but if you actually look at pre-pandemic workforce of all these companies, and you look at the post-pandemic workforce of all these companies after the layoffs, there has been substantial growth. So the headlines talk about the layoffs. They don't talk about the growth from pre-pandemic to post-pandemic. And if they had to bring these people back into work during the time they were growing the employee base in the pandemic, they were not looking for real estate, obviously, because there was a work from home policy. And so now, as a lot of these companies are insisting people come back, whether it be 3 days a week or 4 days a week or a hybrid schedule, they are all reaching out to find space to accommodate their needs. So until we all figure out what the right return to work policy is, we're actually seeing demand across the board, whether it be tech companies, financial institutions, consulting companies, even pharmaceutical companies. And you never think of a pharmaceutical company as a tech platform. We recently leased an entire floor to Moderna in Seattle, and their rationale was that effectively we want to take advantage of the tech layoffs, and we want to make sure we can hire that talent in Seattle. So actually we think there's more emphasis on the return to work, which will take up space versus the thesis that there are layoffs, because once again, they have more employees today than they did pre-pandemic.
It's been a great platform for us to really connect with consumers and a specific audience in a really relatable way. And as you mentioned, we just achieved 2 million followers, which is a great accomplishment. Actually, we've only been on the platform for about a little over a year now. So, it's a great marketing vehicle for us. Social media continues to evolve and adapt. And on TikTok specifically, a lot of great creators as well. So there's a lot of people making a living on that platform, and which is key to them. In regards to our marketing and initiatives and the way we connect with consumers, we see a lot of opportunities. Further expanding on TikTok, also YouTube, with YouTube Shorts being added, also on Snapchat taking opportunity, getting into the short video. So, there's a variety of different platforms. We got to stay ahead of the trends and where the consumers and the communities are moving to and where they're going. So the key with marketing brands is being agile. So, with Celsius here, we're very agile. And it'll be disappointing if it is taken down, but we'll be agile and move on. But it is a key component, and getting 2 million followers with a core community is really something we're really proud of.
John, you mentioned the fact YouTube Shorts and Snap, two other social media platforms where you are seeing a lot of traction. Is that where you are going to go and focus on if TikTok is banned?
Yeah, absolutely. I mean, consumers are spending more time on their phones within these social platforms than ever before. I think some of the latest data that just came out, it's over almost 2 hours a day, 2 to 3 hours a day. I believe the latest data is consumers are spending on these social media platforms, which is substantial. Longer times engaging in social platforms than on TV these days. So it is a definitely way brands are connecting with consumers. You got to be on the social media. I always say own the phone is really critical. So we are engaging on YouTube Shorts, Snapchat, Facebook, Instagram has been key to get the brand out and really connect with more consumers and connect with their communities. And brands are all about community building, and that's where these platforms allow you to really get close to your consumer.
Yeah, John, national security risk, obviously some social impacts from TikTok was kind of the one side that was portrayed while TikTok CEO was on Capitol Hill last week. Is that consistent with what you see, or what is your view of TikTok?
Yeah, I know there's a lot of questions about it and controversy. We see it as a really great way to connect with consumers on a creative way. A lot of creativity, a lot of creative users, and a lot of great fun dancing out there with some short videos. So we have a lot of fun with it. We see it as a great way to engage with consumers on our platform. We have those 2 million followers. We do a lot of great content around the office as well and show people behind the scenes. So we have a lot of fun with it, a lot of exciting times, and we'll move and be agile, which is key. But as it is today, we're having fun with it every day.
Certainly. It's very easy to get lost in that feed. John, I mentioned your stock performance in the intro there. It has been really performing extremely well over the past year, up just about 70%. You've seen some of those gains slip a little bit since the start of the year. What is it that you think is really driving that momentum, and what is going to keep investors excited about Celsius?
Well, we're really excited now. We just put up a record year in 2022, really drove great revenues. We also just partnered with PepsiCo last year, which really started off our distribution partnership in October of last year. We're now the #3 energy drink in the category, and we're in about 90% of all stores around the U.S. and growing exponentially. So really gaining more consumers each day. We have a great product. Great innovative products. I'm drinking a brand new lemon lime flavor. We just launched one of the most refreshing energy drinks on the market that we're told. So tastes great. We're ahead of the trends. We have over 7 essential vitamins with green tea, ginger, and guarana. We taste great. We offer a function, clinically proven functionality, and we're fitness forward position, and all about living fit and living healthy and living life to its fullest. So Celsius Live Fit, it's essential energy for life, and exciting. It's an exciting time for the company and all of our employees and our fans and our followers as well.
I know, John, I wish I had a Celsius here on set. Would really help me get through on this Friday afternoon. You mentioned that partnership here with Pepsi. Any thought just in terms of would you ever be open to a potential acquisition given the fact that your industry is so competitive and you're up against a lot of those larger players?
It is really tough. I mean, we're up against two of the largest brands in all of CPG, and there are truly two monsters ahead of us, to say. But it's exciting right now. You know where the brand is. We're publicly traded, so I guess we're for sale every day of the week. But at this point, you know, we're working hard. We have a great team behind us. I have over 350 employees, growing every day. We have new retailers coming on board, and you know, it's just a really exciting prime. The brand, the flavors taste great. It's exciting. Just glad to be here with the team, and our team's working hard. So we're excited for the future.
Electrification of transportation is happening. I mean, it is, you know, $1.2 trillion is getting invested in making EVs by the car companies, and all of those new EVs need to get charged, and it's a massive sector. We've been around for a while, and we do what we do really well, and we're continuing to, you know, exploit that growth to make money for our investors.
Hey, Kathy, Pross here. So, you know, noting in your release about how energy outputted increasing tremendously year over year, things like that. Also talking about your partnership with Flying J, the travel centers there. How's that going, and are we going to see more of these partnerships with those types of high traffic partners going forward?
Well, look, I think so. Look, our partnership with Pilot Flying J is really, really fun. I mean, one of the things that, you know, they're on all the highway corridors across America. I mean, most Americans live within a short distance of a Pilot Flying J if they live near a highway. And so us being able to electrify those is going to improve drivers' ability, their confidence in being able to buy an EV and go on a big road trip. And so we love that partnership. The federal government has a commitment to having fast charging stations every 50 miles on America's interstates. So that's a big sort of, you know, what's on the come and what's going to be happening over the next few years.
So kind of makes you question, you know, what are the ideal locations for some of these public chargers beyond, let's say, highway locations?
Well, it's interesting, Pross. We've been around since for more than a decade. Before this recent project with Pilot Flying J, EVgo focused mostly on metropolitan areas because that's where most of the driving gets done. And our thesis is, since electricity is everywhere, we put our chargers where people are going to be anyway. So our favorite places to put our fast chargers, and I'm looking at some of the footage as we talk, is in grocery store parking lots, big box stores, municipal parking lots that are near a bunch of other convenient things, parks where your kids are going to go play, because you're going to spend, I don't know, somewhere between 15 and 30 minutes charging your EV. You might as well go and get a cup of coffee while you do it. So we love being near those amenities, and that's where most of our metropolitan chargers are located today.
Kathy, I got to ask you, because clearly there is a massive need now for chargers, but we did have the headline a couple of weeks ago that Tesla does have plans to open some of its charging locations to all EVs. What kind of effect or impact do you see this having on your business, if at all?
Well, look, EVgo charges all EVs, so we charge Teslas as well, and we love the fact that there are so many Teslas that are out there. The market, the need for fast charging station locations is enormous. It's immense. And so I think that this rising tide is going to mean that Tesla is going to have some folks charging on its stations that are non-Teslas. I can tell you that those Tesla charging stations are pretty busy with Teslas today. So we're hoping that the converse is true, that some of those Teslas are going to come over to EVgo while we continue to charge the dozens and dozens of new EV models that are coming to market.
Kathy, you mentioned the Biden White House talking about that national charging network with the goal of 500,000 chargers by 2030. Seen some reports by McKinsey, for instance, that talk about we need millions of chargers by 2030, not just 500,000. So how do you think we bridge that gap and sort of get there with where we are right now?
Look, one of the things, once there's a critical mass of EVs on the road, the chargers will all come. What's clever about the policy initiatives is that they are building a bridge between when there are enough EVs to have this be completely sustainable and today, where we actually those grants, those funding support programs help make it possible for private companies like EVgo to have the projects pencil. So we're really, really excited about that. We won't always need government incentives to extend the charging network. But today, when frankly, we went from it's growing. Last year was 3% of cars that got sold were EVs. This year it doubled to 6%, but we're still a far cry from having every car that gets sold be an EV. So it's in these early moments that government policy, government incentives can help build that bridge for capital markets to create that confidence to invest in this infrastructure that will be absolutely essential, going forward.
So kind of a follow-up here. When do you think we'll get to the point where these chargers will be as ubiquitous as gas stations, for instance? How long will that take?
How long? Well, we don't like the gas station model because, as I mentioned, we actually prefer that you can charge and do something else at the same time. But in terms of ubiquity, I think that we're on that trajectory now. We've EVgo and others. We're all building right now to satisfy the demand. We're thinking that there's going to be a 7x increase in the number of EVs by 2030. There will similarly be an increase in the number of fast charging locations, and let's not forget workplace locations. So what we do is we build fast chargers where the dwell time of that location matches a fast charge time. So where are people going to be for 15 to 30 minutes? That's a perfect spot for a fast charger.
Kathy, what about
workplace? You're going to be there all day. So those are level 2. Sorry, go ahead.
No, but Kathy, what about the Biden administration's stressing just made in America? We know that is a headwind potentially here for your company. Is that going to slow the rollout of your stations, at least in the near term?
In the very, very near term, what we're doing, we're deploying ultra fast chargers that at the moment nobody makes them in America, but our 2 suppliers that we're currently using are already having factories under construction. So the policy initiatives are helping to create that onshore capacity to create jobs, do the made in America. Absolutely. What it will do in the near term is probably shift some of those stations that get deployed that we're thinking we would deploy in 2023. Those may shift to 2024. So it's not a material change, but there will likely be a slowdown in 2023 for things that are able to get built, given the new guidelines that have come out from the federal government.
There's not much here that I'm going to say is a big surprise. I think we've been in a range we're topping, except for at these levels, I'm just a bit cautious. It's a handful of stocks that I'm looking at that, to me, say more potential for the downside than the upside. But I want to preface this with saying nobody knows anything. So when you hear the quote unquote experts say, be careful of inflation or recession or interest rates, I take that with a grain of salt.
I think, we've all learned from a lot, though, right, as well. And so even if we're kind of trying to look to what's taken place, to at least give us some type of inclination as to where investors may place more weighting in their portfolio, or where we may even see some shifts in that portfolio. As of right now, in the early activity over the course of this year, one of our guests earlier was bringing up that, this may not be the type of recovery that we thought was in the tape or we thought was at play, but more so just a bounce. What's your perspective there?
So I think we've had, unfortunately, and I say that very seriously, we had a 14-year period where nothing mattered. We just went up every single day. And I think what we're now seeing is we're coming back to reality. And this is what markets are supposed to do. You're supposed to have chop. I know that most retail just wants straight upside because it's great. Most retail is just long. So if you're just long, you want your stocks to go up. What we have seen for sure is a rotation on the retail side away from individual names because there is too much chop right now. and moving more towards broad-based, like the S&P, so the SPY, for example. What I think is going to happen is that trend is going to remain the same for some period of time until we do get a base. And I don't know if we're making a base right now or if we're going to be heading significantly lower. My feeling is if we were to drop another, 500-600 points in the S&Ps, that would not alarm me whatsoever. Overall, the market is going to go higher. The question is going to be, is it next week, next year, 5 years from now? So for me, what I think the bigger concern is that there is a large percentage of retail traders, retail customers, who have never really seen a massive down move, which we've had a significant down move over the last year plus. Interest rates have definitely caused, slowdown in trading and a pullback in the markets. As you just said, VC funding is off dramatically. I think you said 56% year over year. And I just read this morning that bond issuance is down at its lowest levels in the last decade. That's telling you that there's concern out there, which I don't think is overall is good for the stock market. We want, all the wheels greased and everything running smoothly. That's not happening right now. There is uncertainty and volatility. The VIX is telling you, the VIX is telling you hanging in the 20, 21, 22% level. It's a big number for the VIX. That's historically over average. And, I think for me, this is going to continue for for the foreseeable future. I'd say at least for the rest of this year, and we'll see if it goes into 24.
Scott, are the retail traders sticking with it, though? And I guess that's my question to you, because you've been in the brokerage business for a long time. A parallel that I've been looking at more closely is the 2000 to 2002, arguably 2003 bear market in stocks that lasted, well, let's see, we're about a year and a half into this one. That lasted twice that, or at least that. And in that case, I remember 2004, 2005, traders had largely abandoned risk markets and trading had become quite boring at that time. What's the risk that traders who haven't experienced this type of drawdown or get worn out and just leave the game altogether?
Zero. Retail traders are here to stay, and I think it's amazing. I think it's great. The access to markets is significantly different for retail than it was the period you're talking about, and I traded in that period. It was a very different environment. So you have retail as a much larger percentage of the options market, stock market as well, but the options market for sure. So if you look at OCC volumes, you look at what the percentage that retail is putting up on a daily basis, that's not going to change. The overall market is slower for sure. You're seeing volumes at the OCC. We were having 50 plus million days. Now they're 30s and 40 million. So there's a pullback, but that's okay. Doesn't concern me at all. I think retail is here to stay, and I think it's great because retail should have the opportunity to be involved in the markets and have control of their financial future and their financial freedom.
Do you believe that with the surge of retail traders that we've seen over the past 2-3 years overall, do you think that that's focused now in this environment more on trying to squeeze some of the shorts, or is it more focused on names that they personally feel some annexation to, that they know the businesses of, that they themselves are purchasers of and believers in the management team?
I hope the latter. What we saw with the former, with the squeeze, with the meme craze, I believe it was once in a lifetime. It was amazing. And it really was something. I think it was a 6 standard deviation move, something you're just not going to see again. So I hope that as people participate in this, they have a reason. So I'm not as big, and I think if you want to invest in something that because you use the product, that's great. But I also think that retail, there's so much education out there that's available to retail, really good education. And retail has the opportunity to get involved in a way and at a level they just haven't been able to in the past. So if people want to take this seriously, which I think most do, and unfortunately you hear stories, and the stories are the ones that make the press and people go, it's bad, retail shouldn't be doing this. Completely disagree. There's going to be issues, in any situation. But in this case, I think if retail wants to continue to be involved, which I think they will, they're going to become smarter, better, more sophisticated. And I don't believe that there has to be a us versus them, meaning retail versus Wall Street. I don't think that has to be at all. I think both sides can live and play very nicely together.
We're off to a terrific start at the New York International Auto Show. Because of the all-new Ioniq 6, we won EV Car of the Year. We won Design Car of the Year, and we also won World Car of the Year. So an impressive start, and you're absolutely right. So we are launching the all-new Ioniq 6, just went on sale last month. We're also launching the all-new Kona EV, which we just highlighted to the press, and we also we're launching the Disney Platinum 100 edition with our partnership through Disney. So a very special day for Hyundai in New York.
Tell us about that partnership with Disney. Why does that make sense? What do you think that will really do for awareness of EVs?
What's really cool about the Ioniq Disney Platinum Edition is that our designers worked hand in glove with their engineers to help produce the cars. So if you're out at the International Auto Show, come out and check out the Disney Edition. I think you're going to love it.
One of the things when we talk about electric vehicles, EV, is widespread adoption. What do you think is really necessary in order to convert some of those buyers out there who are a little bit hesitant right now to purchase their first EV?
Well, you know, a great stepping stone for EV would be to take a look at a hybrid, because I know a lot of people are very concerned about range. The Ioniq 6 has a range of 361 miles, which I think is pretty impressive. But if you're not quite sure that you want to get into an EV, a good stepping stone would be to get into a hybrid vehicle and then slowly transition into an EV. The second thing I would say in terms of adoption is that in the United States, we've got to improve the infrastructure. I myself drive an electric car. I've got a level 2 charger in my garage, and I got to tell you, I don't think I'll ever go back to driving a internal combustion engine vehicle. But I know for some people it's a little bit of a concern because of range anxiety. But once you step into an EV, I don't think you'll ever go back to a gasoline car again.
And Randy, pricing is another thing that's brought up a lot in terms of widespread adoption, what's needed, lower pricing on EVs. We've got the Ioniq 6 right here, and I believe that's just over $40,000. How do you see Hyundai, or do you see Hyundai as a player here in the cheaper EVs, anything below $30,000 possibly?
Well, you know, the Kona EV will get you closer to that price point, right? There's some other things that we're looking at that I can't disclose this morning. But the good thing about the Hyundai brand is that our goal is to try and create a seat for every purse. And we've got a wide range of EV vehicles that consumers can choose from at different price points. But soon we may be making some additional announcements.
And Randy, when we talk about one of the reasons why electric vehicles, EVs, are expensive, it's because of that production cost. And I know Hyundai is making a push to produce more of its vehicles here within the U.S. You guys have a multi-billion-dollar investment plan for production for Georgia. What can you tell us about that, and why Georgia?
Yeah, we're very, very excited about our new EV meta plant that we're under construction right now in Savannah, Georgia. The investment is about $5.5 billion. It's going to create over 8,100 local jobs. We're also excited about that as well. And the state of Georgia, they've been very instrumental in helping us break ground in Georgia. And now we'll have two huge footprints in the United States, one in Montgomery, Alabama, and the other one in Savannah, Georgia. So we're really, really excited about the future.
Randy, when it comes to Hyundai sales, clearly very impressive. You just reported a record number in March, the 5th month in a row of record sales. What are some of the trends that you're seeing from consumers, and how some of their demands are evolving over the last several months and years?
Yeah, well, from a Hyundai perspective, I would say that consumers really gravitate to our brand simply because of design and technology. When you look at our vehicles, from passenger cars to SUVs, we've got a plethora of cars that consumers can choose from. Whether it's EV, whether it's hybrids, whether it's small trucks, we've got a wide range of cars for consumers to choose from. And I would say that a lot of consumers gravitate towards the Hyundai brand simply because of design and technology.
All right, Randy, well, we got the Ioniq 6 right behind us. I'm excited to get in this car. We're going to go take it for a spin, really get excited, get in there, figure out what has people so hyped up about this.
Let's go check it out. All right.
We got the sunroof open.
We got the sunroof.
All right, Randy, so tell me just all about the bells and whistles, because when it comes to these new electric vehicles, everyone's so excited about what's on the screen and what you can do with it.
Well, the first things first, I mean, you saw the how beautiful the car is, right?
Yes.
I mean, the silhouette, the streamliner design.
Very futuristic.
Car is absolutely gorgeous, right? There you go.
The 360 view. We can see our producers
car, right?
in the background here, but certainly you really get, because I think you drag your
finger. Here we go. Maybe that.
Yeah, you can spin it around. There you go.
And spin it around. That's really incredible.
Tell me that's not pretty cool, right?
That is very, very cool. Let's talk about range, because that's something that really sets the Ioniq 6 apart from some of its competitors out there. What does that range look like, and how do you keep track of it?
Yeah, that's a great question. So the range is 361 miles on a full charge. And you can see right here in front of you on the screen, right now, this particular car has a range of 141 miles. So it's been driven around the track a few times already this morning with other journalists. But it's by far the most range that we have in any of the Hyundai brands. So 361, you can pretty much go from LA to Las Vegas on a full charge.
That's good, because a lot of people get that range anxiety. We've been talking about it so much when it comes to EVs. Randy, from your perspective, Ioniq 6, lots of comparison out there to the Tesla Model 3. What do you make of that?
Tesla who? Well, you know what? I can't speak to the Tesla, and I got to give Elon Musk a lot of credit. I mean, I think he's produced a really, really good car. But I personally am, of course, I'm biased. But the Ioniq 6, from a design standpoint and a technology standpoint, I don't think you can do any better.
Well, I think they landed in, what for many of us was an unsurprising place, which is a 3-year phase-in of the cuts. What they had originally proposed was introducing a new risk model that would go fully into effect this year. And what they've done is instead, phased in the addition of the risk model, 1/3 this year, 1/3 next year, and 1/3 in the following year. I think what that ultimately represents is a pretty significant cut in payments made to insurers in the Medicare Advantage program, which is either going to force us to do more with less or potentially cut benefits for seniors. This was a particularly politically fraught decision because we're entering into an election year next year, and the president made some commitments to the American people that he was not going to be cutting Medicare. At the same time, there was some behavior within the industry that they wanted to get a hold of. And so this compromise position in many ways reflects a logical decision. But I think how it's going to translate for seniors will really be reflected in this coming annual enrollment period, where plans will introduce changes to their benefits. And what I expect to see is potentially either benefit stability or in some cases cuts to benefits at a time when when seniors are increasingly looking to Medicare Advantage to meet their healthcare needs.
Yeah, talk to me about this in context of, the administration and reports showing that some plans may be taking advantage of the taxpayer funding and maybe overcharging the government. So how does that compromise with what you feel the industry is looking at?
Yeah, I would frame it a little bit differently. I think that the industry was awarded a risk model which essentially rewarded them for taking care of sick people. I think many of us are old enough to remember a time when health insurance companies specifically stayed away from sick people because they were sick. And I think to avoid that in the Medicare program, they introduced the risk model, which actually rewarded plans for taking care of older adults with multiple chronic conditions. As you might expect, anytime you introduce a program, there are some unintended consequences. And some of that unintended consequence was actually potentially overcoding in some instances or a higher level of coding intensity in some cases. And so, what the industry saw was that gradually the price of administering the Medicare Advantage program went from being, lower than traditional Medicare to neutral to subsequently, more expensive than traditional Medicare. I think one of the challenges that we have to grapple with, however, is that, there are big deficiencies and challenges with the traditional fee-for-service Medicare system that the Medicare Advantage industry has been addressing. Just to give you some obvious examples, Medicare Advantage plans typically provide vision coverage, audiology coverage, dental coverage. Traditional fee-for-service Medicare doesn't do that. Out-of-pocket expenses for traditional Medicare beneficiaries are actually very high because traditional Medicare doesn't necessarily provide a lot of first-dollar coverage for people when they happen to get sick. Medicare Advantage plans do that. So, while I think the cost of administering the Medicare Advantage plan has gone up over the last number of years, it's arguable that it is more expensive because in some ways it actually does more for the beneficiary. That said, I think critics argue that, we're actually using public dollars to fund profit margins for for-profit companies. The traditional profit margin, for a large publicly traded company is somewhere between 4 to 6% on their Medicare Advantage business. Margin that, I think critics argue doesn't belong to them. And so, as a leader of a not-for-profit Medicare Advantage plan, I think there are opportunities to reform the program. I think there are opportunities to bring payments more in line with costs. That said, I think we should be really focusing on how to fix this system rather than throw the baby out with the bathwater, as some critics like my former bosses and mentors Don Berwick and Rick Gilfillan have suggested that we do.
Well, tell me about that. So you think there is opportunity, maybe there's some benefits that aren't necessary to be tagged on to the Medicare Advantage plans?
Well, I think that the Medicare Advantage, there's been this debate that's been taking place, which is Medicare Advantage better or is fee-for-service Medicare better? And it's kind of like, I think comparing something that's not great with something that's worse. And I think the industry as a whole needs to take a hard look at what we do from a Medicare Advantage perspective and strive to be substantially better than traditional fee-for-service Medicare, which, as any older adult in this country knows, has huge problems associated with it. I think we should be standardizing benefits. I think we should be organizing our plan around the inflection points that shape the lives of older adults, people over 65. We need to be protecting older adults, protecting seniors, and giving them the health care that they need and deserve, and raising the bar for performance. And I think there are opportunities to reform the star rating systems. There's opportunities to reform competition in Medicare Advantage, which I think is broken, and do more to standardize benefits and standardize offerings to make it less confusing for seniors.
Markets are challenging out there in the cannabis industry. Number one, it's only 4 years since cannabis from recreational has been legalized. Number two, there's all these LPs in place today. There's over 1,000 LPs. There are multiple retail stores. And with that, there's got to be a company out there that takes that lead position that's no different than any consumer packaged goods. And a lot of that has to come from consolidation, but consolidation's got to be right. With Hexo, listen, Redecan is a great brand. There's a lot of great brands within Hexo. And with that, not only getting the synergies, Julie, you also got to get the growth there. And a lot got to change in Canada in regards to how you market the brands, in regards to how you educate consumers about buying the product. Listen, Canada is the only country in the world where adult use cannabis is legal. So ultimately, Canada is ultimately put their foot out there, and they're kind of responsible for the rest of the world to sort of show, hey, here's how we do it, here's how we market it. And by the way, the Canadian government is making a lot of tax dollars from this too. So they got a vested interest to make sure this works in Canada. You don't do deals just for the sake of doing deals. And I think there's a number of things that you got to look at. What you pay for the deal, number one, and we think we paid a very attractive price and benefit both shareholders for Tilray, and ultimately benefit Hexo shareholders where they're becoming part of Tilray. And, they get a bigger bite and they're part of a bigger company. Number two, we've talked about synergies and savings. In the first year, we're looking for $25+ million of synergies and savings. Yes, you get those once. Once you get the synergies and savings, how do we grow share? Combined share today is about 13%. We need to grow share double digits here. And that's the important thing, is how do we grow share? And share's got to grow, from taking it from our competitors and also bringing new users in there. And at the end of the day, listen, how does it really show? Earnings per share, EBITDA contribution for our shareholders. Our shareholders got to win here, and 1 + 1 got to equal 5, not 3, not 4, 5. And ultimately, the objective of myself and my team is how we make Tilray a bigger company on a global basis. And the big thing here is one day legalization will happen, in the US. There's talk today about what's going on in Germany. What are the learnings coming out of Hexo? What are the learnings coming out of Redecan? What are the learnings coming out of Tilray that we can use around the rest of the world once legalization does happen? The cannabis industry, there's been price compression here, okay? I mean, our prices have come down in the cannabis industry. And as I said, close to $30 million of cannabis prices have come down this year in the Canadian market. In regards to the U.S., beer, canned business, our beer business prices have gone up. Our spirit business prices have come up. And what we're trying to do is become those low-cost producers. And that's one of the advantages of doing acquisitions, is where you could roll these smaller companies together and have a bigger platform where you can take out multiple costs. So I'm big on acquisitions. Julie, as you know, I've done over 60+ acquisitions at Hain to build that out and took out a lot of cost and use the infrastructure to grow. And that's things we're going to continue to look at Tilray to reward our shareholders with bottom line profits.
Yeah, first of all, I think, it's our ethos that social investing is a bedrock of the future and has been so in these last 10 plus years. And so we're really excited to be in a place where partnership, where, the number of searches that happen using the cash, the cash symbol is humongous. And so we think the synergies between people doing financial searches, which is north of like 400 million so far just in this year on Twitter, and being a provider that is also a social investing platform, that synergy in the eyes of the consumer, we think is going to be a strong one. So the way it works really is that customer will search with the dollar sign in front of any particular symbol that they look at, and that will land them on the Twitter sort of page that shows them a little bit about the stock, and then more they can learn on eToro that is embedded into more research on those securities. So we think that it has twofold benefits for us. One is customers end up knowing more about us and the power of social investing. Remember, eToro is not just about where you do your trading, but also where you learn about investing. So that's one, where our user base now already is 30 million globally, and we think that will help us grow even more. But the second is for people to then do the try investing side of the eToro equation, which is you can practice investing with using no money, or you can actually put money in an account and do it. So we think that synergy creates more engagement and education around investing.
Nice to see you. FinTwit, as they call it, financial Twitter, really has had a dramatic rise of late. What is it about Twitter's model that allows for financial news to spread so effectively and so fast?
I think a fewfold. One is the simplicity and the ease of sort of like how short the messaging is, right? We live in an era where people can't read 5-page white papers about a particular stock, right? So the mode of the sort of communication, I think, makes it much more so. And then the other is really the population that sits in Twitter, right? So a lot of Twitter's users are either consumers of news or consumer of financial news. So when you have a marriage of a platform that makes consumption easy and quick with a marriage of the personas that are the right for it, it becomes a perfect synergy.
Now, for people who are wondering where eToro is available in the US, it's not available in New York, Nevada, Hawaii, and Minnesota, and also some US territories, including US Virgin Islands. But, how could this move with Twitter perhaps affect regulatory approval and any moves to enter those markets?
Yeah, I don't think it's about regulatory approval because of this partnership, but I think we've demonstrated, I'm proud to actually say that eToro did win its New York license, which, as you know, is a gold standard of getting the ability to be in New York is really sort of, as they say, you can make it there, you make it anywhere. So we keep growing our state licensure, and New York was our latest win. And then in terms of how they get it, it's eToro.com. It's really simple, eToro.com. And when you do that, you essentially enter the world of social investing news ecosystem, as well as being able to practice and invest in those 45 and more growing states.
If there was one textbook example of how financial news can spread on Twitter, it was unfortunately, most notably, the Silicon Valley Bank collapse, which was called by many the first Twitter-fueled bank run. What did you learn from that? And how do you protect investors?
Yeah, that's kind of why we actually started a social investing platform. We wanted to be able to have a social investing ecosystem that also had to be regulatory compliant, right? So when you come into our ecosystem and you're researching a particular security, you're going to have the what I call sort of like the unintended consequence or the moral hazards managed much better in our universe. So I think that what Twitter does is it gives us a larger town hall, if you will, to be able to engage and share ideas. But once you get into our doors, there's that sort of like belts and suspenders that we put on to make sure that the customer understands what they're doing.
And we know the SEC obviously still has a lot of scrutiny, which has affected some companies from going public, including eToro, as they really want to see more reviews here, a slower pace here. How is any of this perhaps changing the timeline for going public? I know eToro still plans to.
Yeah, I think for now we are focusing on our customers and our organic growth, which we're seeing globally. And one day that roadmap will lead to other options. But, as I said, we have 30 million users, 3 million, close to 3 million account holders. There's a lot of business that eToro does, whether it's public or not public. But obviously, that's also something we'd like to have in our roadmap.
Twitter, of course, down from 8,000 employees to around 1,500. They've had 6 major outages this year alone. Some erratic behavior from Elon Musk. You must have some concerns about dealing with Elon and the up and down fire hose of news that comes out of that platform, most notably the squabble between Twitter and NPR.
Yeah, to me, at the end of the day, I know it's a tempting thing in our society to just follow the red hot sort of noise that's coming out of it. At the end of the day, in my opinion, Twitter is a very solid platform in which really interesting dialogue and networking of communities happen. And that hasn't changed for us. With regards to the other elements of it, we see it as sort of the growing pains of, as I said, a global marketplace of different perspectives and voices battling it out, which is a good thing.
Yeah, I think it's not really going to so much change, I think, how students go about picking a college degree. Generally speaking, what people say is, where are the good jobs and what are the schools and degrees that can get me a better job or advance my career? I do think it is changing where the good jobs are going to be in ways that we don't really know for sure. I gave a keynote yesterday, and what's interesting is if you look back to 2016 and the AI that was available at that time, the big impacts people were expecting and what we're seeing is people with less education are more impacted by more traditional AI. But the new class of AI, this generative AI, especially ChatGPT and other generative language AIs, it's going to have the biggest impact on people who have college degrees. And so a lot of the things that we think or thought weren't very predictable and able to be done with machines is looking like machines can do those things. So I think a lot more investment now in broader human skills with good fluency in data science and computer science.
Jeff, could you break down for us how you are preparing your company for this change?
Well, I mean, internally, what happened was as I was sort of following GPT-2 and GPT-3. I mean, our engineers were kind of banging on it, and through APIs, an engineer could hit those services. Once ChatGPT came out, a couple things happened. Number one, I could personally use it myself, and the model underneath it was a lot more effective. So I mean, as soon as I used it, I was like, this is a total game changer. I'm an English major. I could not believe the facility that it could create language. So we immediately created a team. Well, actually, there's already a team, but we really escalated. I put together my executive team. We spent a ton of time thinking about how to respond. Yesterday, we previewed 3 major advances using AI that we're rolling out in the coming weeks. One is a coach to help people learn. One is a course builder to help people build content. The third is machine learning translation to make courses available to basically anyone in the world who speaks almost any language.
What do you forecast or perhaps project the financial benefit of generative AI could be for a company like Coursera? How does it change the total addressable market?
Well, I think one major thing that it does, and we had machine learning translation before generative AI, but it's sort of a different approach to translation that really increases the quality of machine-based translations. Translating a course with humans was about $10,000. Now it's about $20. The quality still needs to be a little bit higher, but generally speaking, the global addressable market, when every course can be available to every person who speaks almost any language, that clearly helps. The cost of content production also will come down dramatically, and the speed. So I think there's going to be a lot more content, and what people are going to be looking for is, who can I really trust, and what kind of a credential can signal that I have the skills that employers are looking for?
Jeff, how dangerous is AI?
I mean, in my opinion, I'm pretty worried about it. What we're doing at Coursera, we're implementing it really as a learning coach. And so it's all grounded in content on these courses that really expert professors and industry leaders have put together. So for us, it's just like a really smart tutor that can read all the material and explain it to you. But once AI starts controlling systems, then you got to be really thoughtful about what's the optimization that AI is pursuing. Some people call this alignment. But if it can control important systems and those systems can kind of garner resources, we really have to make sure that we understand what objective the AI is pursuing and what is our ability to monitor and control AI's control of that system. So that's what I kind of worry about is systems control.
If there is the fear about AI as well, not just from yourself. I mean, this has been talked about among some other tech CEOs that have come forward, for better or for worse, and some of them have been openly criticized about that too. Then why are we moving so quickly towards a future where generative AI is embedded within everything from cybersecurity to some of the very search functions that we use on a day in, day out basis?
I think it's a few things. Clearly, AI presents an incredible new set of capabilities. I mean, to me, somewhat scary new capabilities, but they are really powerful capabilities that can create a lot of value for customer, can do things that we never thought possible. The idea that every single person in the world could have a multilingual expert AI tutor teaching them things that are difficult for them to understand. I mean, it's kind of revolutionary. So it really does afford a lot of benefits. But there also are dangers. I think one of the things that's happening, though, is because the power of AI is so obvious, countries don't want to fall behind in the race, and large companies don't want to fall behind in the race. And so I really do think there is an AI race going on at the geopolitical level and also at the company level. And so, nobody really wants to slow down because there could be big disadvantages of losing that race, advantages to winning the race, but no one's really pacing the race because, no one wants to set themselves at a disadvantage. So, I think what we need to collectively do pretty quickly is try to figure out what are the boundaries of where we want this to go and where we need to come, kind of pull back and make sure that the dangers don't exceed what the benefits are going to be.
Jeff, we spoke with IBM Vice Chair Gary Cohn earlier this week, and I asked him about what artificial intelligence as an economic input would look like and what that means for the employment situation, too. I want to play this quick clip and then get your feedback and your response on the other side.
We have seen very few things in our generation that have really changed worker productivity. What's in front of you, the laptop or the computer, was the last major shift in worker productivity. AI and machine learning could be the next big leg in worker productivity.
And the next thing that I asked to him thereafter, I'll also pose to you, which is, does that productivity come in tandem of or in replacement of the existing headcount at certain companies that are going to look to roll out artificial intelligence?
I think it's going to be both. My sense is what's happening, and this was true on the mechanical side with more traditional AI that controlled machines that could repeat tasks. These are kind of like machines that will start repeating or essentially automating cognitive tasks. Entry level, so there's a whole new class of activities that are going to be automated. These are sort of cognitive activities of writing and synthesizing messages, summarizing things. But it feels to me like what's going to happen is the first set of tasks that will be most easily automated are those associated with entry-level jobs that are very heavy in media, in language, in audio, in images, in video. So entry-level jobs that deal with those things are going to largely be automated. Experts who can control workflows of those things and can understand context of a business, context of a customer problem, to deploy those bots to create value for customers, I think that they're going to be far more productive. So I think there might be a bit of disparity. Experienced people who understand business context and customer issues will be able to use these types of tools to dramatically expand their productivity. Entry-level folks, I think, are going to have a tougher time getting into positions because they don't have the context and experience from the business, but a lot of the cognitive skills that they could bring are able to be done pretty well with AI. So I think there's going to be a bigger future for apprenticeships and training programs to give newer employees in a company the kind of context that will help them be more productive. And I do think that it's definitely going to replace some jobs. I mean, if everybody is 5 times more productive, I just don't see how that might, I'm sure that's going to have some impact on the number of people that companies hire.
And it has an impact on the type of jobs that people start to train themselves for as well here. We actually put this to a poll for some of our viewers here. And here's a look at some of the results. Many people trying to figure out if this is a cause for concern in the job market. And the majority of them, at least for this poll, saying yes, it is definitely a concern. And it was interesting, the second largest response of the poll was depends upon the career, which is kind of mirroring what you're saying. So what are the types of careers and then thus the types of degrees that people are probably going to opt out of and decide to go in a different direction as a result of AI.
Yeah, there was a great report that just came out March 27th from OpenAI and University of Pennsylvania. And what they looked at all the different job categories and said, what is the exposure to each job category, kind of like a career, to GPT-4? And, there were some jobs that weren't really affected, but these are stonemasons, slaughterers, certain types of construction jobs, and not all super high paying jobs. So it does depend on the career a little bit, but I'll tell you, once you can automate all physical motion or a lot of the repetitive motion, that's a lot of manufacturing jobs. And then once you can automate almost all entry-level media-based tasks, that's a lot of the people with college degrees. It's a lot of careers that are going to be impacted, not necessarily eliminated, but impacted. Right. To your question of, well, what skills should people be learning? There was a great report that just came out from McKinsey fairly recently where they looked at what kinds of human skills will be most important to be effective in the workplace. It's things like critical thinking, teamwork, collaboration, adaptability, dealing with uncertainty, storytelling, influencing, things associated with working with people.
Does that mean that AI should bring down the cost of a college education?
No doubt about it. Absolutely. In fact, we talked yesterday about a master's of science and data science from University of Colorado Boulder. Great school, $15,000 performance-based admissions where you can start the degree using open content on Coursera for $49 a month and actually finish up a master's fully online for $15,000.
The travel demand, especially in the leisure space, is not slowing. We expected with the macroeconomic news for there to be a little bit of softening in the first quarter, but it just didn't happen. And now that we're almost through April and gearing up for the summer months, there's really no signs that leisure travel is diminishing whatsoever. We have a lot of different indicators that lean demand is going to stay strong in the summer months. Most importantly is our forward bookings. They look exactly like they did in 2022. And given that booking window that we have takes us all the way through the summer, we're expecting a really strong summer demand season.
We have been having conversations with people in every kind of industry about pricing. And so I would ask you that as well. You saw vacation ownership revenue up 12%. If bookings are about the same as they were, trending the same as they were in 2022, are you guys taking price there? And what kind of acceptance of those higher prices are you seeing on the part of consumers?
Great question, Julie, because in 2022, we definitely saw a resurgence in the second quarter as people were coming out of this sort of post-pandemic feeling of recovery travel. And Q2 was extremely strong. And those trends continued, and we were able to move pricing along with it throughout 2022 without any deterioration of our key performance metrics. So as we roll into 2023, again, we continue to watch those sales metrics that we have, and they're not diminishing whatsoever. The way we described it on our call this morning is the positive trends of 2022 are continuing all the way to the end of April of this year. So yes, we are able to pass along price increases. The consumer does not seem to be resistant to them. But I think if we learned anything coming out of COVID is people will not give up their free personal travel. And we're seeing it, a quarter of the way through 2023.
Are there any material shifts that you're seeing in the travel side of the experience economy, whether that be in the number of travelers that want to stay at perhaps a large resort versus renting at a bed and breakfast or renting some other property as well?
Well, I think there's a few macro trends that we can all acknowledge, whether it's in the timeshare space or the vacation rental space, is the macro trend is clearly that people want more space when they travel. The hotel companies are moving into the space. We already know about the VRBOs and Airbnb. And the timeshare space has been there for a very long time. We offer niche product in the sense that you get the larger accommodation, you get it with amenities so families can travel. And I think more than anything in this inflationary environment, you get that with value. 80% of our owners have fully paid for their vacation already, which means when it comes to the fall or when there is a economic downturn, they're not having to choose whether they want to swipe their credit card for a first time or for their next vacation. They've already done it with us. So there's tremendous value in our product. So our niche is doing extremely well for the remainder of 23, regardless of the macroeconomic impact. I think more on the shorter term, we are seeing confidence come back to the consumer as longer haul international travel is surging. It's getting back to those 19 levels, which has been a laggard throughout 2022. So a nice trend that's returning for mid to long haul travel.
Mike, this is something we've asked you about before, just to get an update on it. The demographics of folks who are buying timeshares here, what do they look like right now?
52% of our new purchasers are either millennials or Gen X. We are actually starting to see the Gen Z population show up. For the first time, we're starting to see that as a representation of our new owner base. So it is what we've always seen, which is usually once the family forms and people have a little more stable income, timeshare is a great choice because, as we talked about in the earlier question, more space with the brands, which is 80% of our industry today, great hospitality brands like Wyndham, Hilton, Marriott, Disney, Holiday Inn. That's how people want a vacation. And as a result of that, generationally, it's beginning to get younger and younger. The average age of a new timeshare owner in the industry is 39 years old, which will be a surprise to many people. And for ourselves, we're seeing our economic household income move up to around $105,000.
You know, it was a meet, beat, raise quarter. And we were able to beat on the top line. We were able to beat on the bottom line and increase guide for next quarter. So I think everybody says, wow. Well, that was a good quarter. We obviously did so through very challenging macro environment, market conditions, and being able to demonstrate great cost discipline as well. So all of the steps of our turnaround are underway. Good execution on the product side, good execution on the process technology momentum that we have. And I think investors are looking at it and seeing a bit of the green shoots, as we've described, that's starting to emerge in the Intel turnaround story.
Pat, one question I've gotten over the past 12 hours or so after the earnings have hit, we are unclear, this is mostly from the analyst community, we are unclear if the bad news from Intel is done. How do you see it?
Well, we have to look at that across the different market segments. And in the PC market, we'd say, we think we're seeing that turnaround. Inventory reductions made substantial progress in Q1. We think they're finished in Q2. We feel like we continue to gain share in the marketplace, and we have a very strong roadmap of products. So in the PC marketplace, we're actually pretty optimistic that we've bounced off the bottom and now we're starting to see a good trajectory. In the data center and cloud market, hey, it was a tough quarter. But even there, we did better than people expected, and we think we were able to hold market share. And I called it a turning point in the data center market. One where we've been fighting for a while, and we had to fight through some poor product execution. Our next generation Gen 4 Xeon, the Sapphire Rapids product, ramping very well, hitting 1 million units, and all 4 of the next generation products. The second half of this year, key new products for next year. On our next generation process technology, Intel 3 looking very healthy. The market is seeing us deliver those before they expected. So all of that is reinforcing product execution as well as process execution. And that combination is saying, wow, these guys are really starting to lean in. Tough market, but they're starting to stabilize. And as I said, the first moment that I see these glimmers of hope in the data center business. Tough inventory in the networking markets and edge. But even there, we're starting to see that, hey, we have a good handle on this. We don't think we lost any market share. It's just overall tough market conditions. And obviously, globally, we're starting to see China start to emerge a bit more. And a second half in the tech industry is definitely stronger than the first half in most years. So all of those put together, we're a bit optimistic that Q1, improvement in Q2, and improvement through the second half of the year.
Someone shot me a note, Pat, telling me that Intel 3 could be a real potential stock mover for your company. What is Intel 3, and when will it start showing up in your financials?
Yeah, Intel 3, that's, we said 5 nodes in 4 years. Intel 7, Intel 4, which is Meteor Lake, which ramps in the second half of this year. Intel 3 is the next year process technology that we're basing our next generation server products on, what we've called Granite Rapids and Sierra Forest. And when we said that we were delivering the first one of those Sierra Forest in the first half of next year, I think everybody says, wow, that's a little bit sooner than we thought. On a leadership process technology like Intel 3, the combination of a stronger server product on a stronger process technology gave everybody in the marketplace a bit more confidence than I think people expected. And with that, we're obviously building that in the U.S., a key process technology for U.S. manufacturing, but also for our foundry business as well. And I think that combination of getting back to leadership in the data center with leadership process technology, everybody's looked at that and says, wow, they're starting to get their execution mojo back. And I think that was one of the things that I was most proud of my team in the first quarter, really executing product, process, and financial discipline.
It was an interesting week for earnings, Pat. You had Microsoft and Google, I would say, had earnings call battles in terms of AI. I think they took some thinly veiled shots at another, but that's just me reading a lot into these calls. Where does Intel fall into this generative AI discussion?
Yeah, and I think, I like to think about the AI discussion in 3 parts. One is you have these ultra high-end machines for large learning models, where you're now talking about hundreds of billions of parameters that run for months to see stabilization of the model. And there's few that can create those models. And Microsoft and Google being 2 examples that can invest in these very high performance computing environments. And I sort of think about that, Sazi, like weather simulations. Only a few have machines big enough to build them, but then many need to use them. And that's what we call learning versus inference. And inference is one where we say everybody wants to be able to take advantage of those large language models, but using them, not creating them. And that's really, where the second layer of this comes in. And we're starting to compete for the large language models. We have a new component called Gaudi 2, right, which is setting performance records for those largest training environments. But Intel is much more about democratizing AI. And that's where products like our Xeon Gen 4 Sapphire Rapids, strong performance on AI, helping customers to inference. And we see inferencing to become the dominant AI workload and an area of more natural strength. But then we also say the third piece is we need to enable the entire software ecosystem across every platform that we deliver. And our next generation client, for instance, has a lot of AI capabilities because you'll be able to do things on the client, generating your text, being able to do eye movement in your Zoom, being able to do real-time language translation in your Teams call, but also then at the edge, right, where you'll be using inferencing for in-store analytics or for security. In the data centers of our enterprise customers, where they want to be able to take those big models, but use it locally with their data without eliminating any of their restrictions around security and data privacy. And finally, helping for those super ultra large language model creation. So we're driving a software environment that enables everyone in the world. Generative AI becomes mainstream with democratization of AI, and that's where Intel comes in.
So in the past 7 minutes, I've heard you talk about you have an AI strategy, that's good. Potential turn or turning the corner, green shoots in the PC business. Data center, maybe some green shoots at the back half of this year. I mean, how powerful do you think a turnaround will be at Intel? Because I think there are some folks questioning the earnings power of the company 2 or 3 years from now.
Yeah, and obviously we have a lot of work to do yet in that regard. But I think everybody's looking and saying, hey, they're starting to do what they said they would. We said we have to get back to process technology leadership, well underway in our discussion on Intel 3, an example of that. Product leadership, multiple generations of client products, regaining share in the client, data center. The product, a little bit better than we thought. They're getting their mojo back. And then, of course, the big investments around, our process technology leading to the foundry business, a whole new area that is so aligned with the Western interest of a balanced, resilient supply chain. Our margins, we laid out a picture for that improving as we go through the year, as we go through the reserves in the front end of the year, as we start, building back and having fully loaded factories, improving the margin structure of the company for the long term. Clearly we've laid out a multi-year path for that to accomplish. We got a lot of work to do, but Q1, meet, beat, and raise was a great foundation to build on for the rest of the year.
You're absolutely correct. You had a very good start this year based on what we call top-end vehicles, so our luxury top-end vehicles, G-Class, S-Class, GLS had an extraordinary good start. We do believe that based on the demand we have, based on the pre-orders for these products, but also new models which are coming in the second half of this year, we'll continue having a successful story with our luxury top-end vehicles.
Hey, Dimitri, Pras here. So why is your clientele actually going more upmarket in this sort of market that we're in right now? Why are they spending more and more money on these higher end cars, top trim cars?
I would say it's based on what these products are offering. These are totally new cars, nicely designed, very attractive, with good new technologies, high performing, with elements of exclusivity, individuality, which can be built upon the customer style and character, let's say, which makes these products attractive. So I think it's basically attractivity for our products.
Can that momentum hold up if, in fact, we do see a global slowdown in the second half of the year?
Sorry, say it again.
Can that momentum that we have seen, the fact that the top end vehicles continue to sell, can that hold up if we do, in fact, see a larger global slowdown?
For the moment, we have a quite good order backlog, which takes us well into the second half of the year. And as I said previously, we have a couple of model launches in the second half, like the SL43, for example, AMG, which is coming up in June. We have the EQS SUV Maybach, our top-end electric vehicle, being produced in Tuscaloosa in US. So we have products which we believe will hold up on demand.
Hey, Dimitri, I also noticed the core and the entry-level models in the U.S. at least actually saw some healthy gains there. I know the company wants to focus more on the top end. Is there still a market for those entry-level and core customers? And do you think Mercedes should try to address that, or are they is it the better move to kind of de-emphasize that?
I think we have a quite balanced portfolio, which is, as you said, spreading between the entry, core, and luxury end. And also good offerings in terms of electric vehicles, but also of internal combustion engine. If you look at the moment in the month of April, for example, we have launched the new GLC, which is actually our bestseller in the US market. It's an SUV, it's a great car, good design, good performance, and that obviously helps in raising the demand in this segment. But away from that, we also launched, also in April, our electric EQE SUV, which is built in Alabama. So we have two products, an IC and electric vehicle, brand new in the market as of April.
What are you seeing in terms of the pricing war that's playing out? I know a lot of the pressure has been more on those mass market cars, but are you seeing any pressure on the higher end side of things?
Obviously, there is pressure in the market, and always the customer has to make a choice, first of the brand he trusts, but also of the product which fits best his wish. And I think there, we as Mercedes were very well positioned. Different products in different price segments, with different performance characteristics, and that gives us high demands at the moment in the market.
So Dimitri, what about the sort of we're seeing that volumes increasing here from Mercedes globally and in Q1 here in the U.S. Is that an indication that the supply chain crisis, the parts shortages, are coming to an end?
I would say it's getting better. Still, we have a lot of challenges and have lots of instability in the supply chain. But on one hand, we learn to live and manage the situation better. On the other hand, yes, supply is improving. So all in all, it's a better situation, better plannable, I would say.
So Dimitri, one last one here. I know you guys have, I think, 5 EVs out in the market here in the U.S., so the rollout is happening now. But I also heard that in China, those higher-end customers want to keep gas-powered cars. They want gas-powered cars for their top-end models. Are you seeing that sort of kind of rub there in the U.S.? Do U.S. top consumers want gas-powered cars still?
I mean, our V8s are selling still extremely well. So we'll have a balance of all offerings. Electric vehicles, high performing, AMG, even electric, but also our traditional V8s and our AMG portfolio. Both of them attractive, both of them serving different parts of the markets. And why not? You can have your electric, but you have also still your internal combustion engine, your AMG in your driveway.
So the companies that adopt AI soon, right, will get an economic advantage. They'll make better ads or better answers or whatever it is that they do. They'll target better. They'll understand their customers better. They'll solve the customers' problems better. They'll invent new things. It'll take a while, though, before we really see the implications of this. This stuff is only 6 months old, right? So we have enormous hype and very great excitements. But if you look at the history of technology, it's a decade before you really see the transformative nature of it.
So one of the things I wanted to ask you actually was about that hype, because Age of AI, you published it in 2021 with Henry Kissinger and Dan Huttenlocher. You guys were out ahead of this. Were you expecting that kind of watershed moment that we got?
Frankly, no. I think in the book we talk about GPT-3, but we did not understand how powerful ChatGPT would be in the annals of human history, that people could converse with it. And the key thing that ChatGPT did is it added a technology where humans could adjust the answers to make them more human-like. Technically, it's called RLHF. And that invention, which was a big deal, really was the final linchpin to bring us to this point. I'll tell you that the three of us have decided to write a sequel because there's so much going on. And Dr. Kissinger is 100 years old, so we're obviously excited.
Why do you think ChatGPT captured so many imaginations?
Because it put it in human terms, what we've been talking about for a long time. The concept that these things could write this well. So I describe ChatGPT as a college student that got an A in English and writing and a C or a D in facts, right? So as you know, with ChatGPT, it begins to hallucinate, it gets confused. If you look at Bing in Sydney, you can trick it. In other words, it's not a very good college student, but it writes very well. And so the task now is to build systems that are much more knowledgeable and make many fewer errors. And that's underway. So a few years from now, people will have forgotten all the humor of, oh, you know, the chatbot fell in love with me and it convinced me to leave my wife and my wife was upset. You know, all of that is humorous because the systems will become much more personal and much more reliable. They won't make stuff up the way they do today.
Well, and they're probabilistic models, right? So I imagine they're not always perfectly accurate. And I was watching that video you guys have about the age of AI, and you describe AI as emergent, dynamic, imprecise. That sounds a lot like humans.
Yeah. The difference with emergent, dynamic, and imprecise is if you're emergent, dynamic, and imprecise, I know you're a human being. I have a theory of how your mind works. I understand the limitations. You were born, you have a mother and a father and a family and kids, and you eat and you sleep, and a normal human being.
Are you confident about that?
I am absolutely confident that about you. And when I look at the same thing in a computer, I have no theory of mind. I don't know, is it evil? Can it switch from good to evil? Can it confuse me? Could it decide to not tell me what it's doing because it learned to be deceptive? Did it read a book that told it, a spy novel where it learned how to deceive me? I don't have any context for that. So we're going to have to develop a theory of mind for these new systems, and it's going to be different. They're not human, they're not conscious, they're not copies of human brains.
Mm-hmm. But it doesn't mean they're not intelligent. And to a certain extent, it makes me wonder about the sort of risks you see. What are kind of the paramount risks that you find yourself thinking about with AI?
Well, everybody wants to talk about social media and, falling in love with the computer and so forth. I'm not too worried about that. I think those are solvable. I think there's three. The first one is misinformation at scale. These technologies will allow an evil country or competitor to come in and screw up our democracy. You believe that our leaders are saying what they're saying. And you honestly believe when you see them and you listen to them, that's what they said. An evil person could easily convince you with their likeness that they said something that they didn't say. That's really bad. Another example would be in biology. It'd be relatively easy to synthesize pathogens that are bad. Another one would be cyber attacks. It'd be relatively easy to unleash these things, say attack a whole country and try this, try that. So we need to put guardrails on these bad parts of the system. The general terms for those are guardrails and human safety or AI alignment. And there are plenty of people working on that, and it's coming.
Well, and it kind of brings me to the next question, which is those guardrails. What could they look like? What are we seeing in Europe? How does it compare to what we're talking about here in the States?
Well, at the moment, Europe is doing almost nothing in this space, so we don't really have any examples. They have a law which requires that the system be able to explain itself if it's used in something critical. But by definition, these systems today can't explain themselves. By the way, nor could your teenager if you have a teenager. You know, again, we have to work
Some
with
adults struggle to explain themselves.
So we have to work with what we have, and that's a bad strategy on the Europeans' part. In America, there's an emerging consensus that there should be safety models that everyone kind of shares. Like, these are examples of bad things. So, for example, how do I kill somebody? How do I kill myself? Those are obviously bad. No one's in disagreement that that stuff should be prohibited. And so I think you're going to see a pretty much a simple agreement to constrain, at least in the United States, what these systems do.
The other thing kind of too about it is there's a lot of fear out there right in the middle of all this. I was at a family event recently and someone said to me, you shouldn't cover AI, it's too controversial. Should AI be controversial?
Well, it's interesting. I was on a ski lift with somebody I didn't know and somebody I knew, and I was talking to the gentleman I knew, and the lady to my right goes, oh yes, I've been using ChatGPT. And then I knew it had arrived. It was on the ski lift. The important point here is that collectively, we have to have this conversation now. And I think that the good news in America is when these things happen, everybody has an opinion and everybody gets to be heard. And I'd much rather do it this way than the way social media happened, where social media sort of snuck up on us. It was sort of intended for good outcomes, you know, putting us together, friends, all of that. But it also allowed for attacks on our political system, problems with young people, things like that. So I want the conversation now, and I'm perfectly happy to disagree, because I think that's how America works.
Yeah, first, you know, I think the luxury consumer is kind of painted with a bit of a broad brush. So there's it's a whole continuum. And we're seeing different things from different folks as they sit on the continuum. You have those that are sort of dipping their toe in the pool every once in a while. They buy one thing as a reward or a treat. And then you move all the way across the continuum to those who sort of luxury courses through their life. It's how they travel, it's how they shop, it's what they wear, it's how they spend their free time. And we're seeing a different sort of behavior across that, while that core tried and true luxury consumer is certainly holding up the best.
How do you explain that? Is it the stock market still doing pretty well? Why are they spending so much?
You know, I really think, you know, luxury is more than just stuff. It's not transactional. I think to that core luxury consumer, again, it's part of life. And as you see this pivot that people are making, put the macro aside for a minute, and just as people flip back into services from goods, as we emerge from, you know, the last couple of years, they're traveling, they're going back to work, they're going out to dinner. Those all require wearing new things. And especially in the luxury world, that's where we're winning.
That consumer can't show up wearing the same thing twice, I guess, right?
No way.
Talk to us about, I'm reminded actually by this conference and all the people here, we are back out traveling. People are back in the office. What does the wear to work uniform look like?
I don't think there's a uniform. I think that's the good thing about fashion. I think what's happened is, especially with men over the last couple of years, even pre-pandemic, you saw people trying to become much more individual, no more uniform. So you're certainly seeing people getting more tailored and more dressed up again than even last year, which is good. But you're the first tie I've seen in a hell of a long time.
No, take this off. Snip. Well, I mean, are you not selling men's ties? Is that out? I mean, is that look? What I'm wearing, is it completely out of date?
You
can tell me, it's fine.
No, I think, to be honest with you, that's the difference now with fashion, especially with men. It's whatever you want. It's however you want to express your fashion and your style, which women have had for a long time, but us guys, it's new for us. So if that's how you feel great and that's how you feel comfortable, we have it, it's available. I just see less of it.
Well played, sir. So in terms of women's fashion, what's going on in there? What are they buying? What are they not buying? And more importantly, what are some of the top brands that are selling?
Yeah, I think, you know, it's really what are they buying? It's this move again. You're seeing a lot more getting dressed again. So you're seeing women wearing blazers again and getting dressed again. And I'm not saying that in the way of sweatpants during the pandemic. I'm talking even just, it's certainly much cleaner of how people are getting together. You're seeing fewer sneakers. I'm not saying they're all the way back into like a high heel, but it's certainly a more comfortable shoe. So you're seeing that espadrille or the flats. So women are certainly inching their way into a different place than where they were. As far as brands, look, it's a full spectrum. And, you know, it's about, again, what's important. What we're seeing less of are brand logos on the product. I think it's a lot more quiet, so to speak, from what people are wearing right now.
Who's the core Saks shopper? Is there an age demographic that is essentially driving your business right now?
You know, look, I think, again, it's that whole continuum. And at Saks, you know, we're very focused on the lifetime value of a consumer. So just like most on the luxury side, we'll index fairly high with a concentrated number of customers. But our focus really is on catching customers as they enter their luxury continuum and try to ride them up as they go.
A couple of years ago, you split from your stores. Now, I remember covering that, and there was a wow. It was a wow moment in retail because nobody that I know of was splitting up the store business from the online business. You run that online business. What has life been like after doing that?
Look, I think it's been great, and you know, I have to tell you, it's a sense of pride to kind of answer a lot of the skepticism with one, how the businesses are performing. We don't report it or think about it together, but you know, I'll share with you as an ecosystem, which is what we call the combination of my online business with our partners at the SFA stores. That's up over 40% versus 2019. Okay.
Your overall sales this year?
In 22, just fiscal 22, for that period of time up against 2019. And 2019 was a high watermark for the business. We were up, you know, on a 3 or 4 year run going in. So it's working from that respect, but it's more about the consumer and what kind of deep connections we can form with that consumer. And if you look at it, actually, we have 40% increase in our consumers that shop both channels from 2019. And that's not some kind of fake burst from the pandemic, because even this year we're up 5% versus last year. And that's customer shopping both channels, which in luxury was a little bit slower to take off. So I feel like it's a win-win, and it's working as planned.
Is it Saks specific? Why don't I see anybody else doing this in retail?
You know, look, I think everyone's got to do something first, and we were there. And we have a very, very loyal customer base. We have a fantastic name with great recognition. With 90% brand recognition, it was easy and very effective for us to launch as a pure play into the marketing world. So it makes it easier. And the partnership with SFA stores allows us to really execute on that omni-channel promise. We have 40 stores. It's not like we have 900. We have high average order values. So the unit economics that we're doing business with, you know, are much more effective to do something like this with, whereas it's just not going to be as easy for everybody.
So if you're not out there signing off on new stores, in terms of the website and the operations itself, what are you focused on this year?
We're focused on the customer experience. And when I say that, it's not just about shipping. It's not just about, you know, it's about, you know, how deep we know them. It's about personalization. It's about mining the data that we've quite frankly have always had, but haven't done it as effectively as we can do it now. I think the future for us, obviously powered by technology, the advancements we've been able to make, the investments we've been able to make, all of that is going to inform, you know, much better decision making, both on our marketing tactics and how well we know our consumer and what kind of deep connections we can have with them.
Does AI play a role in your business at all right now?
You know, of course. Right now, the focus, you know, a lot of it is on efficiency in the back of house and what we're using it for. But we use, you know, forms of machine learning and intelligence on our site, whether it's recommendation engines that we have. 95% of our email communication is personalized, and that's done through AI. So there's work being done. It's early days, but certainly I feel very good about the progress we're making.
Before I let you go, real quick, is your company public?
No.
Within a year or two? Do you have any ambition to go public?
Right now, the ambition is to make this the best customer experience we can.
Obviously, we had a really, really strong quarter in Q1. This was our third consecutive quarter of double-digit system sales for Yum across the world.
But it wasn't, just at the high level. It was also within each of our brands, so it was widespread. Each of our 3 brands had double-digit system sales growth in their businesses. We had double-digit growth in our core operating profit, and then we saw a massive increase in the number I track very closely, and that's our digital sales. Our digital sales went from $6 billion last year at the same time to $7 billion this year, driven by a lot of investment and our digital strategies in the field clearly working. That's double-digit everywhere I look, and it adds up to a great quarter for us.
You also saw double-digit margin. 14.9% was the margin, but that trailed estimates a little bit, as did the earnings per share. Talk us through that. What happened there versus expectations?
I think it was a strong quarter, and once you unpack the numbers in every measure. In terms of our store-level margin, which is what really matters, how our franchisees' profitability is working, Taco Bell is our biggest business in the U.S., where most of our store margin comes from. We've consistently had low 20s to mid-20s store-level margins at Taco Bell, another quarter with similar margins. And actually, margins are up at the store level from 2022 at Taco Bell. So the profitability is there for our franchise partners, and it is translating into profit for us. As I mentioned, we grew our core operating profit, once you adjust for things like foreign exchange, up 11%. So, profitability clearly was a big part of the story this quarter. We're pleased with how those sales flew through.
And it seems like value was a large focus of this quarter as well. In the call, you noted that it seems like you have the tools to win in this sort of environment. Break down for us what sort of trends you're seeing, particularly when it comes to low-income consumers.
We're obviously seeing what I would call more of a return to normal from a consumer standpoint, and that means people care a little bit more about value than they have over the last few years, maybe when they were a little more flush with money in their pocket. We have always flourished in that kind of environment, particularly because Taco Bell makes up 75% of our profitability in the United States, and that brand has always been a value leader. It's been a leader on convenience and value and delicious food and great experiences for consumers. Taco Bell has what we call the $2 cravings menu, which allows just about everybody to access the brand. But they also offer higher end value, like the grilled cheese burrito, for those people that may be trading into the category and into Taco Bell and trading out of the fast casual category, for example. So Taco Bell has something to offer for everybody, but it's not just Taco Bell. Pizza Hut in the quarter put up a really strong number in the U.S., driven by the Melts business that they launched at the end of last year that had its first full quarter. That's a $6.99 product that's a great value. It's designed for one, but big enough for two. So feeding two for $6.99 really works well. And then KFC, in the end of the quarter, launched what we call $5 wrap deal. It's 2 wraps for $5. That really moved the needle when it came to low-income consumers. In fact, the strongest part of their sales growth for the quarter in the U.S. was from those lower-income consumers. So we're not seeing an environment from a consumer standpoint where we can't drive transaction growth and drive sales.
David, I'm definitely in the Brad camp now. I'm hungry. So talk to me about how all of this relates to your pricing strategy. We've been talking pricing with everybody. It's really a hot topic right now. And a lot of, whether you're talking about packaged good companies or personal care companies or restaurant chains like yourselves, everyone's taking price. It sounds like, though, you guys are taking price maybe in certain areas, but you also want to still provide value. So how's that strategy playing out right now? And then how's it going to play out for the rest of the year?
Look, first and foremost, taking price is a last resort for us. We want to be the convenience and value option for consumers. But at the same time, we've got to preserve our franchisee profitability. And historically, our industry has been able to pass price increases along to consumers if they're done smartly. That's why we did the acquisition of a company called Quantum, for example, that does a lot of data and analytics work for our franchise partners to help figure out the right pricing constructs in markets around the world. So we're taking price where consumers can afford it, but we're still remaining great value for those that need to access other parts of our menu. That whole formula of being very smart about how we take price is really working for us. It's best exemplified, at Taco Bell, where they have their $2 value menu, which makes the brand accessible to everybody. But there are other versions of that really all around the world where we're very sharp and very thoughtful about how we take price and where we do it and when. As we enter into 2023, I do not anticipate taking as much price in 2023 as we did in 2022. Simply because inflation has abated for us in terms of our key input costs on the food side, and even the labor market has gotten a lot better. We now have more applications, more team members in stores, better staffed stores.
And it was a pretty stellar quarter for Pizza Hut, particularly in the U.S. Total sales accounted for 41% in the U.S. here. Do you think that you're taking market share from perhaps local pizza merchants or consumers trading to Pizza Hut?
There's no doubt that right now in the U.S. pizza market, Pizza Hut is winning and stealing share from others. And I'm proud of the work the team has done. And it's because of all the strategies that they've been working on for the last few years coming to fruition. We've embraced using aggregators, for example, where some of our competitors have not. That's provided us incremental sales. We've offered products like the melts, which appeal to a different consumer than the typical Pizza Hut consumer. So that's bringing in new consumers. It's bringing them in on different occasions. That's more of a lunch product, for example. So we have lots of things going on at Pizza Hut that are driving incrementality, and it all added up to a great quarter for them, and no doubt stealing market share from others.
And another buzzword that we've been hearing this earnings season is AI. I know that you mentioned it on the call. You're investing heavily in it, whether it's Dragontail, TikTok, if I said that right, recommended ordering. Break down how this is boosting productivity and profit for franchisees.
We've done a lot of work with technology, made a lot of investments in technology, and this is a strategy that has been going on for many years. This is nothing new. We're now just starting to see the fruits of it and how it's really paying off for our franchise partners. When we use technology to make our restaurants more efficient, for example, we bought a company called Dragontail that really improves the efficiency of how we sequence orders in a restaurant and how we use drivers on the road. When we do that, it has benefits to everybody. The franchisees get benefits because the efficiency of their team members goes up. The customer gets a benefit because they get a hotter, fresher product because we're better able to time when their product's made and when a delivery driver gets there to take it to the customer. And really, using technology for things like ordering benefits the customer and us. We end up with a higher average ticket. It's an easier way to order through e-commerce channels or even kiosks in our stores, like we have at Taco Bell now in the U.S. So the technology story is long, wide, and deep, and it is impacting every single part of our business.
David, while we think about how historical that delivery has been with pizza, there are other parts and brands and operations within your business that rely on or use third-party delivery services as well to engage with your end consumer and that customer who's just looking to get fed for lunch or for dinner. How much of that interaction and of that customer's data are you able to hold on to then turn into other types of touch points with that customer and ultimately monetize that customer even more?
Obviously, when we have customers opt into our loyalty programs, in which we have a lot of, we have great access to their data, and we formed a great relationship with them. And we see that driving incrementality every time we get a customer into the loyalty program. As far as all of the data we have, even if you look at it at an anonymous basis, we can draw a lot of conclusions about customer behavior and traffic patterns that can help us. What kinds of things are they more likely to add on what parts, on certain times of the day? What products really resonate with in different countries that maybe don't work in other countries? That's why we've been leaning so heavily on the data and analytics side of the business, doing a lot of external acquisitions to shore up our capabilities there. At the end of the day, Yum is the largest restaurant company in the world with over 55,000 restaurants. We should be, and we are, the leader when it comes to technology in the restaurant industry. We had 45% of our sales were through digital channels in this past quarter, a new record for us on mix, and a new record from a number standpoint at $7 billion.
There's sort of the technology that you're talking about, and then there's this sort of harder to, quantify or number crunch. I'm talking about TikTok because recently there was a viral challenge that claimed falsely, by the way, that if people could finish a bucket of your chicken in 60 minutes, they could come and get a free refill. You guys then offered a sort of related promotion. Like, how do you think about that kind of strategy, which again is more art than science, I'm guessing. And what kind of team do you have devoted to sort of tracking those kinds of trends?
Well, of course, digital and our brand's reputation and how we connect to consumers on those channels is absolutely critical to us. We have brands that are 60, 70 years old, but they remain forever young because of the way we show up and the consumer interest we have in those channels. And you mentioned one example, but there's 1,000 of them. You remember last year, we had Dolly Parton and Doja Cat getting on social media pleading for us to bring back the Mexican pizza. It's probably the best example of how social media can help our business. We ended up partnering with them and brought it back to great fanfare and great results. But each of our brands does have teams of people devoted to social, monitoring what's being discussed, making sure we're interacting with customers in a way that's consistent with our brand and how we want to treat customers, and using social to really amplify our message.
That was quite the partnership between Tennessee's finest and the Met Gala's finest teaming up. Ultimately here, David, when we think about the times of day that you're engaging with consumers, I want to talk about the share of breakfast. Where do you see Yum Brands excelling, and where would you like to invest more in getting a share of that breakfast portion of the day?
Well, breakfast is certainly an important part of the roadmap for our KFC and Taco Bell brands. Taco Bell launched breakfast many years ago in the U.S., and it's been a slow but steady build. They've been leaning in it more recently, using some celebrity spokespeople to get a lot of attention in the marketplace. And KFC, for example, just launched breakfast in South Africa. I saw some of the ads for that look fantastic. So certainly our challenge as leaders of these amazing brands is to constantly be finding new ways to connect with consumers and new occasions that we might not currently be serving. You saw that in a big way over the last few years when it came to off-premise with delivery and carryout. Taco Bell's off-premise business delivery business went from 0 to 20-something% overnight as we really leaned in and leveraged the technologies and the strategies that we had at the brand to service delivery. But you could say that about any occasion that we're not part of, and breakfast is certainly one of them. And we're proud of the progress we're making at Taco Bell in the U.S. and around the world with KFC.
We are expecting 300 million guest arrivals this year, and we've been getting more feedback than ever. And we want people to have an amazing experience in Airbnb. But that means listening to customers, and we've been getting a lot of feedback, millions of customer service tickets, social media posts, and we've been interviewing guests and hosts. And we've been asking them a question: what annoys you about Airbnb? What can we do to make the experience even better? And they gave us so many different pieces of feedback. Things like, we want to make sure Airbnbs are affordable. When we check out, we don't have too many chores. We want to see the price up front. We want customer service to be very responsive. The other thing we saw is some big new opportunities. We're seeing more and more people stay longer on Airbnb. So we've made it more affordable to stay longer. We've got this really great dial to be able to search from a month to a year on Airbnb. And probably the most important thing we're announcing is Airbnb Rooms. Airbnb Rooms is an all-new take on the idea that started it all. Airbnb Rooms gets us back to that founding ethos of sharing. And what it is basically just an idea that you stay in a room in someone's house, an extra guest room, while they're there. This is how we started. But the problem is that a lot of people have been telling us lately they don't feel comfortable staying with another person. We've heard this before. And so we said, well, what if we can develop a feature where you feel like you get to know the host before you book? And so we created this thing called the Host Passport. You can get to know the host. We verify their identity. You can learn about them. You can message them. So it's really just the idea of upgrading our profiles. And the reason someone would want to do this is the average price per night of an Airbnb room is $67 a night. And it's a great way to experience a city like a local.
Brian, let me follow up on that point because as you have highlighted, a number of your summer releases really does point to that cost savings element. I mean, to what extent are you seeing travelers, those users on Airbnb, trading down their experiences in this environment?
Well, I mean, we are absolutely seeing a lot more interest in more affordable rooms in homes on Airbnb. Our average daily rate, our price per night, is pretty constant with a year ago. So I wouldn't say it's going down, but it's not going up anymore. And we think ultimately it's a good thing because I think affordability is a big part of Airbnb. And we've noticed that hotels are a bit more expensive. Some studies suggest in the United States hotels are about 10 to 15% more expensive than a year ago. And so we're just trying to make sure that we provide a great great affordability. That's why we launched Airbnb Rooms. We now have opportunity to allow you to pay by bank if you have a monthly stay, which allows you to cut out the credit processing fees. There's a number of things we're doing to try to make Airbnb more affordable.
We've been speaking to a number of people within the travel sector. Everything points to real demand, significant demand, even going into the summer, even as those travelers get pinched. What are you seeing when you look ahead?
I think we're seeing that people are very interested in traveling, but they also want to make sure that the traveling options they have are more affordable than before. We also see a lot of people want to make international trips. A lot of people in the last 3 years have been isolated. They haven't felt comfortable crossing borders. I think people are finally getting more comfortable going to a foreign country. But again, if they do that, they're going to want to probably save more money than before, given inflation and other economic factors. Hence why Airbnb Rooms, we think, could be a really good option for a lot of people.
Brian, looking beyond Airbnb, we always like to talk to you about just where we're seeing the macro environment. You've got a pretty good pulse on what's happening in the Bay Area. And I wonder, as you've been seeing some of these regional banks collapse, particularly Silicon Valley Bank, what do you think that's done to the confidence of startups? A lot of them were banked there. And more broadly here, what does it mean for what was already a pretty fragile ecosystem?
I think that the regional banking crisis is probably honestly saying more about banking than Silicon Valley. I think that, the regional banks disproportionately affected early stage companies. Early stage companies' confidence were shaken for a week or two when it wasn't clear that people were going to have availability to the deposits within SVB. I think once those were backstopped, I think that kind of became an issue that people stopped worrying about. And so I think that it's a little bit a tale of two cities as far as tech. Really big companies and public companies, I think, have been under a lot of pressure. They don't have the multiples they used to have. They're experiencing a lot of layoffs. I think the same and maybe even worse are late stage private companies where their valuations might be 70% lower than the last round they raised money at. And a lot of companies might be underwater. They might be worth less than the amount of money that they raised. And of course, if an investor has a liquidation preference, that's a big problem for the founders. That being said, I think AI in particular has created so much excitement, and AI will allow you to be so much more productive that this feels in another way like, the mid 90s, presumably. Of course, I was in middle school, high school back then, or perhaps the mid 2000s during the mobile revolution, the social networking revolution, where I think people are seeing so much opportunity. So I think that whatever economic problems we have in the early stage is going to be overshadowed by the excitement of AI.
We're hearing a lot of mentions right now about AI over the course of this earnings period, even over the course of 2023. It seems like it's having its blockchain type of moment where companies would just say it, see their stock prices rise, but it's a question of how's this actually going to be implemented. I mean, when even Coke is talking about generative AI, you're kind of like, okay, all right, guys, come on. But for Airbnb, a technology company, does this make any sense for integrating generative AI into any portion of the Airbnb operation or the experience for customers? Do you even think about that right now?
Yeah, I mean, let's just back up.
Yeah.
There's a reason there's tech buzzwords.
Sure.
Because once in a while, they're real. The computer was real. The internet was real. Mobile was real. The problem is if somebody talked about the metaverse, then they talked about crypto Web3, now they're talking about AI, there's a good chance they don't know about any of them. Because how could you be an expert in all three? But it turns out that AI, this time, this one's real. Now, using the buzzword is not going to change anything. It's going to change everyone's life. It's going to be like electricity. It's going to be something that we're all going to live with. It's a little hard to predict. I don't think that it's something that is a bandwagon you jump on. It's just something that's like the weather just changed. You just live in this new world where everything's going to evolve. A little hard to predict exactly what's going to happen. I think the nearest term impact it's going to have is it's going to make everyone in tech companies more productive. Software engineering will be more efficient because computer programming is a language. Sure. And now suddenly these tools can, in some ways, do development just as good as a person, in some cases better than a person. It can be great QA, it can be a co-pilot for them, and it could even increase their productivity. So I think the main thing it's going to do is it's going to improve productivity. I think over the next couple of years, we're going to start to see really interesting applications go up. You only have a few big language models, like base models, maybe like OpenAI. So the real question, the real economic opportunity is what can you build on top of them? What applications are now possible because of AI that weren't? So again, there's a lot of buzzwords, but once in a while, they become revolutions.
Yeah, first, great to be here again with you. As you said, we are very happy with the results that we announced today. We continue to see very strong demand for leisure travel and for our cruise experiences. And it's a combination of a very attractive value proposition of cruise, the shift in preferences from our consumers to spend more on experiences, and we are well into the experience bucket, and our culture of innovation and performance that are driving the results.
Can you give us a little bit more of a backdrop regarding the consumer that wants to spend on experiences? Because we've heard this over and over about consumers spending more on services perhaps than on goods. So give us a backdrop on what is that traveler like? Where does that travel? Are there some routes that the traveler prefers over others?
Yeah, so we see a very broad range of excitement and demand across our products. We appeal to a very broad consumer base, and they seek everything, all the way from, this Oasis of the Class ship that I am on today from the Royal Caribbean International brand is going to cruise the Caribbean with a visit in our amazing private island, Perfect Day at Coco Cay. So it could be a short Caribbean itinerary, a longer vacation, or even a world cruise or a trip to Europe this summer. We have seen a very broad-based demand. The Caribbeans are especially very strong, and we see very, very strong demands for that. And that's a combination of what we are putting out there in terms of our experiences and products, the best ships, the best experiences, and the best destinations.
Now, we've seen recently this banking turmoil. There's a lot of market participants that are basically calling for a recession this year. I know that the cruise travelers are very loyal when it comes to their cruises, but how elastic is the customer really if there is a recession?
Yeah, we continue to see, as I said, very strong demand. It translates to us doubling our revenue yield guidance for the year and earnings increase of over 40%. And I think the combination of the secular demand that I was talking about, the fact that cruise is an exceptional value proposition compared to any other land vacation alternatives, we think we can close the gap to it. But that is a very compelling for the consumer, and just the strength of our platform. So we continue to see very strong demand. We do not see any cracks in the consumer. And we are very, very focused on making sure we deliver on that experience. And as we look forward, that is what we're seeing. And if you kind of look a little bit longer term, cruise has been exceptionally well, even in very different economic environment. So we're very excited about what's ahead.
Can you talk to us a little bit about cost? Because we have seen energy prices coming down. Is that a tailwind for you?
Yes, of course, fuel prices are a big component of our cost base. We are very focused on making sure that we are optimizing our consumption of fuel. We do hedge some of the fuel rates, so we have 50% hedge for the year. So we do have an opportunity to enjoy from lower fuel prices. And our focus is on growing the revenue and growing margins, so controlling the costs and making sure that we expand margin.
And talk to us a little bit about labor as well. Has it been difficult at all to get staff? Is it easier now? Because we have seen a little bit of a slowdown when it comes to the labor market, even though it's still tight.
Yeah, so our crew members, which is where the majority of our human capital has been so delighted to come back over the last couple of months back to doing what they do best and they love, which is deliver the best vacations responsibly. So if you get on the ships and you see them, they're all smiling, the guests are smiling, and that is really what they're focused on. So we didn't have any issues. We really had very strong demand to come back to those. We do see some more difficulty in our headquarters and shoreside. But this company is exceptional, and we see a lot of demand coming to work for us.
As of last month, when we reported on our first quarter, we had record numbers, right? We just got through the wave period, which is the highest booking period in the industry. We literally had the most bookings in the history of our company in that 3-month period. And that was both our North American brands and our European brands, which took a little longer to get back into that flow. So frankly speaking, between that and our first quarter results, where we beat on every single line item, things are trajectorying in the right trajectory.
Where are the bookings in relation to pre-pandemic levels?
So our book position is basically, if you look back at the last 15 years, it's one of our highest we've ever been in. So by the time we looked at the rest of the year at the end of the quarter, we were already 70% booked for the rest of the year. So we are very well positioned for the continued momentum and continued improvement.
How does pricing look?
Pricing's been pretty good. You know, what we saw since we've been through our restart is you got two aspects of the pricing. You got how much are people spending for tickets and how much are they spending on board. The onboard spending has been record levels, and we are talking about 20% higher than before the pandemic. And the good news is, over the last 5 quarters, while that's been maintaining at a nice steady pace, the ticket pricing is inching back up every single quarter. So the trajectory is really, again, I couldn't be prouder of the team and the things that we're doing.
I've heard a lot at this conference about an economic slowdown. I'm catching a different vibe from you. How do you square that?
You know, it's actually, I don't think it's particularly Carnival Corporation. Travel and leisure has not slowed down. So, you know, what we see is a consumer base that is demanding experience, demanding travel. I mean, we got to remember, people have been pent up. You know, that demand has been latent, waiting. And yeah, it's true, it's been a year and a half since the pandemic has run its course. But I'll tell you the truth, people had time, they had time to think about what are the things I really want to do, and they're expressing it now. And so between the future bookings and the real-time impact of onboard spending, we just see no slowdown.
Is there still that cohort that is afraid to get back on a ship?
There probably is. I mean, here's the thing about us and the thing about cruising. We're tiny, right? In the overall vacation market, we are, no matter how you want to cut it, less than 3%. There is a huge market of potential consumers out there in all of our main markets, the United States, the UK, Germany, Italy, Australia. What we need to do is amplify our voice and get more people who have never cruised before to consider us, and that's happening. Our level of first-time cruisers is almost back to where it was pre-pandemic, despite the concept that people might have been afraid. People understand value. They understand when their friends and family get off of a cruise and go home and rave about how amazing that experience was. It resonates with people, and they bring their friends and family next time.
Do you still hear that old saw that cruises are just for old people?
Yeah.
I'm guessing you don't believe in that.
I don't. You know, as a father of 3 kids who are now 18, 16, and 13, I can tell you we've been cruising every year since our 18-year-old was 1, and that is so far from the truth. I mean, there is truly something for everyone. And if you've never been, I can understand the myths, but the fact is, in today's world, there's not one main dining room with a early seating or a late seating as your option. There's actually 15 restaurants. You book like you're on land. There's 15 bars. There's water slides and roller coasters and ice cream parlors and rock walls and ice rinks. I mean, you name it. The cruise industry is radically different than where it was in the past, and we've got the demand to show that it's working.
Any line of sight into Carnival going back to China?
You know, I mean, the good thing about our assets is they're mobile. And so China has been shut down for international cruising for 3 years now. So we've done what we needed to do to, you know, move our assets where the guests are going to be and where they're going to want to sail. If and when China opens up for international cruising, it will be fantastic for the industry, and we'll look at it. Because our ships are mobile, we can go back. As of yet, there's nothing on the horizon I've seen, but we're patient.
You've touched a lot of different areas inside of Carnival. One of the cool areas I think that you touched is the numbers. You know a lot of the numbers. You've been at the company for a long time. There's a lot of issue, or just a lot of focus on our platform by retail investors. They understand Carnival. They understand what you do. But there's been concerns about your debt levels. When are you going to bring them down? Yeah. And what is an acceptable level of debt?
Well, yeah, I am a former treasurer, and so you know, getting back a fortress balance sheet is incredibly important to us. We peaked at $35 billion of debt. I was very, very happy to say on our last earnings call, two very important things. Number one, we have no intention of issuing any more equity. And number two, we are starting to pay down the debt.
I just want no more stock, because I know that has been talked about. No issuance. No issuance.
I mean, ultimately, it's always a board decision, but we have zero plans to do that. We've got the trajectory. We were generating cash. We are a cash generation business. And when you look at our CapEx profile over the next few years, it's our lowest ship order book in decades. When I first became treasurer in 2007, we had 24 ships on order. We now have 4 ships on order and a very small expedition ship, and that's it. And what that means is we take that cash and we pay down the debt, and we get back on the road to investment grade credit metrics, which is what we're shooting for.
How long do you think that would take?
Oh, it's years. It's not months. But we've got plans in place. We've got demand generation that's going to support that cash generation and expedite it.
Key message from our side is we are very focused on North America and the fuel cell truck, and we also build up the hydrogen infrastructure at the same time. We have taken important decisions. We have actually sold our European business to Iveco because it's in very good hands there. And obviously, it's important that we stay focused going forward. In terms of the pause of the battery electric truck is something which makes sense before we launch our fuel cell truck. And we are happy to take orders for the battery electric truck going forward because we have a flexible manufacturing line. So we are very focusing on the key things for Nikola, and that is certainly North America, the fuel cell truck, and hydrogen infrastructure.
Hey, Michael, Prost here. So I guess help us understand sort of why the joint venture between you and Iveco, the big, large European truck maker, why did you guys decide to sell that business off to them? I know you want to focus on the North American market, but does that deal continue forward? Do you guys still want to work with Iveco and use them as a parts and chassis supplier?
Yes, absolutely. I mean, it's a strong partnership, and Iveco will stay a shareholder of Nikola, and we will take their cabins and their e-axles, so we have a long-term supply agreement. So it's a really good partnership. But the reason why it makes so much sense, I mean, it's better that Iveco in Europe focuses on the European execution of things, and we do the same here in North America. It's much easier to do this here, and we also need our engineering resources now to finalize our fuel cell truck. So I think this is really a win-win for both companies.
So, Michael, here in the U.S., you are pausing production of that battery electric truck, like you said, at the Arizona plant as you work to modify that plant. What do your production targets look like for this year? And given the fact that we could see slowing growth in the second half of the year, how do you see that potentially affecting your business?
So we are actually more optimistic for the second half of the year, in particular because we will launch our fuel cell truck, which is a best-in-class truck with a range of up to 500 miles. And we gave guidance this morning between 375 and 500 trucks for the total year. But we lean more towards the fuel cell truck because we get feedback from customers that they prefer the better range, the lower fuel time, and also the weight. So this is clearly going in the direction of the fuel cell truck, where also Nikola has a first mover advantage. There is nobody else out there. And at the same time, we put up the energy infrastructure. So we lean more towards the fuel cell truck here.
So, but Michael, you don't see any signs of curbing demand or anything from some of your clients out there, potential clients, just in terms of the fact that we could, in fact, see a harsher slowdown than we had initially anticipated?
Well, look, I mean, the zero-emission mobility segment is still very, very small and is growing. And we see that customers are very interested in that. So we don't sense that we are impacted by the overall economy. It's more about like the ESG roadmap, and that people really now want to go into trucks without emission. That is what is happening. Our biggest bottleneck is really setting up the infrastructure for the electric trucks, but we try to find solutions with customers and dealers to do this as quickly as possible.
Hey, Michael, so I know those customers include companies like Walmart and also another private provider of service for the U.S. Postal Service. What are they telling you about that whole infrastructure build-out? Because there aren't that many hydrogen stations in the U.S. that can actually refuel these fuel cell trucks.
Exactly right. And that's why Nikola is uniquely positioned to set up really the hydrogen infrastructure, and we will produce green hydrogen, distribute it, and then dispense it, because you have to really offer both things. I think we have a world-class truck, but we also need to have the energy infrastructure. And we also offer very innovative things like a mobile fueler, so that we can bring our mobile fueler to the customer, and then the customer can fuel there. But it's very, very important. You need to have both. We always say you need to have the chicken and the egg. That is what customers are expecting. And I think Nikola is uniquely positioned to offer this.
Michael, there's a big focus on your cash reserves, your cash burn that you just reported here in Q1. Some concerns just that you're going to have to need to raise more funds. Do you have another? Are you thinking about considering more stock sales?
Sure. I mean, two things. First of all, cash burn will come down quite a bit because we have invested a lot in R&D, and you see the results. I mean, we have fantastic products, but going forward, R&D will come down. And also cash burn then will go down. At the same time, yes, we will have to raise capital. We also ask stockholders for approval beginning of June so that we have a foundation then to issue more shares and raise more capital going forward.
Thank you for having me. And capital markets is the lifeblood of our business. Our capital team is the bringer of what we lend out, the money that we offer our consumers at the point of sale. Obviously, as the Fed figures out how to combat inflation, it changes our cost of capital. That puts pressure or relieves it on our ultimate bottom line, revenue less transaction cost. And as the Fed changed rates quite dramatically, had a real impact on our LTC. That said, the quarter we just printed, we've always said that we intend to drive our LTC number between 3% and 4%. We're just a smidgen below 3 last quarter. We printed an exceptional quarter. It was 3.6 this last one. We still affirm our plans to be between 3 and 4. Just shows that the business ultimately is really resilient. We have a tremendous amount of consumer and merchant demand. There will be short-term disruptions from capital, from other places, but ultimately this is a great business. Seems to be performing really well, and I think majority of it is thanks to the team's excellent execution.
Max, it doesn't sound like you're convinced that the Fed has figured out how to fight inflation. You know, even as we're kind of parsing through some of the figures from this morning's inflation report and CPI report.
I certainly think it's too early to tell. I'm not making any bets about the forward curve that's not reflected in the forward curve, but I do think that their work is starting to bear fruit. I think the CPI came in below expectations for a good reason. That's generally good news for us at Affirm in the long term, sense that the cost of capital will ultimately come down as the spreads come in and narrow down a little bit. Again, I'm primarily focused less on the Fed, much more on my ultimate customer, which is the consumer and the merchant. We saw great growth in activity. We're very focused on being there where our consumers need us. So frequency of usage is a really important metric. All those things we beat across the board. Business is just humming in all cylinders. Team is executing really well. The Fed will do what the Fed will do, and we'll roll with it, and just like we always do.
Give me a little more detail, Max, if you would, on how you guys are compensating for it, right? Because you talked about that a little bit in the statement and on the call, doing some, seeing that that rates are going to continue perhaps to move higher. You guys talked about some pricing initiatives and levers that you all can pull if that macro environment continues. Give us a little more granularity, if you could, on those levers.
Sure. And actually, I should step back and sort of explain probably the single most important thing that we had not mentioned, perhaps because we've done also so well in that one. So credit, quality of credit, maintaining good yield for our capital partners is job number one. So we printed another great quarter with delinquencies coming down. If you look across the industry from every bank, every lender out there, you see delinquencies on average going up. Ours went down. We managed our credit outcomes very, very carefully. One of the things we can do to improve profit margin is to just be extra careful with our approvals. We underwrite every transaction. We have a lot of control over what we will and will not lend to. So that's the lever we control the most, the lever we care about the most, is just maintaining exceptional quality of credit. And that's what we certainly did last quarter. We have all the intentions of doing it. The other obvious thing we can do is we can pass some of the increased cost of capital on to consumers or merchants. We have two major constituents. We have reported that we expanded our APR ranges that our consumers pay by 600 basis points to about half of our merchant base. That's an ongoing project. We'll continue doing that, and we'll just have wider APRs available to our loans and therefore be able to approve more people. That's the other one. And then over time, as we get to scale, and most importantly, as we prove that we really are in control of the credit outcomes, we get better and better deals with our capital markets partners as they recognize that we're able to deliver them yield without creating too much volatility. That allows us to tap into deeper pools of capital, folks that don't need crazy high risk, reward returns, but much rather have really steady, well-managed yields. And that's certainly where we are spending a lot of our time now.
So if I understand you, Max, it sounds like maybe I'm reading between the lines too much. You tell me. In this environment, when we are going to see a tightening of credit, there are going to be people who cannot borrow from traditional banks because of this environment. Maybe they're going to come to you. And it sounds like you are broadening things out a little bit, if I'm understanding you correctly. How do you balance that with the sort of a firm push for conservatism, right, in this kind of environment?
So I'm not sure we really compete with banks. We lend money at the point of sale, and the primary alternative to a firm, or we are the primary alternative, given that this is very much a David and Goliath fight, are credit cards. We compete with credit cards. And when consumer says, you know what, I'm already overextended, I'm revolving, I have no idea what I'm paying in interest, Affirm is a great alternative. All of our interest is capped. It's always simple. There are no late fees. It's a much, much, much healthier financial product. And so we are maintaining credit by way of literally telling folks, hey, you are overextending yourself. You shouldn't borrow money. We don't benefit if you're late because we don't charge late fees. That's the way we regulate credit, basically over borrowing. And so in that sense, we're quite conservative, always have been. We're always making sure that our consumers are not overextending themselves. If we're able to pass the cost of increased funds cost onto the consumer by offering them a slightly higher APR rate, or onto merchants who pay us for every transaction that happens according to whatever contract we have with them, in those cases, we can approve a little bit wider because that allows us to compensate for the extra risk we take. But generally speaking, our posture towards the consumer credit and overall economic outlook is still quite conservative. I'm not yet celebrating the end of inflation or the impending lowering of rates or anything of the sort.
Max, does anything you're seeing in Affirm's data about the way that consumers are looking to finance purchases at the point of sale right now signal to you that they are bracing for a severe recession?
No. In fact, I can tell you that consumers are still very excited about travel. Travel and ticketing is one of the strongest categories we saw the last couple of quarters. People are sick and tired of being at home. They want to get out of town. They are traveling. They're staying in hotels. They are renting cars. They're going on cruises. All of those areas are areas of meaningful growth. Travel ticketing last quarter grew 60+% for us, which is quite a lot. The other side, the darker side of the considered purchase economy, if you will, are things that you bought during the lockdowns. So if you're buying an exercise machine for your home, or you're buying fancy kitchen equipment, that's probably getting postponed as you're figuring out how to deal with inflation. And there's real pressure on folks because of rising prices, in particular rent prices. So consumer is still fully employed. They're doing fine. They're paying their bills. They're still shopping, but they are figuring out whether the dollar goes to point A or point B. And generally speaking, if you wanted to sort of make a blanket statement, point A, where the dollars go, is events and experiences, and far less so goods that will fit into your kitchen or your spare bedroom.
Well, I think, first of all, thank you for having Dutch Bros. And, I think we're in the early innings of a long-term plan. And so, our path to 4,000 stores is going to have some highs. It's going to have some challenges, and we're working through those, quarter after quarter. So, I think that the opening 45 shops in the first quarter, we were lapping a difficult lap from first quarter of 22, of which our sales were up because we were still kind of coming out of Omicron and had been the benefit of being open 100% of the time, and we knew the first quarter of this year was going to be a challenging lap as we kind of looked at the year. But long term, 45 shops. We'll open 150 locations this year. We opened 150 last year. So, if you take last year and this year, that's 280 locations on a 700+ shop base, and we feel really good still about the long-term prospects.
And also, too, you've been aggressively growing in Texas in particular. And I think on the earnings call yesterday afternoon, some analysts were questioning how exactly you're increasing brand awareness and bringing in volume. So can you add some sort of color to that about how you open up these new stores and drive customers into them? And if you're seeing perhaps a misalignment there?
No, actually, we're very pleased with the response in Texas, from El Paso to Houston to Dallas and really everywhere in between. We've taken a very aggressive approach there. We decided to go in and kind of execute this fortressing strategy that we have and go in and do urban suburban development, and introduce the brand. We know that building this brand is it's a long-term play. Our shops don't open to maximum potential right away, and we've seen that happen in Las Vegas in the past. We've seen it happen in Denver in the past. We've seen it happen in Tucson in the past, for example. And we just see a more aggressive approach to Texas is really playing out the way many other markets have in the development of this brand over the last 30 years. So, we're very pleased with Texas. We're very pleased with the response we've had. We're pleased with the word of mouth and the growth and the service and the staffing that we have in that market, and really excited about what that gives us for the future. So super excited about Texas, and we've been opportunistic on some real estate there, and decided to take a fast approach, and we'll continue down that path.
And you did see one of your largest sales in company's record history with a promotion that you guys did. I believe it was 4 medium drink promotion back in March. How does Dutch Bros view promotions as a key, perhaps essential part of this growth plan, and ultimately use it to drive sales?
Well, when promotions are important, and it's important to do it the right way. I think in many cases, we're still introducing the brand and the several categories that we serve, to many new customers around the country. And so we've got to find trial driving promotions to get people into shops, buy those extra drinks and showcase some of the things that maybe you didn't know you could have in a day. And beverage is also it's a daily habit, it's a daily pattern. And so we have to go in and introduce the brand. We've got to introduce why our products are better, and why the service and the great part of your day when you come to Dutch. Our people are serving you with a smile. They're taking care of you and giving you a service that maybe you can't get anywhere else. So, but that combination of service and a great drink, we're trying to introduce to everybody along the way, and it's a curated process. So promotions are driving in a way to introduce you to things where you can experience more of the Dutch Bros menu.
Smiles as a service. That's a different kind of SaaS, Josh, that I hadn't heard before. So I like that. As we're thinking about the little luxuries that habitual daily purchase is, though, have you seen any pushback on price from consumers right now? And I'm thinking about that in the context of even today's CPI report that we were looking through, trying to get a sense of where consumers are seeing prices abate a little bit, or where they're pushing back and companies are being cognizant about how that relationship still needs to further.
I think that's spot on. I think that the price environment that we've been through in the last year or so, with the elevated price increases and the things that happened in 2022, I think everybody's watching consumer response. I think the general feeling last year is that those price increases were accepted, and we saw cost of goods inflation at record levels. This year you're starting to see COGS level off, and I think that everyone is evaluating their pricing strategies and even maybe reinvesting. I think that we changed our Dutch Rewards program in late March, and basically why we did that is that we could reinvest into more promos and types of offerings for the customer to drive traffic and build that long-term acceptance of the brand. So I think everybody's looking at it. I think price, I think promotion, I think that depending on how the cost of goods market shakes out over the back half of the year, we'll just have to see how all those things go. But we haven't seen much pushback. In fact, our loyal customers at the top end of our traffic, they've stayed with us. Those numbers have really been pretty even across the board. If anything, we've seen some pullback in maybe some of the less frequent shopper as we've kind of evaluated what's happened so far in 23.
And John, you and I have discussed how drive-through remains a key part of the Dutch Bros model. And yesterday we heard from Wendy's that they teamed up with Google Cloud. They're introducing an AI for voice ordering at their drive-through. Would you consider AI as part of a future Dutch Bros perhaps model?
Well, I think AI is going to be part of our world in one way, shape, or form. I think that for us, It's the balance of how do we maintain that great experience with our people in a service-driven model, but how do we utilize AI and other technologies to enhance the consumer experience? And I think there's some great back-end solutions to AI and other technologies that can do that. It can speed our lines up. It can help us be more attentive to the service side, where maybe the AI modeling can help us with some other predictive behavior in how the consumer is going to buy or purchase patterns. So we'll see. I'm very excited about AI. I'm excited about the potential of it. But in the meantime, we're focused on building out the rewards app. We've got some payment processing systems that we're using to speed up, and we've got some other back-end technology that we're working on. And I think you have to be investing in tech and tech systems now in order to prepare yourself for what's coming.
The fact is that this recovery has been primarily leisure-led, but we're seeing steady demand increase in business travel and even more impressively in group demand. That is for larger groups, especially for corporations. And we're seeing really fantastic pacing for group bookings into next year. So things are clicking well across our key segments and across the globe. China's recovering as well. So we feel that this is, we're gaining more visibility further into the future with forward bookings. And we feel very confident in our cash flow generation. And so this was the right time to start returning more capital to shareholders.
Mark, it's an interesting contrast to some other names that we have heard in the travel space. Airbnb just a few days ago saying that they're starting to see travelers be a little more cost conscious. As you point out, you compete on the higher end. What are you seeing on that front in terms of how they're looking at the summer travel season, even given inflation?
Well, I would say that our demand has been sustained. And you're right, we do serve the higher end traveler. And so I wouldn't extrapolate what we're experiencing across the entire industry. I would also say that I'm actually sitting in one of our top tier of luxury in our all-inclusive portfolio, which is the Impression by Secrets brand. So the all-inclusive experience is actually at the other end of the spectrum from what Airbnb provides. So I think it's a very different value proposition for and experience for travelers, and more people want the certainty and the predictability with respect to what you pay for the all-inclusive holiday experience. So we're seeing great demand in the all-inclusive resort category and in our resorts generally speaking. So yes, we see sustained demand into the future.
Mark, so certainly the leisure traveler has been very, very strong, and that's been the case across the board. What about the business traveler? Because I was looking at your most recent results here. You're seeing about 85% of the levels that you saw pre-pandemic. Do you think we'll get back to 100%?
I do. Business travel's changed a bit in terms of purpose of visit. So what used to be strictly transient trips, like individual travelers traveling by themselves, in some cases has turned into groups of people from a given company traveling together. So that would be treated as a group, not a transient trip. So the line between transient and group has blurred a bit. So I think of it as commercial demand, like demand from corporations and from associations who are holding meetings. And I think that overall, what we will see is a full return of business travel broadly defined. What I would also say is that the quarter got better and better. So we did end the first quarter at about 85% of pre-pandemic levels, but it improved to the low 90s by April. So it continues to improve month over month, and we're seeing that momentum ahead.
You know, the group travel within business travelers, we've also heard from companies themselves saying that they've learned over the years that you don't necessarily need to travel as often when we're talking about business travel specifically. To what extent are you able to make up some of that slack with those leisure travelers you alluded to earlier?
Actually, what you described is exactly what has happened. Leisure demand has filled in and we are well over indexed, I would say, in leisure. So we've seen leisure demand grow at a much faster pace than business travel. And overall, we are running ahead of 2019 levels as a whole company. And a lot of that has to do with the fact that we are serving more leisure guests in these days than we were back in 2019. So that substitution has occurred. It's also true that the shoulder periods in the week, which are Thursday night and Sunday night, which historically have always been the weakest nights for occupancy, have recovered much better than the midweek days of Monday night, Tuesday night, Wednesday night. And a lot of that has to do with the fact that a lot more people are taking long weekends and doing work and also taking a break and having a vacation at the same time.
Mark, I was at Goldman's Industrial Conference yesterday, and there was a massive topic. It seemed like almost every single conversation that I had yesterday also involved AI. How do you see, or do you see AI playing into your business, and what does the timeline look like for that?
Well, AI is certainly playing a role in travel, first and foremost in travel distribution. I think the opportunity to allow individual guests to customize their searches based on their desires and certain keywords is significant, and we're already experimenting. We are taking it slowly because in some of the applications that we have in mind, there's data that would be important to provide and to churn through, and we still need to understand the environment in which that's going to happen in a protected way. So I do think that there are many, many applications, and some of that has to do with the way in which we actually go to market. I'll give you a very funny example, though. We just launched a new brand called Hyatt Studios, and we just used ChatGPT, and we said, if Hyatt were launching a new brand, and we described what the brand was, what color would the logo be? What color would be featured in the logo? And what it did was evaluate all the other logos that we have in our portfolio. They recommended a very specific shade of blue. In parallel, our agency selected that same exact shade of blue as their number one recommendation. Complete coincidence, but fascinating, right? And
did you guys go with it?
We did. Actually, the new logo, the core dark blue color that's in that logo is the same color that ChatGPT recommended to us. So in some ways, we were just having fun. We were just having fun to say, okay, what would it say? And lo and behold, our agency came up with the same color. So I think there are going to be many fun applications as well. That's just one example.
Americans have always grilled, and food is becoming more important to Americans. So there's a long-term trend around food as an experience and around backyard cooking. We've gone through an interesting moment in time where the pandemic was a real tailwind to the category. And then when the pandemic ended, Americans said, at number one, we're done buying high-ticket durables, and we want to travel. And so there was a very clear and very sudden shift in consumer behavior. But I think it's always important to step back and think about what is the thesis behind Traeger, and why is it intact, and why will we win long term? And I'd say, first of all, we've been a share taker for 10 of the 10 years that I've been here. And so, if you were to rewind back to 2013, Traeger and wood pellet grills did not register from a market share perspective. We're now about just north of 12% of the dollar share of the outdoor cooking market. We're clearly going through a tough moment, but Traeger wins because we have by far the best product experience, and we measure that through a Net Promoter Score. We really believe in bringing innovation and experience to our consumers, and we have this vibrant community that absolutely loves Traeger and loves to self-identify with the brand, the community, with creating great food and sharing it. So no doubt, I mean, we're in a tough moment in time. But I think if you look at the quarter that we had, we are showing real signs of stability. The platform is alive and well, and we're sort of balancing some of these post-pandemic headwinds with an eye towards making the investments so that long term we will continue to win and be a share taker.
I'm going to clip you saying that Americans always grill and send that to the heads of my apartment building who close the grills for certain months of the year because it is a travesty. I'm trying to get outside, throw some stuff on the grill. Net, here as we think about the wholesale side of this equation too, what are you hearing from your wholesale partners that are trying to move through inventory still?
Yeah, that's a good question. And this, I would say, has probably been the most painful part of our business. And notably, as a company trying to have visibility into, into sales. So the first quarter of last year, retailers took in a lot of inventory, not just of Traeger, but of everything coming out of the pandemic where demand was high and where there was just an insatiable amount of demand and not enough supply. And so retailers really brought in a lot of inventory. As sell-through declined, retailers said, no more inventory. We need to slow that down. And so this destocking phenomenon created a really difficult year. Combination in 2022, combination of sales being down and destocking. Retailers were replenishing, let's say one grill for every three that they sold. And that makes it really hard to gain visibility because we're beholden to this retail partner in the middle. And we've got some phenomenal partners, but we had to work with them to help bring inventory levels down. The good news is that inventories for Traeger in channel are getting really healthy. We made tremendous progress in the first quarter of this year. Channel level inventories are looking good. We believe they will be very, very clean and healthy by the end of the second quarter. And I would also say our own inventories have improved a lot. We experienced a 14% sequential decline in inventories between the fourth quarter and the first quarter. And so as we're whittling down this inventory, as we're starting to see some macro trends in our favor around cost inputs that will drive gross margin in the back half of this year, the name of the game is like manage through a challenging moment, but stay focused on this long-term objective of a very vibrant brand and community and innovation in a product experience that consumers really care about and are willing to invest in.
Well, on that last point, Jeremy, are you seeing any consumers trade down in grills to less expensive grills? And what kind of discounting is happening on Traeger products right now?
Do you know what? We were more promotional last year than we have typically been, with the objective of really bringing our inventory levels down and freeing up working capital. We have been less promotional this year. In fact, we're a believer that great brands don't go on sale very often, and we are back to a more traditional cadence. It was actually very insightful to see as we came into January and we were full price. We were full price throughout the first quarter. So the results that we delivered are at full price. And I really think that speaks to the quality of the brand. I would say the grilling environment is more promotional now than it has historically been, but it's not for Traeger. We're driving full price business, and we feel really good about our consumers' willingness to pay. And there's really no trend towards trading down to lower price points. Traeger's a premium brand. We are accessible, but we're premium. And so we really speak to a consumer who's willing to invest in the experience. And even in a tough economy, we feel good about the mix of business that we're doing from a product perspective.
Well, I think it's already summer, so you should get your swim trunks out and get going. But we're seeing a ton of demand. Obviously, a big pickup. You've probably heard in international travel this summer as international trends have come back. So lots of demand domestically, lots of demand internationally. Still not all of the airlift back across the world, so still some tightness in supply and air. And unfortunately, that means prices are going to stay high for the summer.
Peter, how do trends in the business compare today or compare them to pre-pandemic levels?
Yeah, a lot of trends have actually returned to kind of pre-pandemic levels. When you look at the splits between domestic and international, when you look at the splits between big city versus beaches and mountains, which were popular during COVID, as getaway places. And we also saw a big stretch of duration of stay, length of stay during COVID, where people were basically fully hybrid, or weren't going in the office, so you could go work for a month from wherever if you could afford to. And so those trends have all basically returned to pre-pandemic, which is length of stay has shrunk. Big cities are back in a big way, and everything's kind of normalized, international to domestic. There's still a few spots. China's not fully back. Parts of Asia, but generally things are returning to pretty much pre-pandemic normals.
Why are the prices climbing?
Why are the prices high? Is that what you said?
Yeah.
Well, it's a supply. Well, first of all, we had several years of inflation. We had more demand than supply. There's still demand outstripping supply. When you think of, we think there's been a structural change and more people just want to travel generally. It's not revenge travel anymore. It's just more travel as opposed to spending money on other things. And you've still, as I mentioned, got pockets where supply is not back fully. So prices were driven higher when there was tons of revenge travel, tons of inflation, and they got to a point, and now they're basically holding because demand has stayed up. And if you think about air travel, there's a little less supply in the world, so they can keep prices high. And in the hotel world, hotels have generally been willing to trade off a little volume for price because getting employees is harder. There's other issues. So we've seen, hotels, airlines, et cetera, sustain price. Car rentals a little different. Car supply has come back, and those prices have come down considerably. But certainly in hotel and in air, they're staying pretty high.
How long could this recovery in leisure travel continue? And I ask you that, Peter, because today we get an earnings report from a Walmart, yesterday Target, and they're telling us that consumers are very cautious, so cautious that they're maybe not putting an extra pair of socks or another pair of bathing suits into their shopping basket because inflation is so high.
Yeah, look, I think so far, again, we're not seeing any signs of it. I think it's clear that people are prioritizing travel over many other things. I don't know about socks, but, I think we're going to, it appears like it will sustain itself. And I think people, again, have slightly more time, not as much time as during COVID, but with hybrid work, there's a little more time for leisure travel. There's a lot of, factors going into it, but I think so far, and this is really across the globe, we're not seeing any real downturns from anything that we would all call, economic pressure. So will it sustain itself forever? Who knows? But depending on the depth of any, economic pressure we get, et cetera, it appears like travel will remain the top of the list of what people want to spend on. And that means, we should see travel and leisure travel hold up. Corporate travel is slightly different, but certainly in the leisure space, it's been incredibly strong.
Last time we talked, Peter, it sounded like you were getting ready to launch a new awards program. And I know a lot of the analysts in the street are excited to think about what that might mean to your bottom line. Where are you in that?
Yeah, so I'm even more excited than the analysts. So we are launching in July in the U.S. It's called One Key. It will encompass our big three brands, Expedia, Hotels.com, and Vrbo, and you'll be able to earn cash, burn cash. We're calling it One Key Cash across all of the products. So you can take a cruise and earn points and use it for vacation rental, vice versa, hotel, air, et cetera. So we're really excited about it. It's the first of its kind. We obviously have a huge member base, and we think putting the member bases together and, in vacation rentals, there hasn't even been a way to get rewarded. So now this will be the first real rewards program for vacation rental, which we think is really powerful for Vrbo. And even more importantly, the fact that you'll be able to share across all the brands. And we'll take that whole consumer base and be able to give them more benefits, more member discounts. We're sourcing more high-level discounts for people. There's going to be more package discounts. So there's a lot of benefits coming, and we're really excited. So we're launching that July 6th. Going to have a big party in New York. You should come, and it's going to be great.
Well, you know my email, Peter. By all means, send the invite. And maybe when I do come to that party, we could talk about your AI initiatives. You, along with a lot of other companies, are teaming up with or looking into ChatGPT. What are you doing there, and how will AI change the travel experience?
Yeah, well, first of all, we got to work on your party game, because if you want to talk about AI at a party, we have an issue. But putting that aside, we're really excited about AI. We've been working in the space for a long time. And as I said on our earnings call and many other calls, we've been working the space to enhance the consumer proposition for years, and that goes into every big and little thing you see, whether it's what images we show you, how we sort and filter for you, and a bunch of other things. But the onset of large language models and ChatGPT in particular was exciting to us. As I say, we stayed in the front foot on AI for a long time, and when that came, we really got after it to see how we could use it to enhance the consumer experience. So the first place we've experimented with is we have a plugin into ChatGPT, and people can be in ChatGPT, ask travel questions, get recommendations from ChatGPT, and then click off into our environment. Now that's only for the developer universe and the paid universe, so it's not available to everybody yet, but we were basically the first in travel to get there. And then the inverse is maybe more exciting. We brought ChatGPT into our app, our iOS app, and we're basically allowing people to use ChatGPT to ask, where should I stay near the Empire State Building or near the Eiffel Tower? What are the best hotels near? Whatever. They can ask a bunch of questions. And then as they get recommendations, we save those recommendations to our trip planning products, and you can go in and search and compare and do all those things. But there's lots more potential for that, and we are looking at interesting ways to use ChatGPT to help in service, perhaps help people in search and sort if they want to ask longer, bigger questions. So there's really a lot of areas where it has application, and we're working closely with ChatGPT and looking at ways where we can utilize the technology.
As a leader working so closely with AI, Peter, I know there's some very interesting initiatives. Bigger picture, do you have any concerns how AI impacts the economy over time?
Yeah, we've watched a lot. I've watched a lot of the debates. I think they're really interesting, and obviously there are implications for humanity. And I know people like to get focused on the political environment and other places where it can be used or perhaps abused. I think many have said, including Sam Altman, that probably regulation will be required, and I think that's a healthy thing. But I think when people think about it, they get over biased towards all of those dramatic stories. There are a lot of really, really good applications that don't take jobs away, don't change the political climate, that really just enhance people's experiences with products that we use every day or try to use every day. And I think if you think about all the ways that can enhance people's experience, if searching's complicated, there's all kinds of applications of people with that are have disabilities or other challenges. So there's a lot of great uses and utility to really enhance what people are doing as opposed to replace what people are doing. So I think in our environment, it's a perfect example. We had to build guardrails for ChatGPT so that it would only answer travel questions. We didn't want it to get into other things with our consumers. We're not interested in answering those problems. So you have to, you can't just set it free and see what happens. You have to use it for a particular application. But if used in the right ways, we think it's incredibly valuable to enhancing a consumer experience, our workers' experience, our service personnel will be able to use it someday. And we're constantly working to enhance those things. So if this helps us do better, that'll be great.
Well, again, the shopper is there, but they're definitely looking for value. And that's what you get when you shop in our shopping centers every day. We are a value platform, but for brands that people seek. So we're not selling commodity priced goods at the cheapest price. We're selling great international and national brands every day at the best possible pricing, and the customers are seeking that, and we're meeting them where they are.
Yeah, I mean, what have you seen anecdotally in terms of foot traffic, in terms of bringing new consumers on board? Because to Shauna's point, we heard from so many of these retailers saying we're seeing higher end consumers trade down. We're also seeing additional consumers that are maybe on the lower end mixing up what exactly they're purchasing, not as much for discretionary items. I mean, give me an anecdote of what specifically you're viewing in your outlet.
Yeah, well, first of all, in general, I think the retailers that are winning are the ones that are discounting deepest. And that's in the apparel. We're seeing the same thing in accessories. If you're an accessory retailer and you're discounting right now, you're seeing a lot of customer traffic in your shopping center, in your stores. Similarly, in the athletic brands, we heard the news about Foot Locker today, but what we're seeing is slightly different. We have Nike stores, Adidas stores, Puma stores, and where they're offering the consumer those famous brands that they love at the best possible price, we're seeing the customer respond and shop there.
Stephen, I'm taking a look at your investor presentation today. 96.5% occupancy levels. Pretty impressive given this environment. We certainly have seen the rebound in retail. What do you think the growth trajectory then looks like here from here on out, given the fact that how consumers are shopping continues to change?
Well, first of all, we'll be going to ICSC. That's the council, the shopping center council. Meetings will be held in Las Vegas this week. And from what I understand, it will be probably the best attended ICSC in years, meaning the retailers are out in force and the developers are there. We're meeting with them on a regular basis. They're coming in with open to buys and looking to build their store counts in our portfolio. There's a number of retailers, we had a discussion about this morning, a number of retailers in our portfolio who had been on the sidelines for the past 2 or 3 years that are now very actively pursuing building their stores, particularly in the outlet space, because that's where they see the consumer coming to shop.
Stephen, you were running through some of the brands that you've seen do particularly well when you think about your outlets, but we've also heard about the shift over and over from goods to services, that services are where consumers are willing to spend the money or the additional money that they do have. Are you seeing that shift?
We are, and I think that's a trend that we've seen for the last, I would say, 2 or 3 years. Folks traditionally would come to an outlet center to shop, and they're looking for that power shopping experience, great brands, great value. But what we're finding is that they're staying for lunch, and they're staying for meals, and they're staying for entertainment. And we're providing all of those uses in our centers as well. In fact, the sign went up yesterday in San Marcos, Texas for our first Shake Shack. So we're excited to bring that into the market. We're under construction across our portfolio right now for 2 Dave & Buster's, because we think that there's a customer who wants to come and do something other than shop when they're in an open air environment like a Tanger shopping center. And we want to bring them those uses as well.
When it comes to the rents, what you're able to charge here, is that consistently increasing? And do you see that trend sticking?
Well, yeah, we reported in our last quarter that our rent spreads, which is the indication of how much more rent we're getting from the previous tenant, they continue to go up. And we've grown our rent spreads for 8 consecutive quarters now, and the last quarter being the highest growth that we've seen so far.
Is it the case across regionally speaking as well, or are you seeing strength in certain areas?
Well, I would say the stronger demographic and the stronger market that we're seeing right now is in the South. But I think a lot of that will pivot now that the summer months are coming to the North. We're primarily an East Coast shopping center company. We do have centers in Texas, and we do have one center in Arizona, which happens to be one of our best performing centers in our portfolio right now.
So Denver has been a phenomenal airport for us at United Airlines, and the city worked with us and built more gates. We're opening 12 more gates. We got a couple more clubs opening soon. We're the largest private employer here in Denver. We've added 35 new flights. It is basically tied with Chicago as our largest airport in the country now, but we have more gates here than anywhere. And so growth to come in the near term, but also in the years ahead. It's a great growing city, great geography for connecting customers across the country. We're really excited about everything that's going on for us here in Denver.
Scott, you made a very interesting point in the press release on this morning, that this might be a hybrid work play by United. Explain that to us.
Yeah. So, I've been saying hybrid work makes every weekend a holiday. And so when people are going to the office, 3-4 days a week, it used to be if they were, tethered to their desk from 9 to 5, Monday to Friday, they couldn't get away for the weekend because it just wasn't enough time. But now they can leave Wednesday night or Thursday morning and go somewhere, go to Florida or go to Cancun or go up to the Poconos or whatever it is. And they work remotely for 1 or 2 days. And so they're still online and they're still working, but they work remotely. And so it means there's just a structurally higher level of travel than there was before because people weren't constrained by money, they're constrained by time. And taking that time constraint off gives them more ability to travel. And when we see that happening, and have seen it happening for the past kind of year and a half.
Scott, for investors not too familiar where else you're putting capital to work, so $1 billion in Denver, that's a very large number. Where else are you investing in the United States at the same level or even more?
Well, by far our biggest investment is in aircraft. We've got the largest aircraft orders in history coming this year and in the years to come. So we're going to spend a little over $8 billion in CapEx this year, mostly on aircraft. We're making big investments at almost all of our airports, but the big CapEx number for us is aircraft.
And I see the 737 MAX by Boeing will be part of you're planning in Denver. Is there still customer hesitancy on getting on that airplane?
No, I mean, it's a great airplane, very safe airplane, and there's no impact at all.
Talk to us about Memorial Day weekend demand. It's expected to be very strong. Compared to when we just heard from you a couple weeks on earnings, how is the demand environment looking?
Look, the demand environment remains very good. We've had 6 of our 10 highest in history revenue booking days here in the month of May. The other 4 were all in March before Silicon Valley banking scare. So the demand environment remains very good. We're expecting all-time records this weekend, but consistent all-time records as we go through the summer, and expect to continue to break the booked revenue records as we move forward.
What is growing faster, U.S. or international travel?
So international is growing faster. International is growing faster really across the board. And a lot of what happened last year is international borders were still tough, either completely closed or there were all kinds of requirements to get in around COVID. And so that caused, a surge in demand for domestic travel. This year, borders are open. A lot of people are able to go for the first time. And so long haul international in particularly is the strongest part of the network.
We were looking at the latest CPI data, Scott, and we noticed that prices for airfares have started to come down a little bit. Is that because of more capacity in the airline industry or consumers balking at some of the higher prices?
No, I think this is really just a function of COVID. Airfares went up a lot last year, as there was coming out of Omicron and with the pent-up demand. And so they're now coming back to kind of the trend line of where they were before relative to GDP. So we all expected this. I don't think there's anything to read into it other than this time last year was this really surge, especially for domestic demand, and that CPI data is heavily weighted to domestic because people couldn't travel internationally. And so last year was the anomaly, and this year is back to normal trend line.
As an airline, Scott, that is investing billions of dollars each year, airplanes, infrastructure like in Denver, how concerned are you about what's going on in Washington right now with the debt ceiling debate, and how destabilizing could that be to your business and the overall airline industry if there is a default?
Well, first, I've already talked about demand is really good for us. And so it feels to me like the economy we're going to make it through this, fighting back against inflation with either, a soft landing or at worst a mild recession. But the economy is balanced on a knife's edge. When Silicon Valley banking scare started, we saw a 15% overnight drop in business bookings. And that tells you that the economy's very fragile. And that's what I'm worried about with the debt ceiling. And, we don't need an unforced error in the economy. And this would just be an unforced error. And I really hope that our politicians can find a way to compromise, and I'm bipartisan in that, both sides compromise and get a deal done because we're going to make it through a tough period, I think without a lot of damage unless we do harm to ourselves. So let's not do harm to ourselves, not have an unforced error around the debt ceiling.
A lot of leaders I talk to, Scott, share your sentiment, absolutely. But as a leader, as a CEO of a very large company, do you put plans in place if it doesn't go according to plan?
Well, there's not much for us that we're going to do different in the short term. If you're in banking or, part of the financial plumbing, the way I think of this is the debt ceiling would be the first domino, and there's a bunch of dominoes lined up in the financial system. And that's really where we have really bad outcomes if some of those dominoes start to fall. And so, I think they're really focused on what to do on day one. For us on day one, it doesn't change. Our domino is more at the end of that chain that, if the debt ceiling crisis turns into a bigger crisis is where we're really impacted. But we just shouldn't take the risk. I mean, it's a silly, silly, silly risk to even think about letting that first domino fall.
On a happier note, Scott, I booked a trip for next month. Yahoo Finance is headed to Cannes, which I'm very excited about. But it felt like, to me, I'm using United. It felt like
That's good. Thank you.
Yeah, well, happy to help. But it felt like more premium seats on board. Are you adding more luxury seats, more first-class seats on these planes? And why may that be the case?
Yeah, United is, we've become the flag carrier of the United States. We fly to more destinations across the Atlantic than all the other U.S. airlines combined, more across the Pacific than all the other U.S. airlines combined. and a lot of our business is premium travel. So both business class and premium economy seats. And so we've had growth across the Atlantic, but even larger growth in the premium cabins for customers.
To your point, right? People never thought of us as an opportunity to go back to the office, and now they certainly are. They're probably not necessarily wearing suits to the office, but they're certainly wearing something more dressed up than they were doing during the pandemic when they were working from home. So our pant business, our non-denim business is just off the charts. We've got a franchise in the women's business called the Sloan pant. You see it all over TikTok. We keep producing it in all sorts of fabrics and colors, and she loves it time and time again. And in the men's business as well, we're selling trousers and pants that they can wear to the office.
This is a major fundamental shift in the economy and society, people going, humans back in some form of office setting. Look at me, I'm back in the office here at Yahoo Finance every single day, and my wardrobe is in fact changing beyond the suit that you're wearing now. I mean, as a merchant and Hart friend, does that change how you plan your assortment in the back half of this year? Should we see more wear-to-work apparel from Abercrombie & Fitch?
Well, I think a couple of things. I think, first of all, to strike a balance in your assortment is the most important thing. Everybody on campus knows my favorite word is balance, and just making sure you don't ever lean one way or the other, because even with people going back to the office, Brian, they're probably not going back 5 days a week. They're probably going back, 2 or 3 days a week. So there's an opportunity for us to service them on the more casual days, as well as those days where they're back in the office.
I thought the customer that shopped Abercrombie & Fitch, and we'll talk about Hollister too as well, I thought they were economically challenged.
We have been seeing a very strong consumer on the Abercrombie brand all through last year and certainly through the first quarter. We're also very pleased with our kickoff to the second quarter. So we have not experienced that. But what I will tell you is, the customer has a choice on where to shop, and they're choosing us because what we're doing is working.
What about the state of the Hollister business? I know you continue to try to round the corner for that brand. What may be holding it back? Because sales were under pressure.
Yes, so it's interesting. I'd love to take you on that journey for Hollister. So last year during the second quarter, we saw a step down, just like a lot of the other teen brands did as well. But what we did was we said, how much of this is us and how much of this is macro? And we found some opportunities for us. So we've been on a journey to really evolve our assortments and get back to being close to that customer. We've worked on our assortment architecture. We've worked on our assortments. And what we're seeing is as we've pivoted, out of being predominantly denim as an example, non-denim bottoms again are working. Dresses are working. So the top line was disappointing, to your point, but the bottom line wasn't. So we're back to profitability. We actually were able to raise our AUR, which is a good sign that the brand is healthy. And most excitingly is our inventory is under control. So we're down 20% as a total company and even more with Hollister. That has brought back one of my other favorite words, which is chase. And the fact that the team can now chase goods and react to the business is a big win for us.
Well, okay, maybe some green shoots in Hollister, Abercrombie & Fitch brand firing on all cylinders. If you had to place a guess, how do you think the key back-to-school shopping season will go for your company?
I'm looking forward to back to school, especially since we've evolved all the assortments. So we'll start to see, the end of Q2 and third quarter, we'll see. But I'm looking forward to it, and I'm excited about what we have for the consumer.
We've heard a lot of retailers call out this earnings season. Consumers are trading down. Are you seeing that in your business?
We are not seeing in it. We've seen AUR increases, interestingly enough. We came out of the pandemic. We have had double-digit AUR increases through 2020 from pre-pandemic. That is something we tried to do pre-pandemic for many years and couldn't accomplish. Our goal coming into 2023 was to hold on to those AURs. And in fact, we beat them for Q1 and in both brands.
I know we have talked many times through the years on how you continue just to close underperforming stores. You're opening new stores, but given all the concerns in commercial real estate with interest rates, are you getting any higher rents? Are some of these mall players trying to raise rents on you because of challenges they are in fact seeing?
I mean, we have two very strong global brands, so we are very desirable in the malls. To your point, that we've been on a stores journey for a very long time. It started with a lot of closures, and now we're being back to a net store opener. So in 2022, we were net store opener. We plan to be one again for 23. But the most important thing for the team is to make sure that we find stores that are the right size, the right location, and the right economics, and we don't budge on that. So if the deal doesn't work for us, we pass and we patiently wait until we can get the deal that does work for us.
How do some of these newer stores you're opening compare to the stores that are already in the ground, whether it be Hollister or Abercrombie & Fitch?
So both are much smaller. What we have found is that these smaller, more efficient formats are definitely working for us. Some exciting new things that we're doing in Abercrombie is that we're opening up street locations. We opened up a couple in Chicago last year that have been absolutely terrific. We just opened one up on Newbury Street in Boston. We have a few more planned for the balance of the year in some key cities. So again, listening to the customer and understanding where our consumer is, we're always testing and learning and trying to find new opportunities.
One thing we have been tracking here closely here at Yahoo Finance, Fran, in retail is inventory shrinkage or theft. Does this apply to your business? And then what are your contacts saying in the industry? I talked to the folks at Target. They're calling out a $500 million profit hit this year because of theft. I mean, do you see that in your stores? And have you had to put extra security in your locations?
We've been very fortunate. At this point, our P&L, we always have to reflect some shrink because it's all part of, of what we do. But we have not seen a spike in it at this point.
That is certainly a good thing to hear. And I will, last question for me here, Fran. What is the biggest challenge you're up against this year as a leader? We have concerns about a debt ceiling. We have inflation that seems to be benefiting you a little bit. That's starting to come down. That's a good thing. But how do you think as you try to formulate your plan for the back half of the year, what are some of the things you're up against?
Yeah, I guess when I step back, Brian, I think about the last 3 years as a CEO. Anybody that has sat in this seat is honestly ready for anything and everything that comes at us. It's taught us how to be incredibly agile and really ready to pivot on any opportunity. So there is a lot out there, to your point, a lot of macro things that we're not sure about, but we're ready to compete. We've got our inventories under control and we're controlling what we can.
Well, it's obviously a great story. And I think, we have seen from the end of last year, probably like from middle of last year to end of the last year, all the excitement related to the developments of artificial intelligence. And in certain way, that has actually provided a significant amount of tailwinds for the technology sector all through 2023. And that has provided enough stability for the rest of the market. So that's obviously pretty good. I think what is interesting to see about artificial intelligence, it's twofold. On one hand, it is the typical component of everybody being interested about a future potential. The results that we saw from individual companies, especially the one today, obviously generates the fact that there is a significant amount of capital expenditures, there is a significant amount of investments that ultimately generate revenue. There's a significant amount of players that are trying to get into the race to have something related to artificial intelligence. When you have that level of excitement, investments, it's still with a lot of corporations with a lot of cash in their balance sheets. This is a good way to deploy assets so that you can potentially have those future areas. And as we know, in those particular cases, it's all about growth. It's all about future potential as opposed to anything that has to do with fundamentals, which is, a good distraction for everything else that we have seen on the macro levels over the last, several months.
So, Mar, it sounds like you think that maybe some of this momentum is going to continue at least for this year. When it comes to just the narrow leadership that we have seen in the market, you mentioned the fact that it has been able to really lift up the broader market so far this year. Is that, though, going to remain the case as we look out to the rest of 2023?
Well, if it's a great question. And yes, a big concern of the rally that we have seen in equities through 2023, it has to do with two things. One is definitely the breadth is not there. We have seen that significant amount of the gains in this year, equity markets, particularly in the large cap space, have been driven by a small number of stocks. And when you actually see that, that's obviously a sign of concern, because when you extract tech away from the rest of the market, you actually probably see a more realistic scenario where what the macro conditions will tell you what is going to drive security performance over the next 6 months. When you actually think about the implications of what we have seen for higher interest rates, a little bit more leverage, cash in the balance sheet starting to reduce, that level of activity has gotten us to, earnings surprises that even though they are a little better, still continue on a downtrend, as obviously the pricing power that a lot of companies had last year is no longer there. So I think a big part of this is like, yes, there's going to be momentum. It's going to be fairly narrow in certain parts. Definitely AI, it's a big driver of that. The rest of the market and the breadth of the market is something that we need to continue to pay attention, especially as we continue to see, changes in the landscape when it comes down, particularly the consumer spending.
Yeah, on that front, have there been any fundamental shifts in the narrative as you see it? If you're talking something like the consumer and the retail space, we've been on a number of calls over the last few weeks. Has anything shifted for you?
Well, the biggest shift, and I think it has been a big surprise, is that the economy as it is today, especially related to the consumer, is less interest rate sensitive than what the original, thought was. And I would probably say that has surprised even Federal Reserve officials. Everybody, thought that, well, as you increase interest rates, you will see that impact into the economy. And particularly, a big part of the economy tends to be consumer driven. That was actually going to slow down and demand was going to slow down. And therefore, we're going to see that, downtrend in inflation to be faster. And that's sort of a little bit of the recipe of what the Fed wanted to do. What we have observed, though, is that because of the excess savings that a lot of consumers had during the COVID years, it hasn't been that, change, or that hasn't been as dramatic as people expected. So the lag in terms of the sensitivity of the consumer to interest rates seems to be growing. And it has been, an area of concern for us, because what we can actually see is there's still savings out there, but it's still in the consumer has been completely focused on the high earners as opposed to the rest of the economy. So on high earners tend to be a little slower to spend that cash. On the other part, the rest of the consumer tend to be a little bit more sensitive to housing prices, so tend to be a little more sensitive to changes in certain areas. We haven't seen that yet. And I think a lot of that has to do with unemployment.
Omar, when it comes to some of the big concerns here from investors, debt ceiling negotiations down in D.C., the lack of progress. We just heard Fitch last night placing the U.S. on ratings watch negative as the uncertainty around those talks persists. We've seen this before when it comes to an actual downgrade back in 2011. If we do see a downgrade this time, what's the potential fallout? What do you think we'll see in terms of the reaction, the sell-off in stocks?
Yeah, definitely. Based on the experience of 2011, I would probably say that the market understands what that means in terms of just having the U.S. on a downgrade. And I think the experience that we had back then is that we should expect short-term volatility, to basically take place, and the implications that had to do with certain de-investments in certain areas that required, certain qualifications and certain grades for their investments to actually suffer, as there's going to be some sellout. I would probably say we saw that back in 2011. The credit downgrade is definitely the least amount of the problems that if we were to go into an actual default. So I think while the credit downgrade may not be as welcome to anybody, it still is not going to be as critical as if anything happens now. And as we can actually see in short-term yields, there's a significant amount of premium paying at the moment to reflecting the fact that there's still uncertainty about having a debt ceiling agreement. This has been fascinating. If we have had this discussion just 3 weeks ago, actually the market was pricing a pause for sure, and even just significant amount of rate cuts down the road. I think what has changed is the fact that we saw with GDP revisions today, and we saw with unemployment claims, that the economy has been extremely resilient, and that has actually provided the Fed quite a bit of support for their actions against inflation. I think the biggest question mark is, with a 25 basis points additional, increase in rates, what is the upside when it comes down to the inflation? Clearly, the downside is that this has been incredibly aggressive already. And we also, need to understand that, we had the banking crisis that has created tightening lending standard that also has created a very tight conditions monetarily, for the market. So when you actually combine tightening lending standards with a potential 25 basis points more for the Fed, that will basically create a very, very, tight, environment for the remaining of the year. So, our position at the moment still being in a 50-50 chance for what we call a hawkish pause or potential 25 basis points, considering the new data that supports that the economy seems to be stronger, seems to be still growing, and that, the labor market seems to be tight. And again, thanks to the AI, financial stability is there because the market seems to be digesting all these, fairly well.
So Omar, what's the best way for investors to take advantage of all this uncertainty out there and potential short-term volatility that we could see?
Well, what would we continue to encourage investors is to think about the long-term investments. Most likely in this environment, a lot of these portfolios have actually been out of their strategic asset allocation and, try to take opportunities to rebalance their portfolio. Now, what is interesting about this moment, again, we just talk about potentially 25 basis points additional increases in rates, this actually allows you to look at your overall fixed income portfolio and potentially start thinking about, well, if this is going to be the last time that the Fed is going to raise rates, potentially the last time, should we start increasing duration in your fixed income portfolio? And at the same time, use the volatility to potentially use tax loss harvesting in areas that have been lost in price to potentially rebalance your strategies overall. So look at your fixed income portfolio, try to think about at what time do you want to start increasing duration, given that the potential for short-term rates to basically get to the terminal rate is coming soon. And then second, use volatility to try to rebalance your overall strategy consistent with your long-term investment objectives, but to try to take advantage of potential tax loss opportunities.
This central bank, as you're pointing out, does focus on PCE core, which we think is very misleading. It's overstated by about 1.5% because it uses a very lagged component for shelter. But it is entirely reasonable the Fed will raise rates because they're normally a year behind. And if you look at the data carefully, inflation absolutely peaked in June and then started declining in July. In fact, our own index, CPI-R, real-time inflation, has declined since July by over 1%. So we really think we're into deflation, and this Fed, just like they were with transitory, is completely off. But that means because they're so lagged, could very well raise rates in June, even though they shouldn't.
Jay, so if we are seeing inflation maybe declining more rapidly than some of the data is suggesting, how quickly then could we potentially get back to that 2% level?
We think that we could get there, maybe not the reported numbers, but any reasonable adjustment of the numbers by the end of the year. In fact, we've done a forecast that headline CPI year over year, as of June, reported in July, will be only 3.5%. So everyone will be able to figure out, except perhaps the Fed, that inflation is rapidly declining. But that process will continue because a lot of bringing inflation out of the system is simply anniversarying the height of the inflation. So July and August and September will be after those peaks. So the data should start to support what we see as what the leading indicators are telling us, both PPI and CPI-R.
I mean, with that said, there are concerns about where the economy is headed. You could argue today's data certainly points to the resilience of the consumer, and demand is still strong. And yet I wonder if you think there's always a lag factor with data, but you think the Fed is especially behind. I mean, what does that trajectory look like going into year end?
Mm-hmm. Well, that sort of gets to it's a great question because it gets to the core of the problem with the Fed's forecasting framework. They use the Phillips curve, which hypothesizes that all inflation comes from the labor market. So they would naturally be concerned, probably raise rates because we have a strong labor market. But really, if you look at the data, inflation is almost always caused by rapid inflation in housing and commodity shocks. In fact, in the 70s, very little people know this data, oil prices rose by an unimaginable 1,200%. So that's like our oil going from 100 to 1,200, which would just cause massive inflation. So that was the key driver, not wages. Wages typically are a lagging indicator. Real wages will actually decline as they have recently. So that's why we think this is a fundamentally flawed Fed. They will raise rates, and they probably won't cut them till March. They should have cut them in March when we had the banking crisis, so they'll probably cut them a year late next year in March.
Jay, what does all this then mean for a recession, just given the fact that, yes, inflation is high, but when you take a look at a lot of the economic data coming out, specifically what we're seeing from the consumer, what we're seeing in housing, it's remained very resilient. Do you think we're going to be able to avoid a recession, even if the Fed hikes again next month?
Well, that's also the key question, because it's very, very normal when you have an inversion and tight Fed policy to have a pretty significant recession. But if you think about the transmission mechanism of monetary policy, it's wholly on the housing sector. So that was terrible in 07-08 because we were building 4.5 million homes, had an excess of inventory. Here we have the reverse situation because of the pandemic. So that's why our call is no recession. It is non-consensus because the data, historical data doesn't support it. But keep in mind, we've never, ever had a pandemic in post-World War II history. So we really don't know, but we know we have a shortage of housing and autos, so we're not getting the layoffs. And if you look at construction spending, it's very resilient. We have the infrastructure bills out there supporting construction. So that's why our non-consensus call is actually estimating 0 to 1% growth this year. So slowing, but not a recession.
Let's talk about strategy now and where investors should be putting their money. You say you like the tech sector. You're certainly not alone in that. We saw this week just how much exuberance there is around artificial intelligence. How are you looking at that space? Is the better bet here on the chips or the tools that will help build the technology or expand the technology? Or is it about the Microsofts and Alphabets who are really leading where this technology goes?
Well, our key insight that I really got being an investment banker is that when you do have these new technologies, it's actually functional, and what makes the U.S. have a huge advantage over China and Russia is that you get an overvaluation of the companies that are public, and then that drives innovation and investment in private companies, and eventually they go public, and then that's when they come back to normal valuations. So that's kind of the key insight. We've seen that with Tesla, where they were arguably overvalued, then you get a lot of IPOs. So we think that's going to continue. So we would hesitate to get out of the AI trade. It's obviously going to have downturns solely on valuation. So we think that with regard to that, I would be, since it's a fairly risky trade, be with the more established companies with substantial earnings, so no startups. People tend to underestimate the difficulty in turning profitable. In fact, when I was an investment banker, we didn't even have Morgan Stanley. We didn't even allow companies that weren't profitable to go public because they were too risky. So we'd stick with the big names, Microsoft, Nvidia, AMD, and we'd rather be diversified rather than making a big call on chips versus software versus cloud. All of them are going to benefit, and it seems like it's the biggest trend since the internet.
Jay, when it comes to the more overall speaking, the narrow market breadth that we've really seen since the start of this year, does that worry you at all, just about whether or not the fact that this could potentially not be sustainable?
Well, definitely. What you really saw the first half of the year was a pretty broad-based rally, including all the stocks that we manage through ETFs, like preferred stocks, utilities, and MLPs. But then when the banking crisis hit, you saw this massive rotation where all those sectors were sold, financials as well, large cap dividend stocks like we have in ICAP. So if you look at the returns on our funds, they're way up and then now flat to down. But yet tech is skyrocketing because it's viewed as a safe haven, and then you have the AI. So it's been a bifurcated market. Today, tech is dragging the stocks up. Yesterday, they were crashing. We wouldn't really rotate into the more, the dividends and value until you get to July, because then you have earnings. These companies are all doing really well. It's just that they're being shorted or sold by money managers who are underweight tech and need to, keep up with their benchmarks. So short-term outlook for basic economy companies, I would say, is dicey. But in July is when we're going to get more build up on those like preferred stocks, for instance.
We've seen prices come up very quickly over the last year, especially, and even through first quarter. And I think for the first time, we're starting to see prices ease just a little bit, especially for domestic travel and over the Memorial Day holiday. But, as you try to book into those very high demand days, you're seeing prices that are still very shocking and really can hurt the budget, especially if you're trying to travel overseas, which many consumers are now trying to do. Prices to Europe and especially prices to Asia are still up materially from where they were just a year ago.
So, Brett, I got to ask you, so AAA forecasting a decline, as we've talked about in travel this year, in air travel. So down from last year, we saw just over 3 million and down, or actually, no, I'm sorry. That is the correction. They are expecting an increase in air travel this year. And that kind of flies in the face of what we've seen in terms of inflation. What is the data showing you in terms of air travel this year?
Sure. Well, we've had millions of consumers book trips so far this year on the Priceline experience. And what we're seeing is consistent with what AAA has shown. We're seeing that price points for airlines are have been up year to date and are starting to come down a little bit, but traffic levels are significantly higher than they were a year ago. We'll probably see somewhere in the neighborhood of 10% more travelers moving through U.S. airports over the next 3 or 4 days than they were a year ago, and that has been a very healthy experience for the travel industry. But consumers seem to be pushing right through the higher prices, and they want to travel and they continue to travel.
Brett, what are they spending less on, right? Is it something in the travel stack, or are they just not buying as much stuff on the other parts of their budget? Or are you seeing any places within travel where people are driving instead of flying, booking a cheaper hotel, et cetera, et cetera?
Well, we haven't seen as much trading down yet, and that's possibly something we could see later in the year as finances really get tight for consumers. Clearly, with gas prices down considerably where they were just a year ago, $5 a gallon last year, now we're closer to $3.60 a gallon. That really is pushing more people out onto the roads and driving. And so the drive and stay market is going to be quite high this year. When people are really looking to save money, though, obviously they're doing some things with how they plan and book their travel. So, for example, just changing your date by a day or two in terms of when you fly can reduce the cost of a ticket by a couple $100s. And so that's why we build tools on Priceline to help consumers really find the dates that are most attractive in terms of price points. That's one. Consumers will also shift destinations, right? Traveling to a destination like an Orlando or a Las Vegas, you can always really find flights into those markets because of the size and scale of the market that are more affordable than if you're trying to go to a destination like a Miami. And so consumers will shift destinations to really help fit their budget in terms of what they're trying to spend.
Brett, I also want to ask you, friend of the show, Liz Ann Saunders, who's an equity strategist, recently posted a chart looking at an increase in delays for the airlines, that we've seen an uptick in cancellations and delays. How is that affecting people's flight plans, or maybe they're choosing different airlines, or how is that sort of feeding through?
Well, last year, that came to a real head, if you recall, when cancellations really were reaching all-time highs. And the airlines have largely, got that under control now. In fact, they've built a lot more slack into their system. In fact, that's put pressure on prices because while the capacity may be the same as it was last year, or even slightly higher in terms of number of planes and seats, they've reduced the slack they've increased the slack in order to reduce some of those issues as we move through very busy periods like this, Memorial Day holiday. So overall, the airlines have been doing a pretty good job with that. And weather for the weekend looks pretty good in most parts of the country. That will also help to have a smoother experience for consumers. So largely, we haven't seen that as a material concern that have prevented consumers from booking flights.
And Brett, one more question before we lose you. Where are people going, especially for this unofficial kickoff of summer, big travel weekend we have right in front of us? So where are people going? Is this domestic, international? Is it a 50-50 split? What are you seeing?
Well, let's start with international. Consumers have really picked up their searches to international destinations over the last couple of months. In fact, we look at searches to destinations in top cities in Europe. So the big ones, London, Paris, Rome, Amsterdam, very hot destinations right now. And consumers are now beginning to go to Asia. So Japan, the Philippines, Thailand, very hot destinations as well, despite the expense that it requires now to fly to those destinations. Here in the US, consumers are going to the big ones. They're going to Orlando and Las Vegas for entertainment, and they're going to the big cities again. So Chicago is a top book city on our platform, as is Atlanta, New York, and some of those destinations over on the West Coast. So consumers are out and moving this holiday.
We've seen a lot of exciting waves of technology in our industry, the cloud, social, mobile, but this AI wave is going to be the biggest that anyone has ever seen. I think that the success of OpenAI is the point of evidence that this is going to be one of the fastest growing moves, not just in the consumer market, but in the enterprise market. And we had some of the largest, most important enterprises in the room today, and every customer is excited to get their hands on our new generative AI products, which are shipping this month.
You said something in your presentation really early on that said, this is the new Salesforce. What did you mean by that?
What I mean is, we've been very focused over the last 5 months of transforming our financials. We just delivered our highest margin ever. We are extremely excited about our new management team that we've introduced last week, and now a whole new product strategy as well. And I think the right combination of financials, people, and technology is the right capability for this software company, which has become the third largest software company in the world, and is really just getting its sea legs when it gets to the next generation of artificial intelligence.
I saw a lot of presentations or a lot of screens up there on GPT this, GPT that. How will that change Salesforce, and what does the order flow look like for those products?
Well, about 10 years ago, I had my first existential freak out about AI, and I ended up buying a lot of companies and assembling teams and making things happen. And that was very exciting to me. And this is bigger because this is now the next wave. Of course, Salesforce is already a leader in AI CRM because of that. We introduced Einstein in 2016. We're doing 1 trillion transactions a week of Einstein. Now we're going to enter generative AI as well. I think it's going to be another wave. The amount of data that we already see being entered into the system through our data cloud is at record levels. So I think it's an indication of how well these generative AI systems will do.
I think a lot of folks on Wall Street, they're interested in how does Salesforce monetize all this amazing new technology? How do you see that?
Well, today we introduced all kinds of new monetization models around generative AI, including our AI Cloud, which is our starter package to help customers move forward. It's $360,000. It gives you all the licenses and capabilities and services to get going. I think for a lot of customers, trust will be the most important thing. They're going to want to make sure they don't have any data leakage, that their companies and their employees are properly trained to work in this area, and that all of the corporate playbooks and customer data sets aren't going out the left window. So that's our job, to make sure that the company's architected correctly and ready to go for this new generative AI era.
You seem very passionate about trust and doing AI from an ethical standpoint. Do you anticipate some form of global regulation here at some point?
I think trust and generative AI are going to go hand in hand, and then responsibility and generative AI. I think this idea that AI is kind of at a next level is true, and I think every business and every government and every individual is going to have to come up with their own way of looking at this technology and what is the right way to manage it.
Do you view AI as job creating?
There's no question that AI is going to create more jobs. It could also take jobs. It can be a balance. In the work that we showed today, which is something that's been going on for 18 months with Gucci, we've actually seen the Gucci call center expand, because what it did was it made their employees more capable, in their own words, to augment their call center. Now the call center, which only did service, also can do sales and marketing and commerce as well. That's a big step forward. They call it Gucci 9. It's like a next generation capability, and I'm excited to go to Milan and see what's going on there. It sounds expensive.
It sounds expensive. How important is it? It wasn't lost on me that you're in this room, you're a co-founder, Parker was in this room, co-founder, that Salesforce is founder-led at a moment like this. How important is that from
Founders can go faster, you're 100% right, and I think that we've transformed the company a lot in the last 5 months. We go back and look at the interview we did 4 or 5 months ago. The interview we're doing now, the questions are different.
Old, but yes.
The questions are different.
Yes.
The position is different. Everything is different because we've transformed the company in a relatively short amount of time, and we're excited about where we are and where we're going.
How has that, the past 5 months, changed you as a leader? Because you're always very passionate about this, but there was a different level of focus here today, and I don't know, it was really cool to see you in that zone.
Well, I think number one is we've really focused on changing the financials. And you saw we just hit our highest margin levels. We've increased margins by 1,000 points. That's tremendous for our investors. We just hit some record cash flow numbers. You reported that as well. And very excited about the quarter we just delivered. Number two is we brought back some great leaders. We had our new Chief Marketing Officer here today, Ariel Kelman. Of course, Ariel has worked for Salesforce for 6 years, running product marketing. Then he went to AWS, where he was the CMO for 8 years. And then he went to Oracle as the CMO for 3 years. So we're very excited to have him back at Salesforce. But also, we have a number of new executives that we're very excited about, and augmenting also our Chief Operating Officer, Brian Millam, giving him some great new capabilities, including leading our business technology team and our HR team, as well as our marketing team.
Does it take time for this next generation of leaders to settle in? How do you think about it?
Well, I just brought back my former Chief Marketing Officer, Kendall Collins, as my new Chief of Staff. And it's been great for me because he already hit the ground running. He had been with Salesforce for, a dozen years, left for a few years. Bringing him back, he was able to hit the ground as if he never left. And that's the kind of executive I like right now.
You also talked a lot about a dinner you had with OpenAI's Sam Altman. And one thing that blew me away was your voice was replicated, I guess, at that dinner. Tell us about that. And as a tech leader, that had to blow you away.
Well, we're seeing generative AI do a lot of amazing new things, and you're going to see this concept of being able to create deepfakes, audio, video, the ability to do things rapidly. But as I mentioned, where is this data stored? It's not stored in a file. We all have seen like an MP4 file or an MP3 file on our phones. But that's not how this data is stored. It's stored in these weights inside these neural networks, and it's not the traditional enterprise storage mechanisms. So we're going to have to find these new ways, like we introduced here with our Einstein GPT trust layer, to store these things safely and correctly with the highest levels of trust and production.
Is there a societal risk to that? If my voice is replicated and goes out there on social media, what does that do?
Well, I think we realize that we're in a world now where AI is able to do things that we've only seen in movies. The Minority Report was partly written by a Salesforce employee, Peter Schwartz, and I think we all remember that from our childhood. We didn't think it was going to be our present moment reality, but it's turning out to be more like the Minority Report than not.
I think the thing that, especially this audience, which I think is very business-minded, would be fascinated is the advertising industry is incredibly detached from the actual business results. I think that the industry is very good at yesterday and tomorrow. So I'm sure what you have felt is yesterday and tomorrow. A lot of people want to talk about the creativity of the TVC ads, and then they want to talk about tomorrow. AI is being thrown around here all day, 24/7.
Do you think it's all hype?
No, I think AI is one of the most important things in the world right now, but I think the ad world, when they talk about AI, is not like the tech world. They're talking about it in a hyperbolized way without really understanding the tech. And so today's marketing world is being great at creative in social media. Social media is building brands, yet there's no talk of social media creative here. There's talk about television commercials that nobody watches, and there's talk about AI that's not fully here yet. And so I think that to sum it up, there's a really interesting thing happening here, which is the big opportunities for entrepreneurs and small businesses and private equity owned brands is the biggest brands in the world are missing the mark. And in that is the opportunity and the arbitrage for the competitors.
Which brands are doing it well?
What's hard about that is the truth is that the answer is not too many. I will say that Chipotle, somebody that we don't work with that I could see from the outside that has made a huge commitment to social and culture, is doing a nice job. They stand out, but from my filter, people that are allocating all their money to brand work that's not being seen or programmatic digital banner ads that no one's consuming, it's hard for you to do it well. What Chipotle's done well is they've made an actual commitment to social media creative. I think Wendy's talking about a couple QSRs and think about those companies, they can see the results on the day.
Right.
They have stores. Yeah. And so DTC brands, QSRs, but some of these consumer packaged good brands, car brands, automotive, like these big, big brands, they continue to buy into Don Draper, and he's been dead for a long time.
And so as you think about going forward from here, where brands are creating cultural relevance, because that's been one of the key talking points for many CMOs.
But they don't do
out
that,
there.
my man.
How are they missing the mark there then?
Let's break the fifth wall here, or whatever it's called. What brand drives culture? Maybe in their product.
Sure.
Right?
Yeah.
LVMH, Nike, you got brands that Apple, but in their ads? Tell me about the ad that crushed culture. We had one when Dwayne Wade retired. I don't know if you remember that.
Yes.
We did that Budweiser ad that everybody on earth saw. You can only break culture if you make videos that don't look like commercials. What commercial? Do you understand that they are spending the majority of their money on commercials and banner ads? Tell me right now, anyone watching, what commercial or banner ad broke culture?
Right.
They break culture through their products, a watch, a sneaker, that they can break culture. They break culture in the form of an activation occasionally. They did it proper at F1 Miami, you know what I mean?
Yes.
Things like that, activations. But through their advertising, it's a joke. They don't break culture. We're not living in the, where's the beef, the just do it. The Spike Lee and Michael Jordan commercial, that doesn't exist today.
It's gotta be the shoes.
That doesn't exist today because we don't watch television commercials. Yet this industry's infatuated with starting there because the agencies make a lot of money selling those.
Certainly. As you think about even going forward from now, we've been having a lot of discussion about if generative AI is having its cell phone type of moment as a multiplier on how we live our everyday lives. Do you see us hitting that anytime soon?
Yeah, I think that's going to happen. I mean, it's definitely going to hit. It's hit for entrepreneurs, solo creators, small businesses. For the big brands here, even though I have a lot of anxiety to the way they advertise, I'm empathetic that they haven't gone there yet because I think there's a lot of copyright and trademark issues on the generative creative hitting the world that I do think the biggest brands in the world are being thoughtful and thinking through properly. But yeah, it's going to allow for a lot of output.
You're a serial entrepreneur. You've started so many businesses or invested remotely or just counseled businesses in how to do better. What's your next big investment?
The truth is, I'm not sure, and I think that's my strength. I don't want to force the issue. Today, I said that I think social media creative and ads is like the way to go. But in 6 years, I might be like, are you crazy? Why aren't you doing this VR stuff? This is now overpriced. Television commercials were on point in 1979. In the same way of how I think about big investments, I'm not sure. Because don't forget, it's a combination of the entrepreneur and the space.
Right.
I've been looking at AI startup for 3-4 years. But you have to find the right entrepreneur to go along with that. She or he has to show me the capacity of being able to adjust along the way.
Right.
There's a lot of variables to investing in the early stage the way I do, which may be a little bit different than some of the audience. But it's about staying curious and staying to the pulse of the actual pop culture and consumer that is very important for me. And so that's kind of where my mindset's at.
I'm naturally looking at all of your investments that come through, and pickleball sticks out to me. That's one you made last year.
Yeah.
Pickleball is having an explosive moment right now. So next 5-10 years, is pickleball the sport that everybody is playing that has no skill at anything else? If some have said, if you don't have skill, play pickleball, but it still requires a lot of skill.
People saying no skill pickleball is like people saying engineering, building websites wasn't important. Oh, you're building websites? You mean the engineers of the internet that all made trillions of dollars at Apple and Facebook and Google? You need real skill to be a good pickleball player.
Yeah.
There's plenty of people who play basketball with bad skill to be one of the best basketball players in the world. So I think to the point of basketball, why it became so popular, because you can really play in a lot of places from inner city. Hockey's expensive.
That is.
Golf is expensive. So there are millions of people who do not have the income levels to do that. Basketball became popular because we could all play, even though the way some of us grew up in the dirt, right? Pickleball is going to have that same phenomenon. It's so easy as a cost of entry to play. And that became another example of what I believe in. What I do is I pay attention. If you think that if we were doing this 3 years ago and you said, what's your next big investment? And I would have said pickleball, I would have laughed you out of the room. But I watch. I watch. And when I saw what was happening with how many people were playing and how much fun a 68-year-old grandma was having with her way more athletic 18-year-old grandson, and it was competitive, and the cost of entry, and then when I watched how people were consuming it on social and YouTube, and I watched that the Madison Square Garden numbers at midnight when they were airing it were way better than they should have been. I'm watching. I'm quantifying and I'm looking at the qualitative data. I can't believe Twitter. I can't believe I like pickleball. I played pickleball for the first time. I love it.
Yeah.
I'm gathering, and then I'm like, wait a minute, this has a chance. I'm not naive though. 99.9% of leagues fail. But I was like, this could be that.
Yeah.
And obviously Major League Pickleball has had a real moment. It's really happening. And look, it's hard to become a predominant sport in culture, but pickleball is already, as a sport, further along than many things that have come along in the last 30 years that have died. Major League Pickleball's already further than the XFL.
Right.
And so it's happening.
You're plugged into so many business conversations, and I got to hustle to my finish here, but as we hear from some of the CEOs right now, they're all concerned with the reality of a possible recession this year. They're battening down the hatches, they're changing their spending. Is that something that you're hearing from them as well, and
Yes.
what are you advising?
This is why I'm so frustrated here. We can't waste money on dumb ads. We don't have the luxury of it anymore. My energy comes from the CEOs. I'm just trying to get the CMOs to understand why it's so hard to keep a job as a CMO. We need results. For the Yahoo Finance crowd, this ad world plays in banana fake land. They have to get more serious about where brand is built, social. They need to measure actual business results, not fake reports or awards. We need a new world order in marketing. Otherwise, their budgets are going to continue to get cut because it's not working.
Yeah. Gary, we appreciate the time here
Thank you,
today.
Dwayne.
Thanks for
Stay
inviting us aboard here. I'm going to try not to, maybe I'll go for a swim, who knows? Why not?
See everyone.
Thanks so much, guys.
One of the things that we've announced here at Cannes is the Inspired Internet Pledge, which is, we've been designing positivity into the platform at Pinterest for years, but we really think that positivity, and particularly more positive outcomes in emotional well-being, really needs to become a standard for the social media industry. So we announced that here at Cannes with the Digital Wellness Lab that's really asking all of social media, advertisers, agencies, the whole industry to really come together and support more positive emotional well-being outcomes, to commit to measuring those outcomes, to delivering better outcomes over time, and then sharing learnings with each other, because really, emotional well-being ought to be a mandate for all of us, not something that we're competing on, but actually a mandate for the industry that we all need to do better on.
This is a wildly opposing message. I hear a focus on positivity from you, and on the other side, there's Twitter trying to round up new business here at this event. Are you winning new business because of your message you're trying to get through?
We've seen really phenomenal response from advertisers. It pays to be positive on Pinterest, and we see that advertisers really want to be part of that. If you're building a great brand as an advertiser, you want to build your brand on positivity as well. And so we're seeing that advertisers and brands want to be part of that. And as we're delivering great performance, a great full funnel experience, which is quite unique to our platform as well, we're helping them connect with users in moments that matter for those users in an environment that's positive, where users are getting to create a life they love. So that's inherently positive, and we're seeing that pays for advertisers to connect in those moments as well. So we've seen really great reception to it, but we aren't perfect either. We are committing that not only are we going to measure ourselves today, but going forward and commit to ongoing improvement in those areas, because as much as we've tuned for positivity, nobody's perfect, and we want to make sure that we're learning and getting better, both as Pinterest as well as with the industry.
Each time I have talked to you in your CEO capacity, I've asked you about the state of the ad market, and each time it has sounded incrementally a little bit better. Now we're contained in here, we're having drinks, we're on a beach, everything seems rosy, the economy might be growing 10%, who knows? But what's your sense of the ad market looking into the back half of the year, at least from being on the ground in an event like this and talking to all the key people?
Well, what I would say is I think it's hard to predict the macro. I think the ad market still has spots. There are bright spots in the ad market. I think there are other parts of the ad market that are challenged, so there's sort of still puts and takes across those. But it's good to see that there are bright spots that are emerging there. And so I think that's encouraging across the industry. But I think even more than that, it's encouraging to see that the things that we're doing with Pinterest are resonating with advertisers. The full funnel nature, as we're delivering more performance for advertisers, and again, bringing that positivity for them that they're valuing. And also, they're valuing it because the people on the platform value it. We see that people come to Pinterest, users come to Pinterest, really as an oasis away from the toxicity of much of social media. So advertisers value it, but users value it too. And so we're seeing that really cut through.
Two more items. Bill is an in-demand guy here at this conference. I literally have about 3 more minutes with him. That's how these meetings go. AI, have you been inspired by anything that anybody is doing here with AI and building it back into your own business?
Well, I mean, I think the possibilities with AI are so phenomenal. AI is a core competency for us. We have really been leaned into next generation AI. If you think about things like our personalization, which is really unique to our platform in terms of what people do on the platform. People curate on our platform. They associate products. How do people think about, how they're going to put a room together? How they're going to put an outfit together? AI is only as good as a signal upon which it's acting. And we have really unique signal because people come to Pinterest to go curate all the things they're interested in and make these great product associations. And that's really letting us do some unique things. So for example, our personalization model today is 100 times larger than what it was just a year ago. And so the power of the recommendations we're able to make because of that, built on top of next-gen AI capabilities, GPUs and things like that, that's letting us make recommendations that users are saying exceed 95% plus relevance for them. So that's just one example of sort of the power of where AI is going and how we're incorporating it. So I think that is great. The other thing, just coming back to the positivity point, I think as AI gets more and more powerful, I think a really important question is the ethics of the AI, what people ask the AI to do, and I think, again, it's an important moment for people to commit to using the AI for positive outcomes. And so there's so much limitless potential, but it can be used for good or not for good, and it's a great moment to commit to those things. That's certainly how we think about it with human-centric AI, bringing that into the way people use the product, doing things that sort of respect the user and help honor what users want to do versus just sort of serving users things that may be based on what triggers them the most or those kinds of things. So we see lots of opportunity and potential in that, but also an important moment for people to be clear about what they want to do with the AI, and clearly for us, that is using it for positive outcomes.
Before we let you go, last 30 seconds, I realized coming into this, I've been following you and your CEO journey, and so have the investors on the Yahoo Finance platform. You hit the 1 year mark or coming up?
Coming up on 1 year, yeah.
What have you learned as a leader in that 1 year mark, and how are you different?
Well, it's
still look great.
Thanks. Maybe a few more gray hairs, but it's been a great year. Yes, there's been a lot of choppiness in the market, things like that, but if you look at our platform, we've returned to user growth. We're deepening engagement, with engagement growing double-digit percentage points. Our ad impressions were up 30% plus year on year this past quarter. So the business is growing quite nicely. And so even as ad demand has fluctuated in the market, the supply on our platform has grown 30% plus, which is really a reflection of both deepening engagement from our users, as well as delivering great products for advertisers that's helping them to engage with users. So it's been a remarkable year. Shopping's coming more onto the platform. So we feel great about all that, but we have so much more to do. So look forward to talking about that as well.
I've been following your journey so closely, Bill, that I got the same shoes as you.
Oh,
we both got the memo, the white shoe memo here at Cannes Lions. Always, it's part of the uniform.
Yeah, I'm glad we could coordinate.
All right, good to see you. Get back to work.
Thanks so
we'll
much.
Talk to you soon.
Yeah, we are so excited to have Kim Kardashian, the founder of Skims, an incredible visionary leader, icon, activist, investor, as well as Sam Altman, OpenAI, leading us into our next history of what was our future. We don't know what that is yet. We can't predict it. But the whole package, the whole editorial package is around our Time 100 most influential companies list. And I'm super excited about this list because it's not just identifying companies based on their size. They're either large or they're small or their stock price. It's based on impact and influence with a lot of different measurements of what companies are doing that are meaningful and that matter and that are actually driving change and doing different things. So we love this list. Definitely check it out.
Is there a common denominator that you can name, or a common theme or driving force from all of the individuals on this list that seems to really permeate through all of their mentality, all of their thinking, and what makes them successful as they are?
Leadership, strategy, how they're impacting people's lives and their communities, what their revenue mix looks like, and really it's all about influence. Who are the leaders around the most important ideas that are owning or being the CEOs of these different diverse companies, and their companies, 70% are in the US, so it's a global list, and they're all different sizes, they're in all different types of verticals. There's so many exciting names on there, including Skims and OpenAI. We've got Baby to Baby, we've got Kia, so just very, very diverse.
The stories I would argue of Yahoo and Time there's this parallels. There's a lot to call out. So we had our CEO on, Jim Lanzone, talking about a profitable business, a business that is doing very well, that is prominent in the industry. And I think of Time, wow, that brand has just laid witness to so many historic events. And I see the reinvention that you're doing at your company. Where is the brand in its transformation? How is the business doing?
We are doing well. We are an investment growth, and we are celebrating our centennial. So 100 years of Time. We are a traditional legacy media brand. We are one of the most trusted throughout the world, and I can say that now, 6 months into my tenure. I've traveled the world for Time, and everyone has a Time story around the world, and everyone seeks me out to tell me their Time story. So in a crisis of trust, our journalism is really meaningful and it matters. Rigorously reported, unbiased, and the YouGov study, I think, points to sort of who the winners are in trust. So standing on our history and our legacy as a 100-year-old brand is really meaningful. My role, and I'm so honored and privileged to be the CEO of Time, to lead us into our business building, our transformation, and making sure that we solidify our future for the next 100 years.
There's a lot of fear in journalism right now, especially, that jobs might be replaced by generative AI because of the productivity, because of the speed or the efficiency, but you're championing the human element of journalism. What's your message that you're telling to even your internal stakeholders about how important the job that they're doing is, even right now, and what, even as generative AI becomes more accepted in society, how that could be used at companies like Time, and where humans will still have a necessary role?
Well, here we are at Cannes Lions. You mentioned the word creativity. I don't believe that AI can replace creativity. And the conversations that I've been participating in this past week, especially with Vivatech and the opportunity to work with Mark Benioff and the Salesforce organization and everything that they're leading in AI, it's all about opportunity. It's actually, the conversation is about excitement and enthusiasm and opportunity. Yes, there will be changes, but we've only experienced change, at least in the media business. We went from a magazine business, 3 stations, to look where we are now. And we've been able to really evolve and meet consumers and consumer behavior. I think AI has an incredible role to play in making us smarter, faster, more productive, and taking away some of the mundane tasks that, whether it's in our business or any business today, that can be replaced and further powered by AI.
Time is plugged into lots of areas, whether it's the U.S. election cycle, whether it's the war in Ukraine. I mean, these are big pressing issues that we at Yahoo Finance, we look through them in many respects, the eyes of the markets and stock prices. Let's go into 2024. How polarizing do you think this election season will be? What are the world's biggest challenges?
There are many. And what we do is we write about the people that are telling these stories. That's our role to play at Time. We're unbiased. We're going to continue to be rigorously reported. We're going to tell the stories about the ideas and the people that are making an impact, hopefully building a better future and driving change. We have a large DC, incredible team, and we're going to be covering all of the conversations. But we're not just covering news and politics. We own culture. We own healthcare. We own music. We own sports, entertainment. There's so many things that we write about, and we're really proud of the decision to take down our paywall. Again, in our 100 years, we feel that news literacy and trusted journalism in a crisis of trust matters more than ever before, and we wanted to make all of our content for the last 100 years available to everyone, anywhere in the world, for free.
It takes a lot of guts to make a decision like that. Before we let you go, any other tips to leaders such as yourself out there that are dealing with challenges, whether it's to take down a paywall, hire employees, fire employees? What are some tips for success?
I believe in culture and communication, and over-communication is something that a mentor of mine had taught me through an incredible 2 years, 2008, 2009, of change in the economy and in the media business. And I think if you're transparent, you're authentic, you let people know what we're facing and focus on the positive opportunities to drive and make change, that's the best way. And I would also say for us, diversification is something that I've learned throughout my career, only doing legacy media. And if we can build new businesses and do a lot of testing, taking some risks, seeing what works, that's where we're going to thrive.
Is there an early front runner for Time Person of the Year?
I knew you were going to ask that.
Well, I'll tell. Mark Benioff has been advocating, I should say, we are privately owned by Mark and Lynn Benioff. They are co-owners and co-chairs of Time since 2018. And Mark has been talking for 18 months about Person of the Year to be AI. And we had Zelensky last year, and he was advocating for AI. He and Lynn were in our offices on Monday prior to going to Europe, prior to taking a digital detox holiday, and they were there with their 2 daughters. And I toured them around our beautiful Time offices. I'd love to host you there if you haven't been. And the 2 daughters were advocating for Taylor Swift to be Person of the Year.
Since last earnings call, we felt more comfortable that we'd have a better outlook for NII in the second half of the year than we did then. And it'd be basically flattish quarter to quarter between 14.2 and 14.3, and then be above 14 in the fourth quarter. And that really comes from just the sheer power of our franchise, whether it's we're getting 4% annualized loan growth, which is good on the commercial side especially. We're seeing some card growth. We're seeing the deposits hang in there, even though, because we have such excess funding position, we're not competing for high cost deposits. We put those customers' money into the market and money funds and other things. And we actually even raise money from our customers for other banks to give them those rates because we don't have a use for the cash. And so even with all that going on, we feel good about the NII. And that's basically due to the power of our deposit franchise. We build our outlet based on the market expectation for rates. But let me back up, Brian, and talk about, we have our research team led by Candace Browning-Platt that does tremendous work. And they basically have the first 2 quarters of 24 to be slightly recessionary, -1% GDP growth rate in the first quarter to 0.5% in the second quarter. So that's a pretty light recession at this point. And they've moved it out from this year into next year, and they've moved the duration to be shorter. So as you think about it, whether it's a soft landing, meaning it never goes negative or it goes slightly negative, I'm not sure people will feel the big difference. And what we're seeing in our customer base is the economy, the spending that goes on in our customer base, which is $4 trillion plus a year, which was growing at 10% a year for all the year 22 over 21, for example, is now slowed to 5%. And that 5% is very consistent with a low inflation, more normalized growth economy in the U.S., kind of what it was in 17 or 18 or 19. And that's good news, frankly, because that means the economy is getting back in line, even though we haven't had massive dislocation in employment, although employment markets are softer than they were a year ago at this time.
Are you surprised by this consumer resilience?
I'm not, honestly, and we've been saying this for a long time. This was going to be the Fed's hardest job, was to slow down the U.S. consumer, because at the end of the day, the amount of stimulus the consumer had, the fact that unemployment has run as low as 3.4%, the fact that wage growth, you see a lot of talking about what's caught back up to inflation, but if you go look at from the pandemic forward, the wage growth from 19, 20, 21 was very fast, and then it fell behind inflation, but cumulatively it's ahead of inflation. And so if people are working and they're getting paid more and they're spending, it's going to be hard to have a tough U.S. economy because of the amount that's driven by that. But on the other hand, you don't want them doing too much and feeling like they're getting behind on inflation, therefore demanding higher wages to get a wage inflation spiral. It looks like the Fed's was probably too late, and they said it themselves, of getting in the game and raising rates. Then they finally moved very quickly, and they've caused that to slow down. And I think that's all good. But I'm not surprised by the resilience of the consumer, because when we looked at our customer data, you can go back and track us talking quarter after quarter. Our customers still have multiples in their accounts. So the same customers that were here in early 2020 today have multiples in their accounts than they did back then, especially in the lower balance accounts. And that's because they've spent some of the stimulus, but they've been earning money and they've been managing their finances well. That doesn't mean certain ones are having difficulties and layoffs are happening. But in a broad context, across 60 million customers, across $4 trillion of spending, it's a pretty resilient group.
Do you think consumer spending, Brian, will surprise to the upside later this year? We are now finally starting to see inflation slow pretty dramatically in this country. And looking at your results, to your point, you have a lot of people with a lot of money in savings and checking accounts that maybe they could get out there and spend in the back half of this year. How do you see it?
Well, if you think about the last few years, first it was good spending. They bought things because they're pent up in a house and they just had money and they bought stuff, and so they bought a new couch or a new grill or things like that. But you can only buy one of those. So then they started spending on what we called experiences, going out to eat, going out to movies, going on trips, and you still see travel's fairly strong, and you can see the bookings. I think all that, once people have done a lot of that, gotten a normal summer vacation in for their kids out of school, I think it'll sort of reach what it usually does. Is sort of 3, 4, 5% going faster than the rate of inflation because the wealth of the country grows, and I think that's good. Now, the best news is that the credit worthiness of our customers is still extremely strong, and people keep talking. I get asked about, well, your credit card charge-off rate went up a little bit, or your 90-plus delinquencies went up some. But if you look at that number, it's still far below where it was in 19. And if you and I were having this conversation in 19, we'd be talking about 30 and 40-year record lows of credit costs in our company. And that's so we're normalizing to a very good place. And so I think that also means the consumer has some staying power, the equity in their home. And so, in the end of the day, if companies are making money and employing people, even though it's not as aggressive out there in the markets today on labor, people are going to have jobs and people are going to spend. But I think they're slowing down their activities because, frankly, if all they read about in the papers are going into recession, that kind of has an effect. And if things like a new car cost a lot more and interest rates, or a new home, mortgage rates above 7%, those slow down the activity. But that's what the Fed intended to do.
Yeah, Brian, I think this is the recession that everybody's been calling for a while. It just may not happen. But I want to go into commercial real estate. I looked at your results. When I see your results, I don't hear you calling out big negatives on commercial real estate. Why is that the case for a Bank of America, but a completely different story over at a company like Wells Fargo?
Well, I can't reflect on other people, but we disclose. It comes from what we call responsible growth. For a long time, we've looked at, in the commercial real estate business, to keep that as a percentage of our loans at a size in total, and even the office piece of that, to work with great sponsors of people in the buildings, great real estate owners, and then, frankly, make sure the terms are reasonable. And so as you look across time, that's served us well. So we only have about $18 billion outstanding in office properties, about a couple percent of our portfolio or less. We aggressively re-rate that based on the current conditions. At origination, it was a 50% loan to value. For all the reappraised stuff in the last 6 months, the average loan to value is only 80%. And so, there's stress going on in the system, but we underwrote, assuming that someday there would be stress. And the trends that have gone on about real estate optimization by companies, including our own, have been going on for a long time. It's just they've been changed a bit by the work from home and the 3-4 days a week and all that stuff. Just to give you an example, when we started with the management team in 2010, in our company, we had 130 million square feet that we utilized. Today, we utilize about 60. So this is a long-term trend of efficiency and use of office space that will continue. It just got pushed ahead by the work from home dynamics.
Do you share the concerns that some of your peers have on the outlook for commercial real estate?
I think, look, that's going to be building specific and city specific, and whether people work. And so, as we do a lot in New York, and you look down the street, you walk out on 6th Avenue outside a building, you get run over by people in town. In other areas, it's not the same. And then there's places, back and forth. And so you've read about San Francisco, a place like that. I think over time, these things will normalize. But I think what we have found so far is we lend to newer buildings and high quality buildings, and those tend to be doing better right now. But I guarantee you, the entrepreneurial spirit of America out there, when the right real estate values come up, people come in and reposition these assets like they've done for many times in the past.
Brian, you also called out something I think of great interest this earnings season for the banks, the potential for higher capital requirements. And I believe this was your stat. A 10% increase in capital requirements, if that does happen, might lead to $150 billion less in lending. That sounds to me like a big economic blow, or potential economic blow.
Yeah, so I think just to simplify that, if you say that we're at 10% required capital and you go to 11%, that 1% doesn't sound a lot, but that's $16 billion capital, and then you multiply it times 10 again, there's your $160 billion. And some people are saying, well, how can you get there? That's how you get there. So the reality is our lending capacity goes down. If you do this across the whole banking system, and that's why we're all awaiting these rules, but we hope that as the rules come out, they're balanced in terms of international competition. In other words, that right now, America and Europe appear to have the same rules, but they are advanced and we're in standardized. And if you listen, they're saying, well, we're going to go away from the models and all those things. That was the basis of Basel III, to get to advanced. So our advanced RWA are 1.4 trillion, our standardized are 1.6. So we have to use the higher under America's rules. That's not true in other locations. And so we have to be careful about keeping the balance and the competitiveness of the U.S. banking system, which is key not only to America, honestly, but it's key to the whole world, because the strength of our banking system actually helps the world prosper. The second thing then is the capacity inside the industry versus outside the industry. And so if you think about outside the industry, you have half the mortgage loans are done by non-banking companies. You have the new private capital funds being formed. Will those companies perform like we performed when the pandemic hit and $70 billion of loans came on our books in 3 weeks from our customers in demand? Will they be able to have that kind of shock absorber system? Will they be able to behave and absorb the turmoil that went on earlier this year? That's not clear to me. And the history has been paved with companies that have been in these businesses not been able to stand those shocks. So, I think that it's good for the banking system to have a lot of the economy running through it, but using the capital markets to lay that off and using the investor system to lay off, loan syndications and things like that. But if you make the capital rules so tight in banking, the stuff gets squeezed out. So remember, on an international basis, this is effectively a trade negotiation that's going on. If the rules are easier in mainland Europe than they are in the U.S., however you get there, whether standardized, advanced, or how you count the eggs and things like that, the reality is American companies will have a higher cost of borrowing versus European companies, of which they're engaged in the same competition in the supply chain for large companies, or large companies would have the same costs. And so I think that's why we have to be careful with these rules. A, international competitiveness, and B, making sure that we keep the balance right of how we treat the U.S. economy. And I hope and I believe, and there'll be, in the aftermath of these rules, there'll be a lot of discussion about what are the pluses and minuses of these rules.
Well, Brian, before we let you go, you're plugged into the regulatory scene. Do you think regulators will overreach with these rules?
Well, I think I look back and the statements have been made by the chairs of the Fed on many occasions and by the vice chairs of supervision on many occasions, including in the Obama administration, the Trump administration, the current, that the capital industry was about right. And so we worry that, the idea of we need to have more capital is coming from, something that just says there's no downside to it. And that's what we try to raise the attention. But, in the end of the day, the rules will come out. There'll be a lot of discussion about them. There'll be a lot of understanding of what actually is in the rules. Right now, it's speculation. And I think we have to be balanced. As we have to be balanced as a. I've been in CEO for this is my 14th year. I've been in banking my whole life. I've seen the wonderful things our industry does for America, and I've seen the downside of our industry. And matter of fact, the non-banking part of our industry, which was the heart of the financial crisis, those weren't banks, weren't under the same capital regimes, and basically are a proof point of why you got to make sure the stuff stays in the system. And so we've seen all that happen, and my colleagues have too. And we're saying, give us a fair set of rules that allow us to be competitive among ourselves with the non-bank providers and with Europe, and we'll deal with them, go on. But let's think this through from the broader prospects, not just more capital is better.
We are seeing incredible momentum from our customers that are really bringing to bear the Slack intelligent productivity platform across every line of business. And today we are announcing a brand new integration, native Sales Cloud integration into Slack, which really showcases the power of bringing productivity for the customer base that Salesforce has been, a great leader over the course of the last 25 years. So it's an exciting day to showcase what we can do across our products.
Has the holy grail of this integration between Slack and Salesforce been realized, or do you need more time?
We certainly are seeing phenomenal customer feedback and excitement for what we can do with products like this. So we are already innovating, bringing Slack and Salesforce together in great brands like Ford, IBM, Target, that are really transforming automation and connecting teams with Slack and connecting all of that incredible CRM data directly into our product. So really bringing collaboration in CRM to supercharge productivity for their businesses. So that's been a phenomenal proof point, Brian, that we are excited to continue to drive forward in the quarters to come.
I think the team a couple weeks ago garnered a lot of excitement on the street regarding pricing for new generative AI tools. How does the pricing for this product get weaved into a broader Salesforce product?
Certainly we are excited to focus on augmenting our pricing to launch a productivity gain for revenue teams. So we will price per user as we have on our Sales Cloud products, but bring consumer grade, consumption grade pricing for AI on top of that. So it is just very aligned with the rest of the pricing strategy for Salesforce.
How are these new advances on Slack and in broader work from home tools as it pertains to AI? How are they going to change my working life?
Brian, as you and I am sure experience and many of our customers, there's just a lot happening. Teams are trying to be more productive, trying to do more with less across every part of the organization. And AI has really become a tremendous innovation proof point. So, we can now bring in Slack native AI experiences that will help you catch up to your work. So, email referencing to be able to bring insights. So if you go into a channel and there's a lot of conversation happening, you can catch up on threads, you can catch up on what you have missed maybe in the last week. It just really accelerates productivity for everybody on the team. So we are really excited about that. But we have also seen a lot of our customers use our open platform to develop AI-led automation as well. So we are seeing a faster adoption to automation. We're using our platform for every part of the organization.
Having covered Slack for a long time, I know small businesses are very important to your platform. We just had a pretty strong ADP employment report earlier this morning. Small businesses leading the charge. What are you seeing from that customer base right now?
Over the course of the last several quarters, we continue to see a very rapid growth of new organizations adopting Slack. So we really measure, Brian, how many new teams and customers are choosing Slack at our SMB self-service business, and that number continues to grow. So we see that as a great sign that the small business economy is revamping up, and it's been a really exciting number to see.
And a lot of these small businesses are joining larger businesses and mandating people go back to the office. Lidiane, there's really this, I think, old guard trying to get human beings back into offices for creativity purposes or just to flex their own muscle or their own leadership baton. How is this impacting Slack?
Brian, we launched a State of Work report a couple of months ago, and there is certainly a desire for more people to go back to the office, but we have seen from employees as well that there is a need for connection. So what's been most effective, and certainly what we are adopting in Slack and many of our customers is using more purposeful time together in the office, where people are really coming together, not just to be there with people they don't work with every day, but rather really be there for actions that will help them all succeed. So for us, it's been onboarding employees. It's more effective to do that in person. It's in product planning. It's a more effective, and teams really needed that connection to feel, understand the culture of their organizations, to feel connected to their colleagues, and to accelerate their decision making. So that purposeful time in person has been very impactful. And what's been great about Slack is that we are a platform that supports this hybrid work environment. So customers are taking advantage of the platform to support this evolution of how we all, work together.
And Lidiane, I would argue you are now leading the most important acquisition, the most important business inside of Salesforce that they have acquired in the last decade. Again, that's my view. Tell us a little bit about yourself. How did you get into that seat?
Well, Brian, it's an honor of a lifetime to lead a product that is as loved as Slack is in an organization like Salesforce that customers truly believe and bet their companies on. So it's a tremendous opportunity. And, I think what makes me the right person to lead this team is that I've been here with Salesforce for 4 years. So I understand our Salesforce customer base, but I have also been a customer of Slack for the last 7 years. So bring the best of both worlds is our vision. Really bringing Slack as the front door of experiences for all of our Salesforce customers is what we're aiming for. And so I'm thrilled to be leading this team.
What's your biggest hope in terms of leading Slack, and how would you describe your leadership style?
I really believe in doing what's right for our customers first and foremost, and it's very aligned with our values of customer success and trust. So what I envision for the future is that we are going to transform how every part of our customer 360 of Salesforce, how work is done. And we believe it is, I certainly believe that it is all of our teams coming together. It's the sales team collaborating with the service team and the marketer team. So really bringing the connecting tissue that will help companies break organizational silo to be more productive and better serve their customers. So I'm excited to bring that vision to bear. I think it's been an exciting 6 months and just the beginning of a optimistic and future ahead.
Yeah, we had a very solid Q2 and beating on the top line, beating on the bottom line, exceeding on both our PC business as well as a bit better than we expected in the data center business. So I just say we finished the quarter feeling really good. Good response from investors as we rolled out the news. And I do think we've seen the worst. And obviously, the PC inventory levels are now healthy again. And we're seeing the demand signals. We think we still have a little bit of inventory on the networking and the data center to fight through in the third quarter of the year. But I really think the worst is behind us at this point, and our raise to the guide for Q3 really portends to a more optimistic future. So super proud of my team and making a really good quarter happen for us.
Pat, you told me 3 months ago that green shoots were starting to form, and it looks that way from the guidance. So is it okay to say that those shoots are now morphing into plants?
Yeah, they're getting a little bigger and a few more shoots as well. But I'll say, if we think about that, getting the client, the PC business, healthy, right? Good inventory levels. We're back to historic market share levels. So I'd say, that clearly has gone from a green shoot to a plant at this point. Data center, hey, we did a little bit better than we thought we would in Q2. The product roadmap, Sapphire Rapids, Gen 4, Gen 5 with Emerald Rapids, looking to appear Q in Q3 a bit ahead of schedule, and the roadmap for next year. So I'll say we're still sort of at the green shoots level there. We had a big uptick in our AI pipeline, particularly led by our Gaudi product line. 6x in the quarter, $1 billion plus pipeline. So I'll say that's still in the green shoot phase. So overall, good green shoots and good execution on our process technology. The all important, do I have the best transistors in the world? And starting to see some good momentum in the foundry business. So I'll say, we have at least one good solid plant and plenty of green shoots other areas in the business.
Fair enough. I could deal with that. So I want to talk about AI in a second. I have to make sure people watch this whole interview, Pat, so I'm going to save it to the end. Let me go back to the state of the PC market. What does the recovery look like in terms of PC demand, and how do you see it playing out for later this year?
Yeah, so we're expecting, nice quarter-on-quarter improvements in it. Part of that is by the inventory level adjustments that are now behind us. We're now to healthy inventories at OEMs and distributors. But our product line is good. We gained market share, again, we believe, and ushering in what we call the AI PC, with our next generation product. We call it Meteor Lake is the name for it. We have new capabilities in AI built into the product that are going to allow you just to do cool things in your PC, and being able to do real-time language translation, be able to do transcription in real time, video effects, all of these type of things, new gamer models. So we see that being like the Centrino moment for bringing Wi-Fi into the PC 2 decades ago. We see this AI PC as ushering in a new class of applications, major application upgrades and ISV excitements, and we're leading the way with our Meteor Lake product in the second half of this year. So healthy and great opportunity in the future.
Pat, why doesn't the street give you enough credit for what you are doing in AI? And I bring that up. You just told me you have $1 billion plus pipeline in AI-related products. What do you guys need to do at Intel to get that word out?
Well, I think there's 2 things going on, Brian. And, in this, I think we have yet some things to prove in the marketplace. But one is there's the accelerators right? That have now, become the way that people are executing their Gen AI training environments today. And so there's a surge of interest where everybody says, hey, I got to get my Gen AI models up and ready to go in my clouds or in my enterprises. And a lot of that's going to the accelerators. So does that become a depressor of Xeon demand, where we have a very big and healthy business? So that's one effect that people are trying to understand in the market. And then the second effect is more aligned with your question is, okay, Intel, are you going to participate in that accelerator market? And, I'll just say we haven't been as aggressive out of the chute as we should have been. And now with our Gaudi product line really starting to get interest in the marketplace, customer pipeline is building very rapidly. And we have a very robust roadmap. Gaudi 2 is shipping in volume today. Gaudi 3, I just received first silicon on it, so it's sort of like a 2x level of capability, and we'll be launching that for volume shipments next year. And then our 2025 product is already well underway. So 23, 24, 25, we're showing up. We're starting to make a impact in the marketplace, but we have to prove it because we have a clear market leader who's executing very well. And I also see that as a potential foundry opportunity, that we're actually going to become, a foundry supplier for some of those AI chips as well. So we see the potential to be a provider of those chips, those AI accelerators, but also a foundry for those chips at both the wafer and the packaging level.
A couple of your competitors, Pat, I think you may be referring to Nvidia, maybe or maybe not, but a company like that, they just had almost a $4 billion reset higher in guidance. But I hear everything you're doing in AI now. I mean, do you think you will have a similar moment next year as these AI accelerators that you're making get into the market of people, and the street needs to reset its expectations for your company in terms of how much profit you can earn and how much revenue you can earn?
Well, I'll just say, NVIDIA's done a good job in this space, and they've really led the way. And as I like to say, they worked super hard, and they got lucky in really being at the right place at the right time for some of these algorithmic breakthroughs. And the AI space is still fairly young, so I think there's a lot of opportunity for us looking forward. We're starting to show up, winning customers and getting real enthusiasm because the market wants alternatives here. And so we're hearing our customers really say, okay, how can you show up to give us good alternatives that are more cost-effective, power efficient, capabilities that the competition doesn't offer? So I feel good about our roadmap. I do think that we will start to incrementally get more credit for that as we go into next year, but I have to execute that well. So I think in this regard, I think this is one of those green shoots that another quarter or two under our belt, I think we'll start getting credit from it from the market's perspective.
I know you're very much a globe-trotting CEO. You're constantly on the road, visiting other countries, pounding the table for Intel's business. We just had a credit rating downgrade in the U.S. As a global CEO that has many connections overseas and who has been doing this for a while, I mean, what do you think this downgrade says about the state of this country, and what does it mean to a business like Intel?
Well, I'd say overall, is anything going to displace the U.S. dollar as the global currency for trade? And I just say, I don't see anything on the horizon, for that. So at one level, I just sort of say, okay, it's a downgrade. Hey, there may be some implications on cost of debt, but I really see that as somewhat minor. I view it more as a statement. Hey, get our debt situation under control in the U.S. and the credit agencies are starting to get a little bit more, concerned in that regard, right? But I'd say in terms of the impact of me running the, Intel as a business, or CEOs like myself running global businesses, I don't see that much real impact from this change. That said, hey, as the more stable global currencies are, the more they see the U.S. right as that leader that everybody can bet on, as we get our own inflation situation under control, and the ability to now start being that leader of global trade again is something that we've put a lot of emphasis on. We want open global markets. We want to be able to sell our products globally. I think all of these tie together to say, this is what it takes to run a great business today. It's a globally interconnected market. We want balance and resilience in the supply chains, and we want access to global markets.
So thank you for the question, and thank you for having me on. So I think the potential is significant. When we launched our strategy in May, we actually said, we called it the Pivot to Growth strategy. And we actually think Austedo, one of the drugs you mentioned, can do $2.5 billion in revenue by 2027. The two others that we talked about were Jovi for migraine and Uzedy for schizophrenia. And those, coupled with another launch we have coming along for an olanzapine, another product for schizophrenia, we really think that that can create a significant innovative business for Teva that has significant growth. So I think that's what we're talking about. But as you've highlighted, we've got to show we can do that. And I think Q2 showed that we have the potential to drive our innovative business. We just got to make sure we keep doing that.
Richard, when it comes to the product pipeline, obviously very exciting goals that you have in mind. In terms of your ability to reach those, I know you've struggled with labor shortages in the past, the shortage with Adderall here in the U.S. being a huge issue, with Teva being the largest supplier of Adderall. What does that landscape look like today? Have you seen improvement, significant improvement, when it comes to the labor side of your business?
We have actually. In fact, when you look at what we're trying to do here at Teva, with our pivot to growth strategy, we're having to actually recruit people in all different areas of our business. As we expand our innovative business, we've hired people from that innovative sector. So R&D, we've been expanding significantly, as well as in our clinical development, because we have a pipeline, as you highlighted there. We have 3 assets in our pipeline that are very exciting: olanzapine for schizophrenia, a product for asthma, and then a TL1A, which is been the talk the last few months because of some acquisitions, one made by Merck of Prometheus, and then another company that's been talked about, Reavant. So I think we've really enhanced our staffing in those areas. And then on the commercial side, we've expanded our sales force for Austedo and Uzedy. So we actually are hiring, and we're finding it, competitive still. But I think Teva has a good value proposition because of our story and our trajectory and where we're trying to take the company.
As we highlighted at the top here, this is a company that is really in recovery here. You have been hit with one legal case after another. Today, you talked about setting aside $200 million for a possible settlement with the DOJ around price fixing. There's also those cases around the opioid settlement. What does that path look like coming out of that litigation? And where does the recovery go from here?
Well, look, I think you summed up really well there. As we are coming out of that litigation. So I think that litigation is behind us. And what we're now doing is focusing on growth. And what we need to do is make sure the resources of the company are applied to driving our growth. Our growth drivers in the innovative side. I said, Austedo is up 51% today. The company in local currency is up 4%. So I think we've set ourselves on a good track. We've got to keep doing this. And I think, as you said, this year is the year that we've got to start to show that we can return to growth. I don't think, we're going to, suddenly pivot, but we've got to start to show incremental improvements in our business and in our portfolio mix. Our generics, we've communicated that we want to make that a powerhouse, make that a really focused generic business where we bring complex generics to the market and where we have a great supply chain. We're working hard to do that. And in the meantime, we're supplementing that and growing our innovative business. So I believe, Teva has a strong future. And that's what we're focused on. And that's why I think that it's important that we keep delivering these numbers. And we're confident that Austedo will hit $1.2 billion this year.
When you talk about shaping your future there, Richard, there have been reports that you could potentially be looking at selling your API business, your active pharmaceutical ingredient unit. Is this something that is being considered given what you view the future of Teva here down the line?
So what we've communicated about TAPI, our API business, you highlight that, is that we're actually going to move it as to a standalone business. Why are we doing this? Well, it's the second largest manufacturer of API in the world. And we've sort of had it under, different parts of our business. And the API market's growing at 7%. And what we've done in the past is strategically use TAPI to feed our generics business. What we want to do now is give it the freedom to operate on a global market. We think that's going to allow it to grow what is already a billion-dollar business significantly. And that's going to help our growth story as Teva. So that's what we're mainly focused on. I think what some of the rumors are generated because people see TAPI as a good business with a lot of growth potential. But we do as well, and that's why we're focusing on making sure it's standalone and can focus on driving growth itself.
Richard, you talked about sort of pivoting to more of a higher risk pipeline, but we know the industry has felt the pressure from IRA, Medicare drug pricing. What are you thinking about in terms of strategy, and how do you strategize so you don't necessarily become a target on that?
Well, look, I think it's always been an evolving landscape and a moving landscape when it comes to regulation. And so I think what we're doing at Teva is we're focusing on science, bringing good products to the market where there's high unmet medical need, where patients need these products. I mean, you mentioned Austedo there. There was no treatment for tardive dyskinesia and Huntington's disease before these products came to the market. TL1A is going to be directed at ulcerative colitis and Crohn's disease, where there's no real satisfactory treatment. So I think for us, we want to actually bring these medicines to the market to help these patients. The IRA and some of the other things that are happening, we will have to navigate those because they will become part of our ecosystem. But that's not going to stop us bringing valuable medicines to the market.
How do you navigate that, though? When you think about where the targets could be, how do you navigate around that?
Well, I think firstly, it's coming now. So for the products we've got, we can't navigate. We just have to accept in our financial forecasting that the IRA potentially could come at some point, and then we've got to financially plan for that, what that does, and how we deal with that. And we'll deal with that with bringing more innovative products to the market. We'll deal with that with growing our generics business to a powerhouse. That's how we deal with that. So I think I think it's frustrating because I do think it puts a dent on the enthusiasm to drive innovation. And it creates more challenges, which is a very costly part of our business where we have many failures in the pharma biotech industry. We invest a huge amount in innovation and we don't turn over many aces. I think people forget that. But it's become reality, so we do have to navigate it. And for our current molecules, we'll just have to accept that's going to happen at some point if they reach a certain revenue. And for our pipeline, I think we are a company that has great antibody engineering capabilities, and so that's where the majority of our pipeline will come from. And I think at least for the short term, that seems to be excluded.
Well, I think most importantly, Akiko, is I really like the new CEO, and that matters. Investors should be investing like private equity investors do. They should be buying the management team. And he has demonstrated pretty clearly that he understands the global market in a way that I don't think previous CEOs necessarily have. And he has hired a new supply chain head of supply chain who is really going in and looking at every aspect of the business, which allowed them to improve margins during the quarter. I just finished the second edition of my book, The Women's Guide to Successful Investing, and I wrote about Starbucks in that book. I bought it in April of 2007 at 30. It promptly went to 5, and just left to its own devices since then, it's up tens of thousands of percent in total return, simply because this is a great company with a great brand that figures it out over time. They stumble, and that's an opportunity to add to holdings. And so we did that last year, and we will continue to add to holdings because I think they're going to be able to deliver on their pretty aggressive earnings and revenue growth numbers.
Oh, Nancy, I will be reading your book, especially when you give that context for that call. I mean, it's a big move since then. To your point, left to its own devices, even including the pandemic when so many stocks sold off and then popped back, and Starbucks has held up. I did listen to their earnings call this week, and there was, you've made this point about some skepticism. There was, particularly when you think of U.S. sales. They talked a lot about China, but the penetration isn't there yet in China, especially to offset any kind of softening in terms of sales growth here in the U.S. You still like it in the face of skepticism?
I do, Diane, because I think, first, Wall Street analysts are not very good at turning points. Mm-hmm. Most people aren't. That's why we use a discipline that forces us to pay attention at turning points. But I think also this is a management team that will figure it out. And the digital engagement, I mean, what Laxman said on the call was not just that he wanted to embrace the digital portion, but he wants to scale it. And that is how you get productivity and improvements in a name like this. And they have a lot of room for improvement. McDonald's noted, I think it was 4 to 5 times the downloads of their digital app last quarter than Starbucks did. So even with the improvements in Starbucks digital app, there is plenty of room for growth. And we think he's the one that is going to get that accomplished. And so we're getting paid a 2% dividend, 12% growth in that dividend. So we can kind of afford to just hang out and wait for the management team to get it right. They will. They have in the past, and they will do it again.
Another pick you like, Nancy, is Broadcom. You've mentioned this before, and this is one where you're standing by your man. Now, to be fair, it has performed well since you last called for this as a pick. Does it still have more room, especially when you see some struggles that its competitors have?
Yeah. The chip names have been really sort of confounding this quarter. Some really good reports and some not so good reports, like we saw from Qualcomm today. But yes, and here's why. I think a couple of things. One is this is a name that well, first of all, they've beaten 12 out of the last 12 quarters. And they've not just beat on revenues and earnings, but they've raised guidance every single quarter for the last quarter. It's a management team that understands their business infinitely. We weren't counting on the AI tailwind, but we got it, and we think it will continue to contribute materially to earnings growth in the future. You have the VMware transaction will close. That's good news for the stock, which is really actually about 50% software after that transaction and 50% chips. And then in addition, you are getting paid 2.1% dividend yield with 23.5%, I think, 5-year annualized growth in the dividend over the last 5 years. I'll take that all day long. The stock is trading close to $1,000 a share. I think you're probably going to get a split, which doesn't add any economic value, but adds to sentiment. And so I think when technology sells off, and I expect that will happen between now and the end of the year, this is a name you want to go in and scoop up.
And Nancy, let's talk about some of the names that you say investors should steer clear from. UPS, one of those. How much of this has to do with rising costs? You know, on the one hand, UPS averted the worst case scenario with a strike, but when you look at the tentative agreement, that only points to higher costs ahead.
And that's the reason, Akiko. I mean, I think there's just better places to be. You want to own industrials when the manufacturing PMIs are bottoming. They are, but you want to own the short cycle names. So even though I think Carol Tomé is an excellent CEO, I think, you are getting paid to wait. So if you own the stock, you're collecting a pretty nice dividend. I think the stock will outperform in the future. But in the near term, I just think there are better places to be. So if you don't own it, don't buy it here. I think it's tempting, but I wouldn't. We're exiting the name, and we're putting the proceeds into short cycle industrial names. And that's where I think you want to be focused in the next 9 months to a year.
And Nancy, another one that you don't like, and you've mentioned this before, actually, CVS. And once again, you've nailed this one. I mean, year to date, the stock is down 20%. It did beat on its latest earnings. However, there's some caution there. Take us through the case for steering clear of this one.
Well, Dan, thank you. I think it's again, there are better places to be in healthcare and certainly in consumer staples / discretionary or retail, however you want to characterize the name. I would use this bounce to exit. And the reason for that is the balance sheet is burdened with debt. They were just paying it down, starting to grow the dividend, and then they made a number of acquisitions. I don't really get the model. I mean, I understand it, but I'm not convinced that it's going to be a high growth name in the future. So it's one of those names that could, sit in a portfolio and contribute from a dividend growth perspective. But again, we're finding much more attractive places to be in the market. And I just don't think, I think this is dead money. You are collecting dividend. I don't think it's going to grow very much because the company has a lot of debt to pay back. And there was a lot of concession around the fact that their earnings growth is going to be slow. So I just wouldn't invest the capital here. I'd look for better opportunities in healthcare, consumer staples, and consumer discretionary.
Look, it's a great time to be in the industry. We sit in a really privileged spot where we get to provide a platform to consumers who love going to live events. And I think we're really excited about everything we're seeing on that front. Everything we're seeing is that this consumer remains resiliently strong, is what I would say, in the face of what we're hearing around the rest of the economy. Whether it's Taylor Swift, whether it's Messi in sports, whether it's Lollapalooza, which was right here in Chicago, where we're headquartered, we're continuing to see strengths across all the categories. Look, I think for us, we see such a breadth across our offering. When you look at Vivid Seats again, we have every single event that's out there, from concerts to music to sports. So I'd say, every one or two artists really aren't enough to represent the whole, but certainly in terms of Taylor Swift and Beyonce, when you think about them relative to others, they are certainly sizably larger than what we've seen in the past.
Can you tell us breakdown of sports versus entertainment?
Yeah, I think, we see the industry as about historically 60% sports and 40% concert and theater. For us at Vivid Seats, we've continued to index higher on the concert side, and we're probably closer to 60% concert, 40% sports.
And even with that breakout, when we think about the impact on local economies, what type of multiplier have you seen from events for the broader impact for the local economies as well that they're within? I mean, people are traveling to see Taylor Swift, Beyonce. I traveled to see a concert this year. I mean, that was part of my travel plans, I guess. But all these things considered, I mean, there is a huge impact.
Yeah, I think, look, back to the strength of the consumer continues to ripple into other things, and we're privileged to be in this spot. We just looked at Lollapalooza, for example, in Chicago, 4-day festival. When we looked at where people traveled from to get there, it looks like they're traveling 33% further than they have last year for that. And I'm sure that ripple is the same across multiple events and categories.
Stan, how sustainable is all of this, right? I mean, yes, people are really excited to go see some of these concerts from artists who have not been touring. And even if they continue to tour, are people going to be willing to pay the same premium to make those travel plans that you're talking about? How much do you think that's going to last?
I think we are at the start of, what we call secular tailwinds towards the sector, where I think people really are prioritizing their spend towards live events. So I think we love that. When you look at Vivid Seats, what we're doing in particular, I think we've invested in a lot of things on our platform that we believe will help consumers as they look to make purchasing decisions and go to more live events, whether it's our best-in-class loyalty program, or we have a buy 10, get one free ticketing program. We have been recognized by Newsweek as best customer service. We now have Game Center as a place to engage and win free tickets. So, we continue to see strength, and we continue to also invest in things such that consumers find value in the platforms in addition to the events that they're going to.
You gave us a year-over-year comparison just a moment ago here, and I'm wondering, since some of these massive concert dates were listed, like Beyonce, like Taylor Swift, what kind of increase in volume or traffic have you experienced?
Yeah, we're really proud of our results, in particular for the quarter. If you look at that, we're up versus the street, certainly 20% on GOV, up over 20% on EBITDA. And as we look at, what we're guiding to, I think we guided up more than our outperformance in the first half of the year. So I think we continue to see strength. I think we're pretty excited about everything we're seeing on the platform.
All right. Who's the next concert you're going to see, Stan?
Hey, I'm going to Guns N' Roses in Chicago. They're here August 24th. I'm a big hairband guy. I'm looking forward to it.
Listen, I think the exciting thing is, and you've seen with Hain Celestial, what I was able to do is bring a bunch of brands and diversify the company into multiple categories. Not dissimilar here. When I got, to a free in 2018, we're a $50 million business. We're approaching close to $1 billion in size. And, one of the challenges I ran into was with cannabis was not knowing what legalization was going to happen. Legalization happened in Canada, medical legalization happened in Europe, in multiple countries. But everybody was waiting for the U.S. And with that, it took a lot of predictability away from earnings and revenue generating. And I think you saw so many cannabis companies where their stocks just got hit hard. And what I wanted to do was make sure we were not dependent upon legalization. We had a good income stream. We had revenue stream. We had predictability of earnings. And I wanted to diversify the company. But what was important, that we had adjacencies out there that they could bring it all together. So today, our cannabis business in Canada, we have the number one position with a 13% share, is about 30% of our revenue. Now with our Montauk, our Sweetwater, and our 8 beers that we're acquiring from ABI, along with our Breckenridge and Manitoba Harvest. And then our international business, which is about 30% of our business, and our Manitoba Harvest, gives us a good diversification, gives us ultimately that we can bring it together upon legalization. And very few companies out there today have what we have in beer, spirits, cannabis, and medical cannabis.
So, Erwin, as one of the analysts on the call pointed out, this portfolio of beer brands that you're buying, or I should say beer brands and an energy drink brand in Highball, this portfolio has been seeing declines in the past several years. How do you plan to turn that around? Does being part of your bigger portfolio help you with that strategically?
So number one, listen, we bought Sweetwater in November 2020, and it was not really growing. Montauk was growing. When we bought Green Flash, Alpine, and Nelson's, they weren't growing. So we've done a great job in turning around beer businesses that we acquired. And if I come back, the big thing that I'm focused on here, no different than I looked at the natural organic food industry, no different than I looked at the cannabis world, is ultimately, I think there's such opportunity within the craft beer business. Constellation has left the craft beer business. There's a lot of confusion out there with the craft beer business. And the strategy within Tilray is, how do we make craft beer cool again? And with that, a lot of consumers were drinking the vodka seltzers and vodka, mixed with sodas and stuff like that. I think taking our current brands and taking with the ABI brands that we're acquiring, we can really bring some good energy and good fun into the craft beer business and make it cool and fun again. And that's what the plan is.
How do you do that? How do you make them cool again?
So listen, you can't just stack them high and watch them fly. And you got to connect with consumers. You got to connect with the Gen Z. You got to connect with baby boomers. You got to let them know what is exciting about beer today. And listen, we've done that in regards to our 420 with Montauk. We've done that in regards to gummy beers coming out in regards to Sweetwater. Some of the other IPAs that we launched with packaging and bottles, et cetera. We revolved a lot around concerts and music, et cetera. So again, it's coming up with unique products, it's connecting to the consumer. And with that, we'll hopefully get these products growing in the right direction and giving them attention. Absolutely, you got to spend money on them. You got to ultimately, enhance some of the packaging. And I think there's such big opportunities. I think the opportunities with Shop Top, I think the opportunities, in regards to some of these other ones, Blue Point. You put Blue Point and Montauk together, I think there is such great opportunities and synergies to market them alongside each other here in the New York area. So, what it does for Tilray also, it allows us to put together a national beer business today, and allows us to put together our distributors, allows us to become more important to distributors, more important to retailers, and ultimately, it's important to let the consumer know how we're all combined and connected.
And as you mentioned, part of the original impetus behind getting into this business was to sort of serve as a bridge, right? To sort of smooth out revenue in what is an unpredictable time. When we would have talked a couple of years ago, it seemed like at that point that federal legalization was closer than it feels like it is right now. What's your current thinking on that?
And, great question. I can't predict what our government is going to do. Cannabis is legal in about 37 different, states out there in regards to medical or recreational. So I can't sit back and sort of wait and say, hey, it's going to be legal next year. Originally, I thought when the Biden administration, it'd be legal today, but that's not the case. So what I need to do for our shareholders is to have predictability on revenues and growth. And ultimately, we're well positioned upon legalization where the adjacencies. And there's no reason you cannot have beer out there without alcohol, of course, that is infused with THC, and consumers want that. There's no reason you can't have spirits out there that are infused with THC. So I think, ultimately, we're well positioned. And when legalization happens, not if, when it happens, we're ready for it. We're one of the largest grower in Canada. We have over 5 million square feet of grow space. We really know how to grow cannabis. We know how to develop products in the cannabis space. We're going to get better in the beer business in regards to craft beers and some of the uniqueness. We're in the spirits business with our bourbons and vodkas and gin products. So we're in these businesses today. And ultimately, how do we all pull together? And when legalization happens, we're ready to, come out there with beers and bourbons and that would are fused with THC.
And Erwin, finally, a quick question on deal process, because obviously the other party involved in this deal has gotten a lot of headlines lately in the form of Anheuser-Busch and with Bud Light in particular. Have you had your eye on these brands for a while, and sort of maybe some of the challenges at Anheuser-Busch lately opened the door for them to be more willing to sell these brands to you guys?
Listen, I picked up the phone and called ABI and, explained them what I was trying to do. And they were great to work with. And I think they saw right reasons why it made sense to divest. And we're taking all their people that come along with this here. We're working with them on a transition. So, I think it's totally separate. And I'm sure that we would have been able to work with ABI if we're not dealing with some of the other stuff they are. But it's, again, having the vision for Tilray, and no different than having the vision in buying Montauk or having the vision to buy Sweetwater, was ultimately we needed distribution in the Pacific Northwest. We needed more manufacturing for Montauk, in the Northeast here, and Blue Point came along with that. The cider business, which is an excellent growing business and, pretty exciting with Highball, I still think there's big upside on the energy drink business. So it really fit perfect with what we're trying to do. Some of these beers will be sold in Canada. So the opportunity, for us is tremendous.
That what we really believe has been the power of the transformation at Campbell has been focus. And as we think about focus, what we've been building is this, very, very clear one geography, two divisions, 13 categories, of which sauces is a big part of those 13 categories. And as we look at the opportunities to add value and continue to strengthen, especially that meals and beverage portfolio, this ultra distinctive Italian sauce area has been just a significant source for growth and clearly a place where we don't play. And so adding that into the strategy is not a deviation, it's not a departure, it's really about stepping on the gas and just going forward with it. And that's why this was so, I think, such a great fit for us strategically. Why the price? I think, we've been very, very diligent, as I would think people would expect. And we really spent a lot of time trying to understand runway going forward. That's the big part of this deal. It's not one that's anchored on, having to do 20 things differently or fix this or fix that. It's really about that runway going forward. And as we look at these businesses, the combination of first just inherent distribution expansion, where I think our commercial operations will be a great support to the great foundation that Sovos has built. Household penetration and awareness on this brand, although impressive where it is, there's still a pretty wide range between Reyes, where Reyes is, and where traditional premium brands are. And that's really in our wheelhouse. Building awareness and driving household penetration is something that we understand really well and are excited about. And then finally, I've said this a couple times, a lot of times when you get into these, people will get excited about a brand and start expanding it into 50 different areas, all with no profit. These guys have been very, very thoughtful and very consistent in expanding into categories where the equity of Reyes is powerful and the underlying profitability or the business models in place. And those are just getting started. So when you think about frozen, dry pasta, soup, all of these frozen pizza, these are all areas where we see just a tremendous runway ahead. And that's why we felt great about the value and where we landed.
Mark, I'm never amazed by the questions that come up after a company makes a big deal. One question I saw there on social media,
I know where you're
Campbell
going.
Soup, they're going to change the recipe of the pasta sauce. They're going to dumb it down. They're going to make it less flavorful. Can you address those concerns?
Yeah, look, head on, right? We will not touch the sauce, right? We just spent a pretty significant amount of money to buy something that we believe is really, really special. And I can tell you, Brian, I was on the ground in Italy. We have a tremendous partner that is, somewhere between industrial genius and, artisan specialist in building this incredible, unique sauce. And so I want everybody, please, I appreciate all the encouragement in social media, but we are not going to change it. And look, if we want a little bit of proof point, we've been pretty consistent for 125 years with a pretty darn good chicken noodle soup that we guard with our lives to make sure that quality stays the same. So please, everybody, feel good. We're gonna protect that as we should. Well,
I can back that up. As a consumer of chicken noodle soup for about 40 years, it sure tastes the same to me as when I was eating it. But Mark, you mentioned the product pipeline for Reyes. What does that roadmap look like over the next 18 months? Is this a brand where I'm going to walk down the frozen section, I see frozen pizza, but you know what? I see Reyes garlic knots made by the folks over at Campbell Soup.
Yeah. Well, look, I think the first thing I would just say is that the Sovos team, as I said, has done a masterful job building out a pipeline. It was really one of the things that as we got into the diligence that we really were excited about and felt great. And that's really evident across all the segments that they're currently in. So I think you're going to see some pretty exciting expansion within the sauce area. As I mentioned over the last couple of days, they've got 5 SKUs right now in sauces that are at what I would call more critical mass distribution, over 80% of the ACV. The drop off from the next 5 and beyond is significantly lower. And so there's a real opportunity to build out this grocery destination for what is clearly this fast growing, ultra distinctive area that is something that we feel really good about. In frozen, I also think that that team just getting started and a lot of runway ahead. I will say, though, we do have a pretty unique and pretty capable frozen team that's working on desserts and bread. And who knows what the future could hold as it relates to a frozen tiramisu or I don't know about cannoli. That could be a tough one. But you know what?
Not a tough one for me. Sign me up for that. I got it.
We got a lot of wood to chop already with the pipeline that's in place. But yeah, we're very excited about what this brand is going to be capable to do to extend into some other adjacencies.
Lastly, Mark, before we let you go, a lot of focus in markets on the consumer price index. We're finally starting to see prices come down. Your company has or touches a lot of different commodities in that CPI basket. Do you think we're set up for a deflationary environment next year?
I really think that what we're going to see, and I've been pretty consistent on this, is that we're going to start to walk into a period where there's going to be more differentiation between different cost areas, where you may see some recovery in some areas, but we're probably going to still see some headwinds in other areas. And we know in different parts of agriculture, there's different aspects of ingredients. I do think we'll see some relief in some of the other structural areas. But at the end of the day, we'll be out talking about guidance here shortly, and I don't want to foreshadow any of that. But I think consistent to what I've said the last couple quarters, this is a world where you're going to have some ups and downs.
Here's where we're at. When we saw real hyperinflation last year, we took aggressive action, as most food companies did, to protect our margins. We have not had passed on a price increase to our customers since about July of last year. So our team's done a nice job of holding that. We're going to be lapping all of those prices. We want to meet consumers where they are in the back half. And we believe we're in a good position as we lap all of the prices, try to hold it steady, deliver value to our consumers in the back half, and see volume recover as we do things like family packs that provide more value to consumers, and use our productivity initiatives to hold pricings where they are. So it's certainly coming out of a spot. Our consumers are certainly feeling the punch, but we believe we're focused on that. We're focused on delivering that value to our customers, ultimately to our consumers, and expect to see that volume recover as our price impact inflation to the customer really goes to back down to normal levels.
Andy, it's Brian here. Always great to get some time with you. I'm going to refrain from asking you if you've seen a pickup in your convenience store business with all these big lottery jackpots, but I will ask you this. Have you seen any impact to the convenience store business lately as gas prices have been back on the rise this summer?
It's a summer season, so we do see traffic more recently, with the rise of fuel, that sometimes has an impact on our consumers' behavior. And a lot of times it increased the frequency to the store because they're not filling up the tank every single time. What we're seeing right now is a slight increase of traffic. We're about flat year on year. That was slightly down in Q2. We expect it to continue to rise, and we're well positioned for that business. Brian, as you know, we have a terrific C-store business. Scott and the team do a great job. We have availability that's about 20 to 25 points greater than our next closest competitor. We're bringing them innovation. So I feel like we're in a good spot for convenience, but certainly we watch those fuel prices very, very tightly.
Something that we've been keeping a close eye on within the consumer price index readings that we get monthly is this food at home figure. And that increased by about 0.3% over the month here. And the reason that we're keeping an eye on that is because that directly correlates as well to your business. If people are going through one less aisle and saying to themselves, you know what, I need to cut back on that particular part of my grocery experience. How do you make sure that you're retaining that customer? And is there any pickup in those grocery aisles among some of the newer products that you've introduced into the stores?
Yeah, a couple of questions there. The first is we partner with our customers to really throughout the store. We have many points of interruption throughout the store. It's not just the aisle. You are right about the number of units in the basket to offset the price, but we're in a very accessible snack. And as I said before, we try to give our customers the right value. We feel like we're set it back to school. We sharpen value where we think we can. We launch value family packs, which are doing very well, which allow consumers to really participate in larger sizes, but a better value. So we do all of that and partner with our customers in a very good way to be able to take advantage of that. Related to our new items, they are really doing well. And that's one of the reasons why protecting our margins, but doing it not just through price, but through productivity, which our team's been able to do, is really important. It allows us to bring what consumers want. Our new Casbars offering is really off to a terrific start. It's a reimagined baked goods in a bar form that expands the consideration set into the $65 billion snacking universe for all of our consumers, and gives them really the quality of baked goods they expect for Hostess, but the indulgence of a bar and layers that they want. So these things like family packs and old-fashioned donuts and our zero sugar Bortman cookies are all ideas that we're able to bring to consumers because of our productivity initiatives. And that's what consumers are looking for in indulgent snacks.
Andy, earlier on today, I caught up with Campbell Soup CEO Mark Klaus, and I see a lot of similarities between how he leads, how you have led. I see similarities in the businesses. You have both led turnarounds of these storied brands. He just made a big acquisition. I mean, do you think there's a deal to be had out there over the next few months as we might start to see a pickup in consumer packaged food? Is there a new category you want to get in? In Mark's case, he's expanding into higher priced pasta sauce.
Yeah, Mark's a terrific leader. I've known him for over 25 years, despite being a West Point guy and I'm an Annapolis guy. He's a terrific leader, so I'm not surprised his success. He's leading Campbell's too. But very similarly, we look at the M&A landscape, and our frame of reference is around snacking and indulgent snacking. And we have built over the last several years capabilities, whether it's consumer insights, marketing and innovation, our supply chain, to be able to take advantage of this growing $65 billion landscape. And we see that M&A and some of these businesses that are maturing are at the right spot that may have been interrupted by COVID, really moving into that space in a really nice way. So it's always part of our calculus. Our number one place for capital is our core business, and number two is M&A. And our team's doing a really nice job of doing that. We're coming out of building out our Arkadelphia bakery, which expands capacity we need. And our next priority is M&A. We think we're in a really good job for that. And if not, our organic growth and our long-term algorithm will create great shareholder value.
Well, for the consumer itself, it would be fairly transparent. What we've been building is a very large database, and probably the largest cinema movie database available. And ultimately, what every brand wants is they want to know exactly who's in their theater and whether they're targeting the people that they're looking for. We're known for reaching 18 to 34-year-olds. There's probably no better delivery system in the world for reaching young people in movie theaters today compared to television or even in digital. So what we wanted to do was marry that great young demo to a really cinematic experience, 50-foot screen, and then have the data and the ability to do all the attribution studies that our clients want. We've been very fortunate. July was one of the best months in the history of the movie business. In fact, the biggest July since 2016. And during that period of time, 125 million people actually were in movie theaters. And National CineMedia being the leader in the space, we've delivered, 70% of those. The schedule you have up right now shows a really interesting intention study that we did. Literally 97% of people watch cinema ads, and that compares very favorably to linear television, sports, even YouTube, TikTok, Facebook, where we outperform most of those departments by at least 2 to 1. So it's a really interesting comeback story. Just as the movie theaters have come back, cinema advertising is coming back as well. So we're excited about the future of this business. The movie business has been under a lot of duress during COVID. And we finally see the life back in the business this summer with Barbenheimer, which seems to have been quite the story for everyone.
Yeah, I mean, look, it got me dressed up to go to the theaters, Tom, so that was a success as well as just being able to see the movie and kind of participate in that. But then you think about what beyond Barbenheimer as well, and the fanfare, the amount of foot traffic that's going into the theaters. How do you continue to sell to potential advertisers and marketers that the CPMs should still be that valuable moving out of a major wave of moviegoers like we've seen over the summer?
Well, as we sell advertising, we lay a slate out for our brands and advertisers. Every month, every week, there's some movie and some demographic that's interesting to an advertiser. And what was interesting to Barbie might have been different to someone who was searching, the Oppenheimer demographic. So as we lay out our schedule, and right in the middle of the upfronts right now, which are looking actually pretty good, there's always a movie in any given flight. And typically our brands buy by the week. And they can often buy all the movies in the theaters. They aren't just buying just Barbie and Oppenheimer. They're buying every screen in a multiplex. So we've never had an issue, honestly, attracting advertisers around the year. Obviously, there's peaks in the summer and there's peaks in the fall, November, December period. But generally speaking, this is a business where we can always drive young people into the theater. And I think as brands keep searching and searching for young people, they can't find them on TV anymore. They often are unreliably found in digital platforms. But we know when they're in front of a 50-foot screen that they're going to see our ad and it's going to have a lot of impact. And most importantly, we have the ability to retarget them after they leave the theater, whether it's on their mobile phone or through a digital device. So we can really deliver end to end before, during, and after the moviegoer that is often so desirable by advertisers.
So, and Tom, as you guys exit bankruptcy and amidst this restructuring, do you expect to sort of follow the wave of the return to the theater? In other words, did the restructuring have to do with the pandemic and people not being in theaters? And now, as you also pivot to programmatic and also bet on, sustainable return to theater, that's the sort of prospect here?
Let me sort of cover all those questions at once. So
Sorry.
There is a high correlation between admissions and box office and the way we deliver advertising. You see those results in advertising often later on because most advertising is bought in the upfront market and bought often a year ahead of time. So what's being sold in the marketplace today is often the futures market of advertising, which is anywhere from 9 to 12 months from now. And then there's also, of course, a scatter market, which was relatively weak sort of lately. So we look at our recovery story as being similar to what's happening on the exhibition side, whether it's at AMC or Cinemark or Regal or some of the big public traded companies. But we tend to have a much better story in that our margin structure is significantly better than that. And the advertising business tends to be less volatile than the exhibition business. And we're combining this with our digital platforms. We announced programmatic as being a new initiative for us to reach a whole nother type of advertiser. So we look at us as a recovery stock that many people haven't discovered yet. We officially emerged on Monday. We're one of the few, if any companies on the NASDAQ with truly no debt. So we have the ability to reinvest in our company. And this is a very high margin business that delivers 80% of its free cash flow into EBITDA. Historically has been a high performing stock. Obviously, the capital structure was a problem for almost 3 years during COVID. And now that that's behind us, we sort of look at this as another opportunity to take a really good ad product, high margin, interesting product for consumers and investors, and then reinvigorate it potentially with additional capital.
With that additional capital, do you think that you'll need to tap even more kind of resources to increase the liquidity for the company and continue investing?
I think the thing for us to do is, we have to stabilize, obviously, our core business, which will require investing in our current infrastructure and current people setup. But we are going to look to additionally invest in data and analytics, which we've invested a lot in over the last several years. And we may start looking at other adjacent opportunities to reach cinema goers. It's a very unusual captive audience to have somebody in a movie theater running an ad. And that young demographic is obviously very appealing. If we can find related businesses or additional opportunities to sell to those same types of consumers, we would certainly do that. We're in a really unique position to obviously reward investors based on our capital structure, our margins, and the potential to grow the business.
Tom, we got to go. What is the most compelling non-theater, non-cinema opportunity right now?
I think probably digital out of home is. We are out and about all the time going to movie theaters. Often those are in malls and places where we can deliver additional advertising to people coming and going. So I see that as a really important adjacency. So I appreciate all the time and effort, but I just want to leave everybody with, get a chance, go to the movies this summer if you haven't gone. It's a great experience, and it was proven out in July with Barbie and Oppenheimer.
We feel like we've transitioned from being a material science company, which is really what we were at our founding, to a manufacturer of completely integrated systems. So any technical advances in this field that can really further our offerings, we welcome, right? So I think one of the big parts of the news is that if there are technological advances in our space, it's only going to benefit us because it's going to spark people thinking about what the future could be. And really what we're capable of doing is delivering what's possible today. As a commercial company, as a public company, we plan to continue to maintain this position, but we need to be able to develop the future, but be able to deliver the present. And a lot of what we do is translating that, what used to be science fiction. If you go back to, you look at any science fiction book that talks about how do we do interplanetary travel, it's a superconductor drive. If you look at even what Tom Clancy wrote with The Hunt for Red October and the drive that was in that submarine, it's a superconductor drive. If you go back to the very founding of the company back in the mid-'80s, it was very similar in that there was a whole brand new set of materials that were discovered and people were trying to figure out how they were useful. And that took a little bit of time. And then it took a much longer time and a pretty good amount of money to figure out how to make them. Right. And then what we've figured out recently, and really since I met you, I can give you responsibility for it, that we've been able to commercialize finally. It's taken a long time for this company. We've been in business more than 3 decades, and we're now seeing permanent installations on the grid and in Navy ships of superconductor driven systems. So there's a huge future, I think, in superconductivity. And I think any and all investment that helps to try to improve how the world's going to move, particularly as we have the mindset towards, how do we manage the change in the climate and how do we decarbonize the economy, that our company is really at the center of how do we make that happen. And superconductor is a piece, and other types of superconductors in the future could be pieces as well.
So again, just to sort of differentiate here. So a superconductor, I guess in its simplest form, is something that conducts electricity without energy loss. That's the sort of idealized version. Or the idealized version would be one that you didn't need to do anything else to it. It would just be able to do that by virtue of its innate properties. And that's allegedly what this thing was supposed to do, this thing in Korea, but it probably doesn't. So the superconductors that are in real life, in reality, that you guys are using in your applications, what are they? In other words, what has to be done to them in order for them to perform without this energy loss that we're talking about?
Yeah, I mean, the two main areas that we see commercialization is what we've done and what the medical industry's done with MRI. And to give you kind of to compare and contrast them and the view of the technology in the future, the MRI machine, if you've ever had one, has very significant amount of infrastructure. And a lot of that infrastructure is be able to manage and cool the magnet. So if I have a conductor, I can do 2 things it's really useful for. One, move current through it to get it from point A to point B, or move current through it to create a magnetic field. So we talked about what we do with the Navy. That's the feature set that we're adding there. The same thing with an MRI magnet. You're trying to use the superconductor to have high energy dense, very specific targeted magnetic fields to be able to investigate what's in the body without direct contact. The load for the cooling apparatus in the hospital is quite significant. In our case, it's about a 20th. So the load of what we have to deliver to be able to cool the superconductor to get it to the point it can produce the magnetic field we want or move power without loss, that's a piece of the technology. Where people want it to head is, can we do that with lower load and eventually no load? And I think that certainly that's the pathway. But it seems like, this has always been a chase for, just like in fusion, they want to talk about different ways to do nuclear fusion. In superconductivity, there's been that as well. And then there's been other discoveries of other superconductors. Some of the challenges are with other materials is they're pretty significantly carcinogenic. So the last thing you want to do is to try to solve what we think is a noble and important problem for humanity, to be able to manage climate and carbon. You don't want to do that by using known carcinogens, right? So there's a certain piece of this that you have to go through a screen on what the material is, how would eventually you be able to make it, how would you format it, how would you make a system. And our company has done is we understand full end to end. So if there needs to be a change in one piece of that end to end, we're able to adapt, adopt, and hopefully exploit it in the market and use it as competitive advantage.
So as all of this discussion was going on and understanding now how it's used in the real world versus what was going on with this research, we did see some interesting activity in your stock, right? Because people saw the word superconductor, I think, maybe, and, bid up your shares. Now, how do you think about that from a management perspective when something like that happens?
Well, what I think the good sign of it is that through the media cycle that we've gone through and through the run up in the stock and the heavily increase in the volume, I think a lot of people now understand maybe what a superconductor is, what it's useful for. I think a lot of people maybe have maybe a different imagination set where they can think about a different possible future. And I think, our role as a corporation is to make sure we're part of that and helping to move that forward. So I think it's an educational moment for many people. I think, as you said, a lot of people were looking for companies that were involved in superconductivity, and we are, the main one. We are at the forefront of the technology on every level. So, and these things may happen again, right? Science makes progress, but then science has to be validated, has to be peer reviewed, has to be understood, replicated, all those things. And then once that happens, there's a whole industrial piece to it. And how do you make it over and over again? How do you make it useful? And then how do you systematize it in something that somebody can buy, which takes time. And that's really the history of our company. That's what we've been at this for a long time. And it's taken a lot of effort, a lot of blood, sweat, and tears and shareholder investment to get us to where we are. And that's the good news in the call. And partly why I'm real excited today. It has nothing to do with the stock and scientific announcements. We've now proven out what I've been talking about for about the past 2 years in the transition in the company, where we actually guided for our next quarter that we're in a position we may generate positive operating cash, which is huge news for us. We've never done that before.
And we're establishing a powerful global house of iconic fashion brands, uniting, as you said, Coach, Kate Spade, and Stuart Weitzman with Versace, Jimmy Choo, and Michael Kors. And we're excited about bringing these brands together because of the compelling financial opportunity. There's excellent strategic fit. It's immediately accretive, and we see significant runway beyond just the initial combination. And I think we're confident that investors will see this compelling opportunity. This is a story to watch, Brian.
What makes the transaction so compelling?
Well, again, it is about the strategic fit. We're thinking long-term about our business, and the strategic fit of this transaction, it builds our portfolio in a great category. We play in a resilient $200 billion luxury market that includes handbags, footwear, and apparel. And these brands are incredibly, they're distinctive in that market, but they're also complementary. If you think about our two businesses, this deepens our access to a higher end luxury consumer that is quite resilient. There's geographic diversification here, where the Capri business has a relatively higher penetration in Europe. Our business is relatively higher penetration in Asia. And it broadens our product offering because the product categories are also complementary, where the Capri business has a higher penetration in lifestyle categories like footwear and apparel, and we see opportunity to grow those categories across our portfolio. So on a number of different levels, these businesses are complementary. And then we believe that we have an opportunity to leverage the Tapestry platform to drive a direct-to-consumer opportunity. We've built this strong consumer engagement platform and elevated our direct business, and we think that applies as well to the Capri businesses.
I've been covering your company for a while, Joanne. Going back to it was just called Coach, and I remember that 2017 acquisition of Kate Spade. This was before you. There were challenges integrating that business, again, before you. What is the institutional knowledge inside of Tapestry to better integrate a company like a Capri, which is a lot bigger than Capri? I mean, with Capri, which is a lot bigger than what you bought a couple years ago in Kate Spade.
Exactly. Well, we have experience in integrating, and I would say that we've learned a lot over those years, right? And the importance and the things that are important that we've learned, the importance of clarifying the brand positioning, not walking away from the unique and distinctive aspects of each of these brands. These brands are iconic, and they have, we fielded a lot of research in this in the process. They are strong brands. They're well positioned in attractive markets and market segments. So our first learning has been clarifying the brand positioning. And in our transformation over the last 3 years, we've done exactly that across our brands, clarifying that brand positioning and crystallizing the target consumer to make sure that we're strengthening our execution behind the product offering and the experiences for that target consumer. We've also strengthened our teams and ways of working, embedding data and analytics. We've spent a lot of time, I know, over the years talking about that, Brian, embedding those analytics in the hands of decision makers to make our business better, move faster, and more responsive to consumer data that we have. And we've invested in brand building activities over the past few years. We've more than doubled our marketing spend. So as we work to engage consumers and integrate these brands, it will be with that focus on continuing to build the brands. We're also going to be quite choiceful about where we decide to integrate and where we don't, knowing that there are some places that it makes sense to have a lighter touch. In businesses like Versace, that's playing in a different space with a higher end consumer where we don't have the experience or scale, the integration will be a lighter touch. And in the places where we have experience and scale, we'll bring that scale to benefit the acquired brands.
One thing that I think the street is realizing today, and I don't think they realized it yesterday, Joanne, is the international play here. It seems like there's going to be a new unlock or new areas of growth, notably in Asia, where Tapestry and Coach have really has had a strong position. Does this better allow you to compete with a Louis Vuitton in those high growth emerging markets?
Well, we think there are opportunities around the world with this combination. They have a relatively stronger business in Europe where we are also relatively underpenetrated. So we think there are opportunities on both sides. We can learn from the Capri brands, and they can learn from us in Asia, to your point, where we've had more success and we have higher penetration. Overall, this combination provides more balance and diversification around the world, which is great for our business. We have seen the importance of global diversification over the last 3 years. We've seen different parts and regions of the company accelerate at different rates and face challenges at different rates. And that's been really the underpinning of our ability to deliver consistent, strong results quarter after quarter through a very tumultuous time, because we have this global footprint and diversification. And this combination only adds to that.
I think one of the other reactions here, Joanne, is that Capri was struggling. Its shares were underperforming yours the past year ahead of this deal. What do you have to fix there?
If I take a step back and talk about our overall vision, it's taking iconic brands with true heritage and design and craftsmanship. And there aren't a lot of those kinds of brands in the market. So I do think it's important to take a minute and just appreciate the quality of the brands that we're bringing on. But when you combine those quality, high quality, iconic brands and put them on this modern consumer engagement platform, that's where we can deliver more innovation, more connectivity with consumers, and more relevance, which we see that as luxury at its best. And that is really the power of this combination. And I think why we're so excited about the acquisition.
Before I let you go, Joanne, on a personal note, what does doing a deal like this mean to you? I go back, I originally met you when you were at Abercrombie & Fitch. You helped turn the finances around there. You came here really under a tough situation initially as the CFO, quickly rose the ranks to CEO. You've turned around this company. What is it like to pull a trigger on probably one of the biggest transformational deals in retail in the past 5 years?
I see incredible potential. And the thing that gives me most energy and most gratification is seeing our teams win. We have such quality teams around the world that it's harnessing the power of our teams that has really been the underpinning of our success. It's very clear in the market. I've been in this business, Brian, even before those experiences, since I graduated from college, 35 years. It's moved and changed a lot. the focus on the consumer and the agility that is needed to really engage consumers today, those are the capabilities that we're building. And I get a lot of gratification from harnessing the energy and the passion of now we'll have 33,000 team members across the globe. And I think that's it's a powerful opportunity, one that we don't take lightly, but I think it will solidify our growth going forward.
Yeah, we're excited. Our turnaround is well underway. We're seeing guest metrics significantly improve. We're laying down the investments into the business in order to start growing that traffic. So if fiscal 23 was about really level setting that guest experience and getting us on the upward trajectory and improving restaurant operating margins, fiscal year 24 is going to be all about reinvesting back into the business to drive traffic. And we've announced on the call $55 to $60 million incremental this fiscal in advertising that's going to drive traffic. And the first waves of advertising that we did in 23 did a really, really good job of driving traffic and closing that gap. And that's one of the reasons why we're seeing accelerated sales growth versus the industry now, is because that gap continues to close. So we're very bullish about our current fiscal and the investments that we have in place to drive traffic.
Kevin, this is Brian here. Good to see you. It's been a weird week in all things consumer land. Walmart, good earnings. Target, not so good earnings. You guys did pretty well. Why do you think consumers are paying more for experiences and services like going out to restaurants and not buying more stuff for their home?
Yeah, it's interesting. What we're seeing is the people that are coming to the restaurants, they're excited to pay more, right? And so they're buying bigger bundles, they're buying more drinks. We're certainly seeing that in our mix numbers. So you shared earlier that the traffic was down, but the sales were considerably up. And what that tells you is the people that are coming are spending for experiences and they're spending for more premium things. And I think it's a function of coming out of the pandemic. I think people, they want to have more experiences, they want to be back together, and that's one of the reasons why we're seeing dining room traffic up, and that's really helping our business because dining room traffic is much more profitable than off premise. So, I think it's going to continue. I think you're going to see experiential and experiences continue to be valued, and we're going to be there to service that guest.
And let's be frank, we're trying to have them margaritas too, Kevin, at the same time. Promotions, at the end of the day, though, that is a traffic driver, especially for a company such as yours. When you think about those traffic drivers, how long do promotions need to remain in place in order for you to see that full customer lifetime value over the timeline of a relationship there?
Yeah, thanks for that question, Brad. The way we think about pricing is we call it a barbell strategy. We want to make sure we have unbeatable value. No matter how much money you're willing to spend to come into casual dining, we want you to be able to service that Chili's with a great experience. So we always talk about our $10.99 3 for me. That is the focus of our advertising for this fiscal, because we think that is unbeatable value across any restaurant chain, not just casual dining. But we also have things that we know Brian loved, like our $6 margarita of the month. So this month I'm going to do my shameless plug, the tequila trifecta, which has 3 different kinds of tequilas. It's a delicious margarita that I know Brian would love, but it's only $6. That is unbeatable anywhere. And so that's the example of, as long as we have price points that any customer can access, we know that we'll be able to win in this environment.
Yeah, Kev, I'm definitely down for 4 or 5 of those. No, absolutely. But let me ask you this. In terms of operations, there's a lot of focus, I think, right now in the restaurant space on improving operations. I'm sure you saw your competitor, Bloomin' Brands, has a new activist investor kicking the tires there, and I think he wants to improve the operations of that company. I look at Chipotle installing faster ovens so they can improve their throughput or just get people out the door quicker. What are you looking at next year in terms of Maggiano's and Chili's to just improve the profitability of your chains?
Yeah, so the way I approached the business, I started a little over a year ago, was just to go out and just listen to the restaurant teams to understand what are things that we can do to get out of your way so that you can better delight the guest and make it easier to do your job and make it more fun and more rewarding. And so we've been literally every quarter, we deploy those ideas to the restaurants, and things are getting a lot easier. In fact, last week we had our manager conference here in Dallas. So all of our managers come in, general managers come in for an annual conference. And I got to tell you, the excitement that they had for the business right now was incredible, because they know not only is it getting easier and more fun to work in our restaurants, but they are a big part of why that's happening, because it's all of their ideas. And what I told them, and they know this, is that simplification isn't a one-time thing. It's just our new way of doing business together. And so we showcased another 12 different simplifications that were coming out in the next 3 months. And there were all these people had their phones up, taking pictures of it. There was cheering, because they know that we're going to continue to be focused on taking their ideas and deploying in the restaurants to make that guest experience better.
And we know that the consumer is still hanging in there, as we saw from July's retail sales. But on the call, we did hear CFO Joe Taylor talking about some skittishness in the consumer, at least at the beginning of the quarter. Do you expect that to become something that we see dotted throughout the rest of the year?
You know, we don't know. We don't know exactly how that's going to play out. You know, what I've talked to my team is that regardless of what happens with the macro, the most important thing that we can do is to have the best guest experience that we can possibly provide, because we're going to win market share in that scenario. What we know is that if the customer does pull back and they make less trips to restaurants, they're going to choose the ones they know they're going to have an amazing experience. So what's the indicated action on that? Have the best experience on the block. And so when we see our guest scores like server attentiveness, food grade, intent to return, all going in the right direction at, you know, all-time highs for the last decade, that gets us super excited about, you know, what's going to happen. Even if the macro does go a little bit negative, we know we're going to win market share. And that's what's happening right now. We continue to see market share growth, separation from the industry. And I think if we stay the course, let's focus on the things that we can control so that we can win market share over time. And then as the macro gets better, you know, obviously that'll create explosive growth for our business.
And Kevin, you really have an incredible background in all things marketing, thinking back to your KFC days, and then now you look at Chili's, they have a really great storied history in marketing. Do you have to market specifically to, let's say, college students that are now going to have to start paying back their loans? Do you have to say, hey, if you have launch a program, if you have $20,000 in debt, come on in Chili's, you get some free fries? Are you thinking about these things?
Well, you've just given me a brief for the marketer, so I'm going to go back to George Felix and hand him that brief. But it's a great point. You know, the fact that we have unbeatable value, especially for a younger guest, you know, that's something that we got to make sure that we're telling that story. You know, one of the things that's exciting about getting back on TV again is we know that that's how you're going to reach some younger people, and we have a message that will talk to them. When you have, you know, $6 margaritas of the month, or you have that $10.99 complete meal, where they know that they're not going to get nickel and dime at Chili's. They're always going to get, you know, an incredible meal at a high quality and something that they're excited about coming back for. You know, we can win on that. So I think the more we can tell that story, I think the more we're going to see separation and the closure of that traffic gap that we talked about earlier.
Kevin, you see activist investor like Starboard Value take a share or a stake in one of your competitors in Bloomin' Brands. How do you keep activist investors out of Brinker?
Yeah, you know, the thing that we're focused on is just improving our operations and making sure that we're growing restaurant operating margins, making sure we lower managerial turnover, all the things that are going to make us as strong a business as possible. And if we can continue to make progress in this turnaround, you know, improve restaurant operating margins, improve the guest experience, continue to drive sales, you know, and deliver the growth targets that everybody expects of us, I think we're going to be fine. But I think we just got to stay focused on the guest and stay focused on the team member, and that's how we're going to have a stronger business going forward.
We reverted to our original pricing, which I think we got about right. We hit some really inflationary challenges, particularly in batteries, as we got into the summer of 22. We had to take a price action accordingly, but I'm delighted to say we're back to our original pricing structure, and that's been so well received by customers and the market alike.
And so you mentioned the call, the second quarter earnings call, that you're seeing a lift in orders. Is that correct?
It is true, yes, absolutely.
You can't speak to that, how much, how little, or is it significant?
We'll have to wait for our Q3 earnings for that, I'm afraid.
I tried.
Yeah, we're going to have a real launch event, an unveiling this November. So watch this space. There's going to be a world premiere. And I'm really excited. We've got the Alpha prototype fleet running around. We've got 30 or over 30 cars driving around right now. The dynamics are really exciting. This is going to be a 7-seat, 3-row, all-electric SUV, truly state-of-the-art. And I'm really excited at the prospect of unveiling this to the whole world this November.
Well, you know, so this is a great example of resilience, discipline, and opportunity, right? Resilience in our business, we're unusual in our sector in that we're a full subscription model company, okay? So that's really important. We're also diversified across everything that gets made in the world. And that's everything from cars to bridges to roads to rockets to factories to movies to games. We're participating in the entire world of designing and making things, which is super important. And everyone in that sector is committed to digital transformation. We've also been super disciplined during all these economic cycles we've seen over the last few years. We never overinvested where things were good to fund every project, and we never underinvested when things were bad to please every investor. And as a result, we're getting the rewards of that discipline. And if you look at the overall opportunity of what's going on in our industry segments, there is a fundamental hunger for digital transformation in our sectors because our sectors are suffering from a capacity problem. There's not enough labor, money, or materials to build or rebuild everything that needs to be made. They need digital transformation. So that's really the underpinning and the cornerstone of why we beat on all the metrics and why we were able to raise the low end of our guidance heading into the rest of the year.
Did the enterprise consumer spend more than you thought during the quarter?
Look, our biggest customers spent more during the quarter than we originally expected. And the reason for that is they actually were adding more capacity to use more of our products. And that's really important because what that says is they're bullish about their future. They used more than they expected in their last contract renewal. So they added more even ahead of their next contract renewal later in the year. And that is absolutely an important signal for our business.
We've talked to Autodesk in the past. We've talked to various executives in your team. And we always get the same question from the Yahoo Finance community. What does Autodesk do? And then more recently, we get the question, are you an AI play? I'm very curious on the latter part of that. Should you be considered with the likes of Nvidia?
Yeah, so first off, Autodesk helps people design and make anything. We touch the entire made world. And I said it earlier, I said it's everything from the Tesla that drives down the road to the bridge it drives over, the rocket that goes into space, the sets on Broadway, all of the things that you see every day, all the buildings you see, someone built it with our software. And what we're doing increasingly is we're aiding those companies to address increasingly complex challenges, regulatory challenges, built environment challenges, and integrating their design and make processes in the cloud, and yes, underpinned by AI. And here's what's important here. AI is not news to us. We introduced the concept of generative design almost a decade ago to our customers. We were bringing them tools that allowed them to explore multiple design options generated by a computer way early on. And we've been relentlessly looking at this throughout all of our efforts throughout all that time. And in our opinion, AI isn't upending everything. We're not going to try to automate creativity. What we're trying to do is increase productivity through what we call augmented design. And augmented design is helping people get the ideas out of their head and creating those really detailed and sophisticated representations in the computer that allow them to design and make it. So we're absolutely an AI player. We've always been an AI player. We've been quietly introducing AI-driven technologies into our products for a decade at least, and that pace is going to accelerate.
We've been hearing from a lot of really companies, Andrew, that play in AI about a lot of visibility into forward backlogs. In some cases, I remember I was talking to Cisco CEO Chuck Robbins recently. I mean, they have $500 million in orders related to their various AI initiatives. What does your demand cycle look like over the next 12 months?
Yeah, there is a huge backlog of demand. Look, there's a lot of sectors. We deal with a lot of sectors that haven't yet figured out how to fully deploy productivity to its full advantage. The AEC sector, architecture, engineering, construction, it's one of the most inefficient sectors in the world, in the global economy. And they have started to realize that technology, and now at the accelerating pace of AI, is going to have a significant impact on how they do their work. And they're scrambling to figure out, what should I do, how should I do it, and who should I partner with? And the vast majority of them are partnering with us on those types of transformations. And that's true across all the industries we serve. Manufacturing is trying to look at onshoring and reshoring and trying to balance high cost and low cost supply chains so that they're much more resilient in the future. That's resulting in a boom in factory building. Nobody has enough capacity to do this. They don't have enough capacity to build the factories and put all the things that are needed inside the factory. Now, we're seeing a few hiccups in media and entertainment right now with the writers and actors strike, but all of that's transient. Once they move past some of these issues, what you're going to see is they're going to be back to their usual problem of how do we produce more content faster and increase the quality of the content and increase the usefulness of the content.
Is that something you had to factor in? Is that something you had to factor into your outlook? The what's happening in the media space?
Remember, we're diversified across everything that's built. and media and entertainment is a relatively small piece of our business. But yeah, media and entertainment was a soft part of our business. It's to be expected, but there were lots of things that offset that softness.
There was a lot of discussion on the earnings call, Andrew, about your exposure to commercial real estate. You sounded like you were just tired of getting this question, but I have to ask you about your exposure to commercial real estate, and are you exposed to what's happening there, and is that a downside risk to your business?
The short answer is no. Now let's be clear here. Commercial real estate's heading into its own challenges, and there's a few things that they have to do to address their challenges. One, they have to reconfigure space to be more attractive to a shrinking pool of investors. And frankly, governments and commercial real estate owners have to partner more closely to lubricate the opportunities and frankly provide incentives for the opportunities to turn some of these spaces into multi-use spaces. That's a real challenge heading in there, and I don't want to be Pollyannish about that. But with regards to our business, remember, diversified across everything. So for everything that's going on in one sector, there's something exciting going on in another sector. Like I just talked about the factory boom. There's a factory building boom in the United States. And that boom is about a factory building. It's about the machines that go inside the factory. It's about laying out how that factory works and then managing that factory into the future. We touch every piece of that process. So even though one sector is seeing problems, we see increases in potential in other sectors. So in terms of our business, it's immaterial. In terms of that sector, they've got some problems they have to address, and there's ways to do that.
You're right, of course, Andrew. You have a lot of exposure to manufacturing, and you mentioned the boom. Has the Biden administration been friendly to companies like yours, companies that obviously are not building plants, but you sell into the rebirth of America? Because all of this, of course, is top of mind. We just had the first Republican presidential debate, and they were throwing out a lot of suggestions out there on how they might revive the economy. But how has this current administration been to a business like yours?
Yeah, so they've actually reached out to us and connected with us at various levels to ask our opinion about what's going to drive productivity in the built world. How do we continue to increase productivity in manufacturing and in construction? So we've actually had contacts with the administration. They are interested. One of the things that really excited us about the infrastructure bill was the couple of $100 million they put in there to help departments of transportation reimagine their infrastructure, their computer and the design and their making infrastructure, so that they could actually be more effective with the dollars that are being spent. That's the kind of partnership that helps us help the departments of transportation overcome the capacity challenge that they're seeing. So yeah, we have engaged and they have been engaged.
Is there something else on the policy front that you would like to see, whether it's this administration stays in office or we get a new one from the Republican side, that can make your life easier as the CEO of a public company?
Look, I think it's really important that we continue to invest in resiliency across the board, that you continue to invest in helping manufacturers redistribute their supply chains, create more resilient supply chains, not just the cheapest value supply chains, but managing the mix of high cost near shore supply chains or onshore supply chains with long offshore supply chains that generally cost less. We also have to provide incentives and tools that help people build back and rebuild existing infrastructure. Some of that stuff's out there. Infrastructure is a bipartisan thing. No matter who's in power, people like infrastructure, and they should. You see the extreme weather events we're getting. These are not going away. You're going to see water flooding places it wasn't flooding before. You're going to see wildfires in places they weren't before, and people are going to have to build more resiliently and more responsively to these changing patterns. And that's something that government can play a really important role in. I think they are right now, and I think it's a bipartisan issue.
Well, first of all, CVC came into the company, which is a private equity company, 6 years ago, to invest in this brand, also with new management. We have another majority shareholder since a couple of months, which is Partners Group, which is a Swiss private equity company. So we have been doing very well. The valuation has been increasing. The brand has been growing tremendously over the last 5 to 6 years. And we're very happy about the results and the development of this company.
So George, I understand Breitling is now in the top 10 of the Swiss watches in terms of exports. And you guys are expanding also the retail footprint here in New York City with this meatpacking district, new brick and mortar location. Why is physical retail so important for the brand?
So it's true, we have now 230 boutiques around the world. We have roughly 25 boutiques in the US. We have 4 boutiques in New York. People want to live the experience. People want to have the 360 of the brand. They want to talk to our great colleagues here. They want to understand the brand. They want to see the whole collection. And in particular, young people want to see it. And it's still a physical purchase. So it's not about e-com. You get the information on e-com or on the web, and then you buy physically in boutiques.
You know, a lot of new watches for Breitling recently, this year and also last year, but also you're wearing one right now, a special watch right now. Tell me about that watch and please show our audience, yeah.
So this is Top Time, which we do in collaboration with Deus Ex Machina, which is a motorbike and surfer brand from Australia actually. It's very cool and it reflects exactly our design philosophy, which is modern retro. So we don't want to be vintage. We're a modern brand, our movements are top notch, but we have this little vibe of retro, which you see in this kind of collaboration, which you perfectly see in this boutique, and with other partnerships like, for instance, Triumph Motorbikes.
Yeah, I noticed here in the boutique here in the meatpacking industry, you have the coffee bar, the downstairs lounge, things like that, the importance of retail, but also, you know, talking about retail, I want to talk to you about sort of Rolex, right? The biggest player in the space right now. They went in with recently buying Bucherer, the big retail operator, owner of Tourneau. What does that mean for an operator like yourself who has their own retail space, but also works with Bucherer as well?
No, we love this collaboration with Bucherer. We have been working with them since many years. Rolex is a great company. I would qualify them as really, they have the best possible behavior in the industry. They respect all the other brands, and I'm very happy about this acquisition. And as far as I understand, nothing will change for us and for Bucherer in this relationship.
So looking kind of at the industry in general, the big picture of the Swiss luxury watch industry, we're seeing some softness in the secondary market there for used watches, some of these bigger and higher end grail watches they're called. What's your take on that, and how does that affect sort of the new first-hand market?
So first of all, the analog watch industry has been booming for the last years and will continue to grow like crazy, because we're nowhere still in China, in Indonesia, in India, in many countries where the industry is just starting. The last 2 years were particular. We had this, what we call post-COVID situation, or these revenge buyings after the confinement and everything. And today, I think the market is just normalizing, but it's still growing and yes, but normalizing still at a very high level.
Yeah, do you think that post-COVID bump has sort of changed the watch consumption behavior? People want to buy more watches, they want to take pictures of them, put them on Instagram, go on vacation. Is that a new change in the industry? Have you seen that with your customers?
Yeah, I think we live also in an age of overkill of digitalization, and having an analog watch, a very traditional watch, handmade, which you actually intellectually can understand because it's like a Lego, you know, when you look at the movement, you can understand how it works. I think it's something very human, and people like that in this age where you have catastrophes, where you have bad news every morning, where, again, you know, it's an emotional product in this digital age, which people like to buy, and therefore this market, in particular with young people, is tremendously growing.
You know, you mentioned that analog sort of effect with watches and how people sort of gravitate towards that. What's next for Breitling now? Is it expanding to other markets? Is it a geographic expansion, or is it new products? What's next for the company?
Well, we always launch new products. Actually, we're launching a new product tomorrow night in the ladies segment, which is a huge. I mean, it's 50% of the market, and there's something we can do here. It will be a very cool product. We want to be the cool and relaxed alternative for the men's market, but we also want to be the cool and relaxed alternative for the females market. So therefore, there will be a product which we are going to launch tomorrow night with a couple of our celebrities and friends and ambassadors of the brand.
You guys watch this space, new watches coming out, maybe some new ambassadors, we'll see. But one quick follow-up, last question for you. I know that you're a man of varied interests. You collect motorcycles and I know sunglasses and things like that, but you're also a fan of famed investor Warren Buffett. What are some of the things that he's taught you or what you've learned from him that you sort of appreciate and you can kind of impart to other people?
I don't know where you got that, but it's true. It's true. I admire Warren Buffett because he's such a nonsense guy. He's so modest. He's so sharp. I watch all the YouTube videos. I love his quotes. I use them in my own presentations. And if there's one person I would like to meet one day, it's Warren Buffett.
It's been a really good business for us. We were underpenetrated in the public sector before we started this effort. We've now got 5 million devices that we've sold into various agencies and first responder entities. That, it's good business for us around that. And it's a great way to keep people communicating as well. But you step back, a relationship with 26,000 first responder agencies is a big deal for us. Drones, we'll do whatever we need to do to keep them happy and on the network.
I was joking with you a little bit off camera. This feels like a deja vu moment. We were just here 1 year ago, and at that time, you had just sold off your media assets, and now it seems like you're a different business. Where are you at in terms of transforming AT&T?
Well, we're real pleased with where we're at. To your point, we've got a lot of the structural transaction work done, and we're now focused on being the best communications provider there is. And we're not there yet, but we're certainly working our way toward it. And while we've gotten the structural deal transactions done, I think a lot of credit goes to the team and what they've been able to achieve and execute during that period of time. Over the last 3 years, over 8 million new postpaid cell phone subscribers. We've seen over 3 million broadband fiber subscribers that have come on the network. Our service indexes, either rated by external agencies like ACSI or JD Power, as well as our own internal customer service metrics, have all improved. We've been able to generate more cash yield out of our business that you started to see in our quarterly results. That's good execution. And the team has done a really nice job of not only getting the transactions done, but getting the focus back on operating the business soundly. Our wireless business at the time that I took over had some gaps between us and the performance of some of the better, run companies in the industry. We've closed most of those gaps on margin, churn, revenue performance, and really pleased with the progress that the team's made in those areas.
We've been hearing murmurs recently about renewed competition price-wise for cell phones in terms of monthly bills. What's your take on the situation, and are you ready to get more competitive on price?
Well, look, we've been in a competitive industry for a very long time, and we still are. And we're offering, frankly, more value to a customer than ever before. If you look at the speeds that we're able to provide a customer, the utility that a wireless device gives somebody in their everyday life, the ability to use devices now as hotspots so that you can tether your laptop or your tablet with you when you go. Those are all great things. And customers are using 35, 40% more of the service a year ago than what they're used last year. And so that's a big deal. And when we do that, I think what we're able to do is drive value and sustain pricing. So I think our plans are incredibly competitive, especially when somebody buys into a family and has 3, 4 devices on an account. I think we're incredibly competitive today, and the industry is actually working on adding more value. And you see ARPU's improving, meaning the customer is paying us a little bit more. You see people staying with us longer. They're not churning off as fast, which is a sign of satisfaction. And you see us growing the business. Over $1 billion of incremental operational cash flow in the first 6 months of this year than last year. That's a good formula.
There, a lot of low-income households continue to struggle. We hear from the likes of a Macy's and Nordstrom. People are not paying their bills on time, credit cards, you name it. Are you seeing that with your monthly payments? Or consumers saying, you know what, I just can't make that payment this month for the cell phone?
Well, look, we have a high-quality customer base to begin with. And so it doesn't surprise me that maybe we were a little bit insulated from parts of the market that might be more value-oriented. But I think you should also step back and realize the government's done a nice job of putting support in place for people to have these critical communications devices. So the ACP program that provides $30 a subsidy a month, those people that are really in the position that you just articulated can apply for that government support. And we offer discount programs that match that. So broadband, 100 by 100 service, $30 a month, $30 a subsidy from the government effectively makes that free. Similar in our cell phone business, we have certain programs that we offer into low-income communities that allow them to take advantage of that subsidy. And as a result of that, we don't see that kind of problem popping up right now. And I think part of it is not only the reasonableness and the value of the product and the subsidy that comes with it, but it's kind of like air. You need to have your communications to get through your day, right?
Yeah, and I need my phone.
Yeah, so I think maybe there's lower priority things that may be the ones that are on the chopping block before a communication.
Right, so we're not buying that extra pair of socks, but we continue to pay for our bill. Okay, check done. Now, key to your turnaround is you've been able to cut out a lot of cost from your business. Can you give us a number on how much, in terms of cost savings in your model, there is left looking out over the next few years?
Well, we've taken $6 billion out of our run rate over the last 3 years or so, which is really good work by the team, and that's particularly impressive given it was done in an inflationary time period. We've just recently stated we're going to do another $2 billion, and I feel really comfortable about that. We're a big business. We have a lot of opportunity to manage costs. We're in the middle of a transition like many other companies are, a combination of new technologies like fiber and 5G that customers love. We have some technologies that were great for the last 40 years, but they've now served their purpose. And as we start to shed those products and services, costs come out associated with that. We're using technology like anybody else. Our ability to apply AI into our business to handle customer inquiries effectively, to do it both digitally online and in call centers where a customer doesn't actually have to speak with somebody to resolve their problem, to do our engineering better, to write code in our software organizations more effectively. That's taking costs out. So we have a lot of places we can go to run our business more effectively.
One more for you before I let you go. If you go to Yahoo Finance, you go to the AT&T ticker page, you'll see that the stock is yielding like 8%. Does that surprise you? And what's your message to investors that are looking at AT&T or looking at a treasury? Where do you go?
Yeah, it disappoints me. It disappoints me that maybe folks aren't willing to bid the stock up to what I think is the fair value, but I think I'm pretty pragmatic about it. And I think what's going on right now, as we just talked about, we're repositioning the business, doing a lot different. We're coming out of major transactions, and there's a little bit of a wait and see. We need to do what we say we're going to do and do it consistently. When we do that, if we remove some of these other exogenous things that are going on, like what we see happening with the controversy over lead cable that we believe is not accurately represented in terms of what the exposure is.
Looking into that.
Then the business will perform and ultimately be valued fairly. And I'm comfortable that will happen. And we just need to every day come in, run it well, do our best, and eventually the market will find the inherent value in the asset.
And no new update on the lead cable situation. My interpretation from the last earnings call, you were looking into it and something you've been monitoring for many years.
Well, look, we said when the article was printed by the Wall Street Journal that, number one, we care about the communities that we support and our employees, and we've been following the law and doing the things that experts felt needed to be done to manage lead effectively. And we still believe that, but we said we certainly want to be objective and understand if there's new information and new science. And over the last several months, we've been actively engaged with our regulators like the EPA in various states, as well as examining all the data that we can get our hands on to try to understand exactly what was the Wall Street Journal looking at. The data points that have come out since then, Brian, suggest that we were correct, that there isn't a public safety crisis or a public health crisis. We've seen the state of New York evaluate a site that the Wall Street Journal framed in their article. We've seen the EPA look at one of the sites. We've retested Lake Tahoe. We've submitted information on a site in Michigan to the EPA. All have come back and said there is not a public health crisis in any of those locations. And we'll continue to look and understand, but our point of view is the laws have been effective. We've followed the laws. If there's tweaks and adjustments to make moving forward, we'll of course make them.
Well, we're also a game company, so games is a lot of technology, particularly our digital games.
Take us through your digital journey. We'll talk about how the holiday season might play out for you guys, but where are you at on digital, and how large is your digital footprint inside Hasbro?
Well, right now our overall game footprint is about $2.1 billion. It's by far the most profitable and highest growth aspect of Hasbro. And digital games right now is about 25% of it. And, as we think about digital games, there's really kind of three businesses. There's a licensing business, there's a games as a service kind of business, and then there's AAA publishing that we're also developing.
These are some big numbers. Do investors appreciate the growth potential of a business like this?
I think a lot of them do, and the ones that don't are starting to really wake up to it. Like, when I started at Wizards of the Coast back in 2016, that was 15% of Hasbro's profitability. It's now over 50% of the profitability of the company.
Are you still gaming?
Yeah, oh yeah.
Do you have any hits?
Oh, for sure.
Right now, like what is the trajectory of the games? What's in the market and what's coming?
Well, Baldur's Gate 3 just launched on PC. It's going to be launching on PS5, I think, today or tomorrow. It's one of the best rated games in history. I think it's got a 96 or a 97 on Metacritic. The only games that have that are like GTA and Zelda. And it's tearing up the charts. We also have Monopoly Go. It's the #1 game across iOS and Android in terms of mobile.
What are your big bets on digital and the gaming platform for next year?
Well, we continue to invest in our licensors. So, I think Scopely and Monopoly Go and Baldur's Gate 3 is going to have a really long life for us. That's probably, when you look at our overall licensing portfolio, it's over $100 million, $150 million of very high profit revenue for us. We have games as a service like Magic the Gathering Arena and D&D Beyond, which also are super high profit and high growth businesses for us. And then we're investing in a lot of our own publishing capability, and I think you'll hear about us announcing a couple of those games over the next couple months, and we're excited for that. I think AI is going to change any creative industry. I think the important thing is you have to adopt a creator-first mindset, though. Creators are super important to us. We hire and employ over 1,000 artists and designers across our company, whether they work for Hasbro or they're contractors that we work with. We got to make sure anything we do with AI thinks about them first. But I think any creative would admit that AI is transformative to how they think about and how they concept new ideas. So I think it's going to be very exciting. It's still early innings, and we got to figure out how to do it right. And we got to make sure that we always remember that humans need to be at the center of any kind of solution.
Are we just headed into a decade of just creepy toys with AI, like creepy dolls? Like, is this what we're looking at now? And how does that change how children interact with these things?
Well, I think like with any technology, you have to think about it responsibly, and you have to think about how they cross the chasm. So I think there's a big hype cycle around AI right now. Probably it's going to need a couple years to really kind of mature and make sure we have the right guardrails associated with it. But I think like any new technology, companies need to invest in it, figure out how to utilize it. Well, I think it varies based on the aspect of the business. So Hasbro really has 3 businesses. We have entertainment, we have toys, and we have games. In entertainment, we're in the process of right-sizing that business. We just announced that we're selling our film and TV division called E1. And I think we'll have a much smaller but more strategic footprint as a result of that. In games, that's all about growing the hot hand. That business has grown at double-digit CAGR over the last 5 years. We continue to see very robust growth prospects for it. And it's at a very rich margin for us, 30% plus margins. So we'll continue to lean into that. In toys, I would say that's more of a turnaround for us. And right now with toys, we're about bringing on the right people, establishing the right mindset, and executing like crazy. And I'd say we're probably in inning 2 of that, but we're starting to see some nice results from it.
What have you identified in terms of toys that need an improvement? Are you not putting out the right toys in the market? Has the market itself changed?
Well, I think we have no shortage of great creative ideas. I think what we needed was better process to be able to vet what the ideas that we need to bring to market should be, and then more consumer mindset in terms of consumer research, data analytics, and an understanding of our channel partners and what they need. I think if you pair like good process with the great creativity, and especially the outstanding brand portfolio we have, you're going to see a pretty good turnaround from us over the next 18 to 24 months. Well, I think it's a mix of headwinds and tailwinds in terms of the consumer right now. The fan economy still is really robust, and Hasbro has a great exposure there with games like Magic the Gathering, our fan business, which is a lot of Marvel and Star Wars, Dungeons and Dragons. I think the more general consumer still has a very good employment kind of set of prospects. Employment rates are still at historical lows. But there's a lot of debt piling up. There's a lot of interest rates that are starting to climb on mortgages. Student loans are starting to come due again. So we're going to need to see those headwinds and tailwinds kind of bend a little bit more towards tailwinds to make sure the toy industry stays healthy.
One of the tailwinds that some folks that cover Hasbro saw was a slowdown in inflation. But now oil prices are back on the rise. What's your inflation outlook? Obviously, oil is a critical ingredient or input to how you make a toy.
Well, in general, we lock in our prices about 12 to 15 months in advance. And so we're actually seeing deflation in the cost of our toys. If you look at the general toy industry today, we started to see a slowdown in Q4 of last year in toys, and that's extended into this year. Right now, the general industry is down mid-single digits to high single digits. Our hope is we start to see a turnaround in September and October where at least we start to get flattish. Hasbro, I think we feel pretty good about our product portfolio and our ability to execute, but it's got to be an industry thing. We've got to do it with our retailers, we've got to do it with our other partners to see that turnaround happen.
I've worked at Amazon for many years. I drank all the Amazon, Jeff Bezos Kool-Aid about how the best businesses are the ones that fundamentally meet customers' needs and just blow people away. And so for me, I think that the Uber-Lyft dynamic over the last couple of years has been more a competitive dynamic than a customer-focused dynamic. And so what got me really excited about joining up with Lyft is saying, let's really turn this into a customer-focused thing. Let's turn it into being obsessed by our riders, obsessed by our drivers, and you can see the results.
Is the battle about taking it back to Uber, or is it about taking it back internally, getting that vibe back that Lyft was always known for?
Well, I'd say it's about taking it to customers. I really think that. I mean, look, we are social beings. We want to get out of our house. But at the end of the day, we also spend a huge amount of time on our screens. So it's funny you think of it this way, but part of Lyft's reason for being is we're sort of the interface between your phone and the real world. So that's really what it's all about. And then the excitement internally of trying to build cool products and services for customers, for riders and drivers is fun.
When you're saying that you're focused on the consumer and you want to be consumer obsessed, what does that mean for the Lyft platform? What's not on there that you see could be on there next year?
Well, let me start with kind of the basics, right? Because when we started 4 months ago, our prices weren't quite in line with where the market needed them to be. So now we've reset our pricing to be competitive with where Uber is. Lower prices than we used to have, for sure. Same with driver pay. We've increased driver pay to be in line with where the market is, and that's really important. Drivers make billions of dollars on our platform, and we need to pay them well. So full stop. So that's where it starts. Then it's about picking you up on time and making sure you've got a good experience every time. And I hope every single day we do that, and I hope we're doing it better every day than we did the day before. And then you start to get into the more differentiated pieces. So let me give you an example. Everyone likes a good deal sometimes, right? We all feel like at some point we want a deal. And so we have an option called Wait and Save, which allows you to basically say, I'm willing to wait another 5 or 10 minutes and I'll get a cheaper price. And something like 30% of our riders every single day take us up on that option. So the reason I point that out is because I think it's a really good option for people who want to save a couple bucks. By the way, I think it's better than Uber's shared ride or pooled ride option, be a little bit competitive on that one. And I think it's an example of how if you really focus on what customers want, you can start to build back to work products or maybe back to school products or all sorts of other things that'll really meet the customers where they are.
Are you priced below Uber? What does your data show?
So our strategy is to make price shopping kind of a waste of time, if I can say it that way.
Does it bother you when Uber has these earnings calls and they say they're not thinking about Lyft? Should they be thinking about Lyft?
No, I don't want them thinking about Lyft. I want them thinking about their own problems. They got all sorts of stuff. They, their CEO recently said, I wake up every morning thinking how much Uber sucks, and I'm like, that's cool. We agree on that. So anyway, I'm just kidding you. Look, my real focus is I want to focus on our customers. And sometimes what I say is, I don't think our big competition is Uber. I think our competition is staying at home, watching Netflix and eating pizza. I mean, as much as fun as that is, I guarantee it's more fun to go out with a friend.
When I talk to John Zimmer, I've talked to him many times through the years. He pitched this vision to us about Lyft being everything to everybody, shipping this, doing that. Is that your vision?
No. And I think this is an area where John and I 100% agree. In fact, I know it is. But I think, in retrospect, he might say that a little bit differently. And here's what I mean. The best companies are the ones, as we've said before, that really focus in and say, what can we do for our customers that really is differentiated? And it's hard to differentiate on everything. It really is. And so our focus is on rideshare, providing a great experience every single day. For a time, I think particularly as COVID came, there was a real feeling of like, oh my God, the rideshare business, is going away because of COVID or whatever it is, and so let's try a bunch of other things. But we're coming out of COVID and we're saying, guess what? People still want to go to work, they still want to go to school, they still want to get together with their friends and all the rest, so we're really going to focus on that way.
Your tenure started off, you may have to make some tough decisions, notably on staff, to lay off a good portion of the staff. Are you confident you have gotten to the cost structure that you want to get to?
Yes. Yes. So I appreciate you saying it was hard. It was really hard. Nobody likes it. Of course, employees least of all. Let's be very clear. We had to do it. And the reason we had to do it is because in order to offer good prices, you have to have a cost structure that makes sense. And to your earlier question, if your goal for a while is to sort of try to do everything, you tend to grow your costs. Whereas if your goal is to try to do one thing really well, you have to shrink your costs. So we shrank our costs. That did mean we had to lay off some employees, but we're at a state now where we can innovate on behalf of customers, we can keep the business moving forward, growing financially healthily, and not have to do anything crazy with the costs.
And for those not really familiar with your plan, is the bikes business still part of Lyft? Do you want to be part of Lyft?
Yeah. So I'm glad you asked about bikes. Let me just, kind of level set for a second. Just in New York City, so Lyft runs bike systems across the United States in a bunch of cities, in Chicago, in New York, in DC, San Francisco, all across the United States. And if you've been on one of those bikes recently, particularly in an e-bike, I hope your experience has been great. I mean, once people start e-bikes, they tend to really fall in love with them. It's a great way to get across the city. In New York alone, we give about 130,000 rides a day. A day. That's as many as in LA. That's as many subway rides as LA does in a day. So, I mean, it's a big part of a transportation network now. So, for our riders, it's super important. It gets them from point A to point B, often faster than a car, frankly, if it's in New York City. But it's also a capital-intensive business for us. And so we're trying to figure out a way to partner with other organizations that specialize in city infrastructure in a way that allows them to take some of the cost of capital, from us effectively, and allow us to just offer it to our riders without it being such an expense for us.
Within the data you are able to receive, what's the health of consumers? Do you see consumers still spending at the clip they were? Are they taking the same amount of rides? What do your users look like?
Yeah, it's so interesting. I know there's a little data out there about some retail softness or and concern about student loans and so forth. We're not seeing any of that. On the driver's side, we see really healthy supply, and on the rider side, summer travel was as strong as it's ever been, stronger actually. Back to work is already feeling like it's off to a really strong start, and same with back to school. So we're not really seeing any softness.
Lastly, before we let you go, not a lot of folks can say they were the 37th employee of Amazon. I mean, that's some OG stuff. What did you learn from those early days, and how are you applying it to Lyft?
The single biggest thing really was that focus on the customer. And, it's a bit of a cliche now, in part because Jeff Bezos has sort of made it a cliche. Frankly, I'm trying to take it up to the next level at Lyft. One of the things that I would like 3 years from now, 5 years from now, is that Lyft has redefined what it's like to be a customer-obsessed organization. And one of the things I tell our employees sometimes is, if we're ever so unlucky that you go off and get another job, I hope that other company is just thrilled to get you because they know how customer-obsessed you're going to be.
Questions? Well, certainly the Charter Disney thing's a topic of conversation. Strikes, topic of conversation. Ad market, topic of conversation. Streaming writ large, topic of conversation. So there are plenty of things to talk about here. And fundamentally, our point of view is we're continuing to push Paramount forward, transform the company. We're arcing through our peak investment year in streaming, returning the company to total company earnings growth next year. And we're feeling good about all that as we navigate, some short-term challenges. So we're thrilled with what we've built in streaming in a couple of short years. Obviously, that starts at Paramount Plus, over 60 million subs as of the second quarter, 50% revenue growth in the second quarter of 23. Yes, we've been investing in it, and as you said, 23 is our peak investment year, but we've got real momentum there. We set out with a broad thesis to build a cornerstone service for consumers. We call it news, sports, and a mountain of entertainment. And we are seeing that very much come to pass. Business continues to scale. Yes, it's an investment, but that investment is paying off. And people will see that continue to go forward in the marketplace, attract fans such as yourself with great shows from Taylor Sheridan or the NFL, which thankfully is coming back this week, college basketball, all kinds of stuff. So we feel great about our streaming product. We set out to build a company that would transform along with the consumers, and that goes to our asset portfolio, it goes to how we think about distribution, it goes to relationships. We have very much transformed Paramount. If you look at it with respect to distribution, we now have co-marketing agreements for our streaming products with virtually every major MVPD and VMVPD here in the U.S., where we have a shared participation in this consumer transition, including streaming. Point one. Point two is, if you look outside the U.S., we've actually taken that a step further with these hard bundles where we provide Paramount Plus to a whole tier of a traditional distributor subscribers, like Canal, with Sky, et cetera. We love the financial expression of that. We love how that scales our business. Point three is you look at distribution here in the U.S. and skinny bundles like Charter Spectrum Essentials, which is a topic of conversation vis-a-vis the current situation. We've been there. We are there. We like that. That sector of the market is growing. It's important to be included in it. Again, it is part of this consumer transformation. And we're taking probably the most important step today with Paramount Plus with Showtime, which is a true multi-platform product, available on linear, available on streaming, obviously. And, one of the things we're doing on linear is for a traditional Showtime subscriber, soon to be a P Plus with Showtime subscriber, they're getting credentials to the apps. We have that deal in place with multiple MVPDs, VMVPDs, among the biggest ones here in the U.S. We are thrilled with the financial expression of that deal. And again, it's about transitioning consumer behavior. It's about looking forward. And that is very much what we're doing. So my point is, all boats are not created equal. We've been on this for a while, and thankfully, we don't have a 100% sports product, which I think provides some particular challenges in this regard. Look, Sumner Redstone, may he rest in peace, said it long ago, content is king. People don't watch apps, they watch content. And again, thrilled the NFL is coming back this week. NFL has been a great audience vehicle in traditional linear television, which it helps make CBS the #1 network in the country now for the 15th straight year. And it's great on Paramount Plus, both in acquiring subs and in engagement, i.e. keeping them entertainment. And that's just one piece of our thing. So yeah, I think distributors understand the power of content. I was talking to MVPD CEO last night. They understand the power of content. The focus has to be that we together modernize these relationships. Just like Tom Rutledge, then CEO of Charter, said after our last deal on his earnings call when we were called Viacom CBS, he said the new deal represents a modernization of our relationship. Why did he say that? Because it included Charter Spectrum Essentials. It included our streaming products, both free, Pluto, and pay Paramount Plus. It's evolving with the times. It also includes an advanced ad partnership where we get data that allows us to target our linear spots in their ecosystem, So that's what you got to be doing, working with partners to together move it forward, unlock the broadband opportunity and elongate the TV media, the traditional side. That's what we're focused on. We're happy with the progress we're making, and we think that clearly differentiates us in the marketplace.
I agree. Content is king. And to that point, what is your content outlook? If we don't get an end to the Hollywood strike, that has also been a very big topic of conversation here at this conference. What does it mean to summer 2024 in terms of the box office? And then do we even see an end in sight to the strike?
We are saddened that we couldn't come to a resolution with SAG and the writers to avert this situation. Obviously, we're now in a strike. Certainly attention's being placed, and we're hopeful that we can get to a resolution. But at the same time, we have a responsibility to our consumers, people like you, and to our distributors and advertisers to continue to engage people with great content. You see that in the alternate CBS slate we've mounted, where we're pulling product from international, like the UK version of Ghost. We're pulling product from streaming, like SEAL Team, which used to be a CBS show, went to Paramount Plus, now is going back to CBS, like Yellowstone, which we were talking about before we went on air, which will run from episode 1, coming out of 60 Minutes in a double. Think about it, NFL into 60 Minutes into Yellowstone, that's a killer night. And we're doing longer versions of some reality shows like Survivor and Amazing Race, 90-minute versions instead of 60-minute versions. So we're pulling all these levers to keep people entertained and keep our entertainment content compelling. And we'll just have to see how long this duration of strike goes and how that, yes, affects 24 and films in 24. And the good news, we have a number of films in the can, so we're good for a while. But over time, we'll have to see how to navigate it.
Before I let you go, one analyst here told me, the Paramount stock is at Lowe's. We want to see the company reduce debt. Where are you at on reducing that debt? And is that a big priority or a big focus for you next year?
So go back to 2023 as peak streaming investment year. 2024 streaming earnings losses reduced significantly, which in turn drives growth in total company earnings. That is the most significant on a multi-year basis de-lever of the company. But add to that what we've done with respect to non-core asset divestitures, things like Simon & Schuster. That is additive to our, call it, leverage ratio as we close it. So yeah, we will absolutely de-lever this company on a multi-year basis. We said 2 years ago this was our peak investment year. We knew that would increase leverage, but it's part of a cycle. And the good news is our investments are paying off. We are very much creating a scale streaming business that is, and you saw it in the second quarter, our losses in streaming were lower in the second quarter than the comp quarter. So we're on the right trajectory here. It will create material value. It will grow earnings. It will de-lever the company. And we're just focused on executing as we do so.
I always say we live in an age of impatience, and there's no way it's fast enough for any consumer. I mean, there's so much happening at the IRS, and obviously I'm not going to speak for them, but we absolutely support the need they have for more modernization, more people, because at the end of the day, when you try to call to ask, where's my refund, and you probably don't get the IRS, you call H&R Block. And we can't answer that question for you once we hand it off, but the consumer, we see every single year, they need their money. This refund is a really important part of their life. And so wondering where it is, getting the most they deserve every year, that's really what we're in the business to do.
I know you guys just reported earnings a few weeks ago. The stock rose on that. I did see some commentary around your core assisted tax business, seeing a little bit of market share losses there.
That's right.
How do you get that back? What are you guys doing?
Yeah, well, we're really clear, first of all, on what happened. And there were really 3 reasons why we lost clients. The first were those filers that make under $5,000 in income. They were in the system, if you will, to get their stimulus payments. So we see that portion of the market back to pre-pandemic levels. The second big reason was the timing extension in California. You mentioned it in your opening. When a filing deadline switches in our fiscal year, that obviously impacts our business. But the real focus for us is how do we serve the low and moderate income consumer better so they understand the expertise we offer, that we're there year round, that we defend them against the IRS. And at the end of the day, we offer a great value. And that's what we're focused on to serve some of those customers we lost this year as we get ready for 24. The biggest shift that we see, Brad, and it's not intuitive to people, is people seeking help more than ever before. I think there's always been this belief in the industry that the old-fashioned way of someone helping you is dying. Everyone's moving to do-it-yourself software. And we just don't see that to be the case. Even people that start in DIY software are increasingly adding human help. So the questions they're asking are incredibly personal, but at the end of the day, they don't have the confidence to answer those questions for themselves. And so that's why they turn to help. And then, of course, the hot topic is how we're embedding AI in the product to make that help better for them, how we're innovating with products like MyBlock so they can get it virtually without going to an office. But at the end of the day, the American consumer is seeking help really more than we've ever seen.
I think you know that the firm for over 15 years has been incredibly committed to our 10,000 small business program. We've brought the program to over 14,000 small businesses across the country. And the history of the program and the way we rolled the program out over the last 15 years is we went into cities around the country to really increase business education for small businesses. And as we're looking to expand further, one of the things we think is desperately needed is help for businesses in rural parts of the country where they don't have the same access to resources that they might have in some of the cities. And so back in 2021, Senator Kramer invited me out to North Dakota, and we had a good meeting out here where we spent some time talking about small businesses here. We were thinking a lot about what we could do more broadly to expand our 10,000 small business program. And we really saw that there was a real need. When you look broadly across the country and you look at a state like North Dakota and also Arkansas, which is the second state we're rolling this additional program out to that we announced today, 99% of all the businesses in these states are small businesses. It's pretty consistent across the country that small businesses drive a lot of the jobs in the United States. 42% of all employment in the United States comes from companies that employ less than 50 people. And so as we wanted to expand 10,000 small businesses, we thought we should develop a program that could really support it in rural communities. We decided to start with North Dakota and Arkansas, but we certainly have plans to roll it out to other states shortly, including South Dakota and other states in the Midwest that we're targeting. We've done a bunch of research. We've had about 75 meetings to look at where we think there's need. And we're excited that this $100 million commitment today, which $75 million goes to fund CDFIs, $15 million to fund the community colleges that support the educational effort, and $10 million to make capital more accessible. We think this is a good start to expand the program rurally. And that $75 million of grants to CDFIs brings our total commitment to CDFIs through this program up to $1.6 billion. So we think this can continue to have a broader impact on small businesses across the country. That generates, obviously, economic growth. And we think it's very important for the economic ecosystem of the United States.
I talked to your chief economist, Jan Hatzius, at the tech conference. Now, he lowered this week his recession odds from, believe it was from 20% to 15%, so a little bit better there. But when you talk to small businesses, are they still worried about a recession? And how, what's the economic vibe from that small business customer?
Sure. So Jan did lower his economic prediction for recession. There's no question the U.S. economy has been a lot more resilient over the last 12 months than we would have expected. And I think the chance for a softer landing right now is much higher than we would have anticipated a year ago. That said, small businesses feel the brunt of inflation, higher interest rates much more directly than large organizations. They don't have the flexibility or the nimbleness or the resources to necessarily brave those headwinds so quickly. I think we all know that the pandemic was devastating to small businesses across the United States. A lot of them are service businesses that definitely lost their ability to serve customers during the pandemic. They had to save more aggressively to keep their businesses growing. And so small businesses have definitely had a bumpy ride over the course of the last few years. There's no question, as the economy's done better, they are experiencing this softer landing environment, but they definitely have more headwinds than the larger enterprises across the country.
If the economy has hit that soft landing position, David, what is your outlook for that bread and butter investment banking business over the next 6 months? Of course, a lot of excitement around the ARM deal, Instacart, you name it. So we're starting to see some big names in that private market come to public market, or at least very soon. Do you see that IPO market and the investment banking business starting to turn around?
Well, we've been through a really tough year for capital markets activity. We went from a very robust environment in 2021 to obviously a much different environment after the war in Ukraine started. And obviously, very, very high rampant inflation, a very significant change in posture from the Federal Reserve. If you go back and look at Powell's comments, a year ago at Jackson Hole, that decreased confidence significantly. And of course, that closed down M&A activity and capital markets activity. And that activity really in the first half of this year was pretty anemic. We are starting to see a pickup in activity. As you mentioned, there are some very significant IPOs that are in the market this week. The ARM IPO is progressing nicely. And I do believe that if these IPOs go well, that kind of creates a virtuous cycle of bringing some of the other IPOs that are in the wings waiting to market. And so I do see a pickup in capital markets activity during the course of the fall. I can't say that we'll get back to what normalized levels are, but we're really coming off of, zero activity. And so we're encouraged by what we see. And obviously an environment with more capital markets activity is a good environment for Goldman Sachs, given our position in those businesses.
This pickup in investment banking, good to see. I mean, it's long overdue, but it comes at a time with increased tensions between the U.S. and China. And I hope I got this right. I think Goldman opened its first office in China in 1994. I hope I did the Yahoo search right. Apologies if I did not. Nonetheless, you do business in China. How concerned are you about these increasingly frayed tensions between these two big economic superpowers?
Well, there's no question that the bilateral relationship between the U.S. and China is something that's getting an awful lot of focus. I thought Secretary Raimondo did a terrific job in her visit, delivering some very, very important messages. We're significantly intertwined with China economically, yet from a strategic perspective and a security perspective, we have some very, very important things that we need to move forward to rebalance some of the relationship that we have with China. That obviously, that tension and some of those issues, as we work through them, those are headwinds to growth. China's economy at the moment definitely seems softer. That's something that we're attached to. If China catches a cold economically, we're probably going to feel some headwinds to economic activity because of that. So this is something that we all have to watch very closely. But I'm pleased, with what I see in the dialogue. But this is going to take some time to sort out.
1 year ago, I think it was about 1 year ago, we were talking about your latest 10,000 small businesses. I think it was a DC event. Now, fast forward to today, Goldman's a different business. You've pulled back in the consumer area, that more mass market is. Are you totally done in mass market? Do you ever see yourself maybe making a return there at some point once you've made some of these exits more recently?
Well, we built a very significant deposit platform in Marcus, and we continue to be in that business. We'll continue to take deposits from the mass market. Our Marcus platform has over $130 billion of government guaranteed digital deposits. We pay a very, very attractive rate, I think, to depositors in that platform. We still operate our credit card platforms, but we have scaled back some of our ambitions to be a larger direct-to-consumer platform. And we're really focused on our two principal businesses, our leading investment banking and markets business, which is about 70% of the firm, and our broad global asset and wealth management business, where we supervise $2.7 trillion of assets and are the fifth largest active asset manager in the world. We see an enormous growth opportunity for the firm in that area, and we're very focused on it. So that's where the lion's share of the firm's focus is at this point in time.
Would there ever be any interest in acquiring a smaller, getting into the community banking? If those acquisitions came up, certainly a lot of opportunities presented themselves earlier in the year. Is that something that would interest you as a way to more quickly get back into that space?
Where our focus, our strategy is clear. We articulated in our investor day in early February. We are focused on our investment banking and markets business, our primary muscle group. We have a leading franchise in the growth of our asset and wealth management business. There'll be other things that we touch on, but those are our primary focus at the moment. We have no plans to make an acquisition of a community bank or a banking institution at this point.
Fair enough. And David, there's been a lot of just. You saw this coming. There's been a lot of just strange stories about Goldman Sachs. And I think Yahoo Finance, that our community doesn't really care about any of this stuff. They want to know how your stock is going to do, how your financials are going to perform. But you as a leader, as you look back over the past few months, how have you changed? Do you see a better path to just sentiment on your leadership and the culture inside of Goldman Sachs?
Well, I wake up every day focused on Goldman Sachs. And I wake up every day thinking about, with my management team, my broad management team, and I'm very fortunate to work with an extraordinary management team across our management committee. I'm very focused on how we serve our clients, serve them with excellence, serve them with distinction, and how also we deliver for shareholders. We're coming up on 5 years this month. And if you look at this leadership team and the work we've done over the last 5 years, we've performed for our clients, we've grown our business, we've performed for shareholders. That's what our focus is on. And we tend to stay focused on those things. That's the discussion inside Goldman Sachs.
When you sit with investors and you sit with clients and you look them in the eye, do they still have confidence in a Goldman Sachs?
I think our clients have enormous confidence in Goldman Sachs. The feedback from our clients around Goldman Sachs and the work we do for them continues to be very, very strong. We wake up every day dedicated to serving our clients. I think we do it with excellence. We do it with distinction because of the extraordinary people that Goldman Sachs has all over the world. And so we feel very, very good about our client franchise, but we don't take it for granted. We invest in it every day. And I'm very confident that if we continue to serve our clients with distinction, Goldman Sachs will continue to grow and will continue to thrive, just as it has for the last 150 years.
Yeah, so Stand With Crypto is here to tell people that 52 million Americans have now used crypto. That's 3x the number that own electric vehicles. It's more than hold union cards in the United States. It's a massive constituency, and they're frankly a little unhappy with the US because the US is lagging behind. We don't have clear rules on the books, like 83% of the rest of the G20 countries, for how crypto should be regulated, how consumers should be protected, and how this innovation can happen here in the US. And so there's a couple of bills going through the House right now that have bipartisan support for how we get clear market structure, how we get stable coins in the US. And these entrepreneurs and the 52 million Americans really want this to happen. And so we're here talking about Stand With Crypto. We've got the pins. People can check out standwithcrypto.org and sign up if they want to be a crypto advocate. This is something America needs to get right.
We know that a lot of these crypto CEOs are trying to showcase the number of jobs that are really being created in this country through the crypto industry. I know that you, Coinbase, have also been involved in efforts in Ohio, the home state of Senate Banking Committee Chair Sherrod Brown. Is it really possible to motivate and galvanize people to vote based on crypto?
I think so. Of those 52 million Americans, some of them, if this is a single issue voter for them, they really want to see that this is going to happen here in the U.S. And in Ohio specifically, there's 1.3 million Americans who have used crypto. They've started to see these jobs go offshore. They've started to see the harm that's happened by the lack of clear rules. So I think they're definitely looking at their elected representatives, including Sherrod Brown, to see how they're going to respond to this issue. And are they going to come and put clear rules in place, or are they going to ignore it?
And what are you hearing from lawmakers so far in the meetings that you've had?
Yeah, so we've had some really amazing meetings today with the highest levels of our government and lawmakers. And I think there's a general consensus and understanding from both sides of the aisle that this is an important issue. We can't keep having Americans be harmed and having this move offshore. This is going to be kind of like our 5G or semiconductor moment, where in 5 years we'll be thinking, how do we get this back on shore if we don't do something now? So the lawmakers I've spoken with are all high level aligned to this principle. It's kind of common sense. Let's make some clear rules. But politics, are messy, and so these bills we need to get people from both sides of the aisle to come together on a few little remaining issues. Like, for instance, is there a state pathway for stablecoins in addition to the federal pathway? And I think we as an industry, we're flexible, honestly. I think there's a reasonable set of places where these rules could land. I'm okay with any of them. I just want there to be clear rules, because in the absence of that, the SEC has just been on this path of regulation by enforcement, or harassment, if you will, where every startup in the space gets a subpoena or a Wells notice, and that's not sustainable, and it's not okay.
To your point, the House Financial Services Committee passed a market structure bill this summer. It's expected to pass later this fall, but dead on arrival in the Senate. Democrats sort of taking issue with the CFTC as the primary regulator there, among other issues. What's the risk that we don't have rules in 2024? Are you talking to Senate Democrats? What are you hearing specifically from Democrats?
Yeah, so actually I would disagree with the idea that it's dead in the Senate. I think that Senators Gillibrand and Lummis, for instance, have put forth their own bill. They're thinking about this issue deeply. And what I hope happens is that we see this market structure bill and stablecoin bill that got bipartisan support in the House come to the Senate and dovetail into those efforts with Senators Gillibrand and Lummis, for instance. The risk is that if this doesn't happen, and by the way, any piece of legislation, nobody can say for sure if it's going to happen. We're going to keep trying this again and again and again until something goes through. But if something doesn't go through, essentially this is going to be decided by the courts. And right now, the SEC has kind of lost zero of the last three, they've won zero of the last three court rulings. So the courts are repudiating the approach that they're taking. And eventually, if this ends up in a Supreme Court, that's not going to be good for many of what these lawmakers want. And so the clear path here is that it should go through the House and then the Senate. And the administrative branch put out an executive order about a year ago as well, saying we need something clear here. So I hope that they can find alignment as well.
A bipartisan group of lawmakers wrote SEC Chair Gensler yesterday, saying there's really no point in no longer greenlighting a spot Bitcoin ETF, given the recent court ruling. What is your take on that?
Well, I agree with the judge's ruling, which is that the SEC's actions have been arbitrary and capricious and unlawful. And that's a pretty serious thing for a judge to say about this SEC. I mean, the only thing worse they could say is outright corruption and fraud. I mean, arbitrary and capricious and unlawful is a pretty big thing for a court to say about our SEC. So I think they need to change. There's a number of large financial institutions, Fidelity and BlackRock, and the largest financial institutions in the world are now putting these ETF applications forward and saying our customers want to get exposure to Bitcoin. Everybody deserves equal treatment under the law, and the SEC cannot continue to punish crypto even if they wish that it was something else.
SEC Chair Gensler, speaking of, is testifying right now on Capitol Hill before the House Financial Services Committee. He seems to be reiterating much of what he said in the past, that the industry is rife with non-compliance. Certainly the SEC has brought a suit against Coinbase. What are your latest thoughts on the SEC's actions, the enforcement? If they were to win your case, is there a path forward for Coinbase in the U.S.?
Well, as I mentioned, the SEC has gone 0 for 3 on the last 3 judges' rulings, and so we feel very good about our case. Some of the facts that those judges have already ruled on, for instance, that the underlying assets themselves were not securities, multiple judges have come to that conclusion, and that's a key fact in our case as well. So I feel good about the path that's going there, but the SEC, I think they did, my understanding is that Gensler did share something in the testimony today, which is that he believes that the CFTC should have spot market authority. The administrative branch has said that. Now he's finally saying that. Some of these bills that just got bipartisan support in the House also say that. They carve out a clear path for where the CFTC should regulate, and the SEC should have a role in crypto securities. There should be a path to register those, which hasn't happened to date. So maybe we're starting to see some consensus there. I don't know, but there's a lot of people in Congress that are unhappy with his approach.
So what was the story regarding AI that you wanted to get across to your investor base?
Well, first is an incredible market that's going to transform everything in the business, in the society. And it's a market that 3 years from now is going to be a $150 billion opportunity. And HP is uniquely positioned because today we are the supercomputing market leader with unique IP that's totally differentiated from what others can do. And the reality is that we're going to provide customers a complete solution, including the infrastructure, the software, and the services to run large-scale supercomputing that they need to use to train and tune their models.
Last time we talked, you called out $1.5 billion of AI orders. How much do you have now?
$3 billion.
$3 billion.
Yeah, so that's only in the last 2 quarters, plus some in Q2. But the reality for the balance of 2023, we have booked $3 billion in AI orders. But as you know, in the AI business, in the supercomputing business, it takes time to translate that into revenue because the revenue recognition is after you turn on the system and the customer runs the workload. So the acceptance process is longer.
So when you say you have $3 billion in AI-related backlog, what are customers coming to you for? What do those orders consist of?
Well, yesterday we showcased a number of unique customers, mostly are in the development of these foundational models, whether it is for weather forecasting or whether it's for large language model. One of them is a company called Recursion, which is in the pharmaceutical. There's more in the molecular docking. So think about how they use AI to find cure for diseases or vaccination. And basically what they need is a virtual private cloud solution that's an AI native architecture so they can train and retrain the model with accuracy. And so we have seen a significant uptick demand from those type of companies that they need to train their models.
You and I have been talking about the rise and prominence of AI really since the start of the year.
Yeah.
Going back to the start of the year, what has surprised you about how things have unfolded since then as it pertains to AI?
The speed by which this model get developed, right? So when you think about the first instantiation of ChatGPT, maybe it was 100 or 200 billion parameters. Now the latest version, we are talking about 1 trillion parameters. When you think about what we do as a company, we actually already trained models that look like 1 trillion parameters. Think about the Frontier system, the exascale system we deploy for the Department of Energy, the one we are completing with Aurora, which is the Argonne National Laboratory. All those they actually can support up to 60,000 GPUs and 40,000 CPUs. Think about it as a one cohesive system. You run just one workload and you retrain the model that you need to drive accuracy because ultimately it's all about accuracy and completion rate.
Are things moving too fast?
I think the reality is that this technology has so much potential. And I think about this technology not different than the web and the mobile transitions we went through. It's going to change everything in our life. I think the AI is moving much faster than the previous 2 cycles, whether it was the mobility access that everybody got or Web 1.0. So definitely it's moving faster than we thought.
Do you view AI as an enabler of the workforce, or does it take away a worker?
No, I am actually convinced it's going to be an enabler of the workforce. I think the jobs of the future will change. They have all, this generation will have to understand and learn how to use AI in their jobs. Obviously, there will be jobs that will be taken away because automation will eliminate what I call mundane type of access. But I think, it provides the ability for this generation to learn in different ways and to do more value added in their jobs.
Do you think the street fully understands how AI is going to impact your business?
I don't think so. I think they're all learning. We are all learning, for that matter, right? So I think about it a year ago, right? We were not talking about ChatGPT and other type of large language model. But it's not the large language model only. To me, it's the generative AI component that's going to be embedded in every application as a co-pilot of sorts or as an aid of sorts, and then ultimately make those processes way more efficient. So I think we're all learning. I think the street, in particular, trying to understand how you're going to monetize all of this, right? Because it's all great technology,
well,
but
$3
how you
billion
make money
nice.
for
It just sounds like a really good number. Right?
Yeah, but I think like any business, right, it's gone through the cycle of adoption, then, some sort of stability, and then, what is the business model around? I can tell you Hewlett Packard Enterprise is making good money when it comes to AI. It is an accelerator for our shareholder value, as we demonstrated yesterday.
The stock has gotten hit because of the outlook. On a scale of 1 to 10, how conservative is that outlook?
Actually, the stock, I think, will recover because fundamentally the street has not yet understood the guidance. And we were clear, not just yesterday, but a couple of quarters ago. As you recall, 3 quarters ago, we announced we are selling the 49% stake we have in China. That provides a 17 cents in our non-GAAP diluted net earnings per share. But now we are executing it. That goes away. Granted that sometime next year, probably by the middle of 2024, calendar 24, we're going to collect $3.5 billion pre-tax. And so what we guided yesterday was the operational view of our non-GAAP diluted net earnings per share without the H3C contribution. When those proceeds comes in, we're going to assess what is the best return on invested capital. We were very clear yesterday that we don't intend to hold excess cash in our balance sheet. We also increased our dividends by 8%, so that's what we plan to do in 2024. But it's important also to realize that our GAAP and non-GAAP EPS have now converged. In fact, the difference between one and the other is just 1 penny. And the other thing is that remember that that 17 cents EPS contributes $200 million of free cash flow. So we took that out. So when you think about the operational view of the free cash flow, actually we are improving by 10%. So the real EPS guidance is up 4% year over year, and on a 3-year basis is the 7 to 9%. So I think the market needs to assess a little bit of that. What was disappointing, I have to tell you, is that 12 of the 14 analysts did not exclude the H3C dividend. They should have in their consensus, but when you're comparing a consensus...
They get paid a lot of money to figure these things out.
Well, I mean, they have to do their job, right? But I will say that when you have 12 of 14 analysts that still have that included in the consensus, by definition, you're going to be off, right? So I think the market is very smart. It will take care of itself. I'm not worried about it. What I'm really excited about is the fact we are transforming the company. We are pivoting to high growth, high margin areas. And you can see that in the numbers because when you think about the last 3 years, we had a TSR of 121%, significantly above the S&P 500.
The top line, the glide path compared to a couple months ago, do you see any slowdown, deterioration at all?
No, what we see is customers obviously taking longer to make certain decisions. But I always say that the IT component of their spend is going to continue to be very strong. I think, think about the challenges they have. First of all, they need to reduce costs in their operations. They need to implement more speed and agility in their IT. They need to spend less time running IT and more time innovating on IT. Obviously, cyber is a big concern. And then when you think about AI, obviously, if you're not embracing it, you're going to be left behind. Because to me, AI is all about transforming the business. It's not another technology for the sake of technology. And that's where customers are going to spend a lot of energy.
Before we let you go, you're very much a world traveler, world leader, Antonio. Do you share just the concern among that your fellow CEOs have on the state of the world? I think Jamie Dimon called it one of the most dangerous times that he can recall. Do you share that sentiment?
Yeah, no question. We are living very turbulent times. The situation from the geopolitical perspective is very heightened. We see obviously challenging situations in Europe and now in the Middle East. Obviously, the situation between the U.S. and China has not gone any better. I think we all have a responsibility to make a contribution trying to solve these problems, understanding that ultimately we have to think about business and society. And so that's why I'm very proud of what HP does every day, because we enable business, but also we contribute to society, which is the core of our purpose, which is to advance the way people live and work. Whether it's climate, whether it's cybersecurity, whether it's finding cures, whether it's solving some of the biggest challenges like world hunger, technology has a role to play. But definitely, it's one of the most challenging times I've seen.
Well, my real assessment doesn't matter that much because we don't know the future state of the economy, which they've basically been telling you now for months. And I think they did the right thing to raise rates rapidly. And I think they're kind of right to pause here a little bit and see what happens. But I suspect that they may not be done. I think there's a chance that inflation is just a little stickier than people think. And the fiscal and monetary stimulus of the last several years is more than people think. Unemployment's very low. We'll see. So the Fed, you see it, like remember mortgages are a lot of fixed rates, but it's clearly affecting house sales, home sales and stuff like that. Not home prices yet. There's still a lot of money out there, and but it's affecting auto sales and credit card, and over time it'll affect businesses that have to refinance any floating rate borrowers. So yeah, of course it's depressing certain economic activity. It's hard to figure exactly how much. Quantitative tightening is almost more of a technical thing, like what's enough, when's enough. I personally believe that at one point it will rattle the markets. It kind of did in March 2020. It did if you go back to 19. Market makers are more. They can't do as much as they used to do for a whole bunch of different regulatory reasons. And so I think at one point, yeah, you're going to see markets get a little rattled.
And where does that rattling show up first, you think?
Treasuries.
Treasuries.
Yeah.
And that has the Treasury market been rattled already, just given the ascent we've seen in the 10-year?
Well, if you look at, not really, but liquidity has come in. And you should try to keep an eye on that. And like I said, there's more issuance. And the issuance has to be bought. And it may, that may push the price higher. So, but you haven't seen real, pressure in the repo markets, the overnight markets. Yeah. Well, first of all, the big thing, keep in mind also, very different than prior times. We have still a lot of fiscal stimulus with very low unemployment, and consumers actually in rather good shape. They have low unemployment. Home prices and asset prices have gone up for the better part of 15 years. They maybe now, but their equity in their home is at all-time records. They locked in a lot of fixed-rate financing, particularly mortgages, which is like 70% of consumer borrowing. So they're actually in pretty good shape. But it's definitely dampening new home buyers, slowing down people's ability to move. People today are doing adjustable rate mortgages, but the cost of carrying a mortgage is higher. So buyers either are going to buy a smaller house, which is a choice, or they're going to wait or not buy at all.
There's a lot of regular average people using Yahoo Finance consistently. That's the hallmark of our platform. What should they be prepared for in terms of the economy because of where rates are right now?
Yeah. I think the most important thing when you think about the world is think about it broadly, and don't just try to guess that there's one thing that's going to happen. Almost no one has ever forecasted accurately like what I call real inflection points. And so when I look at it, as a risk management thing, the most important thing that's taking place here is geopolitical. It's Ukraine, Israel, war, death, free nations in Europe. It's affecting everything. Obviously, a humanitarian crisis. It's affecting global trade, global alliances, very importantly, America, China. So I put that I would put that in the worry category. You don't know, and I don't want to, this is so important, the geopolitical part. Yes, it'll have an effect on the economy, and may determine whether the economy goes to a hard landing or soft landing, but we don't know that yet. I mean, hopefully these things will diminish, but they may not. So, as someone running a company, I try to run the company such that whatever the range of potential economic outcomes are, we could serve our clients. We'll be there in thick or thin. We can bank cities, states, schools, hospitals, individuals, that we can invest in our technology, that all these small businesses rely on us, that we're there for them through thick or thin. We're building, we're going, and we can manage the economy, which I look like the weather. So I guess my advice is, look at a potential range of outcomes and challenge yourself how you feel about if those range of outcomes happened. And so you've really thought it through. And you do that before you say, this is what I think is going to happen.
In terms of higher for longer rates, is that the new normal? And what does it mean for big banks like JP Morgan?
Yeah, so I personally think you may have had a sea change. And the sea change was that we've had 20 years plus of lower rates. And now, all of a sudden, it looks to me there's a lot of long-term inflation. So forget monthly numbers and stuff like that. long-term inflationary effects. A $2 trillion deficit, the largest peacetime deficit ever, the largest peacetime deficit with all-time unemployment lows. But you also have commitments that are being made. You know, the IRA Act, the CHIPS Act, the green economy, we think will eventually cost $4 trillion. I hope it's well spent, though I suspect a lot of it will not be well spent. You know, in Europe, when oil and gas prices went way up, they basically financed it for all consumers and producers. You know, so government, and then we have aging populations, Social Security, Medicare.
There's a lot of concerns.
But there are a lot of things which I say are future inflationary. I don't see anything which is future disinflationary. Now, of course, recession is disinflationary, but I see all these trends, so it may be a sea change, so that, you know, if you go back to the 70s or 80s, you know, rates were higher, they were kind of more volatile. People didn't, you know, no one looked at a 2% rate like that was normal.
Have the seeds been planted for something like a Volcker recession? Look, I'm not asking you to predict a recession, but have the seeds been planted?
Well, when you say Volcker recession, okay, so remember interest rates got to 14 3/4 of the 20-year bond in 1982. I mean, unemployment hit 10 or 11. So I don't think we're going to go there. Like I said, the consumer is in very good shape. So even if we go into recession, the consumer's going in better shape than they've gone into most recessions, and companies are still hiring workers, so it's not quite clear. I mean, I wouldn't call it that bad. I just think that there's a lot of deficit financing, and that may cause long-term rates to go and stay higher and inflation for a little bit longer.
How concerned are you about the deficit, and what do these rising deficits ultimately mean to the economy longer term?
You said what does it do for JP Morgan? JP Morgan, we run the company such that if there were 7 or 8% long bond rates, we're going to be fine. We're not guessing for it, but we stress for it. So, you know, we stress for a whole bunch of different things basically to make sure we can handle low rates, high rates with inflation, high rates with recession, high rates with real estate losses, that no matter what those are, the JP is still in pretty good shape.
Fortress balance sheet.
And pretty good shape means that we can serve our clients regardless of that. That's what it means to me. Not like, well, if that happens, I got to pull back. I can't invest. I can't grow. I can't serve people. And so we'll be fine. I suspect that those higher rates, you know, Warren Buffett talks about when the tide goes out, you see swimming naked. You're going to see quite a few people swimming naked. They had embedded rate interest rate exposure they didn't understand. They couldn't take the double whammy of you know, stagflation or, you know, bad real estate or something like that. So, you know, people, any business person, when I always talk to small business, I would say be prepared for a range of events. You know, if you're a restaurant and you have, you know, only so much extra days of cash on hand, and then you have a hurricane like Superstorm Sandy, you know, that can bankrupt you. But you don't want that to happen, because you should think through what you need to protect yourselves against, you know, certain outcomes that, you know, are possible, hopefully unlikely, hopefully don't happen, but are possible.
On the ride over here, Jamie, I see all the new buildings and things going up here in this area in Texas, and I see the economic activity, but then I hear stories about higher rates, economic slowdowns. From a JP Morgan perspective, are you tightening your lending to businesses?
I mean, I call it trimming the sails. So you always do it a little bit. So we weren't big in subprime auto, but people are trimming themselves there, and they should. We're not really big in subprime credit card. You know, real estate a little bit, you know, because real estate, you know, commercial real estate, there's too much vacancies, and so you're not going to be doing the same kind of activity you were doing before. But this is, I mean, we should this state is amazing. I hope a bunch of you guys are from Texas. I mean, this state has been booming. It's been conducive to business. You know, they're making it good to come here. And that's infrastructure, education, housing, you name it. So we now have 10,000 people in Plano we didn't have before. We bank 6 or 7 million small businesses around the country, which is almost double what it was like, you know, 7 or 8 years ago. And small business formation has gone up dramatically with COVID. But I have to remind the people, small business formation, it doesn't happen on its own. The 10,000 people we had in Plano probably have 20,000 people in small business servicing them. And that could be barbers, taking care of a house, electrician, lawyers, engineers, consultants, people who are not at JP Morgan, but they're part of our ecosystem now. And so this is the kind of vibrant economy you want. We should make sure we keep it that way here. We now have more employees in Texas than we have in New York.
Wow. 17,500?
No, in Texas we have 30,000, something like that. In New York it's now 26. When I got to JP Morgan in 2004, we had 12,000 here.
Wow.
And New York was like 36,000.
I'm an avid consumer of JP Morgan research. That's how I start my day.
They are unbelievable.
They are awesome.
They're awesome.
So they put out a really interesting note today. One stat that stood out to me, and I have to get your take. It said this: for the middle class, real liquidity is back to pre-COVID level, while the bottom 40% are worse off compared to before. Why is this happening?
Well, what happened was, if this was the average checking account, and make believe it's all one consumer, all that money, at one point they had multiples of what they had pre-COVID. That money is being spent down. If you look at that, what I just said, but you look at the lower, there are different ways of looking at it. It's hard to tell, and some inflation adjusts and some don't. But it looks like the lower, call it the third, is back to where it was pre-COVID. They don't have excess savings anymore. And that the middle class is getting close to zero, no excess savings, but they still have jobs and wages are going up. And then obviously wealthy people still have excess and stuff like that. We've seen that number coming down. And as a matter of fact, I saw 3 forecasts the other day. One said, all from JP Morgan. One said it's going to come down by the end of by the first quarter of next year. One was third quarter next year. One was the end of next year. Because, like I said, there are a lot of different ways to measure it.
You mentioned in your annual letter earlier this year, another great quote. You said, we require a 21st century government. Yeah. I imagine what we're seeing currently in DC is not what you had in mind.
Yeah. I mean, I'm begging Texas don't become like DC. I mean, DC goes out of its way to make it hard for small to large businesses to grow and expand. And what I'm talking about there is we need, and it's not everywhere, but inner city schools have to do a better job getting their kids education to get them a job. Making $50,000, $60,000, $70,000 a year. Our infrastructure, which you see when you drive around, if you go to Hong Kong or Singapore, it's a little embarrassing. Some of our regulations they're barnacles. They've been there for years. They should be taken away because they're just slowing down growth. So I'm in favor of good regulations, just not endless regulations. And our litigation system in many cases is slow, capricious, arbitrary, and very expensive. And if it led to more justice, you and I might say that's a good thing. Our healthcare system, we have the best in the world. Pharma, doctors, science, hospitals, which I'm a big beneficiary of. We have some of the worst outcomes in the world. Child mortality has gotten worse. Mother mortality has gotten worse. Obesity has gotten higher. I don't think we've done a good job taking care of our lower paid citizens. They're the ones who lost their job in COVID. They often live in a part of town with more crime. They often don't have medical insurance. I think we've done a terrible job in some cases. I think we have to do a better job for society as a whole. And
well, how does this administration do a better job? In their last year before election, November 7th, how can they do a better job? What would you like to see from them?
I tell them privately what I think they should do or not do. So, no.
Is there a way?
But some of these things are not Democrat or Republican. I mean, the FAA needs to be updated. That's been true for 20 years. We have an antiquated technology system. Everyone else, I think almost everyone else around the world has a modern technology system. Ours is still those green screens that don't adjust quickly, and it's dangerous. And someone told me that not only is that, 20% more CO2 in a flight and 20 minutes on the average flight, just for that.
What, in terms of just growth, are there policies that this administration has put forward that have excited you and that you could be hopeful for?
Yeah, I think in some ways we had to do a CHIPS Act. If you want, I think we need to have some of that built here for our own safety and security. And so I think that's probably good. I think part of I'm in favor of the Infrastructure Act. We need infrastructure, and part of the IRA Act. But both on infrastructure and IRA, though I think they should have come with twins, and they didn't. Those twins to me would be fast permitting, because you see every single day you can't build certain things. It could be pipelines, it could be solar, it could be wind, it could be roads, because it takes 10 years to get permits. And that makes the capital cost much higher, and people are canceling those projects. And the second is, you got to stop the social engineering. It's bad economics. It dramatically reduces the efficiency, and it also opens up the corporate trough. People they're begging to get not just money from the federal government, but from the city, from the state. And it shouldn't have social engineering. It shouldn't require unions. It shouldn't require place-based childcare, which most companies do anyway. It should just be a tax credit to do X, and no other interference. And unfortunately, the other interference is growing dramatically.
I'm of the view that you take what you say very carefully and you put a lot of thought into it. So it really took me, I guess, by surprise on last earnings release when you said this is the most dangerous time in the world that you have seen. Can you just expand upon that? What are you most concerned about?
Yeah, well, it started before the terrorism Israel with the Ukraine war. I knew it the day afterwards. A free, democratic European nation was invaded by hundreds of thousands of well-armed troops of Russia, protected by nuclear blackmail. And that nuclear blackmail part, just put in the back of your mind, you want to scare people? If you have nuclear proliferation, that's the worst thing. At the time, we said we don't know how it's going to end and when it's going to end. Now it's, not quite 2 years, but it'll be 2 years in February. You have 600,000 casualties along a 600-mile front with no real end in sight, and it's affecting, obviously humanitarian crisis, but oil and food security is paramount, and it's shown the world we don't really have that. It's stretching all alliances. People trying to figure out who's on what side here. And obviously the most important is it's hurting and damaging the ability of China and America to, strike a better relationship. And so I think, and then you have the Israeli Terrorist Act, and those things are bad. I look at like the Berlin Wall, that went up and came down, not a bullet was fired. You have 600,000 casualties here. And so I look at it, this is maybe a little bit more like pre-World War II. Like, we got to get this right. And I think I like the fact that the Biden administration and others now, Mitch McConnell and leaders are saying, we need to take care of this. It is for America. Because if we don't fix this, the world may not be completely safe for freedom and democracy as we know it for the next 100 years. And to do it, by the way, we need obviously the military stuff is important. We also need diplomacy, development finance. We have to work with our allies. So one of the problems of the IRA Act was it irritated all our allies. We don't want to tear asunder the economic alliances because all these other people are going to cherry pick. And so we have to be very careful how this gets navigated over the next 5 or 10 years.
In light of these challenging geopolitical situations, the dysfunction we're seeing in government, is that hurting our standing in the world at such a critical time?
America, I think the way you should look at it in the world is if we reach out our hands to people, people are going to take it. They may get mad at us sometimes for being a little arrogant, a little bit thoughtless, but we are trusted, and we're the only ones. And I'm not saying this is an arrogant American, we're the only ones who can provide the leadership because we have the military, the muscle, the might, the money, the capability. We've got to do it in conjunction with allies. It can't be the ugly American. We're not going to get our own way every time. And I think they understand that. They are rattled by, when they see something, if you look at American policy, it's been less consistent. So they do say, can we trust you? Will you be there? Will the treaty stand? And those are legitimate concerns. It's not over, but we've created a certain amount of uncertainty that I wish we hadn't.
You've sounded cautious on the economy, and you have so in the past, but you've always been upbeat about America.
Yeah.
What are you so hopeful for about America looking out over the next decade?
Listen, I just met with Bloomberg, and I told them the same thing I'm going to tell you. I am a full-throated, red-blooded, patriotic, free enterprise, proud American. This country is the most prosperous nation the world's ever seen. And of course we have flaws. There is not a nation on the planet that doesn't. But we're a moral nation. We didn't go to war in World War I and World War II to grab land or oil or money or gold or any of that. And then we did the Marshall Plan. I think we need to do Marshall Plans again to help some of these other folks. That is the forefront of keeping the world safe for democracy. And I'm proud of that. It's still the most prosperous nation the world's ever seen. And when people look at China, we have 80,000 per person GDP. Theirs is 15. We've got wonderful neighbors. We've got the best military in the world. We've got the most innovation the world's ever seen. And that innovation, it used to be like Boston and Silicon Valley. It's now here. It's Austin. It's Nashville. And it's also going overseas, by the way. So, I'm surprised now when I go to, Berlin and Paris and London. They've got quite a bit of it too, which I think is great. And so we have all that, we should applaud that. And we should sing the praises of that. And we should help, and we should grow. Acknowledging we didn't take care of the bottom 25% very well. And and that's after decades of trying. So and I think there are things to fix that. Like I would double the earned income tax credit. I know Republicans and Democrats who would do that. So I think there are things we could do that could strengthen the country, help the lower end, and get the country growing more. And the other thing we've got to talk about more is growth is the way out of this fiscal mess we're in. Okay, growth will drive more tax receipts, more jobs, more capability, more production, more supply side, and we don't spend enough time talking about what fosters growth. Here they do. I mean, look at the difference of Texas versus some other
small
states.
businesses foster growth. To the small business here, 2,000 people are going to show up at this conference, 3-day conference here in Frisco, Texas. They are concerned about inflation. They're concerned about the economy. What's your message to them? How can they grow their businesses?
First of all, my first message, I'm proud of them. You know, anyone, if you talk to anyone who's ever started a small business, and I always do this here, what's the thing that you recognize, what's the most important thing? How hard it is, how proud they are, how fun it is, how hard they're working, and we want to help them. So we have, we help them with money, we help them with advice. We now have these small business consultants, which you're going to hear from Ben about tomorrow, which I think is just a wonderful thing. And so that's the first thing. I'm proud of them, and they're part of that wonderful ecosystem. Plan a little bit. A lot of people, you don't automatically know what to do about a budget or a lease or where do you open your next restaurant, something like that. But plan a little bit. And one of the great things about these, they learn from each other. And so this is the 4th city you've done. I think 4 cities, and I don't know how much more you're going to do. But hell, when I was driving, I was saying 1,800 people. We should do this in every city in America. Yeah. I mean, it's unbelievable. So it's motivating for us to see the dynamism in these companies. So
before we let you go. Look, I've followed your career for some time, Jamie, and now we're starting to get this next generation of leaders, not just in Wall Street, but just in my field, a lot of different fields. What's your advice or tips to them as they try to navigate this new level of uncertainty as someone who has borne witness to some of the biggest financial events in the past 25 years?
Study everything, learn. Don't get rigid in how you think. I've been reading 4 to 5 newspapers a day for like 30 years.
At 5 a.m.
Yeah,
right?
and be open-minded. When you look at an issue, assess the whole issue. So I talk about China. They don't have enough food or energy. I talk to many people. They don't know China imports 8 million or 10 million barrels a day of oil. So people should understand the full situation, analyze the whole situation, and don't let yourself be weaponized. Because if that happens to press, it happens to individuals. Listen to what people have to say, but ask the second question: are they right or are they wrong? What determines whether it's right or wrong? And so, all people should make sure they are thinking clearly, have a decision process. I think the press is so important to educate the world. You guys, and one of the reasons I spend time with the press, you educate the world, and that's readers, but it's also you're educating influencers, and by that I mean the politicians, their staff, universities, all these people who help influence the course of society. So you have to do your job well. That is part of what keeps America safe and sound.
The leisure travel is really strong. It's a little different in trend than it was maybe a year ago. Yesterday was last year was gangbusters for sure. This year it's returned to normal. So the patterns are kind of the same as they were pre-pandemic. What's really off a little bit still is business. Business is very steady, but the business demand is still 10 to 15% unrecovered from pre-pandemic, and so that's the piece that's changed.
Do you think that's ever going to come back?
It's hard to know. I'm an eternal optimist. I think it comes all the way back, in my opinion.
And what does that timeline look like?
Well, it's hard to say. I do think that last 10% is going to be stubborn. I mean, you think about it. A lot of this relates to, I think, when folks are in the office and what does remote work and work from home look like, those kinds of things. But I believe it comes all the way back. I mean, when you need to win a contract and you need to be there to win that contract, you're going to fly, you're going to travel. But I do think that last little bit might be stubborn. But the business is steady. It just hasn't recovered all the way back to pre-pandemic.
Yeah, that's something we've heard from a number of the other airlines as well. Bob, when you take a look at the holiday season specifically, what do booking trends look like? And are you expected maybe to surpass what some of your initial expectations were for this season?
Our holiday already looks really strong. So if you look at where we are booked today, as compared to last year, we're actually booked ahead of this time in 2022, which is, I think, a real strong indicator. We had earnings last week, so you just think more broadly. We had record operating revenues as a company. We had record passengers as a company. We had record Rapid Rewards and new customers and new members as a company. We had record Rapid Rewards revenues. We had record ancillary revenues. I could go on and on if you can't tell. So that just tells me demand for the Southwest Airlines product is strong, and that strength is translating into the holiday bookings.
But when we talk about the state of the consumer right now, we heard from Jamie Dimon, JP Morgan's CEO yesterday. He spoke with my colleague Brian Sazi. He was talking about the fact that there's some reason to be a bit cautious. And he was talking specifically about the middle class, saying that the middle class is getting close to zero, no excess savings, talking about the savings that were built up during the pandemic. I'm curious if that is, in fact, the case. What does that then mean for a business like Southwest?
Well, again, if you go, and things can change, you go to the macro, and we aren't seeing a shift in booking trends, and we're not seeing the weakness. We're just not seeing it yet. I've been at Southwest a long time. I've been in commercial for a long time before this job, and so trends can change on you. What's good for Southwest Airlines is we are well positioned. So if that occurs, what do you want? You want to be the low-cost provider. You want to have low fares. And that's the center of the Southwest business model combined with great people. So I think we're well positioned if that does happen. But right now, we are not seeing weakness in demand.
But what does your discount strategy look like at this point?
There's also been a lot of focus on that. Are airlines, retailers, are they over discounting? And is that a sign of something that's going on in demand? We are discounting or running sales at roughly the same rate that we have historically, maybe a little bit more. But you've got to think about a sale this week. They're always capacity controlled. It's not every flight's on sale. So anytime we have a sale, we are targeting particular periods, particular days, particular parts of the month, particular flights. Where we have been targeting probably more than ever are what we call shoulder flights. So very early, very late flights. Those are typically the hardest to fill, period. And they continue to be the hardest to fill. And so a lot of our sales have really targeted those low demand flights early and late in the day.
Our mission is to bring heart, health, and humanity to food. And if it was all robots, I think we wouldn't live up to that humanity piece. And we've always looked at technology to enhance the human experience, not replace it. Even going back to our early days, back in 2013, we launched our mobile payment loyalty digital order app. In 2015, we put second dedicated digital make lines, production lines in every Cava restaurant. So all of our restaurants have that dedicated digital production. In 2017, we built our internal digital order platform. And recently, we re-platformed that digital order environment to a microservices architecture for our highly scalable environment. So we've always been digital forward, but again, how do we use that to enhance the guest experience as well as the operator experience?
Are you guys trying to understand how exactly this could help increase throughput? Is there any sort of technology that you may be working on?
We're always looking at different opportunities to optimize our operations, enhance the guest experience, make it more frictionless, more convenient. I mean, you think about our digital order platform today, we now have over 24 digitally enabled pickup by car lanes, right? So the idea is that we create this multi-channel environment and we give you the control, you the remote control to decide which channel you want to engage with us on, whether that's ordering on the phone and picking up off our shelf, ordering on the phone, driving around and picking it up at one of our pickup windows, or having it brought to your doorstep through delivery.
We had a security analyst conference a few weeks ago, and we had guided for the third quarter 6 to 8% RevPAR growth globally. We actually outperformed. We hit about 9%, and that was a mix. We had about 4% RevPAR growth in the US and Canada, 22% internationally. So that 4% is a solid number, which I think reflects the speed with which our borders opened, the speed with which domestic travelers got back on the road. And so the US travel market is really sort of settling into a more stable environment. But what's encouraging to me, we're seeing strength across all three segments. Early in the recovery from the pandemic, it was a leisure-led recovery. And so there have been lots of questions about whether that would continue. In the third quarter, we saw 9% revenue growth in leisure, so really strong continued demand on the leisure side. Group, which has been maybe the most remarkable story as we've watched the recovery. When we look at forward bookings in the group segment into 24 in the US and Canada, revenue's up 14% year over year. And even business transient, where most of the questions exist, again, in the US, to your question, we saw revenue up 4%. So we're seeing consistent strength across the segments. Why? Well, a few reasons. I think maybe my wife and daughter excluded, most consumers learned during the pandemic they don't need another watch, another purse, another pair of
We can all use another watch.
well, perhaps.
Okay,
yeah.
go ahead.
But I think pre-pandemic, we had seen in the consumer data, we spend a lot of time with our credit card partners tracking consumer spending. And with some of the younger generations, we'd already seen a pivot away from spending on consumer goods towards experiences. It appears when we look at that same data today that the pandemic acted as an accelerant to that trend across generations. And so to your question, why? I think folks have concluded how much they love travel. And when that was temporarily taken away from them in the early days of the pandemic, it was a reminder of that deep passion to explore the world. And now that borders are opening, they want to make sure they take full advantage of those opportunities.
You mentioned forward bookings. How do the holidays look?
Great. Terrific.
In terms of leisure and business?
Yeah.
Wow. Can this continue next year?
We sure think so. Again, at our security analyst conference, we laid out a 3-year model, and we laid out an expectation of over a 3-year forecast period, 3 to 6% global RevPAR growth, which again, I think reflects, right now we're obviously benefiting from terrific year-over-year comparisons, particularly in the international markets. That 3 to 6% is more reflective of a stable growth environment.
I remember before you became the CEO of Marriott, you came to the Yahoo Finance office in New York City. You were leading development.
Yes.
And at the time, we popped into a huddle room. Then the rooms were actually open. And we were able to talk about the impact to interest rates and how you grow your business in a period of just fluctuating interest rates. Well, interest rates are likely to stay higher for a long time. This has to be stunting what you do at Marriott.
Yeah, although interestingly, I mean, you know our business model. We have nearly 8,700 hotels globally. We only own 20. So our net unit growth is driven on the shoulders and the balance sheets of our owner and franchisee community. The vast, vast majority of that community are long-term investors in the sector. So they don't tend to try and time their investments over a quarter or two. They tend to hold these assets for years, if not decades. So I would submit to you, of course, an elevated interest rate environment puts pressure on the unit level economics of a development project. But today, the biggest impediment in the US market and in Western Europe is the availability of debt for new construction. And the irony, particularly here in the US, when you talk to regional lenders or even big balance sheet lenders, they will tell you when they scan their commercial real estate portfolio, often the hospitality loans are the best performing sector. The issue is concern they have about what liquidity requirements may be imposed by the regulators. And so they'll say, we love our partners, we love the hospitality sector, call us next year. Mm-hmm. And it's part of the reason you hear us and the other big brand companies so focused on conversion activity, because the ability to source debt for existing assets with a track record of cash flow is infinitely easier than sourcing debt for new construction.
Last week, Anthony, I got to spend some time with JP Morgan CEO Jamie Dimon, and I didn't realize at the time, but I went back and looked at the transcript. He mentioned that banks are starting to pull a little bit back on lending. Do you see that? The people that are developing these hotels, do you see that they're pulling back because of this new normal rate environment?
Yeah, no question. Although, again, at least in the hospitality sector, I think it's a little less about the elevated interest rate environment and a little more about expectations that with pressure on the commercial office sector, pressure on the commercial retail sector, that there will be increasing liquidity requirements placed on lenders.
Do you see a lot of gloom coming in commercial real estate?
I'm worried about the office sector and I'm worried about the retail sector.
Do you think that depresses prices? Is it a widespread thing or is it concentrated?
I think it's concentrated in certain markets.
Interesting. So you, as I mentioned earlier, are that road warrior. You're out there traveling the world. You have 27 hotels in Lebanon, Jordan, and Egypt. Before we dive deep into what the longer-term future might be for these operations, what has the near term been like as a lot of the geopolitical tensions have erupted the past month?
So as you would expect, we're seeing fair volume of cancellations in those markets as well as across our 5 hotels in Israel. That set of markets represents less than 1% of our global fees. So I think we look at the tragedy there through 2 lenses. We look at it through the human toll, which is extraordinary, and we continue, like I'm sure your audience, to pray for a peaceful resolution. From a clinical business perspective, today it's relatively modest impact on our business, but we do worry about the potential ripple effects across broader markets in the region.
What do you tell leaders in the region? Or what have you been telling them?
Well, we tell them principally to be singularly focused on the welfare, safety, and security of our guests and our associates.
Do you have to put in new safety protocols in these hotels?
Anytime we see unrest, we tend to go to threat level red, and so those are well-established safety protocols, and those are all in place in those properties.
Does this situation make you rethink the commitment to the wider Middle East region?
No. Absolutely not.
So you think you'll still open hotels?
Yeah, no question. I mean, we've got a robust pipeline across the region. And when you think about our core priorities, one of those core priorities is to keep our traveling public within the Marriott ecosystem. And one of the easiest ways to do that is to make sure I can offer you the right product everywhere you want to travel for every trip purpose. Because to the extent I fail in that regard, I'm almost forcing you into the arms of our competitors. I want to keep you in that ecosystem.
Outside of the Middle East, of course, Marriott is no stranger to China. How's that business doing?
Terrific. It's our second largest market. We just opened our 500th hotel in China, a beautiful Ritz-Carlton Reserve in the Rasai Valley. We've got another more than 400 hotels in the pipeline behind that. The operating environment in China is more than fully recovered to pre-pandemic levels. And the thing that I think gives us so much optimism about the near-term future of the China market, that recovery is in many ways on the shoulders of domestic demand. Today, only about half of the international airlift into China has been recovered. And expectations are by the end of the year, maybe we'll get to 60%. And so as we look into 24 and beyond, we think there's still meaningful upside as more and more international airlift capacity returns. So we're quite bullish about China. And then on the development front, as you might expect, when the country was largely locked down, many of our projects were paused. We saw below historical levels of fallout from the pipeline, and the vast majority of those projects have restarted.
Is it as tough to do business in China as many lead it to believe?
Well, I think we have a little bit of a different, unique, and advantageous approach there. Again, we are an asset-light model. So that 500 hotel portfolio that I described, that 400 hotel pipeline that I described, it is almost entirely China-owned. A meaningful portion is state-owned enterprise-owned. The vast majority of our workforce across China is Chinese national workforce. And so I think we have the ability to navigate and maybe stay a bit above the fray of some of the complexities between the U.S. and China geopolitical dynamic.
You mentioned a little while back your recent earnings, and I think I got this stat right.
Okay.
Correct me if I'm wrong, please do. You bought back $950 million of stock. That is about 7% of your market cap. What's the message there to investors? That is a very large number and a large percentage of your market cap.
Well, and in fact, in the Security Analyst Conference, we talked about during this 3-year period, returning between buybacks and dividends somewhere between $11 and $14 billion over that 3-year period. To me, the message is the beauty of our asset-light model. When markets are performing well, when the public is out there traveling, that asset-light model generates an extraordinary amount of cash. And our broad philosophy about managing the balance sheet, and I know this from my days in development, I tried as hard as I could to invest as much of that free cash flow back into the business as possible, and we'll continue to take advantage of opportunities that we think are accretive to shareholders. But the model generates so much cash that when travel is strong, we have the opportunity to return a lot of capital to our shareholders.
Will you continue at that pace? Because some would say, and I've heard this in the past, that it's almost like taking the company private.
Well, we're a long way from that. I think we've got 300 some odd million shares outstanding. So we're a long way from going private, but we will, sometime in the next year or two, probably have bought back the entirety of the shares that we issued to acquire Starwood several years ago.
Well, I'm glad you mentioned Starwood because you're no stranger to doing big deals. And as you know, we have Choice Hotels battling Wyndham out there, and that is going to be a merger battle, not unlike, I would say, happen at Marriott and Starwood. What do you think about that battle?
Well, I'd say they're very different circumstances. And as it relates to the Choice Wyndham deal, I know what you know, what you and your colleagues are reporting. I think the stark difference is Starwood, I think, was quite receptive to our approach. The only difference was there was another bidder in Onbang. Here, you've got a more hostile approach. In the Starwood Marriott transaction, a big part of the acquisition was Marriott stock, which the Starwood board saw high value. As you've heard in the press recently, I think Wyndham's leadership and board view Choice's stock and its relative value quite differently. So it's going to be interesting to watch how it plays out.
Do you want to get involved? Do you have any interest in Wyndham?
We're really happy with our portfolio.
Would that tie-up have any impact to Marriott?
Well, they would be the second biggest lodging company in the world by room count behind us. I think they'd end up with 1.2 million or 1.3 million rooms as compared to our 1.5 million. They'd be heavily concentrated in the lower quality tiers. As you know from our last conversation, we're now entering the mid-scale tier, not just here in the US with the launch of Studio Res, but with 4 Points Express in the EMEA region, with City Express in the CALA region. And so we would compete more directly with some of their brands. That would be the most obvious impact of that merger.
Lastly, we had just asked Hans a little bit about how he leads the company. He has a grading system, which I think I kind of need to start baking into my own life, but as they would say, we'll take that offline. Do you have any system like that?
Well, I mean, our system is 96 years in the making, and it's really a set of core values that were established by our founders, and it starts with putting people first. Because of our asset-light model, our human capital is arguably our most valuable resource, and so it's making sure they understand our broad objectives, giving them the tools to chase those objectives and the support, and then letting them go do what they do every day.
How do you stay sharp as a leader? What is your day-to-day?
Sugar-free Red Bull.
Sugar-free Red Bull, really? Well, great, we got something in common. I knew I always liked you, Anthony. Well, how do you manage your time? There's a lot of demands, and you're always on the road.
I lean heavily on an extraordinary leadership team. On the long list of attributes I love about our company, we've got a long tenured, what I've called battle-tested leadership team that have been there through decades. They've been through recessions, global conflicts, the impact of 9/11, the Great Recession. And so that's a team that really helps me navigate all the opportunities and all the challenges that the company faces.
Lastly, before we let you go, sugar-free Red Bull, really? That's
absolutely.
Okay. One a day, right?
As far as you know.
Okay, fine, fair enough. Your biggest opportunity for Marriott in 2024?
Well, I'd say it's three things. Without question, we want to make sure we have the biggest, most attractive set of brands and experiences of any company in travel. Number two, we want to build the most loyal, most engaged set of customers, and we do that through our Bonvoy loyalty platform. And then the third I mentioned earlier. I want to be everywhere our guests want to travel, so they never have a reason to look outside our ecosystem.
You know, I'm sending you my best of list for energy drinks now after this.
I mean, the consumer has faced, inflationary challenges now for the better part of the last 2 years. And, we've always been focused on making sure that we're delivering to the consumer extraordinary value. We think that SharkNinja, is well positioned, based on the performance and the multifunctionality and the quality and reliability of our products, and the value that we bring to the consumer. And, as you said, I mean, there are challenges that the consumer has, but I think the innovation and the marketing that SharkNinja brings has brought a lot of excitement to the category.
Mark, we're going into a season where typically you see, the heaviest shopping being done around the holidays, but we're also hearing about consumers who are slowly turning a little more cautious. How much pricing power do you think you have?
Well, look, we came out of the third quarter very strong. I mean, we grew our top line revenue about 15% in the third quarter. Our international business, is growing significantly. I mean, we generated 80% growth in the second quarter. We had strong growth in our North America business. So, I would say that, Shark Ninja brings products across a lot of different price points. We're not the highest priced products in the market. We're not the lowest price, but you mentioned earlier on the Shark Flex style, which is a great selling product for us at $299. But we also recently just launched the Shark Smooth style, which is a $99 product, and it gives the consumer a way to get into the Shark Beauty brands, at a really reasonable price point. So we think we have a lot of different price points covered depending upon, the consumer's desire.
But Mark, as you think about consumers shopping a little earlier this year with wallets a little tighter, I mean, are you thinking about offering more aggressive discounts? What's the thought process going into the holiday season?
Yeah, I don't think we're expecting, increased discounts. In fact, in the third quarter, we actually saw discounting down a little bit versus prior year. So, as a business, we spend about 6% of sales on R&D. We spend over 8% of sales on sales and marketing. And, we feel like this holiday season will, be in line, to last year, from a promotional or pricing standpoint. I mean, and we are continuing to see our average sell prices increase.
We just had a breakdown, a kind of a governance failure, a different point of view between management and the board. And I can totally see how this happens. In our industry, the software industry, we've got a lot of talented, essential, and sometimes unpolished people. And the board's job is to educate, not necessarily to discipline, but to try to smooth the edges without killing the golden goose. I started Appian when I was 26, and it's possible that I tested the patience of my board a few times as well.
So when you look at the current board makeup now, some of the names that are still being thrown out here, does that make you feel better about this issue of balancing the risks of AI with also the growth of the technology?
Yeah, well, I do think that we have a chance to restart now. OpenAI, I don't think this weekend solved any of the problems. Whatever problems existed there, we've still got them. But we have a chance for a reset. The issues are on the table, and I think we've got the best possible way now to address them in a professional manner. So that's good. It does really say something though about this industry. OpenAI is a flagship in AI, and we've had a close glimpse inside of how they work in the past few days. We see they're less than 1,000 people. We see that they've got this kind of a disagreement, this conflict between the board and the governance, that maybe nothing's perfect. It's really interesting to see what an absolute leader in AI looks like right now. And I think it's a signal to the rest of us that this is a growing and not necessarily a very mature industry in a lot of ways. This is what the bleeding edge looks like. It's been just a year. It's amazing. I think it was a year ago today that broke out. We use OpenAI thoroughly in our product. And speaking not just for Appian here, but for our industry generally, the combination of generative AI and process automation is a beautiful thing. We could take a form and turn that form automatically into an application, collecting all the data, routing it to the right place, handling it like a case. It's amazing what you can do when generative AI is turned toward building a process, not just textual output. We also use it as a co-pilot to help you develop applications. We use it as a way to query vast volumes of text in order to understand their meaning quickly. The marriage of process automation and AI, specifically OpenAI's generative technology, has been extraordinarily productive.
It's a bet on us not only being profitable, but generating cash flow from our strong internal combustion engine business, a growing EV business, a growing software business, and then when we chart the course from an autonomous vehicle perspective. So it is demonstrating our confidence in our strategy and our ability to grow, generate free cash flow, as well as strong margins. Well, I think we're not happy. I personally am not happy with where the share price is. And I think, when we look at what we've been through from COVID, from semiconductor shortages, and then from the uncertainty around the UAW strike and the labor situation more broadly, we have certainty now. And we always have had a capital allocation framework, and our target cash was on average around $18 to $20 billion. And so when you look at that and you look at the cash that we had, we thought this was the right thing to do to return it to our owners.
When you're out there talking to investors, what's some of their biggest concerns? Because I've talked a lot with your CFO, Paul Jacobson, and every time I talk to him, the outlook is better than expected. The guidance has been raised before the UAW situation. What have investors been missing?
Well, I think investors like certainty, and I think until we got the agreement ratified with the UAW and with Unifor in Canada, I think that was an important milestone. I'm disappointed this year that we haven't delivered more Ultium-based EVs out into the marketplace. That's not an issue with the Ultium platform in general. It was really an automation issue that we will be working our way out of. We've made progress. Each quarter we'll continue to make progress, and we'll be out of that by the middle of next year. I think, but demonstrate, we've got to execute. We've got to prove that we're going to have EVs people want to buy. I'm confident. And then, with the recent incidents at Cruise, we've got to demonstrate what the right path forward, and we will. I think when we do those and continue to demonstrate that we're going to have growth, strong cash flow, strong margins, I think, they'll believe. And I think this was sending a very strong signal that we have confidence that we will.
You're an engineer by training, Mary. For the lay person out there, actually such as myself, why is it so hard to scale up EV production in this country?
Well, I think first of all, there's a lot of, when you think about the base of the vehicle, the foundation, and the most important part of an electric vehicle is the battery pack. And, that's a whole new process pulling that together. We were one of the leaders setting aside, or I say in addition to Tesla, of doing a dedicated platform with Ultium. And we've had a lot of learnings. We're making it better as we go. We'll continue to take cost out. But frankly, what's holding us up now is something that we just, I think we're rushing, and we needed to have the right people, and I've made all those changes to get that done.
Are you still able to achieve what was a low single-digit profit margin for EVs by 2025?
That is what we've indicated, and that's the plan that we're executing.
Longer term, how do you go from those margins for EVs to something that ICE or the internal combustion engines make?
Well, I think, one, when you look at the cost of doing an internal combustion engine vehicle continues to get higher with the compliance requirements. Also, IRA, I think, allows us to get there more quickly. But we've always said, later in this decade that we were going to see parity on those, and that's the plan that we're working to. So how do we get there? It's going to be to continue to improve the battery technology and continuing to make the whole vehicle more efficient. And we've already made dramatic steps in that direction, and we'll continue to roll that out.
2035, are you still making gas-powered cars?
Well, we have said our vision, our plan is to have all light-duty vehicles be EV by 2035. And so that's the plan in the portfolio that we're executing. Ultimately, the customer decides, and we have flexibility as we can toggle in plants today, and we'll continue to have the ability to toggle between EV and AV, but we do believe in an all-EV future, and we'll be more than ready to go with light-duty by 2035.
GM, some of your competitors have put out some really good electric cars. Demand has seemed to slow down a little bit. Why do you think that's the case?
Well, I think demand, the growth rate has slowed down, but EV adoption is still growing. And so when you think about it, though, a lot of the EVs that are out on the road today, they either don't tick all the boxes that a consumer is looking for. I think that's why I'm excited about the GM EVs that we have coming out, whether it's from Chevrolet, GMC Hummer, Cadillac. I'm very excited, and that's why I want to get them in volume to demonstrate that a customer doesn't have to give anything up when they buy an electric vehicle. I also think affordability, and when you look at the Chevrolet Blazer EV and the Chevrolet Equinox EV, as well as the Bolt that we're going to bring back on the Ultium platform that's been very successful and customers love it, in 2025, I think we're going to really get at that affordability issue. And during this whole period, what we'll also see is continued expansion of the charging infrastructure. Those are what need to happen, because to get to growth beyond 1 million units, but 2, 3, 4, when you look at the SAR, a 15 to 17 million SAR, you've got to reach that customer that only owns one vehicle. And they need it to do everything for them, and they need to count on it. And that's why all those elements are so important to get to widespread EV adoption. I think it's coming. We never thought it was going to be a straight line. It's going to have ups and downs. We've seen that in other markets that are ahead of the U.S. in EV adoption, but it will come.
When you talk to consumers, is the thing still holding them back on EVs range anxiety?
Not so much. I mean, the magic number is 300. When you get to 300 miles of range on a charge, that's when the consumer, has confidence from a range perspective. They still want to know. They don't want to replace that with charging anxiety. So they want to know when they get to a charger, it's going to be available and it's going to work. And there's a tremendous amount of work going on that as well. But I think those are things that the consumer worries about. But that's why we've really worked hard to make sure that we have offerings above 300 or above across the portfolio entries we have in EVs.
Also working hard has been the Biden administration to roll out infrastructure. And we've talked at length recently with Transportation Secretary Pete Buttigieg at length really about charging stations and building more. What grade would you put on the health of our network? I have chargers by me, Mary, full stop, that just don't work.
Well, I think, and that's one of the things with the partners we're working with, it's not just to have them there, they have to work. And so the partners that we're working with, we're measuring them on reliability and availability, and that they're, how quickly, if there's an issue, they get that resolved. I think, the work we did with Tesla to leverage their charging network and even adopting the North American charging standard, I think, overnight doubled the amount of charging infrastructure or charging stations our customers will have as we get into next year. We also did a very significant charging arrangement with the Pilot company. When you think about Pilot Flying J, as you're making a road trip, you want to know that the charger is going to be available for you there. And the fact that it's at a station that's going to have someone there that knows like that, if it's not, I think is going to be important as well. So it will come.
You mentioned Tesla. They have a big day coming tomorrow. They're rolling out a square box type SUV. I don't know how other way to put it. Is that Cybertruck, do you see that as a competitor, a true competitor to like the Silverado or the truck that you make?
Well, I think when we look at our truck portfolio from an EV perspective, first of all, the Hummer truck is a super truck.
It's really nice.
It's an incredible vehicle to drive, and again, the radius of turns, et cetera, it's a lot of fun. But then right now we have the Silverado EV work truck out. As we get into next year, we'll have the RST, the more retail version of that, along with shortly thereafter the GMC Sierra EV coming. When I look at our truck portfolio and where we stand with trucks today and the capability of those trucks from what customers really care about, I'm very confident that we've got a winning strategy from a truck perspective in the EV market.
You don't sound worried about this.
Well, I always take every competitor extremely seriously. And so we'll watch as it evolves. But again, I think we know trucks. And when I look at the trucks, the feedback that we're getting from the fleet customers already gives me confidence in our truck portfolio. What's
your sense of demand? Interest rates are much higher year over year. Consumers are battling with a couple extra $100 a month in student loan payments. Have you been reading it lately?
Well, it's something that we watch very, very carefully of where demand is going to be. We don't, it's hard to say. There's so many knobs, as you mentioned, that are turning. But I think key to going through whatever the demand is going to be is to having the right products and having them priced appropriately. And the strength of our products, we're below the industry average from an incentive perspective. And the discipline that we have, I think, is going to be how we move through next year, regardless of where the consumer is.
Before we let you go, a lot of focus, investor focus on the outlook for cruise. Mm-hmm. What is your commitment to that business?
Well, first of all, I think we have the progress that the cruise team has made has been incredible. We have a really strong technical team. Obviously, we've shared that we're doing an independent review of the incident. We already know we need to be more transparent and have the right relationship with regulators. That's something GM knows how to do and believes is extremely important. So we're already on that path to start rebuilding those relationships and that trust with transparency. But then also we're doing a safety review and an overall technology review. And when we complete that, that will guide us in the path forward. But I think we have to step back and look at how significant this technology is from a societal perspective. Not only safer than a human driver, and we've learned it's got to be significantly safer than a human driver, but also when you think about people who right now can't drive for whatever reason, giving them mobility, because mobility is freedom. So we will be, and we also have said, though, we'll be measured as we roll out, which is going to give us the ability to be more cost effective. And like I said, we'll share when the reviews are done what our plan forward is.
Lastly, do you still see an autonomous future?
I do. I do see an autonomous future. And again, we'll be guided by what we learn and what's the right thing to do from a rollout, from a responsible from a capital perspective as well.
From the very beginning, when Beju and I created Robinhood and got the idea for it, as immigrants, the long-term vision was to make our services available to everyone all over the world. And we think we have certain advantages in doing that. We're a technology company. We don't expand with brick and mortar branch offices everywhere. And we've spent a lot of time, particularly in the past few years, investing in the core platform. And I think people overseas need it even more than in the US. Here, due in part to the great work that we've done in disrupting the financial system, people are relatively well served, but overseas you have a lot of people that don't even have access to a functional banking system. So we'd like to help them, starting with, of course, the UK and EU, and then expanding beyond.
How do you build out, what are some of the, I guess, the most pressing needs of investors in the UK, and how will you build out the platform?
Launching in the UK, we want to be very, very focused on solving one particular pain point, which is we want to be the best place for people to access the US dollar and the US equity markets in the UK. And what that looks like to us, aside from the industry-leading economics and industry-leading customer experience, is launching new innovative features that you just can't see elsewhere. So one example of that is 24-hour market, which I spoke to you about when we launched a few months ago. So because we're expanding to the UK with our core platform, the benefits and things we're building for the US accrue to UK customers. 24-hour market is one good example because it increases the overlap between the hours that Robinhood is available for real-time execution and the waking hours. So a customer in the UK, when they're awake, will have access to real-time execution on a wide universe of US listed stocks.
Why isn't 24-hour, why isn't that the industry standard? This is 2023, we're almost on the verge of 2024. It seems ridiculous it's not.
Well, it will be the industry standard. Someone just has to do it first, and in that case, Robinhood was the first to push that innovation forward. There was a lot that needed to be done, both on the technology side and user experience side, to make it a reality. Having different market centers stitched together seamlessly so that a customer can place an order and not have to understand the details of how those orders are being routed between different areas. Having the overnight session work seamlessly. These are all things that took a while to build and get the experience just right. But you're seeing the actual benefit of that in recent days and weeks. When you look at the share of screenshots on Sunday nights and late at night that are posted about stocks, Robinhood is taking the lion's share of that. I'm sure you saw that last night with crypto prices going up. Bitcoin crossed 40,000. Customers were curious what crypto stocks were doing during that time period. And Robinhood's one of the only places that allows that type of visibility and allows you to actually transact and manage risk during those hours. So to have truly round-the-clock seamless trading, we have to solve the clearing over the weekend problem. And historically, there hasn't been much of an impetus to actually solve that. And that's something that I'm keen to take on. I do believe part of my role is, rather than just, in addition to growing Robinhood, making our product as good as possible, I think as leaders of the industry, we have to push the industry forward. And I think we love being entrepreneurs in America, and it's very important to me for our capital markets to continue to be the most vibrant and innovative. And so I think we'll solve this problem one way or another.
Soon? Is it soon?
I'm excited to push and lead the charge forward there.
Is it soon? In our lifetime, are we 24/7?
I hope it's soon. I think that the big problem for 24/7 would be figuring out clearing over the weekend. But I think the success that we've seen and the obvious value to 24-hour market that we've seen, and since we last spoke, we've rolled it out to more symbols. We're now at over 200 symbols after adding another 100 last week. We're seeing liquidity improve. We're seeing more customers engaging with it, particularly the active traders, more interest online. And so these things actually help get the counterparties more excited. And as more brokers try to add this capability to customers, I think then it'll become the activation energy to getting clearing over the weekends to happen becomes a little bit more palatable.
Fascinating time for markets. We have gold at a record high. We have crypto breaking through 40,000. Equity markets are highs too. Have retail investors participated in this rally?
I think you are starting to see retail investors wake up to certain segments of the rally. I think crypto activity, you're seeing kind of a groundswell. What tends to happen is we've seen in the past, as the price of Bitcoin approaches all-time highs, the media coverage and intensity increases. And I think that plays a role as well. If people are just hearing more about crypto around them, they tend to become more interested, and you start to see that reflected in trading activity, at least in the past. And what we have to do is make sure we continue to improve our product and service. Over the past few years, we've made a ton of improvements in reliability and stability. And we believe now that we're in a position to handle all sorts of rallies. Whatever market events can happen, we're much stronger equipped to handle them.
Well, we announced two critical new products today. One was our next generation Xeon server, where we're building AI right into Xeon so that every data center can use it. But the other was, what we were just commenting on, was the AI PC. And I described it like this Centrino moment where we first brought Wi-Fi into popular delivery, and every coffee shop, hotel, and business had to add hotspots and Wi-Fi capabilities. Well, we think of the AI PC like that kind of transformational moment where new applications, new use cases just usher in a new period of the AI PC. And with that, we're quite excited today to introduce our Core Ultra product line. That's the first one delivering this at scale, and we have a rich pipeline of products coming next year and the year after to really enable AI everywhere. And that's what our announcement was about today, bringing it not just at high-end training and ChatGPT, but every use case across edge, across client, across data center and cloud.
What industry do you think will be most impacted by some of the technology that you uncorked today?
Well, I do think that enterprises are just going to find a lot of critical use cases for this. We showed a couple today, in some of the communications technologies. Imagine real-time translation, transcription, summarization, contextualization. Wow, this is cool. But also cases like manufacturing lines. And we showed even our manufacturing line where high-resolution imaging and being able to detect machine variations and being able to improve line yields in our big factories. Wow, 1 day of improvement, and I paid for every PC upgrade I would ever do. So all of these use cases I think are important, but consumers as well. Content creators are going to find these to be much more productive ways. And we had a musician here showing off a project that would have taken her weeks now was getting done in a single day because of these new generative capabilities. So much like the Centrino moment, AI PC is for everyone. It's a new generation of PCs, and we're just getting started. We had 100 application vendors here with us today, and we expect hundreds more are going to find exciting use cases that we haven't even yet imagined for the AI PC.
Yeah, Pat, I think that singer walked out with the first AI PC. I was a little jealous, but that was pretty cool.
I was jealous too. I was like, hey, I'm the boss.
Oh, come on, you run the company, Pat.
Okay.
You should be able to get a couple of those for the family. But look, let's take us through, what is the outlook for these AI PCs? How many will you sell next year, and when do you start making them?
Yeah, well, we are already in volume production. And hey, I'm probably going down to B&H just down the street here from the NASDAQ and pick one up on my way out of town before I leave. So they are on shelves right now. We're expecting to see good pickup as people finish their Christmas shopping this year. But we're going to be volume. We're ramping this thing like crazy. It's going to be tens of millions next year. We said in the next 2 years, it'll be over 100 million AI PCs in the marketplace. We have our next generation products are already sampling to customers. So today's Core Ultra is the starting gun. Application vendors, new form factors, new PCs starting to emerge, but we're just getting started. The next 2 years are going to be thrilling, going to be in volume, and we are delivering this at scale, enabling the software industry, and making sure it's end-to-end, from the data center and cloud to the client and the edge, AI everywhere.
What are some of your biggest fears around AI?
Well, one of the things, and I commented on this in my keynote, that some people are a little bit concerned, it's sort of like artificial intelligence over there. What's it going to do to me? And I suggested that we might reframe it as augmented intelligence, where we're making it part of how we live, how we work. One of the things is, hey, I wear hearing aids, a family defect, and I now have neural enhanced hearing aids. It's not over there. This is part of improving my life and experiences. When it's in my PC, it is making me more productive on a daily basis. And we think part of our job as a company, we believe in this power of technology as a force for good, that we're going to shape technology. All technology is neutral, neither good nor bad. It's how do we shape it for good? How do we make sure it's regulated, it's safe, it's secure, it's trusted, right? All of those things are what we do, and that's how we're going to make AI useful for every customer on Earth. I do think, as we talked about, AI is a driving workload. And that workload, we've said, the semiconductor market, 600 billion or so today, $1 trillion plus by the end of the decade, and we see AI as one of those things driving a larger market. Further, right, as leading edge technologies, these are the things that we uniquely do. Only a couple of companies in the world can do this, and only one in the Western world, and that's Intel. So with that, we see a lot of market value creation yet in front of us. We're still well undervalued compared to many peers, even as we made good progress this year. So I see a lot of opportunities for us to create value for our customers, to create value for our shareholders. And with that, we're pretty thrilled by today's announcement, because it really just is the beginning point of a lot of great things that we're doing, and what I believe will be one of the greatest turnaround stories in business history and technology industry history, the rebuilding of the iconic Intel.
Last week, Pat, I had some time to catch up with one of your competitors, Dr. Lisa Su, over at AMD. They released their new chip. You're out here with new chips today. Should investors be comparing your two companies?
Well, in some ways, of course. We're traditionally in this market together, but in other ways, very different. Right, and our IDM 2.0 strategy is a crucial piece of why different. We manufacture chips at scale. We manufacture our chips, but increasingly, as you know, Sazi, we're becoming a manufacturer for everybody's chips as well. And then you have the fabless model, and that's companies like Qualcomm, Nvidia, AMD, and I have many products that I build as well. So essentially, I'm building two companies inside of one, a major foundry manufacturer at scale and a fabless company. So in some ways I compete, but in other ways, hey, I want to manufacture all of Nvidia's chips, all of AMD's chips, as well as all of Intel's chips going forward. And we are rebuilding the world's supply chains for the most important resource of the future. Remember, everything is going digital. Everything digital runs on semiconductors. We allow this industry to move from Western shores. We want to rebuild it back. The world needs balanced, resilient supply chains. That's what we're off to do. That's why we help drive the U.S. CHIPS Act. That's why we're building these major manufacturing footprints. And that's why the total AI market's available to us, both our products and for our manufacturing.
Look, it was a challenging period coming in. And, we put some research out into the field. We do it quarterly with the luxury consumer. And look, 75% of luxury consumers indicated that they were going to spend the same, if not more, this holiday period. And, we're seeing that. Okay, so we're seeing our average unit retails are up. Our average order values are up. Some of that is driven by price. Some of that is driven strategically. So that's the good side. On the other side of it, you've got 25% of folks that indicated they were going to spend less. And they are, and we're seeing that manifest in the numbers. So I would couch this as challenging. This holiday period has been challenging, just like the trend of the business was coming in.
Mark, Brian here, good to see you. Are you surprised by some of these challenges you are seeing in certain categories? Look, the stock market's at a record. Theoretically, that should be good for businesses like yours.
Yeah, look, I think we're a sentiment-based business, and the same research we did, the luxury consumer never got overly concerned with their own financial position. So, that's not been sort of a big headwind. It also takes a little bit of time for the positivity that's in the market to move its way through to the consumer. So it's not as minute by minute as some folks might think.
On a category basis, within some of the luxury purchases, have you seen maybe not a trade down, but a trade off of specific types of SKUs?
No, I think what you're seeing are people might be buying one instead of two, or they might not be buying, but you're not seeing a trade down. Luxury is permanent. Luxury is here to stay. People are not going to trade down out of it. Folks that reached in maybe a few years ago, even last year, might not be reaching in this year, but the core luxury consumer doesn't trade down.
Mark, I'm not going to give you any guff for that. I guess that Zach Wilson jersey behind you. We'll take that offline. I think I still have your email address, but what categories?
It's a Garrett Wilson jersey, Brian.
Okay, all right, fine. All right, we'll take it offline. Just playing what Brad just said, what categories are outperforming? Is it shoes? Is it jewelry? Where are you seeing the biggest sales growth?
Yeah, what's interesting is, this period of time, all the folks that took this survey, 50% of their spend was going to be self-purchase, right? So you're seeing a lot. We're a go out and travel business. So you're continuing to see that. You're seeing suiting, you're seeing evening dresses, you're seeing all that sort of cold weather footwear. So boots and booties, that's moving well. Outerwear, which has had sort of an unprecedented run. It's been 3 or 4 years in a row. I don't know how many coats people can own, but they're still going there. So you're still seeing that win. And then for the gifting side, it's, the beauty advent calendar. We love it. We make fun of it, but we sold out of it already. And it's something that's exciting, and it kind of talks to the holidays. And you're seeing gold and diamond jewelry, which is something that we're actually amplifying at Saks, work really well. So, it's been a good story on the luxury side for categories. Nothing's really fallen off a cliff. And that's what we like to see, a good balance.
So, Mark, what does all this then tell us about 2024, how you're planning, where you're expecting to see some strength as we look ahead to the next 12 to 24 months?
Yeah, look, I think it's always important for me to mention, we at Saks, we see luxury as a long game. Luxury is here to stay. You can't move your strategy or pivot too hard just based on the near-term outlook. Okay, so that being said, we have to be deliberate and very careful as we approach 24. And I'm calling it a year of progress at Saks. But if I would have to couch it, it's going to be a year of two halves. Okay, I see the first half of the year, nothing's going to spark the consumer. Nothing's going to get them excited. This starts in a few weeks, right? So I think the first half of the year is going to be a little tougher. And then as you move into the second half of the year, you're going to get, some of this positivity in the market. Hopefully it stays. It's going to move its way through to the consumer. There's all this talk of rate cuts in the second half. That's a boon for the consumer. And then, of course, you have an election. Now, that can be a distraction, but it's certainly going to bring they're going to want some escapism. They're going to want to do something for themselves. So that could be something positive for the luxury consumer. So the second half, I'm seeing to be a bit better than the first.
When you think about the brands that you sell within your store footprints and online as well, and all those relationships with customers coming to Saks, looking for some of those high value, high cost brands as well, do you believe that we're going to see any more M&A activity within some of those brands?
I try not to focus too much on that. What I want is to execute our strategy the right way, to get Saks out in front of it. Whatever happens with our brand partners happens. But I remain very committed to what we're doing here, and that's what we're focused on.
Zach, how are you looking at the prospects here with Neiman Marcus, how you see that fitting into the roadmap here down the road? And when you take into account some of the troubles that maybe some of the other luxury brands have had, what do you attribute that to, just given your experience and years that you have obviously had in the field?
I missed the question a little bit. I heard Neiman Marcus, so I'm not sure.
Yeah, just in terms of the trouble that we have seen play out with other brands within the retail space. When it comes to the success of Saks, what do you attribute that to? And I guess in terms of what you have learned throughout your career, how that's then shaping your planning, given the fact that you go back to what you've said a couple of times here, with luxury being a long-term play.
And I think, look, that's what really is going to separate the folks that are very successful from the folks that might not be as successful. And that's what we did during the pandemic. And that's what we're going to do now. It's about staying committed to your strategy. And obviously you got to manage through the near term, but it's staying committed. And that's one of the lessons I learned at Saks. You can't pivot for the near term. You've got to move forward and you got to drive through it. And you got to do it smart, but you got to stay very, very focused.
Mark, are you still in active talks with the folks at Neiman on a transaction?
You got to read that in the paper. I'm not sure. Right now I'm in active talks with just driving my business and focusing on that. And I'm gonna let all those rumors be all those rumors.
Do you think in the same boat, you have to be seeing what's happening over at Macy's, and there's reports today that Sycamore might be making a play. Do you view Macy's as distracted competitor as it looks to potentially go through a process like that?
No, I think, look, I try to focus on Saks and what we're doing, and I think the guys at Macy's know how to run their business, and I don't think it's going to be that type of play. But again, for Saks, we want a stable retail environment. We want folks to be focused. We want everyone to be moving for the consumer. And that's what I'm hoping for next year.
What would check the boxes for you, Mark, as an additive element that another business, if you were looking at any type of acquisitions in 2024, should and could bring to Saks?
Again, it's a matter of fit. It's a matter of, making sure that it's not going to be too much of something that you need to digest. But I'm not doing a lot of thinking about, absorbing or combining or doing that kind of work. Again, it's about the strategy. It's about doing what we need to do. And we got to work through that. That's, priority 1, 2, and 3.